man-made cotton, all of that has surged yet again.
Indeed, Manisha, thank you for those updates there from the commodities market. Now, on that note, let's also listen in to Timothy Moe, the Chief Asia Pacific Equity Strategist at Goldman Sachs, who gives his outlook on oil prices.
No one really has an edge in terms of the short-term direction of markets. I think that's painfully obvious with the events over the weekend, so we don't have to belabor that. So recognizing that, we have to say, well, how can we add value in an uncertain environment? And our strongest view, just to get that on the table up front, is to stick with the themes that we liked from a longer-term structural perspective before the war that may in fact be given a tailwind by the ripple effects, the consequences of the war, or at least not be impeded by them. And to be more specific, there are four key things that we feel a high degree of conviction on. Number one, maybe super obvious, but still valid nevertheless, is energy security. Number two is defense. Sad but true that there's going to be a need to rebuild all the armaments stash, which has been, or inventory, which has been depleted, and also the modern battlefield has changed: AI, drones, anti-drone warfare, etc. I think all that's becoming very clear, but it nevertheless is structurally an increase in demand. And I can quote 4 Korean companies that in the past 3-4 weeks have had an increase in orders as a consequence of the Gulf warfare. So the actual fundamentals for those companies have improved, but their share prices may have come down. Ergo, the risk reward on investing in them at this point looks better.
We'll take a short break, setting you up for the day's trade on the other side. Stay tuned. Welcome back. Now, the US stock futures have begun trading after the weekend break, and all of them are trading with losses in the initial ticks. And that's after Donald Trump has announced the blockade of the Strait of Hormuz after the talks in Islamabad failed to reach a deal. The Dow futures were down at one point by almost 550 points. They are trading with losses of close to 400 points currently. The S&P 500 futures are down 50, while the Nasdaq futures too are trading with losses of close to 200 points. Let's now listen in to David Miracle, who is the chief US economist at Goldman Sachs, who shares his forecast on the inflation figures for the rest of the year.
So we saw a very large increase in headline. I think we will likely see another one in April. Very quickly, that's going to mean that headline inflation goes from the mid-2s to, we think, something like 4% just a couple months later. Now, the impact on core inflation, I would expect to be more moderate. We have raised our core inflation forecast for the year by 0.3 percentage point. I do think we saw the first signs of that coming through today in the airfares move, although I suspect that there is more to come there, and that the pass-through of higher energy prices to companies' costs and consumer prices will be more gradual for the rest of the economy.
And based on all of that has transpired over the weekend, let's set you up for today's trading session for our own markets. Our research team is here with the trade setup, stocks that are likely to be in the news, and of course the setup on the F&O side of things as well. Firstly, Vivek joins in to get all the market cues that you need to keep an eye out for. Vivek, good morning. And after a very strong recovery last week, it's a bit of a gap down start this morning.
Well, good morning. We entered the week with a lot of trepidation, expecting that, there could be any outcome as far as the talks of US as well as Iran in Islamabad was concerned. And the talks haven't gone well. They haven't agreed upon key points. And on the back of that, you've seen a risk-off rally across equities, and especially you've seen a very strong rally come about as far as Brent oil as well as oil futures are concerned. Like you mentioned at the start of the show, Dow futures, S&P, all of the futures are actually trading with sharp cuts. Brent, however, has surged quite significantly and now trading comfortably above the $100 a barrel mark. On the back of that, Asian markets have taken cues from the weak handover that we've seen from the weekend, and Asian markets have started to trade on a weak footing. Indian markets too are now expected to see a gap down opening of almost 1.5%. But in the week gone by, you actually saw quite a lot of positive cues. A 6-week losing streak was broken. FI has actually turned positive in terms of buyers on Friday's trading sessions. That was one key positive that we would keep an eye out for. Today, what is it that we will be watching? Number one, we will be watching all of the oil sensitives, expect oil marketing companies, etc. to see quite a bit of a sharp cut. Keep an eye out on NBFCs. On Friday evening, RBI issued draft directions on upper layer NBFC classification, and keep an eye out on the entire auto pack. Delhi has now come out with a very aggressive EV mandate, so expect most of these stocks to react quite sharply today.
Vivek, thank you for that update there. Over to Upasna, who would list out the stocks that should be on your radar. Upasna, good morning.
Good morning, Hormas. First up, let me start with Swiggy. Now, the co-founder Lakshmi Nandan Reddy has resigned as the whole-time director with effect from 10th of April 2026. And mind you that the board has also gone ahead and approved the appointment of Funny Kishan and Rahul Bothra as the additional directors with the effect of 1st of June 2026. So this stock certainly will be on our radar today on the back of that management reject. L&T also in focus, as L&T Realty Properties, the wholly owned subsidiary of the company, has executed a share purchase agreement for acquisition of 100% stake in International Green Spaces worth nearly about 1,123 crores. Torrent Pharma is the next one. US FDA concludes inspection at company's oncology facility in Bileshwarpura with 0 observations. Hoodco and NBCC also in focus, as Hoodco has signed 2 MOUs with NBCC for redevelopment project in Bikaji, Kama Palace, and also the second one is for the funding of sustainable assets of NBCC. EPAC Durable also in focus, as the company has received incentive of nearly about 37.5 crore as a part of the PLI scheme. Enviro Infra Engineers also in focus, as the company has received letter of empanelments for execution of 2 projects in Maharashtra, and the overall sum is nearly about 971 crore. And now lastly, coming to various NBFCs will be in focus, as RBI has released a draft for amendment of directions of upper layer NBFC identification, and the potential new entrants here to the upper layer list is nearly in the likes of REC, PFC, IRFC, and even Hoodco is what we are watching out for. So all in all, we'll be watching out for all these stocks in today's trading session.
Upasna, thank you for that update there. And lastly, Sudarshan joins in with cues from the FNO space. Well, Sudarshan, good morning. The best week in 5 years, but it looks like a gap down. What was the FNO data indicating?
Good morning, Harma. So it's Nifty weekly expiry day, and after Friday's data, we were looking for a continued momentum in the market, and that's what the cues we have been getting from the domestic market. So Friday, it was another day of short covering. FI shorts are at lowest levels that we have seen in last 2 months, that's since February of 2026, and FIs have cut short positions for 4th straight day. But here comes the entry of the old man and his comments on the global cues. And global cues over the weekend have turned extremely negative after US and Iran have failed to reach an agreement in the first meeting. And that has led to crude, I would say Brent, again back of the level of $100 per barrel. Also, we'll have to track how our volatility index moves and also rupee, because these things will decide how exactly our market moves over this. And tomorrow it's a holiday, so we'll have to be careful how exactly we take our positions. As far as the put call ratio is concerned, yes, on Friday we see big put writing, and that's the reason put call ratio has gone back of the level of 1. On Friday it was 1.12 versus earlier level of 0.96. If you take a look at the options data on the put side, 24,000, 23,900, these 2 put options were very active, and there was a sharp fall in the premium. While in the contrary, on the call side, 24,500 and 24,300 have seen maximum increase in the open interest, with premium for both these call options moving higher. And also in the index futures, in the stock futures, in the index options, in the bank Nifty options, everywhere we have seen buying by FIs for the first time in the last 2 months, and that has led to long exposure increasing further to 22%, while on the short side, exposure has fallen to 78%. So support for Nifty, I'll look around 23,700. As far as resistance is concerned, it will be 24,200. Two stocks are in the band. Those are SAIL and Samant Capital. Some of the stocks after US Iran failed to reach an agreement, OMCs, all the Asian paints, all the paint names, and also Indigo, and some of the stocks that have seen fresh longs and fresh shorts on Friday. Fresh long side, Sona BLW, Cummins, ABB, Siemens, and on the fresh shorts, Coal India, Coforge, and LTIM.
Oh yes, Coal India, one of the big underperformers on a day when the market did very well. Sudarshan, thank you for that update there. Take a short break. On the other side, India CPI inflation due later this evening. More details on the other side. Welcome back. Now, India's March consumer price inflation or CPI is due later this evening. A CNBC TV18 poll sees that figure at 3.46%, up from 3.21 in February. Core CPI, however, is seen slightly higher at 3.6%. Lata is here to sum up the expectations from the street. Lata, morning.
Well, the numbers become important, obviously, because we have had 1.5 months of higher and higher crude prices visually. So there is a fear whether this CPI number could be terrible, but it won't be. At 3.46%, it's not a huge jump. Even this jump over last month is because the government did pass on some price hikes for LPG cylinders and for aviation turbine fuel, ATF prices, those two passed on. The other, I'm giving you only two numbers, that is Jan and Feb, because this is a new series of CPI and therefore not comparable to year-ago levels. However, we must look at core CPI. That one is important. It's coming in a little higher at 3.6 because certain other metals and, core CPI represents non-fuel, non-food numbers. Other, petrochemicals, etc., do have an influence on core CPI. So that number becomes very important. That's coming in at 3.6, so that's important. Food CPI is going to come in higher, according to some people, at 3.7% compared to 3.4 in the month of February. That number again has to be watched because just as the CPI numbers will be announced, we will get the monsoon forecast also at 4 p.m. and there are El Nino fears. So let us watch out for that number. The March number will not be important, but going forward, food CPI could become a terrible number if the monsoon forecast is not as happy as we would like it to be. The only reason why we have to look at the CPI numbers, this may be the last benign number. After May, when the state election results are announced, it is possible that petrol and diesel prices for you and me are also raised, and then we could see a sharper rise in the CPI. The WPI number, wholesale price index number, is important. Watch, that comes in tomorrow. That number is important because there are no controls. Everything just falls in. So we could see a lot of people are expecting a WPI closer to 4% and a big jump from the 1.8% we had last month. because that's where the price increases show.
And that's what the street will also be watching out for. Lata, thank you for that update there. But the Reserve Bank has now released draft amendment directions on methodology for identification of classifying upper layer and government-owned NBFCs. Now, under the new rule, the criteria for identification will be reviewed periodically. The asset size threshold for identification of these NBFCs will be reviewed every 5 years. Now, these are not final rules, of course, and the RBI has now invited public comments for its proposal. Ritu is now joining in with more on this. Ritu, tell us more.
Well, the much-awaited draft amendment directions around the classification of NBFCs are out. These are still proposals. Feedback is invited by the 4th of May, after which the final directions are going to be issued. Let's start with the biggest shift. Right now, upper layer NBFCs are identified using this fairly complex parametric scoring model that assigns a 70% weightage to quantitative factors like size, interconnectedness, etc., and 30% to qualitative factors like the nature and type of liabilities, the group structure. But now, RBI is proposing to scrap this, and it says upper layer NBFCs are going to be identified based on size. So any NBFC with an asset size of 1 lakh crore and above, based on the latest audited balance sheet, is going to qualify. There's another important change. Currently, the top 10 NBFCs by size are automatically included in the upper layer. This automatic inclusion is now proposed to be removed. Now, on the government-owned NBFC, the shift is equally important. At present, the government NBFCs cannot be placed in the upper layer, and they are restricted to the base or middle layer. RBI is now proposing to remove that restriction, which means government NBFCs will also face tighter regulatory oversight going forward. Now, RBI also clarifies that the criteria itself is going to be reviewed periodically, and it has introduced a clear timeline of 5 years. So overall, simpler size-based classification system for large NBFCs that will sit in the upper layer, and no exemption to government-owned NBFCs. Now, as for the important questions of what happens to the fate of Tata Sons, that is currently in the list of 15 upper layer NBFCs, well, not much changes as per this circular. It all comes down to RBI granting them an exemption and deregistering them as a CIC. So we need to watch out for that one.
Ritu, thank you for that update there. And as we call time on the show, veteran playback singer and an iconic voice of film music, Asha
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, good morning.
Morning.
Hi, good morning. It's a brand new week. It's a Monday morning, a truncated week, and there's all important talks on Saturday. That dialogue has ended in a deadlock, and markets are reacting. Stocks down, oil up.
Well, that's right. Let's hope that, in fact, that ceasefire does hold. Until that does, then you have some kind of hope. But otherwise, the cues this morning a little bit iffy. At least Rima's brightening up the mood with some green, but it's likely to be a red-looking screen.
And you know what? I think we start lower, but there is a non-negligible chance that we see a bounce towards the end because markets are always waiting for the next tackle.
Yeah.
All right. I mean, something to turn the sentiment and a tweet, a post, whatever. We'll see how it goes. But let's just take a quick look at where we start. Right to the word go. So over the weekend, negotiations between Iran and the US basically, you can say collapsed, but it's not as if, on day one or day two even, over the weekend, an agreement was supposed to be thrashed out. That is why there is a 2-week ceasefire period. And by the way, right at the beginning of when that ceasefire was announced, the language said that if both sides agree and depending on how the negotiations are going, that 2-week period could be extended. So to expect that within the first 2 days of talks, even though they went on for 20 hours or whatever, that an agreement is going to be thrashed perhaps was unrealistic in that sense. Now, Trump, of course, blamed the collapse of talks on Iran's nuclear ambitions. J.D. Vance, who was on the U.S. side, sort of representing the U.S. in Pakistan, flew back. But, again, it's not as if J.D. Vance was going to be in Pakistan endlessly for the 2-week period negotiating, etc., etc. So that was never supposed to happen or going to happen. Now, Trump announced that, and this is the new thing in that sense, he announced that U.S. military would blockade the Strait of Hormuz, almost like, my blockade to end your blockade. But the strait is already sort of shut for all practical purposes. And now Trump is saying that starting Monday, that is today evening, a U.S. Navy is going to block any transit ships. Basically, he's going to, ships passing through the strait, which have perhaps paid a toll to Iran, could be intercepted and sent back. So that's what they're going to do. And there was, of course, language to the effect, basically, that if U.S. Navy is attacked or other ships are attacked, those entities would be, I think he said, blown to hell. So 2 big, long tweets yesterday is what we saw from President Trump. Iran's military advisor to the current supreme leader has said that the U.S. is doomed to fail in a naval blockade. Oil prices will come up on your screen. They're already there, 7.5%, 8% higher, but $102 odd a barrel is where Brent oil prices are at. So this is a 8%, very, very sharp jump in that sense coming through. I think the last oil tanker to pass through the Strait of Hormuz was passed through on the 27th of last month. And it typically takes about, 20-25 days for oil through the Strait of Hormuz to reach destinations in North Asia, etc. So you're going to start to, if this remains shut and no oil, there's no normalization of the strait, you're going to start to run down inventories across markets in even more severe fashion. So, stock prices can do what they want. They normalize very fast and they react very fast on the other side as well. But this is a physical commodity issue, which I think we'll have to take note of. Lots of Asian countries, remember, have already imposed restrictions one way or the other. Philippines, which, for example, is dependent for about 95% of its oil from the Strait of Hormuz, from the Middle East, basically, has imposed an emergency. We've in India imposed restrictions, etc. Some of that was expected to be rolled back, but I guess not for now. And others have done so as well. U.S. equity futures are lower. S&P futures down about 0.75%. And I said this right at the beginning. Market participants, of course, looking over their shoulder for the next taco trade, whether this is going to sort of, simmer down once again, and we'll hear something new from President Trump, etc. I think, fundamentally speaking, this is not the end of ceasefire. It may be the end of ceasefire. And given the fact that J.D. Vance left Pakistan by saying that, they've not agreed to the nuclear program, to curtailing their nuclear ambitions forever, and President Trump has said it, there may be the need to flex some muscle. And you may see some, flare up here and there. But, I think markets would also perhaps look through all of this. They may react a little bit, but I think you'd really need to see the start of something really big for markets to panic right away. Otherwise, I think this is slow burn, what's happening or not happening, which is ships not going through the Strait of Hormuz. Remember, Nifty's already recovered 70% of the Iran war-induced fall. So we've come a long way. Last week, of course, was consequential. 6.5% of the Nifty, almost 8.5% of the Nifty Bank, and likewise for the mid and small cap indices as well. So we've come a fair distance. And when you come a fair distance, when there are negative shocks, you will react on the other side as well. So these are the support levels. 23,950 is the first one. That'll get breached today. The second support is 23,682, which is nothing but the lower end of the big gap, which, by the way, happened. So that's essentially the working range. 23,682 is the first one, and then 23,462 is the second one that we are working with. GIFT Nifty will come up on your screen. Quick sense of how we likely to start, and we'll have to pick it up from there. So 350 odd points lower on the GIFT Nifty this morning. 23,752 is the indicative open. Nigel is walked across to the wall with the FNOQs. Nigel, take it away.
Well, since the United States and Iran peace talks didn't come up with a concrete solution, it has led to strength in the dollar index as well as crude oil prices. While equity markets across the globe, they are very, very nervous this morning. As we know, crude oil spike was triggered by President Trump announcing the Strait of Hormuz blockade. So we'll have to keep an eye out on developments on that front. But there were a couple of positives on Friday itself. FIs, well, they turned buyers in the Indian markets, and that's the first time since late February, 25th of February 2026, that they turned buyers. We also need to track now whether or not this was a flash in the pan, or it's going to be a bit of a trend reversal, because they have been selling lock, stock and barrel, particularly in the month of March and the initial part of April itself. Additionally, the FIs, well, they went ahead and they covered shorts with a massive 21,000 contract swing on Friday due to the mild addition that we saw on the long side and the shorts getting covered out as well. So, in fact, if you look at it over the past few trading sessions, the FI net short positions, we should get that one up for you on the screen, the FI net short positions, that's down by close to around 60,000 contracts in the last few trades, while the clients, they are the ones that have been net long. But they've been gradually unwinding their long positions. In the last few trading sessions, their long positions have come down by around 30,000 contracts. So FIs remain short, clients remain long, but both of them are unwinding positions on their respective sides. But in Friday's trading session, the FIs went ahead. They wrote close to around 7 puts for every 1 call. That gives you a sense that the bulls want to go ahead and they want to defend lower levels. Now, looking at the options data, well, the levels that you get up, on the screen, there was some kind of writing at around the 23,900, the 24,000 put. Both of them did see some writing in Friday's trading session. So it appears for the timing, the Nifty is in a broad 1,000-point range, give or take a few 100 points here and there. So the broad range will be around 23,500 on the downside as a reference point, while on the upside, 24,500 will be a bit of a resistance zone. But it's imperative that the 20-day MA on both the frontline indices, that is the Nifty as well as the Nifty Bank, that doesn't get breached, and you'll want that to get defended. The India VIX, well, in the past few trading sessions from the upper end of around 29, it's crashed to sub 20. And the bulls will want, this not to spike towards a 25 odd mark. So that will be a key indicator to track as well for the market. So we'll keep an eye out on the VIX and the broader market outperformance. That's something that showed that maybe, in fact, those animal spirits are gradually coming in there, because in the last few trading sessions, you'll see that actually you have the mid-cap index that's outperformed what the Nifty has done. My gut is still the ceasefire is in place. The bulls will remain optimistic, and at lower levels, they'll be looking to get in a little bit. For the starters, the GIFT Nifty suggesting close to around 350 to 400 point downtick.
Well, in line with what we're seeing across the rest of the regional markets, where the Nikkei, the Kospi are all down about 1.5%. But this is after a 7-8% monster rally that we had last week. There is a give back, and the Dow Futures too is down nearly 350-400 points at open. Let's get in then. Our guest then, William Lee, Chief Economist and Managing Director at Global Economic Advisors, is now joining in. William, lots to talk about on the war front. But before that, wanted to get your thoughts in on the U.S. data. U.S. inflation in March inched up by 0.9% on a month-on-month basis, the biggest monthly surge that we've seen in 4 years, year-on-year up 3.3%. So this is real evidence of the Middle East war beginning to ripple through the US economy. And even the consumer confidence data plunged to a record low in April. This was according to the University of Michigan survey. So clearly there is a lot of anxiety around rising energy prices and the impact of the war. What have you made of this US economic data? What does it mean for the economy and the Fed decision going ahead for this year?
There was no question that we were going to have higher inflation on the headlines because energy prices have gone up. But I think you have to remember that energy also acts as a tax on consumers. And then again, you would naturally expect consumer confidence to be dropping like a rock at a time when more than 80% of the population in the United States is living paycheck to paycheck because they're not the owners of the stock market wealth that has appreciated so much over the last several years. So the affordability issue, the tax that's been put on them that offsets part of the rebate that they got from the big beautiful bill. Those are the concerns that are the downside of the U.S. economy. And you did mention, but let me add, the GDP numbers that came out are also a little bit concerning because growth has gone down from what the Atlanta Fed had projected for the first quarter that was supposed to be the high 2.5 or 3%, came out to a 1% GDP growth. So even GDP is starting to react downward in a downward direction. And so for me, the concern that I've been expressing on your show has been that the Fed and the authorities should be worried much more about what's happening to employment, income produced for workers, their job security, rather than inflation, because prices have gone up, no question. But if you look at where inflation expectations are, that's a telling signal. 5-year break-evens for sure have gone up by about a quarter, almost half a point. But if you look at the longer term, 5-year forward inflation rates, those break-evens have been dropping like a rock. They've dropped from about 2.25% down to almost 2%. They've dropped by a quarter percentage point over this last several months. And I think that's a very important signal to say that the financial markets are pricing for a spike in prices, a jump in the price level, but not a bout of inflation that could cause the Fed to start to become more stringent. The transitory word I hate to use, but I think the markets are pricing for a temporary spike in price levels, but not inflation.
Okay, all right. William, hi, morning. A blockade to end another blockade. William, what do you make of it?
Yeah, when the size of that Iranian team showed up, it really made it very clear to me that there wasn't going to be much movement because when they have so many people from Iran watching each other, it's not clear to me that anyone really had the authority to negotiate. So it's certainly not surprising that there wasn't any movement on the real key issue that the United States was concerned about, which is we don't want nuclear weapons in your hands. And I think the U.S. is willing to say, look, we'll give you free uranium if you want nuclear power, but just stay away from the refinement of uranium, and they won't even agree to that. So I think the real issue is who's going to hurt more, and how long will it take for the hurt to cause someone to blink? The Iranians are hurting because right now they're depending very much on the export of oil in the black market to be able to raise revenue. And if the U.S. is successful in blocking off their ability to export oil, it's going to really be hurting on the domestic front. And whether or not the Iranian Guard and the extremist factions are going to be able to maintain the position or not comes into question. So we'll see who blinks first once the embargo gets in place.
As someone pointed out, they had for a month, right? They had this windfall of very high prices. So they have that as a buffer.
Exactly.
The point is, it's not just, who blinks first. Asia, for example, William, is largely dependent on oil from the Middle East, right? So you already have measures in place. Another month of this, it's not a good scene at all.
Let me also point out that right now, if you look at where the traffic of oil tankers are going, a huge stream of tankers are going around the Horn of Africa toward the United States and Latin America. So there's a supply of crude will be interrupted temporarily, but the supply lines are starting to get restored. Alternative sources are being sought after, and it'll take a little bit longer for the crude to get from the United States to the markets in the Philippines and North Asia. But certainly other supplies are coming online, and I think that will help quite a lot.
All right. Hi, William. What do you make of the Federal Reserve? They want the bank's info on private credit. They're keeping an eye out on the risk on that front as well. Do you think we're ignoring one big risk out there and things could potentially blow up? Because we know the private credit market is rather large in the United States.
Very much so. And in fact, if there's any vulnerability out there that we haven't talked about because of all this Iranian and other issues that have been on the burner, the private credit situation, I think, is one of the biggest vulnerabilities in the financial markets right now, because the lack of transparency and, more importantly, the lack of liquidity for people who want the liquidity is something that is characteristic of these private credit markets. But as we talk about opening up private credit as investment vehicles for retail, that really is the red line, which I hope doesn't get crossed, because I don't believe that retail investors are in a position to be able to use private credit in their investment portfolios the way professionals do. Even professionals are often caught off guard when they say that, oh, we might be able to get quarterly liquidity for investments that go for 5 to 7 years. That's ridiculous. And funds that promised quarterly liquidity for those type of investments shouldn't be around. So I think the vulnerability in private credit is a big one. And if there's going to be a blow up in the financial markets, I'd be looking there.
You know, the old joke, right, William, about private credit? What don't you understand about private? I think that's the...
Absolutely.
But yeah, I mean...
when I was at the IMF, I was one of the editors of the Global Financial Stability Report, and there we always talked about liquidity and visibility. That those two things are completely missing with private credit.
Yeah, you know, the thing is, these are all mostly closed-ended structures, right? So something happens, you don't know till much later, unless, of course, you know, these funds decide to disclose it. Thank you very much. It's always a good chat. Appreciate your time here, William. And thank you for being here on CNBC TV 18. Let me tell you what the interactions are, which are lined up here on the program. 8:35, we have Deep Pal of Cohen Advisory to discuss the geopolitical developments over the weekend. At 9 o'clock, we'll have Maulik Patel of Equirus to put the spotlight on the oil and gas space. Rajiv Batra of JP Morgan will be a market master of the day. 9:30, we bring you a discussion around RBI's new proposed methodology for identification of upper layer and BFCs. 9:15, our special segment, Quarter to Quarter Tak. We focus on the insurance space with JM Financials analyst joining us. And towards the end of the program, Latha in conversation on the NBFC sector outlook with Suresh Ganapathy of Macquarie Capital. That's the lineup here over the next 2 hours.
Time to slip into a short break. On the other side, we go full tilt on the stocks that we're tracking for you. For the time being, I give you a sneak peek into our top 10 segment. Oil and gas producers, PNG Housing Finance, Saman Capital. They'll be reacting to positive news flow, while oil refiners, GAIL, city gas distribution companies, PFC, REC, Hudco, and IRFC. They are stocks that will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. It's time now to get you the CNBC TV 18 list of top stocks for the day. First up is the big rise and spike seen in crude prices. Manisha is now joining in. Manisha.
The news that has come in the evening or over the weekend clearly tells you a rebound in crude is what we're looking at. So the crude prices fell 10% in the previous week, but we've started 8 to 9% on the higher side in Asia right now. With U.S. announcing blockade of Strait of Hormuz, U.S. to only target vessels transiting the strait to and from Iran ports, and that would mean that the blockade will remove 1.5 to 1.7 million barrels per day of Iran supply. Now, 10% of that goes to China, almost 57% to UAE, and some part of that has started coming to India as well. So there are serious repercussions of this, especially for the Asian markets therein. Also, when you look at the other metal prices, we have seen a bit of a decline there, but major gains clearly continuing in case of crude oil prices. Not just crude, if you look at heating oil, you have all the biofuels, gasoline, jet fuel prices, all of that has surged anywhere between 4 to 8% in Asia right now.
Okay, all right. Thanks a lot for that, Manisha. Well, let's hop across to Sonal. She's tracking the oil refiners as well as the city gas distribution companies. Morning, Sonal. Good to see you, Ben. Hope you enjoyed the game last night. I believe you're first at the Wankhede.
First ever live cricket match experience, Nigel, but that conversation for some other time. But for now, city gas distribution companies, of course, will be in focus because this blockade that is possible at Strait of Hormuz. Now, remember, around 25% of global gas transit happens through there. And Nomura, in its note, also says a complete blockade of Strait of Hormuz may also impact LPG supplies for India. And for crude oil, it could impact 2.3 million barrels per day of incremental supply of oil. So that, of course, will impact supply and prices as well of these two commodities. As far as refiners are concerned, the government has gone ahead, increased the export duty on diesel from 21.5 to 55.5 rupees per litre. Duty on ATF has been increased from 29.5 to 42 rupees per litre. Nomura has put out a note where they say it could benefit OMCs, and they expect this windfall tax not to be applicable to Reliance Industries' export refinery, which is almost half of its total refining capacity. So that is a positive. Domestic refiners like Reliance, Nayara, MRPL, HPCL and others will be subjected to windfall tax on export of diesel and ATF, but it's not a big problem for these companies. But yes, higher crude prices could be for all these refiners.
Thank you very much for that. The other big development is RBI has issued a draft notification on the review of NBFC upper layer framework. Basically, now what constitutes an upper layer NBFC? Ritu joins in with the fine print.
Well, Reema, the biggest shift is that RBI is proposing to do away with the parametric scoring model altogether to identify these large upper layer NBFCs and replace it with a simpler system, which is that any NBFC with an asset size of more than 1 lakh crores is going to qualify as an upper layer NBFC. Also, it is proposing to remove the automatic inclusion of the top 10 NBFCs by size into this list. And importantly, the restriction that was there on government NBFCs from entering the upper layer, that is also proposed to be removed. So to ease that, again, RBI is allowing these government NBFCs to deduct the exposure backed by state government guarantees without any cap. And this is important because many of these lenders have concentrated exposures to state bank projects. Now, upper layer NBFCs are subject to tighter credit concentration norms, regulatory capital governance and disclosure requirements as well. So if the proposal is implemented as is, some of these government-linked NBFCs like REC, PFC, IRFC, HUDCO, they could fall in the upper layer category, so going with the mild red for them. While some of the smaller layers that are currently already in the upper layer list, like PNB Housing or Samman Capital, which have a threshold of under 1 lakh crore and could potentially move out, we're going with a green for those names.
Thank you very much for that. And there are lots more news pieces that we'll discuss through the course of the day. For example, the Delhi EV policy draft that's on the agenda. And in terms of earnings today, it's ICICI Pru AMC and Just Dial. And post-market hours at 4 o'clock, we'll get the March CPI inflation print for India, expected to rise to 3.48% versus 3.21% in the prior month. Thank you guys for joining in and giving us a quick summary of the stocks to watch. A quick recap then. Stocks with positive news flow are oil and gas producers, that's basically ONGC, Oil India, PNB Housing Finance, Samman Capital. Stocks with negative news flow are oil refiners, GAIL, City Gas Distribution Companies, PFC, REC, HUDCO and IRFC. We will get into a break. On the other side, we'll connect with Deep Pal of Cohen Advisory to discuss the geopolitical developments over the weekend. Stay tuned.
Welcome back. You're tuned in to Bazaar Morning Call. And as always, we have Hormuz who's joining in to tell us about some of the big movers on Friday. And there were plenty of them. Some of them were backed by volumes and some had a good amount of delivery. Hormuz joins us to crack it down for us. Morning, Hormuz.
Morning, Nigel. And yes, indeed, there were a lot of these names that were buzzing around in the broader markets on Friday. And two of the biggest movers on the Nifty 500 on Friday had significantly large volumes. One of them, of course, was New India Assurance. And the commonality, of course, in both of these names that I'm about to highlight, both of them are underperformers. And New India Assurance was one of them. The stock was up 20% on Friday, the biggest single-day move since November of 23. It was the top gainer on the Nifty 500. It has gained in 4 out of the last 5 trading sessions. Now, Friday's volumes were the highest in almost 9 months. This is July of last year. It's 7.6 crore shares were traded on Friday. The 20-day average is only 6 lakh shares. And Friday's volumes were the sum total of the last 145 sessions put together. And that was the kind of volumes you saw on New India Assurance. But of course, the delivery, well, only 6.5% of those were marked for delivery, close to 50 lakh shares. The 20-day average here too is just 3 lakh shares. Now, from its bonus adjusted IPO price, which is 400 rupees, the stock is still down 60% from those levels. The other one was Cohance Life Sciences. That was another major mover yesterday. That too was up nearly 20%. It was the biggest single day gain since May of last year, since the name started trading as Cohance. It was earlier Suven Pharma. The third straight day of gains seen last Friday for the stock. Friday's volumes were the sum of the last 35 sessions put together. There's close to 5 crore shares were traded on Friday. The 20-day average is only 8 lakh shares, and only 5.5% of those shares were marked for delivery. So that comes up to around 26 lakh shares. The 20-day average is close to 4 lakh shares, and this stock too is down around 30% so far this year itself, and from its 52-week high levels the stock is down well over 65%. And lastly, the other major mover on Friday was Coal India. After the sharp fall that the stock saw in the second half of the trading session, that is when the volumes also picked up on the stock. The top Nifty loser on a day when the markets were up almost 250-300 points, the biggest single day fall in over 2 months. The Friday volumes were the highest in over a month as well. 3 crore shares were traded on Coal India, double of its 20-day average, which is close to 1.5 crore. The delivery volumes on Friday were the third highest in 2026, with close to 1.25 crore shares marked for delivery. That too is almost double of the 20-day average of 65.5 lakh shares, and was trading close to its 52-week highs before Friday's fall was Coal India. So down still 8% in the last 1 month, but still holding on to some gains for 2026.
All right, Hormuz, thanks very much for that. That's an interesting list of stocks there in focus. We'll take a quick commercial break here. The GIFT Nifty still indicating a 350-odd point lower start. We'll come back with, 30 minutes out for the pre-open session, by the way. If you could just quickly pull up the dollar rupee, right? It's not open yet, but I just want to make a point that, today, 10th was the last day for players to unwind their arbitrage positions. If you remember, because to curb excessive speculation, the Reserve Bank of India had come out with those 2 circulars, which proved to be pretty effective, which basically forced offshore players, largely banks who were dealing with offshore clients, etc., to sell dollar positions here and buy dollar offshore, to kind of reverse the arbitrage which they were playing for. The offshore rate, dollar rupee, was always higher as compared to the local rate. So they had to reverse it. The last day was the 10th. So, essentially the point I'm making is, starting today, you will see what demand supply looks like, because that unwind is over now. They had to do it by the 10th, and I'm assuming that's all done now. So starting today, we will see the actual demand supply playing out on the dollar rupee rate. We'll take a quick commercial break here. We'll come back. We'll have Deep Pal of Cohen Advisory to discuss the geopolitical developments over the weekend. Stay tuned, coming up. Okay, welcome back. 25 minutes to go for pre-open session. Let's get in Sudarshan, who's got the top brokerage calls of the day lined up. Sud, good morning.
Good morning, Prashant. So HSBC has initiated coverage on solar companies. So on Acme Solar, target price is 350 rupees. Call is buy. It says it's one of the fastest growing vertically integrated power producers of renewable energy, and 6 gigawatt contracted capacity gives long-term earnings visibility. It forecast EBITDA CAGR of 72% over FY 26-28. Next one, CleanMax. Here also call is buy and target price is 1150 rupees per share. It says it's the largest provider of renewable energy to CNI users and expect strong growth as more companies use green energy, and forecast EBITDA CAGR of 60% over FY 26-28. JP Morgan has initiated coverage on housing finance companies. On PNB Housing Finance, call is overweight and target price is 1,000 rupees. On Bajaj Housing Finance, call is underweight and target is 70 rupees per share. On LIC Housing Finance, call is neutral and target price is 580 rupees per share. It says system mortgage should grow at 8 to 10% over next 3 to 5 years and prefer housing finance companies' strong underwriting, low-cost distribution, and ability to deliver market share gains. Bajaj Housing Finance stands out, but premium valuation to peers, it believes that it seems unsustainable, and PNB Housing Finance is in early years of its turnaround and offers growth at a reasonable price. As far as LIC Housing Finance is concerned, it may continue to lose market share gains and lacks immediate catalyst, but low valuations limit downside.
Thank you very much for that, Sudarshan. The new development over the weekend is the fact that there is going to be a naval blockade by the U.S. starting 5:30 p.m. U.S. time, though the Iranian Navy chief has called the Trump threat to block the strait as ridiculous. But that's going to be the big development to watch. Here is the President, Donald Trump, speaking on the Strait of Hormuz situation amid the rising tensions with Iran.
Their military is destroyed. Their whole Navy is underwater, you know that. 158 ships are gone. Their Navy's gone. Most of their mine droppers are gone. We have a lot of people, as you know, at 10 o'clock tomorrow, we have a blockade going into effect. That'll be 10 o'clock tomorrow. Other nations are working so that Iran will not be able to sell oil. And that will be very effective. Iran will not have a nuclear weapon. Will not have. There is no way that they're going to get. They still want it, and they made that clear the other night. Iran will not have a nuclear weapon.
Okay, well, Deep Pal is Director of Geopolitics and Policy at Cohen Advisory Group. Deep, good morning. Good to have you with us here on the program. Thanks for joining in. So then, how does this work? This is basically to clear the blockade thing first. This is a blockade of, Iranian oil, right? Not other ships which may have been allowed to pass, because it looked like the latter earlier. But I think there's some clarity coming that this is only for Iranian oil.
Right. So it is for ships that are berthing and leaving Iranian ports, so ostensibly for Iranian oil. However, it is for ships of any denomination, which would be, let's say, even a Chinese ship or belonging to any other country. So CENTCOM has kind of, as you mentioned, CENTCOM has clarified that unlike what President Trump was saying, that any ship passing through the strait will not, in fact, be interdicted, but ships only berthing in Iran. However, that raises a whole host of questions. One, a blockade is an act of war, so that immediately escalates things substantially. But at the same time, I mean, as a thought experiment, imagine a Chinese flagged ship which has Chinese warships waiting to escort it on the other side of the Strait of Hormuz, leaving an Iranian port and getting stopped by an American warship. That creates a whole it's like the situation of nightmare. So I think we will still have to wait for some more clarity to understand how this will be operationalized. Also, understand that that area is still very heavily.
Yeah. Deep, just one question: does this clarification that is only for ships berthing at Iranian ports, basically to deprive Iran of oil money, oil revenue, right, by selling oil? But does this, in practical terms, make any difference in terms of, that the point is passage through the strait? But for all practical purposes, there was hardly any passage through the strait anyway. I mean, the situation now is pretty similar to what it was on the 1st of April. So in practical terms, does it make a difference?
Very minimally so, right? Because apparently on either side of the Strait of Hormuz, the count of ships that are waiting to cross are somewhere in the 800s or so. We have heard about 7, 8, 9 ships a day passing through the strait. So let's assume all of them are berthing in Iranian ports and buying Iranian oil and crossing over. So you stop those 8 ships. As I said, that also is difficult considering there may be other countries and their navies guiding these ships. You don't want to get in their face trying to stop them from buying Iranian oil. And this instruction, this decision is also directly incompatible with an earlier decision of allowing Iranian oil to enter the world market, essentially to keep prices down. So the moment you do this, you are pushing prices to go up again. So yeah, it's difficult to see how this will help. It will, of course, help stop the flow of money, perhaps, to Iran, at least from the sale of oil. But beyond that, it's difficult to see how this is going to play out.
Deep, you were making the point about how ships from China, perhaps they would be impacted. They would be willing to perhaps pay the toll. Some of their ships were at least passing through, maybe just a trickle, but they were passing through. So what are the geopolitical implications of this now also directly impacting this naval blockade, impacting countries like, say, China or Russia? Do you see this as a sign that perhaps the war could escalate from here on?
Look, I mean, the fact that the conversation did not go anywhere in Islamabad is an indication that both sides are very, very far away from where each of them stand on what they want out of the negotiation of the ceasefire. Fortunately, there's still about 8-9 days left in the ceasefire, so perhaps there is an opportunity for the mediators, whether it's Pakistan, whether it's China, whether it's someone else, to reach out with some versions of Islamabad Talks 2.0 kind of a proposal and see if something can happen out of it. But dialogue essentially would be the best way forward from here because of the various other options that are on the table. They are A, have far higher political costs, B, are definitely not going to be palatable to the domestic audiences of the countries fighting, and C, have far lower chances of success. What neither side will obviously want to do, because as we have noticed, the US wants to get out of this war, leave this behind, focus on the very important midterms that are coming up later. So the US will want to get out of this situation at the earliest possible. On the other hand, for Iran as well, there are considerations. There has been substantial damage. They have been asking for their money that's been blocked in various countries to be unfrozen. They would also welcome some sign of respite. But the two countries have approached this ceasefire and this dialogue and everything that's gone since then very differently. The US wants a quick out. It wants Iran to quickly surrender in their terms and then move on from the war. Iran, on the other hand, believes that it has kind of pushed back very strong opponents who have definitely far more firepower than they do, and they want an acknowledgement of that in the conversation. So that's where we are at. Something like a blockade, something like stopping ships of various denominations trying to leave Iranian ports does not help the situation. Again, this is an area that has been mined, so obviously it's very difficult to operate there. There may be ships from other navies that might be escorting these ships. So it sounds like a very difficult thing to pull off. We'll have to wait till tonight Indian time to see how this happens and what happens. But it doesn't seem like something that will be easy to do.
All right. Hi, Deep. Good morning. Good to see you in. This is Nigel on this side. You know, from an equity market perspective, when the markets open in the next 20-30 minutes or so, investors will want to know whether the risk is towards de-escalation, or do you think things escalate from here? The good news is that we have a holiday tomorrow, so hopefully there is some kind of taco and, you know, Trump comes back to more rational ways. What would you think? The risk is towards escalation or de-escalation?
Yeah, I think the really good thing that has come out of this is that despite all the bluster and everything else, neither side has really said that the ceasefire is done and over. We are walking back from the ceasefire, right? And as long as that happens, that basically means that there is some kind of back channel conversation, whether directly or whether through mediators, that has to go on, right? No one, as I said, everyone wants to get out of this and find an off-ramp that works for them. So essentially, look, 47 years of enmity cannot be walked back on in 21 hours of conversation, right? That is pretty obvious, right? So I don't know if President Trump's message will be walked back on, but what we are seeing happen already is there is a kind of calibration that is happening, right? Now, the top thing on Iran's agenda would be regime security that they have managed. If they can get some of their funds unfrozen, they would take that as a positive response. On the other hand, if the US has all this while been saying that Iran cannot make nuclear weapons, we have obliterated their abilities, they're possibly trying to get to the uranium. If some kind of a middle path can be found over the next maybe 24, 48, 36 hours, and the conversations, we won't learn of them till they have obviously reached a substantial point where they can be talked about in public, some decision has been made. But I think that is basically where things are stuck. There is definitely hope in the fact that the ceasefire has not been broken. So that points towards a willingness to de-escalate. But both sides have to feel that their key points, their top priorities are being listened upon. Until that doesn't happen, we have mercurial personalities on both sides. So the risk of escalation remains. And please also understand, we are talking about Iran and US here. Another major player in all of this is Israel, which has reduced its bombing of South Lebanon, but can ramp it up again. And that will again push Iran in a direction that is away from trying to dial things down.
Deep, this has been a great conversation. Thank you very much for joining in with your time and expertise this morning. The ceasefire came into effect on 8th of April, so technically it's in force or expires on the 22nd of April, so still in place as of now, though it's always been fragile and it continues to remain fragile. Dharmesh Kant, Head of Research at Chola Securities, is now joining in on the show. Dharmesh, thank you very much for joining in. First, you want to just quickly comment on these RBI draft rules on that 1 lakh crore asset to qualify them as an upper layer NBFC. Any market implications of this, according to your analysis?
Yeah, good morning, Rima. Thanks for having me for the show. I don't think there's going to be any major market implications on that because all the top tier NBFCs are already into the upper layer category, so it doesn't move a needle out there for them. The only impact which I can see is the cost of funds getting lesser for people who migrate to the upper layer, and maybe the government undertakings like PFC, REC, which was not there, when they get move into it, it would be advantageous for them, to my mind. One, because the cost of funds will come down a bit. So 10-20 basis point advantage on the NIMS front will be there for these people. At the same time, they are catering only to A-listers in the power finance space. So concerns regarding stricter regulations and rules won't be meaningful for these companies. So if there is a decline on PFC REC because of this getting through this draft rules, I think it's an opportunity to buy them.
Okay, all right. Hi, Dharmesh. Good morning. Good to see you win. The big casualty on Friday was tech. Tech did come in for a pounding yet again. Though that index actually has been the outperformer since this war started. That said, what would you do in the tech space? I think Orient Pro is a stock that you've repeatedly said that you like. I think it showed some signs of coming back to life on Friday. But how would you approach the tech industry? The stocks that you like, will you go for the product-based companies or will you stick to the services companies?
Yeah, good morning, Nigel. I mean, the tech story is unfolding the way, it has been, anticipated. The margins did not come up to that extent. The currency advantage was there, but otherwise we can see a deceleration in the operating margins of most of the tech companies. So earnings this time would be very important. Orient Pro, let's wait for the result. Let's see how the results pan out. To my mind, it should be 15% plus kind of a profit growth on the Orient Pro. The order book has been very strong, and the company has corrected quite a bit. So it has shown some resilience. The other company which I am looking into tech space is Tata Technologies. I mean, last quarter, the promise from the management was very strong, around 10% plus kind of a revenue growth with operating margins, getting better from 14%, which we clocked last time around. STEC will play a good role out there. The synergies, how it is going to play out. The bifurcation of the organic growth and inorganic growth would be the thing which I would be looking into, whether it is 6-7% of organic growth and 4-5% from inorganic growth will take it to 11-12% kind of a growth. The problem of Tata Motors is already out of the way. We have seen the numbers of both Tata Motor passenger vehicle and CV vehicles. So the outlook and commentary out there. I think it's again a cheaply valued stock. So apart from these two companies, we will be first watching the numbers. And maybe, Nigel, it's more to do with product and engineering research and services kind of a company, which should be paying a feeder to AI developments, would be the ones who, if at all, they come out winner from this tech down cycle.
Dharmesh, on Friday, Coal India was down nearly 4% after the company said that they will be absorbing the raw material price shock. So that disappointed investors. Do you think, to your mind, this move by Coal India is going to be a little transitory because they don't want to appear to be profiteering from this particular development, or by passing on the higher costs? What is your own assessment, and does it change the narrative on Coal India?
Yeah, remember, this is a problem with most of the, where the government is the promoter of the company. So you don't have the flexibility of taking advantage of, market plays into force. So now this will be absorbed. To my mind, if it's again a good dividend play, futuristically, say 3 years, 4 years down the line, it's going to become more of a holding company with all its subsidiaries, getting listed one after another. So 2 more are in the line for next year. So that will take care of 60% of the consolidated profit all put together with the 4 listings, which will be into place by the end of FY27. So we are playing Coal India more of a buy on declines kind of a strategy with people who prefer dividend yield, and the risk reward ratio does look favorable here out there. Otherwise, I don't think it's a wealth creator from here on.
All right, what we're going to do is we'll take a quick commercial a break here. Dharmesh, of course, stays with us. Dharmesh, coming back to you, we'll be back with more questions to Dharmesh. A lot of individual stocks that we want to tackle more. We'll get you the technical trading ideas as well. Stay tuned.
Welcome back. Hope you're having a good morning. Well, for starters, the GIFT Nifty suggesting that we pull back a good 350 points. It'll be interesting to see what goes on with the broader markets because that's been the place where, in fact, you're seeing some kind of traction and there's been a big outperformance out there. Dharmesh Kant is still with us. Dharmesh, I wanted to ask you about the cement pack. You have been tracking that very, very closely. And to be fair, January and February were very, very good months on the demand side. And there were price increases that were absorbed as well. However, towards the end of March, we do see that a lot of volumes do take place. And because of that, pricing comes under some pressure. Now, in April, again, the price hikes have been announced and demand has been more or less flattish. What's your view on the cement names? You know, there are some of those mid-cap names that are trading at a very sharp discount to replacement cost. And sometimes you've seen in the past that something's got to give at that point of time. What's your view?
Yeah, I mean, there's always a buzz about, inorganic expansion taking place in the cement space, and that keeps the mid-cap space quite buoyant. The volume uptick has been good across the pan-India region. Even in the April so far has been panning out quite decent, and the weather again is helping them out because the summers have not been that harsh, larger part of the India as it was anticipated in the middle of March. So I think that's happening quite well. The only problem with the price hikes are happening, but because of the input cost hike, the net of discount price, they don't have any yield on the margin front. So to our mind, margins are likely to be fairly stable. It's a volume growth which will take care of, a bottom line and profitability. Stock prices have not done significantly anything different last 2-3 months. So it's been a volatile and fluctuating kind of stock prices. Our suggestion would be to go with a basket buy kind of an approach, have a couple of large cap names, UltraTech and Ambuja looks pretty attractive out there. Avoid Shree Cement because they are going into premiumization. Last quarter numbers were not that great. So one quarter more, will have to have a look on it, how things are panning out for them. Other than that, from the mid and small cap space, maybe a Ramco Cement or Dalmia Bharat can be pushed into the basket. So these 4-5 plays as a basket play can yield better results before the monsoons set in.
Okay, got that. What would you do with some of those aluminium plays as well? You know, there's a big disruption because of that prices are remain elevated. And for some of our domestic names, the coal price hike as well is not hitting them because they have some linkage. They also have some captive coal coming in from their mines. And now Coal India is going ahead and saying, we want to supply more coal. We want to keep coal prices down. And our interest is aligned with the customers. That should be good as well because input costs not going up that much and getting the benefit of higher aluminium prices. What's your take? Take some money off the table, hold on to them.
Absolutely, Nigel. I mean, you have highlighted all the points very clearly and distinctly. I think it's going to work to the advantage of aluminium producers, and we have two strong players in India. One is Hindalco and the other one is Vedanta. Nalco, again, comparatively very cheap valuation out there as regards to, say, Vedanta valuation multiple. So all these three company looks well. 17% year-to-date aluminium price size has been there, and it looks like it's likely to stay going forward for this entire calendar year. So we have been, I mean, last 6 months, the trade on the commodity play has been quite simple. Any declines, 4 to 5% kind of a stock price decline should be used as an to add opportunity. We do think that 10-15% more kind of an upside in, say, near term of 3 to 6 months for a company like Hindalco, Vedanta, and Nalco is very much on the cards. Valuation wise, both have Hindalco and Vedanta have moved to the +1 standard deviation kind of a PE multiple based on last 10-year valuation track. But I think things are changing for them as of now. And with margins getting a tad better than what they've been reporting, as you have just highlighted, because input prices won't go up and blended realizations are going to go up, augurs well for them. So all three of them is a good basket buy, and we have been recommending that to our clients on periodic basis.
Yeah. Got that. You know, we'll just get in the technical trading ideas as well. You know, Mitesh Thakkar is with us and so is Sudarshan Sukhani. Gentlemen, good morning. Good to have both of you here. GIFT Nifty will come up on your screen and we'll just take a quick look at where though the rate still 350 odd points lower right now. And about a minute or so, we'll get the dollar rupee rate as well. As I was saying earlier, because the deadline to reverse arbitrage position, the RBI deadline was the 10th, which was Friday. Today, you will get a better realistic picture of the dollar demand supply kind of equation on the dollar rupee. So that will start to come up shortly as well. But Sudarshan, how are things looking? What would you do this morning?
Yeah, good morning. Well, I would be a buyer this morning. This market has already discounted all the bad news. We saw 22,200 and we are well above it. Now a 350-point decline or a 400-point decline is going to happen not once, but many, many times. As the market builds a base, as the Nifty builds a base, it's going to see a lot of sharp surges and sharp dips. So today is one of those sharp dips. So for the Nifty, somewhere once the market say finds some minimum stability, or let's say a number is 23,600 to 23,700, where the Nifty is expected to open, that's a buying opportunity. I don't give a stop because you have to use options, call options for April end expiry to buy. The cost of the option is your stop. Be brave again.
Time to be brave. I was going to ask you that only, Sudarshan. Is this the day to be brave? And you've answered me that. So, all right. So, look, you're looking to, play this market on the long side on this bad news that we're seeing this morning. Midesh, what about you?
Yeah. So, I, will wait out to see what the reaction is. For me, I think the level of around 23,600, 650 is a key area. And we might open just above it or just around it. So in case there is lack of follow through buying, then I'll go long. So, because you get a good entry point with a tight stop loss, and that's where a lot of averages are converging around this 23,600, 650 zones. So maybe around those levels we'll venture into buy trade, but that call I think I'll take once the market opens.
Okay, let's get to the stock specific action then. Good morning, gentlemen. Mitesh, what are you going with?
I have 3 sells and a buy call. Primarily, I think the sells have to be slightly adjusted because there will be a gap down. So you'll have to see and wait and watch. Which stocks you can take some sell positions upon. So the first one is 361. That's the broking arm. I think that's a sell. Sorry. Keep a stop at about 1,031. Look for targets of 975. Selling Coal India, after a long time, Coal India gave a breakdown on Friday, so sell with a stop at 441 for targets of 420. Buy on Cummins, if it opens around 5100, 5080 zones, buy with a stop below 5030 for targets of 5250, and IOC is a sell with a stop at 145 for targets of 138 to 137.
Okay, got that, Mitesh. Taking note of your calls. By the way, keep an eye out on the bottom of your screen. As Prashant mentioned earlier, that April 10th deadline, that's gone, done with. And we know from the time the RBI, announced those measures to squeeze the market a little bit with regard to the arbitrage opportunity between the NDF market as well as the local market. We did see that the rupee pulled back from ballpark around 94.9 all the way to around 92.5, 92.6. Now, what's happened in the initial part of trade today, as the money market has opened at around 9 a.m., is that the rupee is showing some sort of weakness. So it's immediately depreciated by more than 0.5%. Let's see whether or not there is a bit of a knee-jerk reaction, or in fact, the rupee can stabilize, because that's going to be an important trigger. Remember, from an FI flow perspective as well, they'll not want the rupee to continue depreciating as we've been seeing very, very swiftly. If I'm not mistaken, in December it was at around 89, which swiftly depreciated to around 94. And for them, via the depreciating rupee itself, they're making losses, irrespective of the market move. So you'll want to keep an eye out on that
and
one.
Also separately, overnight, even the dollar index spiked because of the impasse in the talks. So dollar index spiked, and many of the emerging market currencies have also are trading lower. The Philippine peso is down nearly 1%. Lata was saying the Korean won is also down close to about 0.25%. So that overhang is also there. But in a nutshell, I think the key takeaway is the rupee has opened sharply lower this Monday morning. But we've got Sudarshan's calls left.
Well, that's right. Yeah. Sudarshan, fill us in with the calls.
Well, it's a more of a buy list. Max Health is a buy with a stop under 938. HDFC Life is a buy with a stop under 593. PG Electroplast is a buy with a stop under 478. I have only one short selling idea, that's Coal India, keep a stop above 444. The stops themselves are not relevant because the markets will open much lower. So for the buying, you have to adjust the stops. But the theme is look for good quality stocks to go long.
Thank you very much for that. Let's talk about the oil and gas space. The government has raised the windfall tax on diesel exports to 55 rupees per litre, on aviation fuel ATF to 42 rupees litre, effective immediately. The petrol export duty remains nil. Maulik Patel, head of research at Equirus Investment Securities, is now joining in. Maulik, we're living through extreme volatility when it comes to crude prices, from highs of 120 down to levels of 90. We stabilized around $96, $97 on Friday. Now, once again, we've seen that overnight spike. Broadly, amidst all this volatility, what is the investment advice that you're giving to people who, come to you, whether it's for oil and gas producers or the consumers like CGD, etc.? What is the broad call now?
Yeah. This event of the last 1 month is like a black swan event, right? Which we analysts and investors have thought about. Okay, on that Strait of Hormuz, it is closed. You have this kind of a shortfall, and it does. In my view, the oil has been behaving. It's been it's initially it was volatile. It's still volatile, but it's in the range of this $90 to $120 per barrel, right? Now, you look at from the oil price perspective, before the war, I think the oil was around 65. That's what the fair assumption was, that entire of 2024 oil was in the range of around $60 to $70 per barrel, largely. In my view, that oil in a new normal for the next 1 year or so, it will not come below 80. So 80 is enough fair value on that, given that you have massive reduction on the inventory size. The global inventories are down by almost around 300 to 400 million barrels. So it takes time. You have the damage at some of these production facilities in Middle East. So it takes time to normalize the flow. That's $80 per barrel. You add geopolitical risk.
Hi, Maulik. Just going to request, our team to just fix that audio, I think. So it's not very, very clear, but we want to understand Maulik's view. For now, what we understand is that, he's definitely working with that premium because of the disruption we have seen via the logistical issues, via the crude that's coming in, via the Strait of Hormuz, as well as some kind of lower supply in the market. So he's building in that Brent crude prices will not go back to that $65, $70 per barrel, but it will stay elevated around that $80 per barrel odd mark. I think we have Maulik back with us. Maulik, hope this line is better this time around. So we have the news flow that we've heard over the weekend as well. What will your approach first be to the city gas distribution companies? They like to start off on the back foot. Would you be a buyer?
Sorry, Nigel, you have to repeat that because there were...
Yeah, now you're absolutely clear, so that's good. The city gas distribution companies, there's some negative news flow that's come in there. First, what is the financial impact and what is the official call you'll have on the city gas distribution companies?
So on CGDs, particularly on the likes of IGL and MGL, which are more CNG focused, and this particular Delhi EV policy which has come, it can be written negative. And if you look at the growth perspective from the CNG, IGL has been reporting around 4-5% growth over the last couple of years because of the phase out of the DTC buses. This three-wheeler registration put another cap on that. In our view, that the Delhi, which is another 2/3 of the CNG volume for the IGL or overall is pie, has not been growing, and it will continue to be there. It's another part of the IGL's business, which is in the new geographies, your NCT areas like Ghaziabad, Gurgaon, Noida, Greater Noida, which are growing at a much higher pace than the company average. So yes, so that's one. The growth rate will not come back to the very high number which we used to. Second is on that there is a very important is that the government should take this opportunity of the crisis in the sector to come out with some reforms which have been long pending. One of the reforms for the CGD sector is pending, that introduction of the gas under the GST. There is on CNG you have an excise duty which is on a percentage basis of the selling price. And if you look at in the last 4 years, the CNG price in the country is almost double. It used to be around 40, 45 rupees at the time of the COVID, and pre-COVID, it's now around 80 to 90 rupees at the most of the places. So government has to rationalize that excise duty which they have been imposed on the CNG, and if they do that, then there can be some kind of another demand spurt which may come up, or the growth in a CNG X of Delhi or X of MGL, which will continue to be drive there. So our recommendation is that you go for that in any kind of this dip for the IGL and MGL.
Maulik, in the event of a complete blockage of the Strait of Hormuz, what will be the impact on oil supplies, and particularly anything, for India, given the LPG supplies are also crunched, though a couple of ships did pass through?
So I think, before it was 20 BD which was passing through. Still, the last 1 month or so, it's only 1.5 BD, which is actually the Iranian oil, which is passing through the Strait of Hormuz.
We've got you in a very bad line, so we'll try and reconnect with you at a later time because we're approaching pre-open as well. But thank you very much for joining in. It's 9:10, time to get in our technical call. Sudarshan, yours?
It's HDFC Life. Buy HDFC Life. The initial stop is 593. You'll have to adjust it based on the open.
HDFC Life. Mitesh, yours?
I'll go with a sell on 361.
Thank you. Sell on 361. RBI has mooted a 1 lakh crore asset threshold for NBFC upper layer classification. Ritu now joins in with the implications. Ritu.
Well, Rayban, that is the big shift. Earlier, upper layer NBFCs would be classified on the basis of various scoring models, qualitative and quantitative. Now, it is a much simpler system where RBI is proposing any NBFC with an asset size of more than 1 lakh crore is going to qualify as an upper layer NBFC. That is the biggest change. The second one is that they're proposing to remove the automatic inclusion of the top 10 NBFCs into this list. And third, the restriction on government NBFCs from entering this upper layer is also proposed to be removed. Now, keep in mind, for an upper layer NBFC, there is tighter credit concentration norms. So exposure limits come down to 20 to 25% of Tier 1 capital from as high as 40%. There's stricter regulatory capital and governance disclosure requirements as well. Now, specifically for government NBFCs to ease this transition, RBI is allowing them to exclude the loans that have state government guarantees when calculating the exposure limit. And this is important because a lot of these lenders have large concentrated exposures to state-led projects, so they can continue lending to them without breaching the limit. Now, in terms of impact, of course, these government-linked NBFCs specifically that have asset sizes of more than 1 lakh crore, like your REC, PFC, IRFC, HUDCO, they can potentially now fall into the upper layer list, whereas smaller players like PNB Housing and Samman Capital that are currently part of the 15 upper layer names but have assets of less than 1 lakh crore could potentially move out of the list. But as for the fate of Tata Sons, there's no explicit relief for them, and all of it will very much depend on what RBI decides to do with their, application on deregistration as an NBFC.
Thank you very much for that. Mangalam now joins in with the latest on Avenue Supermarts.
Well, there is a brokerage note that has come in on Avenue Supermarts this morning, and it's a contra sell on DMart. MK has written they've initiated coverage, a sell rating, and a target price of 3,700 rupees. And those who are, on the other side for DMart, the bearish side, they have just two arguments. One is the valuation, and that's what MK says. The stock is trading at 70 times forward, PE pricing in what the DMart business needs to become and not what it is. The second part to that is the competition that has come in from new age businesses. Earlier, it would be e-commerce, and now it is quick commerce, where they're saying that quick commerce players are now only trading at a 4 to 13% discount. In fact, DMart bill cuts per square foot are down 5% since FY20, even as quick commerce saw dark stores increase from over 420 to about 2,000 in 2 years. Capex per store on DMart also has increased by about 60%, and that meant that the return on invested capital has come down by a few percentage points too. All of this with the price to earnings growth ratio, PEG ratio, which is comparable to Trent and Titan, with growth not coming in as fast. They are structural sellers with a target price of close to around 3,700 rupees, but the bear case target for them is close to 2,200 rupees.
Okay, all right. Mangalam, thanks very much for that. So those are specific stocks which are in focus. There's less than 2 minutes to go for the market open. The Nifty is indicating a 460 odd point lower start. So 23,600 roughly is where we are likely to start. So we are going to be below the lower end of the gap which we had. The gap was made on Thursday, last Thursday, which is the 9th. The low was 23,682. The gap that I'm talking about, by the way, is the gap which was made from the, between the 7th and the 8th. I mean, we closed on the 7th at 23,100, and then we gapped up the next day at 23,850, right? That was that massive gap that we had last week. And the lower end of that gap is the first support that we put out, which is 23,682. And this morning, we are starting below it. Let's see. I mean, after the initial, pressure, we're able to come back above it or not. I mean, the next support zone is at 23,460 odd level, which we will have to sort of reckon with, I guess. We'll see. But this is, the opening is going to be steeply, sharply lower. What do we have? 23,600, okay, 23,650, 670. So very quickly coming back to the 23,650, 660 kind of levels, which is exactly around the lower end of that gap, but we're still under it at open. 1.7 lower. Nifty Bank is down about 2.5%. We've got the mid-cap index, which is down sharply, about 2% lower. The small-cap index, which is down as well. 1,800 stocks are lower, about 190 stocks are higher. So that is the overall picture at this point in time. The Nifty heat map will give you a quick sense of where we're likely to start, and then we'll pick it up from there. Coal India, ONGC, and Sun Pharma are the three names which are up in the green. Bajaj Finance, Asian Paints, and Indigo are the top losers. I mean, it's an oil shock by and large. Rima.
Well, we rallied about 1340 points on the Nifty last week. Of that, about 400 points have been given up this Monday morning. On the Nifty Bank, the rally was about 4,400 points, and straight away with a gap up opening, 1,500 points lower. In terms of percentage, it's 2% lower on the Nifty and the Sensex, and now the Nifty is gravitating below 23,600, in fact closer to 23,550, while the Nifty Bank, after a 1,500 point gap down, is around that 54,400 mark. On the way down, it's the oil shock which is hurting. So Asian Paints, Interglobe Aviation are down 4% at open. NBFCs are weak, so Bajaj Finance, Shriram Finance, they rallied hard this last week. There was a big rebound taking place, and now they're giving up some gains. Auto names are under pressure. Eicher Motors, Maruti Suzuki, weak in trade. Adani Ports, Adani Enterprises, weak. A lot of banking names like State Bank of India, HDFC Bank, ICICI Bank under pressure. L&T is giving up nearly about 3%. Reliance Industries has cracked 2.5%. On the way up, as Prashant said, only 3 stocks in the green. ONGC, Coal India, which was down 4% last week, is rebounding a bit, and Sun Pharma is the other one, which is eking out a small gain. But other than that, it's a very poor advance decline ratio. So today we've got about 11 stocks declining for 1 stock advancing, with the mid-cap index underperforming the benchmarks. Mid-cap index down nearly 2.2%.
Well, that's right. The stock that's taking it on the chin actually this morning is Jyoti CNC. That's because the French authorities have initiated a formal judicial investigation against their French subsidiary. The allegation is alleged export of dual-use machinery in violation of EU's export control laws. And that explains why that stock is getting absolutely clobbered as we speak. So big downtick is what we're seeing on that name. What else? You have Enviro. That's the stock that's actually doing well on the upside because they've won a 970 crore sewage infrastructure project order in Maharashtra under SBM 2.0. So that's the big stock actually on the upside. On the headline index, the Nifty is down 480 points, but the bigger pain actually is in the broader market, which has been outperforming. Less than 200 stocks are advancing. And I'll tell you what, if this market has more steam left, then by the time we wind up, the number of stocks advancing should be much higher than what we're seeing at the start, which is currently less than 200 stocks. And also the Nifty should defend this 23,500 odd mark. Let's see whether or not that does play out. ONGC is higher because of the spike that we're seeing in crude oil prices. But otherwise, more or less, it's a negative market. HCC is down. Bank of India is down 4%. OMCs are down. Ashok Leyland, the stock that's rallied close to around 25% actually, 15%, beg your pardon, from around 150 all the way to around 177 odd. That one has come in for some profit taking. So net, a red looking screen, guys.
Yeah, absolutely. It is a red looking screen, and we are I mean, I think it's the negative feedback loop, right? I mean, I think you've got the rupee, which is lower as well. The dollar rupee should come up on your screen. And we will, for the last, 10 days or so, we didn't have that, the negative pressure from the rupee. But we're back at about 93.32, which is about 0.65% higher on the dollar rupee. And it's the pressure on the currency coming through as well. So 2% lower on the Nifty. Let's just quickly look at Asia as well. So the Nifty is 2% fall. Is it in line with what we're seeing in the rest of Asia? Or it is more, it is less? Just gives you a quick sense of how Japan, Hong Kong, Korea, etc., where they are at. That one is higher. Is that one trading? I'm not sure. But it's showing a slightly upper, higher move. Hang Seng is up about 1.25%. And maybe some other markets as well. Rajiv Batra is with us. He's head of Asia and co-head of Global Emerging Markets Equity Strategy at JP Morgan. Rajiv, good morning. Good to have you with us here. Thanks for joining in. So this is, how would you read it, Rajiv? This is, in the, there's no escalation of conflict in that sense. There's this blockade which is supposed to happen. As a market participant, would you read this as, for the lack of a better word, normal, back and forth, one step forward, two steps back? That's how it's going to be before you kind of get towards some kind of permanent de-escalation. Rajiv.
Thanks, Prashant, for having me back on the show. So you rightly pointed out, we are not fully out of woods yet, but any case kind of an escalation from here can lead to a further weakness into the stock market. However, that said and done, the direction of travel is positive. Over the last few days, we saw the 2-week ceasefire announcement come through in place. Finally, both the parties, US and Iran, had a weekend meeting. And then Iranian ambassador ended by saying that this is one of the many such meetings coming in place. So at least the direction of travel is positive versus where we started early March or even last month where situation we were in. So expect choppiness to remain in the market, but that will also give an opportunity to people to buy quality spaces in weakness. So currents are improving. That's what I'll say.
Rajiv, hi. Morning. Rima here. So JP Morgan was bullish entering 2026. Your Nifty base case target was 30,000. You were anticipating earnings growth of 14,000. All that has changed on account of AI and now the war. What is the expectation for India now? How have you revised your forecast, if at all?
So we have revised down India a Nifty target now to 27,000 as a base case overall. The way we are looking at this shock which have received to the not just India growth, but even global growth through 3 lenses. Number 1, the nature and the magnitude of shock. Number 2, looking at what is the underlying expansion story going through and how much it can absorb. And lastly, what is a monetary policy response? Taking the initial assessment, it's still a constructive baseline, or you can say a cautious optimist baseline, because of this ongoing expansion cycle can absorb most amount of a shock and bring the above potential growth to a trend level growth. Whereas inflation will increase substantially, but it will be largely transitory. And then lastly, with Fed, JP Morgan expected to remain on hold, may lead to emerging market central bank, which include even RBI, to also remain on hold, not going for a hiking per se. So taking that view into account, you can say we are cautiously optimistic right now on equities versus the way the year has started.
Rajiv, what are you factoring in terms of earnings growth? It's going to be a difficult one, right? When we started off this year, no one thought that we'll be dealing with Brent crude prices at these levels. And we had that cushion because we got used to seeing Brent at $65, $70 a barrel. Now the macro factors actually are suddenly going to turn into some headwinds on various parameters. So putting that in, what kind of EPS growth are you all factoring in?
Thanks, Nigel. So at start of the year and even today, the consensus earning growth forecast for CY26 is close to 18% and CY27 is close to around 15%. When we came out with our outlook, we came up with a much more, you can say, a lowered or a calculated estimate of around 13% earning growth for CY26 and 14. So the starting point was lower for us. And the reason behind this, if you look at consensus forecast for the last 15 to 17 years, every year, whenever we start the year, end of the year is almost 2 to 3% lower. But now when the oil shock has come into play and we have looked at both on the bottom-up basis through sectoral lens as well as top-down. So across the key sectors which are getting impacted, consumer, autos, financials, OMCs, logistics, there have been slew of around 2% to 10% EPS cut on a weighted average basis by my sectoral analyst. And from economist side, we have cut down GDP growth by 50 basis points. Taking these factors into account, we are reducing our earning growth estimate by 2%, which gives 11% earning growth for CY26 and close to around 12% earning growth for CY27. That gives us around, you can say, a CAGR of around 10.5%, 11% over the next 2 years.
Rajiv, what's the foreign investor feedback on India now after all this has played out? Because the rupee is turning out to be a bit of a headache. Oil price hurts us more than many of the other emerging market currencies. You said growth expectations, what was supposed to be a very benign high growth environment for India going into 2026 has sort of changed now with higher inflation, maybe transitory, but growth expectations have also been moderated. When you speak to FIs, what are the top 3 concerns and the feedback that you're getting, and will they come back? Are they warming up to India?
So if I can answer this question in the 2 parts, first of all, the concerns which are playing on top of their mind, number 1 is AI. Even though near-term basis, you can say after the January and February correction in IT space, it is largely in the price of next 12-month revenue growth slowdown and disruption. But structural concern on Indian employment pattern and how the IT sector model will evolve, software services, that remains the key question mark. The second point is double-digit earning growth. That has been a mystery which we are trying to solve for the past 5 to 6 quarters. It was about to get solved, and most probably this ongoing last quarter earnings season, which has just started, we will get that double-digit mark this particular quarter. But after that, because of this oil shock, that will persist and keep us eluded away from a double-digit kind of an earning growth. The third factor, which has now recently come in, is a very weak local currency. Now, these people are dollarized investor, and if my currency keeps on weakening, they are not able to make interesting kind of an IRR return which they are able to generate from the other market. So taking that view into account, they are remaining on sideline. And beyond that, which we are seeing that when global markets are making a comeback as the noise goes down, which was Wednesday last week, global markets are 5%, India was up only 3%. In that scenario, investors are looking at thematics rather than looking at sectors or a country. And the thematics which are prevailing right now are in the space of space, AI, nuclear, or even robotics, where most of large cap stocks are not there in place in India at this juncture.
Yeah, I've got that. So on a relative, Rajiv, on a relative basis, I mean, the JP Morgan, relative preference, how does that look like in Asia?
So we are cautiously optimistic on across market right now. India remains still an overweight for us, but the most preferred market within the Asia region right now is China. Where we can see there are enough amount of a buffer, market is available for cheaper. Most of the themes which are prevailing globally do exist, and it is also a significant under-owned market like India by the foreign investors. So that's remain number 1 preferred market. Within Southeast Asia, it is Malaysia, again a net energy exporters like China, and top of it, not having much concerns regarding either the reserve level, import covers, or even have much more stable currencies per se. So that's within the 2 different regions per se. But in terms of overall markets, we are still maintaining overweight on China, Korea, and India.
Any new themes, I mean, which will emerge out of this conflict?
Definitely. Number 1 theme, I'll say, is energy security. So name linked to upstream energy, coal-related name, renewables will gain more traction, even if, let's suppose, a few months down the line, the tensions stop. But this may not stop countries to start refilling their inventory line. This will not stop country to expand their SPR capacities per se, and even explore other sources of energy. And that's the reason why one of the themes which I have highlighted, global investors are looking is towards nuclear for much more energy purpose, household consumption purpose per se. So that themes will prevail. And beyond that, the real asset theme, as we have seen 3 years back, gold started. After that, metal and mining started joining the race, and now it is energy. So as we are moving towards much more a regionalized world, or you can say a deglobalized world, real asset security is becoming a key theme, not just from a year or two, but almost from a decadal perspective.
And how is JP Morgan looking at this entire energy security theme in India?
In India also, we are holding a neutral, because if you look at MSCI India, most of the exposure is still on the OMC side, which are downstream and sufferer. But beyond that, we still prefer upstream. We still like coal and coal-related names, and we also like the renewable companies. And even on the auto side, yeah, we do like endeavors which government is doing on the EV end.
When you talk about coal-related names, how do you play that? Because Coal India, a bit of a dampener at this opportunistic time. Suddenly, the management comes out and says that we want to supply more coal, we want to be increasing prices, we'll take the blows with regard to higher input cost. Investors are not impressed in Friday's trading session. What are the ways you are looking to play coal?
Sorry, I will not be able to answer.
The buyers of coal. No, I just wanted to know the buyers of coal, because the input costs will not go that much higher in India in comparison to the globe, or maybe the aluminium names that buy some coal from Coal India, or maybe some of those ferrous names, the DRI companies, because they use thermal rather than coking coal. Wanted to understand further with regard to that coal argument.
So initial part of energy, if you will, trying to see the puzzle, governments are not letting the end consumer being hurt, be it the businessman, be it the household, that is not letting being passed on to that. But if this problem persists, and as we are seeing, even if the war stops today fully and supply normalizes, it will take close to 3 to 4 months for energy supplies to normalize, which means if the oil prices remain higher, at some point of time, you will let not just the oil-related, but even the coal-related also price slowly and steadily being passed on. So it provides you a barbell in this kind of a world, that if this get extended and slowly and steadily for demand destruction prices are being passed on, you will start getting the impact in the coal-related space also. So initial round, you may not get the increase in earnings and stuff, but where you will get support, because that space is under-allocated by the fund manager, you will see a further build-up in terms of valuation re-rating, and then later followed on by earnings when prices are being passed on.
Rajiv, just talking about the near term now, in the last conversation you had said that the maximum period for a global drawdown is typically 4 to 5 weeks. The median is 2 to 3 weeks, but the max is 4 to 5. And that sort of seems to have played out now with this conflict and where we are right now, middle of April. Where do we go from here?
So if we look at the trajectory, or if we look at the previous crisis also, the most recent one, I will say, is of the 2022, when the Russia-Ukraine war broke out. And prior to that was COVID. Like the COVID one, March 23rd, market from the trough after the Fed put arrived. And later on, markets kept on grinding higher. It was not that the market was not declining, but market was giving you a higher lows rather than giving a new lows per se. And it took almost few months to make up to the previous high or surpass that previous high which happened early part. Similarly, in the Russia-Ukraine war also. So it is unfair to say that we will have a very sharp V-shaped kind of a recovery, because the you can say the aftermath or aftershock of all this kind of an impact are yet to show up and come up in the growth indicators term mode. Once that all start getting pricing higher, you will keep on seeing small rebounded coming in place. But yes, higher lows could be the way it can be approached if the situation remain as it right now, rather than a serious escalation happen from here on.
Rajiv, just one final question then. I think some of the emerging themes that you said you like are AI, nuclear, robotics, etc. Right? India was seen as a bit of an anti-AI theme. In the other themes that are emerging, if you could just once again tell us those, how is India's positioning vis-a-vis the rest of the emerging markets, say in robotics, in nuclear, etc., and the other themes that you like?
Yep. So if you look at the upcoming pipelines or capital raising effort globally, these are the four hot spaces, particularly in US and China, where more issuances are coming around. And whenever market goes back to the normalcy mode, these are the four particular themes where people are chasing, and any stocks linked to that, they are adding to that. When we look at the India allocation, you have very few large cap stocks who are belonging to this particular theme. But there are a good set of a mid cap and the small cap stocks which are part of this cohort, and they will be benefiting as this theme start picking up, particularly like we can say in IT space. In IT space, there are specific mid-cap companies which are outperforming large-cap companies because of their niche model of servicing to the AI and generating revenue through that. Like this, we have in nuclear or nuclear equipment side, names exposed, space-related, or even, I will say, even in the robotics end too. So once this exposure start broadening and the newer issuances in the large cap end comes in this particular four spaces, definitely India will also, or India equity index will also benefit.
Rajiv, thank you very much for joining in. Great chatting with you. As always, look forward to the next one.
Thank you.
Thank you. Moving on now to the other big story. The Reserve Bank of India has proposed a significant overhaul of the framework used to classify upper layer NBFCs. It's now shifting to a much simpler asset size based methodology. So basically, NBFCs who have a 1 lakh crore asset size will qualify as an upper layer. Ritu's been talking about this since morning. Abizar Divanji, founder of NeoStrat Advisors, is now joining in on the show. Thank you very much, Abizar, for joining in. I think the big change is also now the inclusion of PSUs and government-owned NBFCs in this classification of upper layer NBFCs, which means there are implications for an REC, PFC, IRFC, etc. Give us your initial thoughts on this particular and the impact on PSUs.
I don't know why there was a distinction earlier anyway, Rima. I don't think that kind of distinction was ever required because these are large PSUs, PSU NBFCs. The other thing is that, the whole issue around upper layer NBFCs was that they are very much nearing that of banks. And if they are nearing that of banks, then two things are required: better and more stronger supervision, higher levels of capital, provision of liquidity, and biggest among them is transparency through listing. So these are the considerations or tenets based on which this was formed. And why should PSUs not be part of it? I think it's a logical conclusion now to say that these are nicely independent run companies. Once they get listed, there will be even more transparency. Some of them are already listed though. Though it's important to note that when RBI came out of the list in 2023, 15 companies are classified as upper layer, none of the PSUs were in there. That's because the regulation did not cover them. But now it does.
Yeah, absolutely. Abhijit, hi. Sandeep, hi. So PSUs is one. What happens to Tata Sons now? Abhijit?
So I don't think Tata Sons is impacted by this. Now you have to understand Tata Sons issue in a little different format. First of all, I don't think this regulation has come out in any way detrimental or for Tata Sons. Now, this is simply a simplification from the earlier regulation, which said that there is a subjective basis. Now we come to an objective basis, which is 1 lakh crores. Tata Sons falls within the 1 lakh crores? Surely it does. But if you look at the regulation, there's a layered regulation here, and you have to understand that. One is, under the earlier regulations, where RBI had the discretion, in 2023, Tata Sons was the only CIC to be included in RBI's list of companies that need to get listed as upper layer. Under the new regulations, that flexibility is gone. And the only criteria left is 1 lakh crore. Now, under the 1 lakh, it says RBI can use its discretion, but within the 1 lakh crore limit. So that is one. Now, the second and the most important issue is Tata Sons likely to remain a CIC? That's a very important question. Now, what are the classifications of a CIC? It says you have to have 90% of your assets in securities, whether debt or equity, and of which 60% has to be equity. That's one condition. Condition number 2 is you should have directly or indirectly public deposits involved in funding those assets. If there are no public deposits left on the Tata balance sheet, which frankly we don't know because it is not a listed company, then very clearly the justification that Tatas would have is actually we are not a CIC and hence why does the listing regulation even apply? But if it is classified as an NBFC, then the listing regulations will apply. There is no way out of that because there is no subjectivity left.
Right. Abhizar, yeah, let me get Sandeep in as well. Sandeep, Abhizar, of course, explained that, but just come in on this Tata Sons issue, because the point is, if it is just based on asset size, the discretion is gone. So then, I mean, the discretion for RBI to give exemption is gone, and it's just that's a change from the earlier side. So where does that leave Tata Sons?
So I think Abhizar said it correctly. I don't think it impacts Tata Sons at all. Essentially, even earlier, I think based on the complex rule they had, Tata Sons would fall within 1 lakh crores. Obviously, they fall within. So there's practically no change in terms of how it impacts Tata Sons. It would certainly have a huge impact on public sector NBFCs. And when I say that, I mean, there are certain NBFCs which are actually very dedicated to a sector. And as you know, there are exposure norms with respect to companies and with respect to an industry. So, entities like REC and PFC, which overwhelmingly kind of by mandate of law probably are required to lend to power distribution and power generation, will have an issue really. Either RBI will have to create carve-outs for them, or for them to fall in line is
Sandeep, but
not very clear to me.
Yeah, the earlier regulation, right? There was a composite scoring methodology, qualitative, quantitative factors, with a degree of regulatory discretion by the Reserve Bank of India. All that is now gone. It's just so.
That's right.
So I mean, when we say that it doesn't, there's nothing changes for Tata Sons. I mean, will they have to get deregistered as an NBFC to stay out of this?
No, so here's the thing. See, I think based on the numbers I have, 3 NBFCs would exit this list, right? And Tata Sons is not one of those 3. And of those 3 also, the norm is that there's a 5-year kind of cooling off period, so they cannot exit. So unless RBI changes the norm to say that, the 5-year exit norm is no longer applicable for these 3, they will still have to fulfill all the requirements for the next 5 years.
Yeah. So, Abhizar, you want to just come in there on that question?
I would just look at it, see, every regulation is devised out of logic. And the clear logic of any listing or classification, something as an upper layer or even as an NBFC, should be the involvement of some kind of public money. And if there is no public money, very frankly, why should a company which is just a holding company of shares?
No, I don't disagree with the logic, Abhizar, but I'm just saying that given the new, given the change now from the earlier regulations, just purely by a reading of that was the question.
No. So clearly by reading of that, it's very clear. RBI says anything over 1 lakh crore has to be there's no discretion. There is no list. It says that we come out with another list, but that list also has to be within the ambit of, as they say, paragraph 24, which basically says 1 lakh crore. So at the end of the day, 1 lakh crore cannot be breached. Now, what has happened, interestingly, you have to see between 2023 and now. 2023, 15 NBFCs were classified as upper layer. Most of them went to the market and got themselves listed, luckily at a time when the markets were great. Today, the number of companies that fall above 1 lakh crores are mainly 6 or 7. Some of them are already listed. So ideally, some of the NBFCs which were below 1 lakh crore are already listed now because they were in the RBI's October 23 list. So now, frankly, what are we left with in current regulation? 2 things. One is large NBFCs which have not yet listed and figure out how to get them listed. And the other is, let there be a consolidation or a listing within the government entities. Because government NBFCs, the problem is they're normally controlled by some or the other PSU. And the idea is like take the Power Finance Corporation. So our Power Trading Corporation, PTC. Some of these companies need to consolidate, come together, and become much larger infrastructure service finance providers. I see the logic there.
Sandeep, which are the three companies facing a potential exit? I can see PNB, Sammaan Capital. The third one is?
Third one is, I had it somewhere, but I don't, I don't have the name in front of me, but yeah, there are three companies.
There are three companies. And any unlisted companies which may get classified as an upper layer and therefore, because there is that mandatory listing in a period of 3 years.
Yes, so I think all the entrants are actually all the public sector ones. So yeah, so the third is Piramal Finance.
Piramal Finance.
So PNB, Piramal and Sammaan are the exiting companies, and there are 7, all of them are public sector, I think, except one, I guess, Bajaj Finserv. And Jio. Okay, two private and 5 public, which will enter.
Yeah. That, Abhijit, this 5-year lock-in, right? Once you are in the upper layer, so how do you get out?
I think the only way you can get out is applying to the RBI, frankly, because these are all directions of RBI. This is not part of the Banking Regulation Act or not part of any other banking act. It's a regulation of RBI. If you go to RBI and prove, that's what I'm saying, that if you are not taking any form of public finance, then why are you an NBFC? The only way to get out is to declassify yourself from NBFC. Now, all the companies that Sandeep named, except, of course, the CIC company, Tata Sons, all the other companies actually are in the business of NBFC because they're in the lending business. So their ability to get out of NBFCs is difficult. Their ability to get out of being upper layer is there now. But some of them already listed. So very frankly, I don't know. It's only the level of regulation that will now get impacted. When you come to CICs, the only CIC ever classified as an upper layer was Tata. Every other NBFC per the RBI's rules, CIC rather, as an RBI rule is classified as a mid layer. So I think we boil down to this one issue saying, is Tata Sons an NBFC? If it is an NBFC or a CIC, then very frankly, Hobson's choice, it has to list. If it is not one, it doesn't have to.
Will there be, Abhijit, out of the listed companies, right? In your opinion, will this, they will be, I think they'll be regulated to exposure limits, etc. as well, right? So maybe you'll have to diversify. Will there be any issue there? I mean, diversification is good, but it can impact growth as well.
So somebody from RBI told me a few months ago that even if we have for upper layer NBFCs, regulation like banking, if bank is regulated at a scale of 8, the upper layer NBFC is not regulated at a scale of more than 4. So still, I think the regulatory arbitrage even between upper layer NBFCs and banks will remain. Exposure norms will become issues, but the advantage is going to be on the liquidity side, because I think RBI will open up some liquidity window for upper layer NBFCs because of their systemic risk.
I see. Sandeep, you want to add to that?
No, I think Abhijit captured it accurately. I think essentially there will be exposure limit, which will be an issue for at least 2-3 of these entities, which are very specialized entities like REC and PFC, which kind of very focusedly lend to one sector only, and there are group exposure norms which they will breach on day one. So either they will have to kind of have a path to get into other things, which is pretty much opposite of what they were set up for, right?
Yeah.
Or they get an exemption from RBI. It will have to be one of the two for at least 2-3 of these companies, which will not be able to meet with the exposure norms.
Yeah, absolutely. Abhijit, great insights. Thank you very much, Sandeep. Appreciate your time here and good conversation, gentlemen. We'll actually invite PFC, REC, etc. on the program and ask them, what they're going to do. As Sandeep said, they were set up for a specific purpose, sector champions, but of course now they may have to diversify or go to the RBI, seek an exemption. We don't know. We'll have to get clarity. Thank you very much, both of you, for being here. We take a quick commercial break here. 400 points on the Nifty. 23,630 is where we are at. More coming up on the other side. Welcome back. I think we'll focus, of course, on the markets in terms of what's going on. But let's also turn our attention to a sector and get you expectations from the space. So insurance is what we are looking at, right? And we're going to look at what the fourth quarter for insurance companies is going to look like. Ragvesh is with us. He's insurance and capital markets research analyst at JM Financial Institutional Securities. Ragvesh, good morning. Good to have you with us here. Thank you very much for joining us. Just a quick word. I want to first put out what our colleague Yash outlined on Friday, because we put out information with regards to the March data. And this is all source-based information. If we can quickly pull that up, I think I'll be able to sort of outline and contextualize this, because we get the monthly data. We already have January and February. And now, of course, on Friday, we put out what the March numbers are going to look like as well. So HDFC Life, March retail APs, we understand from sources, is down 1%. Axis Max Life has grown 7%. ICICI Pru Life is down 1%. SBI Life is up 8%. Canara HSBC Life is down 3%. So basis this, HDFC Life and ICICI Pru Life will miss their guidance, because if you aggregate January, February, and then now with what we're putting out in March, will miss what they put out as guidance or guided for full year growth. So it's not been a great March generally for insurance companies out there. So that's the March numbers I wanted to quickly contextualize with. Ragvesh, go on. What's your assessment? I'm not sure if you have these numbers that we put out, but how do they change the equation now for the fourth quarter?
Yeah, good morning, and first of all, thanks for having me on the show. While of course the numbers have not been released, but based on our channel checks, there was a sense of weakness in the markets. So why so? Broadly, if we look at the headline AP numbers, they're broadly influenced by the savings business, which are high ticket size as compared to protection, which is a lower ticket size business. Now, what we have seen in this quarter is, and especially so in March, the markets have been volatile. So in volatile markets, the demand for ULIPs, which is the market-linked product, has traditionally been lower. Now, this is something which we have not seen in the mutual funds. If we go back 7-8 years, even in the mutual fund inflows we used to see in weak markets, the inflows used to reduce. In that space, now people are incrementally buying the dip and using the market weakness to make inflows and take the units. That has not happened in ULIP so far. Hence, there was an expectation that with choppy markets, ULIP growth would be weak, impacting the growth. Secondly, on the fixed return or the return guarantee side, when there is an uncertainty in the market, you perhaps do not want to lock in your capital for a longer time. Hence, there was an expectation of a weak growth for the month of March. Contextualizing it for the entire 4Q, what we see is the broad trends, like some of the players, say an SBI Life or a Max Life, which have outperformed on growth for the full year, have done pretty well, even if we consider these numbers which you are putting out. So the broad trend that I can think of is the ones which had done well through the 11 months have outperformed the other two in the last month as well. So no surprises there. Expectation is a single-digit growth for the fourth quarter for ICICI Pru and HDFC Life, which is similar to what I was expecting before. Similarly, for SBI Life and Axis Max Life, growth is expected to be better. Even if I consider these numbers, around 10% kind of growth, 10% plus growth for both of them, with Axis Max Life outperforming. So So I won't say that these numbers are totally out of context, broadly expected.
Apparently, April, for the first 10 days of April, have also not been great, Ragvesh.
Yeah, so essentially what was there in the last month, in March, flows through to April as well.
No, because if the only reason I'm saying is that if March people postponed, right, because of that, on the savings side at least, because of interest rate hike expectations, etc., it should show up in April, right? If it was a postponement. But if April is also weak, How does that square?
See, in April, even though markets were good in the last week, today again we are seeing weakness in the markets. So it's not right to say that people have digested that the worst is over. There is expected to be some volatility, and I think that is showing up in weaker growth. Secondly, I would like to highlight that in April, if you look at every year, April is a very small month. So the sense I get from the channels is typically the agents, the bank salesperson, the bank RM, these guys take some time to start off the next year after the logging in for the last month of March for the year is done. If you just anecdotally, if you think of it, every year in March, people I mean the agents and the insurance companies take that extra time to finalize the accounts. Hence, the first week, 10 days of April are always slow. So I would not extrapolate that yet. What my thought process is, if the uncertainty continues, perhaps 1Q will always also be weak, just as March was. Here I'm highlighting that it was March which was weak, and broadly the quarter was otherwise okay.
And if Q1 also turns out to be a bit subdued, will it be HDFC Life, ICICI Pru, which could be under pressure with outperformance seen by CNBC and Max Financial? What would your expectation be for the coming 3 months?
So for SBI Life and Max Financial, we believe that growth is a lot more structural and less subject to market demand. Specific reasons: SBI Life, heavy dependence on their banca, but that has provided them with a consistent outperformance over the broader private sector for the last 10-15 years. So even if the private sector grows at, say, 10% for the year, I would expect SBI Life to grow at, say, 13-14. The equation turns when the private sector is growing at, say, 18-19%. At that time, I would consider maybe SBI Life still grows at, say, 16-17. So in a year when we expect growth to be weak, I would prefer SBI Life over, say, an HDFC Life or an iPro. Max, on the other hand, has outperformed significantly over the last year, somewhere around 500 basis points plus growth over the private sector. Hence, I would continue to be positive on that name going ahead as well.
So do you want to tell us the pecking order, the stocks that you like, the upside, downside in each of them?
So at this point, I would prefer SBI Life. As I was mentioning, resilient growth. As long as we believe there's uncertainty in the markets, I would prefer SBI Life in the life insurance space, followed by Max, followed by iPro Life, and then HDFC Life. iPro Life is more of a valuation call. But even if growth is weak, we expect the strength of the franchisee to recover to growth in the next few months once the entire volatility is settled.
I wanted to cover one more issue, and this is, I think, also important. In the first quarter of FY27, this is another story that we put out last week. On the 7th of April, we put this out, that in the first quarter, April to June, health and term life policies will get listed on Bima Sugam. And they want to operationalize, I think it's already up, and they want to operationalize it. It's only going to be for customers. It's going to be B2C, not B2B. But that insurers were likely to recommend a reduction in commissions on Bima Sugam, on policies sold on Bima Sugam by up to 90% to the IRDAI. I don't know where that is at, but this is insurers themselves recommending this. Is this going to be a big, how do you read it? Is it going to be very consequential or not so? Costs will come down quite a bit, I'm assuming, if this were to happen. The cost to consumers.
Yes, the cost to consumers should come down, but the key concern there is, even in term life and especially the health insurance policies, there are a lot of specifications that a customer wants. The ability of Bima Sugam to provide those customizations, explain that to the customers, will only evolve over time. So I would not expect a lot of business going through to Bima Sugam today. Maybe going down as the platform evolves. It can take a larger share as all the insurers are there and all of that. But for the time being, I believe that in the term life and health insurance policies, we need somebody to come and recommend it,
But a term policy, Ragvesh, is it so? I mean, it's pretty standardized, right?
The first concern for a person is what is the exact amount I need. For instance, I may have a thought process that as I accumulate wealth over time, the requirement of the sum assured that I need will reduce.
My point is that I don't know how much people for the nuance and what is covered, not covered, and you need somebody, I guess, right? But most people, I'm assuming, go in with, okay, I need this much, and they look for the best possible policy, at least on the term side, health, and even on the health side, right? I mean, isn't it possible if there's a material difference in pricing, people find out from elsewhere the policy that they want, and then they buy, they do the transaction here.
Yeah, that is definitely possible, but I would believe that disincentivizes the person who is making the pitch and who is helping you understand the product. So if the difference is not huge, commissions would not be over the life cycle more than say 15 to 20% of the product. So am I willing to incentivize somebody who has helped me understand my requirement, helped me understand the various products available, and in the end, essentially deny him of the commissions only for a 15-20% reduction in prices on a platform? Perhaps not.
15-20%, Ragvesh, is a lot, right? I mean, I'm just saying that, and this is at the end of the day, if these are standard products, I don't take away anything from, but I'm just saying practically, if the difference is very large, we'll see. As you're saying, you will need some intervention and some help. And by the way, the team behind Bima Sugam, I'm told, is the same team which was behind UPI. So I don't know how, but it'll need to be operationally, very good, and it'll need to be very helpful, I guess, for it to really take off in a big way. But appreciate your thoughts here, Ragvesh. Thank you very much for joining us, and good speaking with you. Well, Nagaraj Sethi of HDFC Securities is with us. Nagaraj, good morning. Good to have you with us here. Thanks for joining in. Your thoughts on the index, Nifty, and how would you trade it?
Hi, good morning, Prashant. Yes, after a massive rally of 1,800 points in the last 6 sessions, Nifty showing some healthy correction technically. I think after the series of low tops and bottoms, I'm expecting Nifty to form a higher bottom this time, a total reversal of that trend. And I'm not expecting a bigger threat this time to the trend. And at the lower levels, at 23,400 to 23,200 is going to be a strong support for the market. In the next few sessions, I'm expecting Nifty to bounce back, and this is going to be a buy and dips opportunity for the market. I have 2 stocks from the long side. First is one from a sugar front, Dhampur Sugar. Chartically has been in a strong up move, higher tops and bottoms. Currently placed at the edge of a breakout of a bullish flag pattern somewhere around 143, 145 levels. Technically, overall chart pattern is looking positive. One can look to buy at the current market, currently around 140 to 30, and immediate upside target would be around 152, and one can place a stop loss at 137. Second one is Auto Ancillary Front, JBM Auto Limited. The stock price has been in a constant run. It has conquered the 200-day EMA hurdle, currently placed around higher levels at 630. One can look to buy at this point of time. And 670 is going to be the immediate target for the stock price, and 610, one can place a stop loss.
Thank you very much for joining in. We're already seeing a recovery. It's been a 100-point recovery from the day's low for the Nifty. The low was 23,550. Now we're at 23,670 on the Nifty Bank. At the session lows in the morning, we were down 1,550 points, and now we managed to recover about 350, 400 points. The entire solar renewable theme is gaining traction. So MV Photovoltaic, Acme Solar, where there is a bullish note today, these are stocks up nearly 3.5%. Ather Energy continues with its rally from yesterday. So that's NTPC Green Energy is another one. We will get into a break. On the other side, we'll invite Manisha Gupta to talk about commodities. Stay tuned. Welcome back. Let's talk commodities. As promised, Manisha is now joining in. Manisha, what are you looking at?
Well, I'm looking at the crude oil prices because remember last week was a 10% decline on that reports of ceasefire between US and Iran. But that seems to have turned around completely because we woke up in Asian markets with 9% of gains for the crude oil prices therein. Well, the US has announced a blockade of the Strait of Hormuz, and US says that they will only target the vessels that are transiting the Strait of Hormuz to and from the port of Iran therein. The blockade will remove estimated 1.5 to 1.7 million barrels per day in sense of Iran supplies there, which clearly has been one of the saving grace for the month of March and mostly for April as well, because those ships have been closing out and moving out of Strait of Hormuz to various Asian destinations therein. Iran also says that any military presence near the Strait of Hormuz would be treated as a ceasefire violation therein. The US-Iran talks collapsed in Islamabad as Iran refused to curb uranium enrichment, leave the control of Strait of Hormuz. This is, of course, by the reports. And then apart from that, it also was about asking their frozen overseas assets given access to in sense of Iran, which US, of course, clearly did not agree to. In the meanwhile, there is some crude coming in out of Saudi Arabia, which says that they have restored full pumping capacity via the east-west pipeline to Red Sea. And they also say that when it comes to the output from the Manifa field, that also seems to be back into the markets therein. But I want to take you through some numbers herein. So when you talk about Strait of Hormuz being shut for Iran vessels, this is what Iran has sent or exported in the year. In last year, it was 1.6 million barrels per day. 2024 was 1.5 million barrels per day. Exactly the number that the markets fear would be out of the international markets therein. Now, this is what Iran has done on a month-on-month basis. So when you look at the month of March, 1.9 million barrels per day. For Feb was much higher at 2.2. So between that month-on-month, it was a 15% of a decline. But even with that, March at 1.9 million barrels per day, it is much higher than what we've seen in December, in November, and for the month of January as well. So this is exactly what the world is losing out at this point in time. Also, when you look at the top oil Iran destinations therein, UAE is where 57% of that went. This is, of course, for redistribution, refining, etc. And then China consumes nearly 10% of Iran exports, Oman at 6%, and then you have Afghanistan, Pakistan, India as well, looking at 2.25% of what we got in 2025, which is slightly higher than what India has been doing in the month of April there. Now, when you look at the top 6 crude suppliers to India for the month of March, Russia clearly tops that list. And then you have Saudi Arabia, Angola. Markets also looking at Iraq, UAE, and US stands at 4.2 million barrels as well. 2026 is heading into a deficit is a report that is coming out from various banks and brokerages. Remember, we started this year with expectations of a surplus anywhere between 1 to 2.5 million barrels per day. But Macquarie now says with 136 million barrels stuck at Strait of Hormuz, that situation clearly has reversed and we are looking at a deficit therein. IEA says that the war has shrunk global oil supply by 11 million barrels per day at this point in time. ANZ says that 9 million barrels per day has been removed from global markets. ANZ also in a report says that 1 to 2 million barrels per day of this perhaps has been permanently removed, is the reason you're looking at $100 a barrel back in case of prices.
Okay, all right. Manisha, thank you very much for that. We'll take a quick commercial break here on the other side. Our special segment, it's the economy. There's what, we'll discuss, of course, the banking and NBFC sector outlook. Latha is in conversation with Suresh Ganpati on the other side. Stay tuned.
Welcome back. Bank Nifty is once again the underperformer today, as it has been for a better part of 2026. Higher oil prices, higher inflation, and higher yields is therefore hurting them. That's for the moment. Lower growth can also hurt if, the quantum of loan growth also starts falling later in the year. How will Q4 numbers pan out? And more importantly, how will the current year, FY27, pan out? Which stocks to bet on? I have a master of this space, banking and NBFCs, to speak to us, Suresh Ganapathy of Macquarie Securities. Suresh, good morning. Thank you very much indeed for joining us. We actually had a detailed discussion on this NBFC upper layer business. It's only a discussion paper. But anybody who's negative because of that, or anybody who's positive, that we should take note of?
No major difference there, Lata. I mean, if you look at it, most of the important NBFCs will still be in the upper layer category. There are some 3 NBFCs who may not really fit the size criteria of about 1 lakh crore. But then anyways, those 3 guys are already listed at this point in time. The critical implication here is what happens to Tata Sons and consequent listing. But again, that's a different picture altogether, right? Because I think the only way they can get delisted, or rather, the only way they can avoid a listing is to get deregistered as an NBFC CIC. Otherwise, actually, nothing material changes, except that for PSU NBFCs, there is an additional kicker or an additional restriction which comes in form of the fact that they need to keep a CET1 of 9%. Many of them are already above that. There are other upper layer NBFC norms in terms of exposure limits. Some of them could be in violation, and therefore there can be a requirement to diversify away the concentration risk, which can affect growth depending upon how much of them is getting violated at this point in time.
Okay. Yep. Just to clarify, for upper layer NBFCs, there is a large exposure framework that kicks in. So, you cannot be exposed to one entity for more than 25% of your CET, of your net worth. And that's what Suresh is referring to. But it's a discussion paper. We have time for that. Suresh, let me come to the more important issue of, as a sector, what does Macquarie think about banking? It was the go-to sector for all brokerages. But with this problem confronting both inflation and growth, do you think the sheen goes away and the distance to higher NIMs just got longer?
Partially, yes. I mean, there is a possibility that the margin improvement that we were expecting in FY27, that gets delayed a bit, or for that matter, that gets extended into FY28. And there could be a rate hike, not necessarily happening in FY27, maybe somewhere later during calendar year 2027, let's put it that way. But having said that, I think you have to look in the context that, Lata, valuations are more than adequately factoring in. Today, you are getting private sector banks at valuations, some of them below COVID, and on an FY28 basis, anywhere between 1.4 to 1.6 kind of price to book, core price to book. Now, if you look at the return on equity that we have got in our models, it's anywhere between 15-16%. I don't see a risk to that, Lata. The only way the ROEs get affected significantly is if there is a worsening of the asset quality cycle. Margins here and there going down by 10 basis points, or loan growth not being at 13 and being at 11 doesn't necessarily move the ROE in a big way. So we really need to assess how the credit quality situation is. As of now, early signals are indicating that things are still very comfortable. Obviously, it's an evolving scenario. We will see how exactly some of those things play out.
Okay. Yeah, that's a fair point. At the moment, maybe it's not yet 90 days to the crisis for us to know about the stress. Yeah. Let's come to the results and the early indication. We have HDFC, 12% advances growth, 14.5% deposit growth. Axis Bank, 18% advances growth. Deposit growth also not bad, 13.9. If you looked at the early numbers, what's your pick of the pack?
So ending into the year, the growth has been strong across the board, specifically loan growth. PSU banks obviously have been slower in deposit growth. Now, my point is like this, Lata. If you look at it, the gap between PSUs and privates is the lowest seen in the history, right? I've covered the sector for 20 years. Never before we have seen the gap being so low. Partially, it's also got to do with the fact that the private sector banks have got derated very significantly. And the PSU banks have, of course, gained market share on the loans front. No, as per our analysis, we do believe that the gap between loan growth and deposit growth is currently existing, especially in the balance sheet of PSU banks, cannot last for more than a couple of quarters. Maybe somewhere around October onwards, either the deposit growth needs to pick up for the PSUs or the loan growth has to come down. More likely, it's going to be the latter, right? So we will see a convergence of loan growth happening there. And to that extent, in that context, with a FY27 perspective, we believe private sector banks at these valuations are better compared to the PSUs, especially when we believe that loan growth for the PSUs have to come down because the deposit growth is much weaker.
Okay. Okay. Let me get bank-wise. The first one that will be off the shelf, I think, will be HDFC Bank next weekend. We have, of course, advanced deposit numbers and then separate statements from the exiting chairman. Overall, what will you look for, and are you positive on the stock?
Yeah. So look, there is a great valuation support, and you're getting HDFC Bank below COVID valuations. So at this price, or at COVID valuations, so at this price, it makes every sense to buy the stock with a 2 to 3 year perspective. I think the single most important metric that the market will be focusing on, not only for this fourth quarter, but also for subsequent quarters, more so for HDFC Bank and then for many of the other banks, would be margins, because it's very clear that the market now wants margins to improve, specifically in an environment where loan to deposit ratios are going to remain high. That's less of a constraint going forward. And obviously, you've had a good deposit growth, right? So deposit growth and margins is something that we'll be keenly looking out for. But having said that, fourth quarter across the board, Lata, will be tough. I mean, I know we have not specifically spoken about the fourth quarter numbers, but I'll take this opportunity that most of them will have a tough environment when it comes to margins. Most probably it will be flat to slightly down because we have had a tight fourth quarter, and you will have to brace yourself with a lot of mark-to-market treasury losses going into 4Q. And YOY numbers look bad because your margin started coming down from 2Q, 3Q onwards. So if you look at 4Q of this year versus last year, the YOY numbers look pretty bad in terms of margins, and therefore would be your earnings growth.
Okay. HDFC Bank has always argued that even if we don't do, pre-merger margins, we will come to ROA to those levels. You don't think that hits off, that if they deliver on ROA, higher ROEs, the margins will be forgiven?
Look, 1.9% is what they are currently reporting an ROA, with a margin on an assets basis 3.4, on an earnings assets basis 3.6%. I do believe, Lata, that they cannot improve their ROA without improving their margins. I think the levers are pretty limited. The OPEX levers, in terms of cost ratios coming down, will take a longer period of time. The real immediate kicker will only come in terms of margins. Okay. And speaking to investors, the clear view is unless and until they show margin improvement, it is tough to argue any of the other triggers being there from a re-rating standpoint.
Okay. Well, what is your pecking order?
We are still sticking, today, the large cap private sector banks are available at such cheap valuations. There is no point in going down the order in terms of mid cap banks or PSU
within
banks.
The large cap, is it Axis first?
No. So we are still looking at today, interestingly, Axis, ICICI and Kotak, all of them are Axis, HDFC Bank and Kotak, all of them are almost trading at very similar valuations. If that indeed is the preference, you'd rather go with the best two ones in the system, which is ICICI and HDFC Bank.
Okay, fair point. I don't know if I'll have enough time to look at NBFCs, but you have not been extremely positive on Bajaj Finance, although they are showing sterling growth numbers, above 20-22%. What's the pecking order there? Is Shriram up there because of the rating upgrade?
Yeah. So look, yes, the growth numbers are still strong for Bajaj Finance, but a point for your viewers here is that 22% loan growth for Bajaj is the lowest seen in the last 15 years, right? Excluding the COVID period. So we keep them on a higher pedestal, and so has been the valuations. But all said and done, whether it is war, whether it is the SME issue, whether it's the base effect, whether it's the unsecured loan issue, the reality of the matter here is that growth this cycle has to be lower for BAF compared to what it has been in the earlier cycle, point number one. And second, it has to come at a lower ROA. You can't sustain 4% plus ROA. So in that context, we remain pretty cautious on BAF. Shriram Finance has a scope for further improvement in ROA. Valuations are at a significant discount to BAF. And growth levels are also actually narrowing, right? Because Shriram's growth is where it is, whereas BAF's growth is coming down. So there is every reason for us to believe that Shriram is a better pick than BAF at this point in time. Yeah.
Fair point, fair point. But more generally, will you prefer banks over NBFCs given the rise in market yields?
Yes. I mean, it's pretty clear that growth this cycle is lower, as I've already said. The risk from all the supply chain distortion is initially greater in terms of NBFCs, where there is commercial vehicle, and all said and done, post the elections, who knows, the government goes ahead and hikes the petrol and diesel prices, right? So we will have some impact on CV sector. So there are a lot of moving parts for the NBFC space, which makes us a little bit more cautious compared to the banks. And banks are still available at a reasonable valuation for the growth and ROE profile that they have got. So clearly banks or NBFCs is my pick at this point in time.
Okay. And within that, you would rank Shriram high within the NBFC space, although banks... Yeah, after
Shriram
banks, it would be Shriram.
Shriram and AB Capital. We are also looking at that. And also insurance. Of course, we've not discussed that, Lata, but insurance sector has massively got derated. I mean, they are also offering reasonable value at this point in time across the board. Yeah.
Okay, yeah, I thought I wouldn't have enough time for insurance, but what is the pecking order in insurance?
We do lag both HDFC Life and SBI Life. HDFC Life has significantly got derated. This year has been pretty much challenging in terms of growth for them. But I think that creates a good base for next year. And I'm just assuming if protection growth sustains heading into next year, we are looking at a good margin upside and VNB growth across the board for the likes of HDFC Life as well as SBI Life. Yeah.
Okay. And just one word in terms of banks itself. Any PSU bank at all? I thought you, actually, even mid-cap banks, weren't you very positive on City Union? So just the banks which we couldn't discuss, RBL, City Union, any PSU bank.
Yeah, I've been very clearly arguing, as I said at the start of the conversation, large cap banks are more or less available at some kind of a mid-cap private sector bank valuation, so no need to go down the order. Okay. We do like SBI, but the only point which I'm trying to drive across, Lata, here is we are at the highest level ROA for PSU banks. I mean, from there you can just go down. You can go in only one direction, which is down, because you need to make ECL related provisions, which surprisingly the market is not factoring in. We may have a tough El Nino environment and what it does to the agri NPA. So my point is the risks are more to the downside than to the upside at this point in time. Yeah, okay. For the PSUs. Yeah.
Fair point. Just a last word. Rupee, of course, has gotten weaker today. Did you hear anything about potential losses for banks because they have they had high arbitrage positions, which Reserve Bank clamped. They had to bring it down before April 10th, and they had to take mark-to-market losses as of March 31st. The SBI chairman told us it is insignificant when we interviewed him, but he couldn't say more because of silent period. What are you picking up?
Yeah, see, look, I think you should not look in losses only in terms of the rupee. You generally higher bond yields would have also resulted in higher losses. The way you should look at it is that this year so far, that is the 9-month number, treasury profits have been very supportive. Whereas 4Q, you're not going to see that. You're going to see pretty dismal treasury profits, and therefore at an operating profit level, things could remain pretty challenging. So heading into 4Q, I mean, don't be surprised if earnings disappoint, mainly on account of much lower treasury gains, or in fact, for that matter, treasury losses. But everything will be done and dusted at the end of 4Q, unless we are looking at the fact that there are more rise to bond yields and potential more rupee depreciation. So,
yeah, fair point. Actually, after the Reserve Bank policy, yields crashed. But as of March 31st, they were standing at 7%. So the banks have been a little unlucky with respect to the rupee and bond prices as of March 31st. Out of time, Suresh, but we hope we will be able to touch base with you as the big banking and NBFC results kick in. Thank you very much for joining us. I just wanted you all to pull out Piramal Pharma. There is a voluntary action indicated by the FDA, which is actually a relief because it's not worse. It's only voluntary action. So that may be positive for Piramal Pharma. And of course, we'll have Ekta coming to explain more about that. You can see the uptick in that stock. Wrap up on Bazaar on that note. Chartbusters coming up.
High-stakes US-Iran talks in Islamabad fail. Iran says the Strait of Hormuz remains open to civilian shipping, but now after fighting to reopen the strait for over a month, President Trump orders a US blockade of the vital waterway, sparking fears of a sustained energy crisis. The market opens with a gap down. All sectors trade with losses.
The United States plans to blockade the Strait of Hormuz sends crude prices soaring back above $100 per barrel mark. Stocks of explorers surge, while those dependent on crude derivatives sink in trade.
Enviro Infra Engineers rallies over 10%, 12% now, as it secures letters of empanelment for execution of 2 projects in Maharashtra worth about 1,000 crores collectively.
And Jyoti CNC's French subsidiary Huron is being investigated for alleged violation of export norms for dual-use technologies. The stock is down more than 10%.
And the government releases new draft CAFE 3 norms as it looks to accelerate EV adoption. The New Delhi policy is also re-released with both offering incentives for electric vehicle adoption. Auto stocks, however, slips on the proposed norms.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And keep an eye out on the bottom of your screen. We have some news flow coming in on HAL. GE Aerospace, they've signed an IAF to set up an in-country depot facility for F404, I think, engine. So, that should be a bit of a tailwind for HAL. And I think that's why the stock has recovered from the day's low. There was some news flow as well with regard to GE in the past few days, which is a positive read-through for HAL. And that's why the stock has perked up a little bit. Remember, on a valuation parameter as well, the stock was trading at around 40 times. After this correction, it trades at far more palatable levels. So I think the valuations as well work in favor. We'll try to get a further clarity on that. But that's clearly a bit of positive news flow, Mangalam. But for the markets on the whole, we're down. But you'll have to say we're not out because of the recovery on the Nifty and because the breadth of the market from less than 200 stocks advancing. Now it's up to around 800 stocks. Crisscross lines getting closer to each other.
It's been a very good day of trade so far if you're a bull, largely because, incrementally the impact of whatever news comes by on the geopolitical front is having a lesser impact on the market. So we opened about 500 points lower, thereafter swiftly recovered about 200 points from there. So 23,555 is an important low that we'll have to track. The Nifty Bank as well, while down about 1,000 points. Obviously, all of last week, we saw a bigger gain on both the Nifty as well as the Nifty Bank. So giving back some of it is not a bigger worry. And despite the geopolitical uncertainty, oil, while it has spiked, it's still holding around levels of 100, far lower than what it was in the peak of the crisis. The only thing that we'll have to monitor as we move along is the put-call ratio ahead of expiry that's moved towards 1.3. But good time to get in Shivangi Sarda of Motilal Oswal Financial Services for a quick technical check on the market. Shivangi, we've recovered from the lows, down about 300 points. Where do we go from here?
Nigel, thank you for having me. So we've seen that markets have reacted quite positively even after the gap down opening, and our markets are absorbing any bit of supply pressure, which is quite positive. And we've seen that even India VIX has cooled off significantly from its highs, and right now it's over 20.5 levels, but overall it has been sinking lower, which is a positive. Now, looking at the overall structure, there might be some bit of volatile cues to continue because of the global cues, but we're looking at buy on decline as of now in the market. And we're looking at 23,450 as an important support base for Nifty, with an upside move towards 24,000 and 24,200 marks. Now, talking about Nifty Bank, we've seen that the smaller banking names have contributed to the recovery here, and especially the PSU name stocks. And we've seen that, Bank Nifty overall has been a little lackluster from the opening zones, but overall momentum is picking up here for the good. And we're looking at 55,500 as the next levels for Bank Nifty, with a support of 54,500 zone.
Okay, got that, Shivangi. What about individual stocks? What are you tracking?
So individual stocks on my radar, first up is Wari Energy. We've seen that this has given a consolidation breakout of the last 15 trading sessions with good amount of volumes adding in today. The kind of follow-up that we've seen from the last 2 sessions is quite remarkable after it surpassed its previous hurdle zones. Overall, we've seen that even on the monthly basis, there has been a very smart recovery in the last 1 month, which has recouped most of the losses of the last 4 months. And overall, this stock looks quite positive, and we're recommending a buy here. Now, the next targets that we're looking out for is 3,500 for Vari Energy with a support of 3,300 zones. And the second pick on my radar is ABB. In fact, the entire space is doing quite well, but this one has been one stock which is kind of giving out bottoming out structure on the positional time frames. And on the daily frame, we've seen that higher top, higher bottom is intact from the last 6 sessions. Now, stock has surpassed its important key moving averages on the weekly basis and thus looking quite positive here. So recommending a buy here. The next targets that we're looking out for ABB is around about 7,200 levels with a support of 6,700 zone.
Okay, all right. Shivangi, I wanted to check the chart on Sarda Energy. You know, we were just talking about it on the show on Chartbuster just last week itself, that Sarda Energy as well as Godavari Power and Ispat, the market capitalization is similar. Though Sarda Energy's EBITDA is much more than what Godavari Ispat does. In the near term, Godavari Ispat will have the tailwind because it's more into steel and it's scaling up the steel presence, while Sarda is looking more at the power side of business. And that one today is looking like it's pulling back. You know, Sarda is up close to around 5% after pulling back more than 15% from the recent top. How's it looking on the charts, Shivangi? Both stocks, by the way, even from a valuation perspective, not very cheap at all. But today it seems Sarda is up and about.
Definitely, you know, Nigel, we've seen that both these stocks have moved, you know, with a lot of correlation in the past, but overall in the recent times, Godavari has consolidated from the last 15 or trading session with a little slightly lack of follow-up buying, even though support base is intact here. Whereas Sarda is, you know, witnessing a good amount of volumes adding up at the price rise, which is kind of amplifying the up move here. So definitely this one is getting ready for a, you know, further up move, in fact, if I may say. And the next targets that we're looking out for Sarda Energy is around about 620 levels. And the support is acting out at 570 zones.
All right, take that point, Shivangi. Thanks a lot for that. Stock up around 5%. We're also seeing some traction in the other parts of the market. What we'll do is take a short break, come back, take note of all those movers on the other side of this break. Welcome back. Just look at a few of the broader market names which are surging right now. Atul Auto is one of them, up 17%. Perhaps one of the beneficiaries of the CAFE norms that have been coming in for the electric vehicles. That stock is surging with decent volumes, just less than 10% away from a 52-week high for Atul Auto. The other group of stocks which are doing well, Zydus Wellness has been a rank outperformer this month. It's up around 25%. So a big move is what we're seeing on that one, backed by volumes as well. And finally, we are also seeing some traction in names like Metro Brands, up around 4% for that stock, higher with volumes backing it too. But the Reserve Bank has released draft amendment directions on the methodology for identification of classifying the upper layer and government-owned NBFCs. What does this mean? Who does this impact? Ritu Singh joins in with more details. Ritu.
Well, these are draft amendment directions that propose changes in how upper layer NBFCs are going to be classified. And the biggest shift is that RBI is proposing to scrap the existing parametric scoring model, which is currently used to identify them, and replace it with something much simpler, where any NBFC with an asset size of 1 lakh crore and above is going to qualify in the upper layer list. RBI is also proposing to remove the automatic inclusion of the top 10 NBFCs into the upper layer. And importantly, the restriction on government NBFCs currently from entering the upper layer is also proposed to be removed. Now, keep in mind, upper layer classification comes with tighter credit concentration norms, so exposure limits coming down to 20 to 25% of Tier 1 capital from as high as 40% earlier. It also involves stricter regulatory, capital, governance, and disclosure requirements. Now, specifically to ease the transition for government NBFCs, RBI is proposing to allow them to exclude the loans that have state government guarantees when calculating the exposure limit. And this is important because many of these lenders have large concentrated exposures to state-backed projects, so they can continue lending to them without breaching this limit, and it eases the transition for them as well. Now, in terms of impact, of course, all of these large government NBFCs that have assets of more than 1 lakh crore, your REC, PFC, IRFC, HUDCO, they can potentially fall in the upper layer list. And on the other hand, smaller players like PNB Housing or Samman Capital that are currently part of the upper layer but have assets of less than 1 lakh crore can potentially move out of the list depending on the final classification. As for Tata Sons, the question mark remains. These changes do not give them any explicit relief, and whether they get an exemption from listing is going to very much depend on what RBI decides to do with their deregistration application.
All right, got that, Ritu. Thanks a lot for that. Well, the government has also released a new draft notification on the CAFE 3 norms as it looks to accelerate the pace of EV adoption. Sudarshan's the man in focus. He's been giving us updates on the EV side of things, even on Friday with regard to the two-wheelers. But Sudarshan, tell us about this recent piece of news.
So over the weekend, government has come out with new CAFE emission norms 2027, and now they are saying that this would be assessed over 3-year blocks. So 3-year blocks, what does it mean? So from FY28 to FY30, or similarly from FY30 to FY32, they'll consider the period of 3 years instead of year on year that was earlier as per the earlier draft. Now, proposed standards are scheduled to come into effect as of now from April 1, 2027. So what are some of the major changes? First, strong hybrid super credit has been cut from 2 times to 1.6 times. Second, explicit 3G CO2 per kilometer concession for small cars has been scrapped. Third, deregulation technologies has been introduced, and which can reduce EV mix compliance by 2 to 4%. And in case of non-compliance, OEMs can buy credits from BEE, that is Bureau of Energy Efficiency, and they can buy credits at rupees 2,500 per gram CO2 per kilometer in FY28, and that increases to rupees 4,500 by FY32. Now, Nomura has come out with a note, and they are saying it can be positive for which stocks and can be a bit negative for which stocks. So first, regulation to accelerate EV adoption. It prefers Mahindra & Mahindra, Hyundai and Sonacom, and believes that latest notification balances the interest of all stakeholders. Now, if you consider the entire volume of, suppose that Maruti, now how much of total volumes they need to have EV to meet the mix? So for Maruti, it's 1 to 3%, Hyundai 4 to 7%, Tata Motors Passenger Vehicle 4 to 7%, and M&M 13 to 15%. Nomura believes changes are positive for M&M and Hyundai. For Maruti, it may need to reevaluate if it is still viable to launch hybrids, and Maruti had an advantage if strong hybrid credits were higher and small cars had got extra credit. It's also positive on some of the auto installers like Sona, BMW, Minda and Sansera Engineering.
Right, Sudarshan, thanks a lot for that. So that's about all the EV adoption plays in today's trading session. But the government has hiked export duties on fuel exports. Sonal joins in to tell us the potential impact that it may have on refiners, city gas distributors and oil explorers. Sonal.
Well, a lot has happened in the oil and gas space. Of course, crude oil prices going above that $102 per barrel mark. Additionally, the duty on export of diesel that has been increased substantially to 55.5 rupees per litre from 21.5 rupees per litre. On ATF exports, it has been increased to 42 rupees per litre from 29.5 rupees per litre. This is done in order to ensure that there are more supplies for domestic market because of the ongoing West Asia war. Now, as far as the oil and gas space is concerned, Nomura has written a note where they talk about war risk premium has returned as peace talks stall. Oil supply may face further pressure if the US enforces a Strait of Hormuz blockade, and a full blockade would impact 2.3 million barrels per day of oil supplies, and that is something which will keep increasing oil prices, and gas shortages, that could be a possibility, LPG especially, considering the Strait of Hormuz is an important transit area for LPG supplies. As far as the increase in export duty is concerned, they say how it would be a positive for oil marketing companies, because remember, standalone refineries like MRPL, for instance, it exports 40% of its diesel and ATF, and that would now be routed to the domestic oil marketing companies for it to be sold in the market further. So they say Reliance's export refinery is likely exempt. Only the domestic units would be impacted, and the export refinery around 50% of their overall refining volume, so the impact could be limited. Standalone refineries will send OMCs at lower post-tax prices because it has been capped, the refining transfer pricing. So it will be a positive for oil marketing companies because they'll keep getting the inputs at a cheaper price, and this could reduce the procurement costs for OMCs. And HPCL may benefit most because they have the most amount of external sourcing. So, but the crude oil price hike is something which could continue to be negative for oil marketing companies.
All right, thanks a lot for that, Sonal. Well, on that note, though, we'll slip into a short break, come back, continue our focus on stocks that are moving around. Welcome back. You're tuned into Chartbusters here on CNBC TV 18. Well, the rupee crossed the 93 mark and it's down close around 0.5%. Given the higher crude prices and the likely prolonged blockade of the Strait of Hormuz. Lata joins us to fill us in with an analysis on the rupee's move. Lata?
Well, the failure of the weekend talks has created a bit of a red across the screen, the EM currency screen, but we are the second most weak currency, losing about 0.7%. Of course, the more important part is the psychologically important 93 mark was crossed after the Reserve Bank put its controls on long positions. We were south of 93 for a good few days last week. Now we crossed 93 and it crossed 93.30 pies, 40 pies to buy a dollar. Philippine peso has fallen even more. It's about 0.8, 0.9% lower. See, all these countries are impacted if the Hormuz Strait is closed. Philippines is very badly impacted. We also will be badly impacted. The other point dealers tell us is that actually the Indian market went short on dollars on Friday, assuming that something positive can come from the US-Iran talks. So that short covering also led to dollar becoming expensive. Also, of course, let us remember, banks selling long dollar positions up until April 10th ended because that was the Reserve Bank's deadline to bring down excessive positions. All told, the expectation is that now the Reserve Bank may start coming in. Some people are suspecting that at 93.4, public sector banks were supplying dollars, may have been on behalf of Reserve Bank. That said, the fundamentals are clearly stacked against the rupee. Further weakness is to be expected.
All right, further weakness is to be expected. It will be very interesting to see the impact of that on the equity markets and the flows as well. But let's get an earnings preview coming in thick and fast. We have our special Quarter Se Quarter Tak segment, and the life insurance sector is on our radar with what the street is expecting. We have Yash joining in. Yash.
Well, for the life insurance industry, it's likely to be a quarter where growth slows down and the focus clearly shifts as far as margin performance is concerned. In the fourth quarter, where January and February was strong for life insurance companies, the month of March is where things really went wrong for life insurance companies, particularly the last 15 days. The biggest hit could be seen for HDFC Life, where individual annualized premium equivalent or individual APE in the month of March will be seen dropping by about 1%, which is expected to slow down the entire year FY26 retail APE growth to just about 8% as against the company's guidance of 13% growth. A likely 500 basis points miss as far as that guidance is concerned. From the worst hit to the least hit, Axis Max Life Insurance retail AP in the month of March is expected to grow at about 7%, which will bring FY26 retail AP growth to about 19%. The management had guided for a growth which could be about 400 basis points higher than the industry. And this means that Axis Max Life is expected to sort of surpass its FY26 guidance by at least about 300 basis points. For ICICI Prudential Life Insurance, retail AP growth is likely to be dropping by about 1%, which will lead to a year-on-year drop of 1% in its FY26 retail AP itself. The company had guided for doing better than the industry, which is expected to be a growth of about 12%. ICICI Prudential Life on that metric with just a 1% drop in its FY26 retail AP will miss that guidance by a big about 12% as far as the full year itself is concerned. Finally, when it comes to March, the next company is about SBI Life. As far as retail AP in the month of March is concerned, that is expected to grow by 8%. What that does is FY26 growth comes at about 13%, just achieving its FY26 guidance of 13%. Finally, Canara HSBC Life Insurance, in the month of March, the growth is expected to drop by 3%. There is no specific guidance, but for FY26, the actual number in terms of growth will be about 19%. As I said, there are various reasons why growth has been slow, geopolitical reasons, and equity markets underperforming because of that will have its impact on the ULIP portfolio, which are the chunky premiums which life insurance companies get. Indication of interest rate hikes leading to people postponing savings policy rates. They'll be able to lock in a higher rate, and the expectation is postponing those sales. Finally, the third point, as far as the sentiment itself is concerned, due to the geopolitical factors, people are avoiding any sort of financial commitments. All of this impacting the growth in the fourth quarter. And as I said, the entire focus will now shift on what kind of margins do these companies derive from that slow growth in the quarter.
Okay, all right. Thanks a lot for that, Yash, for joining and giving us that key expectations from the sector. By the way, just take a look at some of these stocks. They moved to the high point of the day. Sarda Energy, the stock that we had spotted earlier, the stock is firing away, and the volumes are very large. I think we should get that one up for you on the screen. Stovecraft, a stock that was actually in the red, that's moved into the green, so keep an eye out on that. A big underperformer. That's spiked up in trade. Eternal is another name actually that's done pretty well. So I think we should get that one up for you as well on the screen. And I think, you have KPI Green. That's another power-related name. Sharp correction from the top. That stock has spiked up in the last few minutes. I'll tell you what, we'll wrap up on this edition of Chartbusters. That's it from Mangalam and myself. The team of Trading Hour takes the action forward.
Good morning. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me as always, Hormas Vatakia as well as Ritu Singh. Down 300 points for the Nifty. After a good week, all of last week, hopes of peace. And then there were failed talks. The market opened nearly 500 points lower. From there have been a 200-point recovery. So we're down, not necessarily out. The interesting part, however, is that the advance decline ratio, we have 5 times the number of stocks advancing right now as against what was at the start of trade. And those lines are coming closer. The VIX is higher, and as is the India put-call ratio. The only thing we have to monitor as we move forward towards today's trading session is the expiry that plays out ahead of the holiday tomorrow. So Ritu, there is a solid amount of uncertainty which is playing out, but maybe the market's now beginning to live with it.
Yes, live with it. In fact, a bit of a recovery in the last hour. I mean, we're still very much in the red. The sell-off is very broad-based. Almost all sectors are in the red, but a bit of a recovery from the kind of lows that we saw at the start of the trading session. Leading the sell-off, of course, we have the Nifty PSU Bank, Nifty Auto. They've fallen by nearly 2% odd or more each. The Nifty Bank also leading the fall, 1.73%. That's where it's currently at, down. And both the frontline indices also down 1.3%. But that said, it is a bit of a recovery. The advanced decline ratio you were pointing at, we started the day with nearly 3 stocks declining for 1 stock that was advancing, or even worse, actually. Now that's come down to about, less than 2 stocks are declining for every 1 stock that is advancing. But yes, a lot of factors in play, a lot of movers and shakers as well. Hormaz, good morning to you. What are the top names to focus on in trade?
Morning, Ritu. And today being the weekly expiry of the Nifty, considering tomorrow being a holiday, you would expect some volatility to come in the second half of today's session as well. But nonetheless, it's been a 200-odd point recovery that you have seen from the morning lows, at least in the first couple of hours of the trading session. Well, the Nifty Bank, though, it's a 1,000-point cut today. But then, of course, the index was up almost 4,500 points last week. So giving up some of that is only par for the course. This, too, has recovered, well, almost 450 points from the lows of the day. It's still a 1,000-point cut nonetheless. And the currency too has seen some bit of depreciation in line with the weakness seen in the risk assets. The currency at 93.28 has been at similar levels ever since it opened. And oil prices, of course, seeing a rebound above the $100 a barrel mark. You take a look at the green energy stocks in today's trading session. NTPC Green, 7.5% higher, among the top gainers in the broader markets today, still below its IPO price though. Acme Solar, a positive brokerage note coming in from HSBC, is up 6, and MV Photovoltaic too saw a positive brokerage note last week, is extending those gains, now up 4%. Look at the electric mobility names. They were doing well last week. They're continuing from where they left off. Ather Energy is now 900 rupees. 5.5% higher. Electra, Greentech and JBM Auto too continue to move in tandem with each other. You take a look at the newsmakers today. Tata Chemicals at one point was up 11-12%. That has given up half of those gains. We're still holding on to gains of around 6%. Jyoti CNC, after the news regarding its French unit, 13% lower on the stock. The top loser in the broader markets today. HPCL, of course, in line with the oil prices, and Atul Auto, one of the key beneficiaries of the CAFE norms, the draft norms that have come in, 16% higher on that stock. PSU banks are not doing well in today's session, as you pointed out. All of the constituents trading with losses ranging anywhere between 2 to 3.5%. And lastly, some stocks that are bucking the trend in the broader markets today. Zydus Wellness is one such name. The stock is up around 6 to 7%. It's seen a similar move recently as well, 9% higher in today's session. DW Development too doing well, 7% higher, and Sterlite Tech continuing from where it left off last week, another 5% circuit in today's session.
Right, take that point. Thanks a lot for that, Hormaz. Those are a bunch of stocks which are buzzing around in today's trading session. But we do have a lot of the auto stocks which are on our radar as well. The Delhi government released the draft Delhi electric vehicle policy, which is for the next 5 years, laying out an ambitious roadmap to accelerate electric vehicle adoption across the capital over the next 4 years. Let's go across to Sudarshan for the details. Sudarshan, Ola is lower, all the others are higher.
So now we know the reason why in the last 2 to 3 weeks we have seen a big move in all the major names which have exposure to electric vehicles. Ola in the last 2 weeks had seen a jump of almost 70%. But now if you go as per the Delhi electric policy draft that they have released over the weekend, it talks about that it has increased the price level for which that incentives would be applicable. They have given for electric two-wheelers rupees 2.25 lakh. That's the reason all the other names are higher, while Ola Electric has slipped in today's state. So first, I'll talk about what's the rationale behind this policy. First, to curb the pollution. Second, accelerate transition to cleaner transport, and focus on cutting emissions that form almost 23% of Delhi's pollution. So now in the details, draft has offered incentives like 100% road tax waiver for electric cars, and will be expanding charging infrastructure, building a stronger EV ecosystem, and encourages a gradual move away from petrol and diesel vehicles. So first, for EV cars up to rupees 30 lakh to get 100% exemption road tax and registration, and those incentives would be valid till March 31st, 2030. Vehicles priced for rupees 30 lakh will not be eligible for those incentives, and Sorry. Also, the draft proposes 50% exemption for strong hybrid vehicles. Now, coming to electric two-wheelers. Incentives for electric two-wheelers with ex-factory price up to rupees 2.25 lakh. In the PM E-Drive scheme, that is around 1 lakh rupees. So, this is beneficial for all the companies like Ether Energy and all the even TVS and Bajaj Auto. And for this, in the first year, incentive is up to rupees 30,000. In the second year, 20,000. And third year, that reduces to 10,000. For electric three-wheelers, from January 1, 2027, only electric three-wheelers will be allowed for new registrations as far as Delhi is concerned. And incentives for this in the first year is 50,000, second year 40,000, in the third year 30,000. For school fleets, they have given the phased out electrification, so 100% electric within 2 years, 20% within 10% electric within 2 years, 20% within 3 years, and 30% by March 31, 2030. As far as government fleets are concerned, all hired and leased vehicles will be only electric except exempt categories, and that will be effective once government comes out with the norms. Now, fleet operators, they have put out certain restrictions, will not induct new petrol or diesel vehicles after government notifies the timelines, and there will be limited exception for certain categories till December 2026. And how will they do it? They have talked about EV charging and swapping infra. So land owning agencies will identify sites for public charging and battery swapping stations, and all new buildings and infra projects must have the EV charging ready. So it's the clear indication from Delhi government to move to electric vehicles ASAP, whether it's about electric two-wheelers, electric three-wheelers, also EV cars.
Sudarshan, thanks very much for bringing us that update, and we hope you give your throat some rest and get some water. Names like Ather doing very well in trade today on the back of that news, near their all-time highs, up strongly as we're seeing in this session. But let's move on. Acme Solar is also seeing some gains following a bullish note from HSBC, while Torrent Pharma is in the green following a US FDA clearance for its key oncology unit. Vinny Motiwala has been tracking all of these names and joins in with the details. Vinny.
Hi, good morning. So first up, Acme Solar, one more solar company that's seeing a positive up move. On Friday, we had a couple of other names which were buzzing because of an initiation note kit that came in from JM Financials. Now, today we have a note that's coming from HSBC. They've initiated coverage on Acme Solar. Target price is 350 rupees per share. What is the company highlighting? One, India's power industry, that's growing. Renewable energy, that's been in focus as well. And that is what will lead to the growth for Acme Solar. And Acme Solar is one of the fastest growing companies, vertically integrated company in terms of producer for renewable energy as well. They have 6 gigawatt contracted capacity, which gives them long-term earning visibility, as well as the FDRE, that's the renewable projects, as well as BESS, that will improve the returns for the company. So what HSBC is forecasting, that the EBITDA growth would come in at a CAGR growth of 72% over FY26 to FY28. So in terms of growth, financial visibility, order book visibility, it's very strong, and that's why they're positive on this one. Now for Torrent Power, what we're seeing is coming in is that the US FDA has concluded one of the inspections in an important oncology facility for the company that was in Bileswarpur with 0 observation. So this is positive. The inspection was carried out between 6th April to 10th of April, and this facility plays a very important role in the oncology portfolio for the company. So in terms for the global market, more drugs coming out, oral oncology drugs that will come out from here as well. So key for Torrent Pharma, and that is why it's buzzing in trade.
Doing well for itself is both Acme Solar is up now 5.5% higher, as we just highlighted, and Torrent Pharma too, doing fairly okay for itself in what is an otherwise wobbly and volatile market. By the way, Enviro Infra is up 12%, among the top gainers in the small cap index in today's session. So good going for that stock as well. Take a short break, put the spotlight on the bond markets on the other side with Manisha Gupta. Welcome back. Shifting focus now to the bond markets. Manisha is here with all the latest from there. Manisha.
Thank you so much for that. And as we look at the Indian bond markets, well, they have opened 5 basis points on a lower side. And that is because the whole trade setup seems to have changed. You have the Brent crude prices, which is back above $100 a barrel with nearly 8% of gains. And then you also have the talks between the US and Iran failing to reach any consensus. This is exactly opposite of what we saw in the previous week for the bond markets, where the Indian government bonds ended the previous week as the best in nearly 6.5 years. The neutral central bank policy aided the sentiment, and so did the fact that the crude oil prices had declined by 10%. The Indian rupee put a second straight week of gains, and the Indian equities put the best weekly gain in 5 years or so. But that, as I said, has completely changed at this point in time. The likely central bank buying is something that the markets are looking at right now, and which is expected to be better than what the street was looking at. The 10-year bond for India is on the positive side. Also, Indian markets seem to be waiting for the CPI data today, where there's an expectation of 3.4% for the month of March versus 3.2% in the Feb, and the core inflation is likely to be staying below 4% therein. So that's going to be an important number that the money markets will keep an eye on. Take a look at the corporate bonds then, and the bonds maturing in up to 5 years seem to be doing well here. In the secondary market, NSE and BSE, that is, as you can see, between Friday and Thursday, Friday has seen a very sharp decline coming into the markets there in sense of total volumes there. Also, when you look at the corporate bonds, the most traded in the market have been NABARD. It also has been Lucina Land Development, Piramal Finance, and Hyderabad Metropolitan Development Authority. No new bonds in the last couple of days have been announced from boards of corporates. So that is something that the markets are missing at this point in time.
Right, Manisha, thanks a lot for that. So those are a bunch of trends coming in from the bond prices. Bond prices are lower as oil flares up. We'll take a short break, come back. The new rules for NBFCs is the CNBC TV18 big story of the day. We'll get you the details of that and what it means for the sector with AM Karthik of ICRA, Sanjay Doshi of KPMG.
Welcome back, and it's time for a big story of the day here on Trading Hour, and that is RBI's proposed new norms on how large upper layer NBFCs are now going to be classified. And there are significant shifts that RBI is proposing that is going to have repercussions for a lot of existing NBFCs, starting with the big shift, which is earlier, upper layer NBFCs would be classified as upper layer on the basis of various scoring models, which was parametric. It was based on qualitative and quantitative criteria. Now, RBI has proposed to scrap that and come up with a simple system, which is to look at the asset size. So if an NBFC's asset size exceeds 1 lakh crores, they will qualify to be an upper layer NBFC. The second change is that earlier, the top 10 NBFCs would automatically fall in the upper layer bucket. Now, that is proposed to be done away with. The third big change is that government NBFCs so far were not were not exempt from being classified as an upper layer NBFC. That also is proposed to be removed. However, keep in mind, a lot of these government NBFCs have significant exposures to state government-backed projects, and therefore, to ease that transition for them, RBI has also proposed to exempt the fully guaranteed state government exposures from the computation of their exposure limits to ensure that there is no breach in these limits as they transition. These are still draft proposals. Final norms will be drafted only after comments are invited by the 8th of May. Keep in mind, for an upper layer NBFCs, the regulations are tighter, the capital exposure norms are tighter, there is greater disclosure requirements, governance requirements. So a lot of these NBFCs therefore are going to be impacted. What happens to the fate of Tata Sons? That has been the question. Well, not much changes because of these rules. It will simply now still continue to depend on what RBI decides to do with their deregistration application. But for a lot of these government-owned NBFCs like PFC, RFC, IRIDA, HUDCO, etc., they could potentially be included in this list because their asset size far exceeds the 1 lakh crore threshold. But joining us today to discuss these proposed overhauls for the NBFCs are AM Karthik of ICRA and Sanjay Doshi of KPMG. Gentlemen, thanks very much for joining us here. Karthik, to begin with you, specifically on the government-owned NBFCs, the likes of HUDCO, PFC, RFC, etc., the state government exposures are significant. Even with the exemption that has been provided, do you think some of them could still be in breach? And secondly, and I'm talking about the likes of HUDCO that don't only have government-backed exposures, IRDA, that don't only have government-backed exposures, and does it also effectively neutralizes, the stricter rules that come along with being an upper layer NBFC?
Yeah, hi, thanks. The government-owned NBFCs will easily qualify for the upper layer. There are two things which have come up. One is, the classification versus the asset size, based on which all these entities will classify for the upper layer criteria. The exemption has been provided specifically for the concentration norm, which applies to an IFC depending upon whether it is in the middle layer or the upper layer. So the points that you talked about specifically on the state government related exposure and the exemptions from a concentration norm perspective, which was applicable at the middle layer level, is also applicable now to the upper layer entities, which is a change that the RBI has done with the draft regulation. But more importantly, what has changed is that when an entity is moving from middle layer to upper layer, the concentration norms which are applicable for an IFC in the middle layer were 35% of tier 1 and 30% of tier 1 and 50% of tier 2 from a single and a group exposure point of view. So that will get tightened when they move to the upper layer entity. So the group exposure norms, which were about 50% of tier 1 when they were in the middle layer, becomes 30% of tier 1 in the upper layer. But at the headline level, we don't estimate that to be a major concern at this point in time, because a lot of these entities do have a sizable guaranteed exposure, state government guaranteed or the central government guaranteed.
Except IRIDA, Karthik, though. But Karthik, IRIDA has, I think, almost 71% private concentrated exposure, not government. What happens to them?
So we'll have to look at it. Basically, most of them are significantly below the levels which are stipulated even now. So we'll have to see essentially what will be the impact. But headline should not have any major impact on any of these entities.
Sanjay, what is your reading? I mean, even the fact that government-owned NBFCs with these large exposures are getting all kinds of exemptions to ensure that their transition is easier, does it uneven the playing field between government and privately held NBFCs? And overall, do you think just sticking to the asset size of 1 lakh crore as the threshold, does it risk diluting some of the risk sensitivity, the interconnectedness, etc., parameters that would have typically been looked at to qualify for tighter regulations?
Sure, Ritu. So, see, there are two parts to it. So, one is, of course, all these regulations is kept in mind with the systemic risk
if any particular institution is bringing to the market, and hence how you really mitigate it. Now, when you look at this entire thing around, as you were putting it, and as Karthik mentioned, around the state government loans, etc., right? So there are two parts. One is the exposure norms, and has to have to really cover from a capital adequacy perspective. From an exposure norms, anything which is guaranteed by the government or state government, I think the treatment is the same, whether it's for private or whether it's for public sector NBFCs, where they are excluded to the extent there is guarantee available. But for state government guarantees, there is a requirement for a capital to come in. So effectively, it's been there. And hence, is it going to really, this particular draft, if it becomes a regulation, is it really going to make a material change? The answer is no, definitely in a short to mid-term. But longer term, I'm sure, I think slowly and steadily, there will be a direction where do you really need this kind of guarantees, or you really want to bring public sector entities and private sector entities completely to market factors. So that's the other perspective to it. But net, we don't really expect a major mid to long term change, mid to short term change in terms of any such transition or change happening.
But Karthik, the draft also speaks about the fact that there will be a proposed 5-year review cycle for the upper layer asset threshold. And currently, out of the 15 upper layer NBFCs, it's only Tata Sons that is not in compliance with this 3-year mandatory listing norms. It is supposed to be listed by September. But now, do you see that with this, there have been experts who have told us that this would not impact Tata Sons, and they have options with them as well of declassifying themselves as an NBFC. Does that option still lie on the table for them? And if so, what can Tata Sons do otherwise to navigate this listing criteria?
To comment on the entity specific question, but it's up to the regulator and the entity to decide on the way forward. But going by this new regulation, it's completely dependent on the asset size, and the asset size qualification applies for Tata Sons. But we'll have to see how it is worked out. So it's entity specific. I think it will be between the regulator and the entity to decide on how they navigate through this. But having said that, we'll have to look at the 5-year life cycle, which is applicable for any upper layer entity. So the transition which is applicable for an entity to be, once it is classified an upper layer, it continues to be an upper layer for a period of 5 years. And also there is an option at the regulator to look at entities which are moving towards upper layer. Right? So entities which are not qualifying for upper layer but will become an upper layer definition maybe in the near term. So they typically tend to sensitize those entities. This is part of the regulation which is already there in place. So typically tend to sensitize and see what is the way forward if the upper layer becomes applicable for these entities over a period. So these are all discussions which happen between the regulator and specific entities, and things which is completely between the two, and they decide on the way forward. So difficult to exactly comment on what will be the way forward for a specific entity that you brought about in the question.
No, we take that point, and periodically as the economy grows, as these entities grow, etc., these norms need to be revised as well. But one more point, Karthik, which as of now do you see outside of what is there in the upper layer and what has been discussed already in the unlisted space, do you think could make the cut in the very near future? Do you have any guesses out here? Any calculated predictions that you can make?
I think all of them are listed, which may qualify for this criteria at this point in time. So we don't see any unlisted entity which will make the cut. We'll have to see how the RBI transitions on the entities which are currently there in the upper layer category, but may not necessarily make the cut of 1 lakh. They do have the time of till September 27, when the 5-year timeline lapses for some of them. And that the RBI and those entities which are currently upper layer and not possibly making the cut which the RBI is proposing on the asset size, they will decide on on the way forward. So not on the unlisted space which can make the cut and and not be listed at this point in time.
Sure, that's PNB Housing and Sammaan that are below that 1 lakh crore threshold. But keep in mind, they have a 5-year window from 2023. So it's not that they will immediately exit, even if these guidelines are implemented as is. But Sanjay, a final question. Some of these smaller NBFCs that are perhaps significantly below or just below that 1 lakh crore threshold, do you think we could see some active balance sheet management to ensure they remain below it, for the time being, to avoid tighter regulations, especially, when it comes to bank-like regulations for these smaller NBFCs? Do you think they'll actively manage their balance sheets to avoid doing that?
So active management, I think slowly and steadily, it's going to be a group level exposure. Means how do you actively manage is effectively, do you really want to go off balance sheet, which ideally people and especially larger NBFCs like to have loans on their balance sheet, number one. Number two is, can you split and have multiple NBFCs? Again, that has a lot of restrictions. So their ability to maneuver and keep the balance sheet size lower effectively will not work in a mid to long term. Short term, maybe they can try to do a bit. So the reality of life is for them to really accept it and start preparing to get into the upper layer NBFC. I think the other point which you all also highlighted is on, and if I don't want to go into specific entity as Karthik mentioned, is that the entire core investment companies, right, the CICs, how RBI is going to look at CICs which are really above that particular size of 1 lakh crores. Are they really bringing risk back to the market in terms of a systemic risk perspective, from a public funds perspective? So I think the decision making will really lie whether a CIC, however large it is it something which the group really wants to have or the shareholders wants to have effective control within their own subsidiaries and within their own groups, and hence they are not really bringing any kind of systemic risk to the market. So then should they be registered and hence should be an NBFC and hence should be an upper layer or not? So two aspects. One is, yes, anything which is slightly less than 1 lakh crores, be ready. Start getting your act ready in terms of preparing yourself for the tighter regulations which are going to come in if this becomes regulations. And the second one for CIC is really make a decision whether they want to or they should become an NBFC or not if they don't have any risk from a public funds perspective.
Yes, and I believe the CIC are referring to as Tata Sons. We'll have to see what happens to their deregistration application. But Karthik, Sanjay, both of you, thanks very much for giving us your time here and helping us understand these important regulatory changes for NBFCs. On that note, we're going to slip into a short break. But when we return, we're going to discuss market technicals with Somil Mehta of Mirae Asset Sharekhan and also discuss his top trading ideas.
Welcome back. You're watching us here on Trading Hour, and this is the update coming in from the FNO desk. Given tomorrow is a trading holiday, it is weekly options expiry today, and ahead of that, and given the sort of uncertainty that we're seeing globally, there is weakness in the market, though that weakness has been, ameliorated. We've seen recovery from the lows, nearly 200 points for the Nifty, a little more for the Nifty Bank as well from the lows. The mid-cap index too, currently lower by just about 330 points. The advanced decline ratio, if you notice, the lines have been coming closer to each other through the course of the day. Though there are more stocks which are declining than the number of stocks which are advancing. The number of stocks which have advanced have only increased as the days progressed. And that brings us to the levels that the street is working with this time around. If you look at the 23,600 put, that has seen a fair amount of writing, premium of almost 20 rupees, telling you that that's an important support zone to watch out for. 3 crore shares in open interest out there. 23,500 puts as well, seen a fair amount of writing. The premiums all but eroded 3 crore shares out there as well. The 23,700 put too is equally active right now as we speak, 50 rupees. So 23,650 is an important support to track. But on the way up, crossing the 23,800, 23,900 may prove to be a bit of a resistance. Why do I say that? Because, there have been some call writers active out there. Today's low marks an important level to track as we move along through the next few trading sessions in terms of the uncertainty that we navigate. But among the stocks that are doing well, the power theme seems to be standing out in today's trading session. Tata Power and Adani Power, both of them seeing a lot of long positions being added. We've also seen some short covering in the likes of Voltas. Remember, the departments, the weather departments have spoken about a heat wave over the next 2 weeks or so. So to that extent, Blue Star, Voltas would be stocks that we'll be tracking because they've been beaten down on fears of a weaker than expected summer this time around. So would the heat wave help their cause or not is something that would reflect the way these stocks move. As of now, shorts caught on the wrong side, those stocks buzzing around.
Indeed, doing well for themselves are these names. Mangalam, thank you for summarizing that for us. Now, Saumil Mehta from Mira Asset Sharekhan is now joining in for a quick chart check. Saumil, good morning. Thank you for joining in. This fall that you have seen today is seeing a recovery from lower levels, yes, but is 23,500 a realistic possibility at this time, or do you stay with that low of today and then you move back towards 24,000, 24,200? Your call on the index and your stock recommendations as well.
Good morning to everyone. The first point I would like to make is that the overall trend is still negative. We're making low top, slow bottom on the monthly, quarterly charts, and crucial levels on the upside are not broken yet. We are still trading below 200 daily exponential moving average. There are some very crucial trend lines which are broken on the index level and on large caps as well. Now, if we are talking about very short term, the crucial level in the very short term is 23,500. Yes, of course, that is 10 daily, very close to 10 daily exponential moving average for Nifty. And crucial resistance is 40 daily exponential moving average, which is close to 24,000. I'm not expecting markets to go above 24,000 at this point of time because the overall trend is still negative and we have open gap down today. And I'll be expecting markets to go down till 23,200. That will be my first target. And if it does not sustain about those levels, then 22,250 is absolutely open, which is the previous swing lows. So view in the medium term, in the short term, now becomes negative, and I'll be expecting lower levels. Same with Bank Nifty as well. The crucial levels would be 40 daily exponential moving average, which is the resistance, around 55,700, 750 levels. And I'm not expecting markets to go above those levels. And my targets right now in the very short term would be 53,500. My two stock calls would be on the sell side. Both are already in the downtrend, and today it has open gap down as well. The first one is Eternal. Eternal is already in the downtrend, taken resistance at upper Bollinger Band on the daily charts, 40 daily exponential moving average, and today it has started the downtrend. My stop loss would be 247 on the sell side. Targets would be 220. The second call would be Indigo. Indigo has had a very good bounce back, has taken resistance at crucial levels, crucial averages, and again started a downtrend. Stop loss would be 4,580 and target would be 4,000.
All right, Somal, we'll leave it at that. Thanks very much for joining in with your views. We have to slip into a short break, but up next, we're going to discuss market fundamentals with Shehzad Madon from TCG Asset Management. Stay tuned. Welcome back. You're watching Trading Hour. Let's get you a quick check on the macro signals. The market's still very much in the red for the frontline indices. It is down by about 1.2%. But that said, you do have the Nifty near the high point of the day. So some recovery building in. But the rupee, that's been weak today. One of the weakest Asian currencies. In fact, now down about 64 paise against the dollar, currently at about 93.37 is where it's trading. Remember, today is also the first day after that 10th of April RBI deadline on the $100 million cap on the net open positions for banks. That is now behind. But today you're seeing pressure also because the dollar index has strengthened overnight. The primary reason, of course, for all of that is the decline in, escalating geopolitical, no decline rather, in the tensions in West Asia, the collapse of peace talks, the subsequent US naval blockade, all of that is adding to the tensions. And that's also sent, some of the oil prices, they were up almost 8% overnight. The Brent is now higher by almost 6.7%. They've reclaimed that $100 to the barrel mark with the blockade threatening to curb up to 2 million barrels a day of exports. So, the 10-year GSEC yield, though, that's also under pressure. It's jumped about 5 or 6 basis points today, which is, of course, a direct reaction to what's happening on the oil price front. That has also rekindled worries about imported inflation for India. And the rupee weakness, of course, is adding further pressure. Markets now are going to take their cue from the CPI data that will come in later today. That will come in after market hours. It is expected to show an uptick to about 3.46% for the month of March, according to a CNBC TV 18 poll. So that's as far as the macro setup is concerned. But let's go across to our guest. Shehzad Madon from TCG Asset Management joins us now to discuss market fundamentals and his top sectoral picks. Shehzad, thanks very much for your time here on Trading Hour. With this on and off in trade, in tensions in West Asia, What are the sectors you think are safe spots for investors? What are the areas you're staying away from? Capital goods, some of these sectors, Equitas, these are your top picks. But where are you seeing opportunity in the current highly volatile environment?
Ritu, good morning. Thank you so much for having me on my show. Pleasure being here. Well, we've got different portfolios addressing different segments of the market. So one of the portfolios which we have, which is the investment opportunities portfolio, something which we've been running actually for a little over a year. We play various themes in this, which include, among others, something on the energy transition. And of course, it's become hot and topical at this point in time, but this is not something which we're looking at it. We believe this is a longer term theme. This has continued and is likely to continue going forward for the next very, very many years, very, very long runway for growth. Another theme which we're playing is on the digital infrastructure. We think the build out which you are having, while it has again become more common at this point in time, but the build out which you are likely to have on account of your data privacy and you controlling your data sovereignty is something which is going to play out. Defense is something which we are very, very positive on. And please, I just want you to see when we talk about these sectors, it appears that it is very topical, and this is the reason why we're talking about it. But the point is, this is something we've been running for a little under 18 months, and we believe that these themes, not just now, but are likely to continue to go forward very, very strongly. Further to that, the manufacturing, mobility, urban infra, those are some things which are continuing. Those themes, to our mind, will continue to play out very, very strongly. Right? So that's in one of our portfolios. We believe this is multi-year. They have been the fastest growing segments of the market and are going forward to, in our opinion at least, likely to be by far the fastest growing segments of the market, simply because that's just the way the geopolitical situation is worldwide. This is just the way it is, and it's not likely to change in the foreseeable future.
Shahzad, good morning. Thank you for joining in. You mentioned mobility, and a lot of these green energy / mobility / renewable energy names have been on a tear all through the month of March, even in the first bit of April as well. Say the likes of the JBM Autos and the Olectra Green Techs and the likes. Anything from that space that you like, or do you stick to the tried and tested renewable energy players, the Premiers and the Varis, because that is a segment would also get more prominence, especially considering the energy crisis that is currently ongoing?
So good morning, Hormuz. You have a portfolio with you, and you've seen it that we don't have any of the particular players which you mentioned, but we have other stocks which are participating in the renewable energy, the latter group which you mentioned, which are participating in the renewable energy theme. But it's not just the stocks which participate. There are so many of the picks and shovels guy. If you're looking at renewable energy, probably the best way to play it is transmission. And those are among our significant holdings there. It's a build out which, in our opinion, is likely to continue for many, many years. So there are so many ways to play this theme, and this theme is so multi-dimensional, and not just local, also global. So yeah, many ways to skin the cat. This is what we play.
All right, Shahzad, I was looking at some of your holdings. L&T in particular stands out because obviously it has been among the worst performing stocks ever since this skirmish started, and that's largely because of its exposure to the West Asia business. The company has on multiple occasions clarified that it's just about 5% of their overall business when it comes to the part which has been affected, and rest is business as usual. The stock correction has been over 30%. Have you added in this fall, or have you held on irrespective?
We've added a bit, not too much, but we have added a bit. In our view, a lot of these concerns are overdone. That's at least our opinion. Yeah.
Shahzad, any view on the NBFC space? I mean, in your holdings, I don't really see any large names, but any view on the NBFC pack on the back of RBI proposing tighter guidelines for all NBFCs with asset size exceeding 1 lakh crore? So, especially some of the government-owned NBFCs, whether you see some pressure in the near term, or, would you be taking any positions there?
Okay, so in the in the particular portfolio you have, and what you have in front of you is what we've taken to the market. But we do have some positions in some of the larger NBFCs. In our opinion, at least, there is no significant impact of these guidelines on the stocks we hold, at least. I mean, nothing in particular.
Right. I also wanted to understand your conviction on DB Corp, because again, print media, digital, not monetizing as much. And I speak as a person who's part of, the media fraternity. So just wanted to understand how print is evolving, how the business is evolving for investors, and also the price, the stock down from its peak of near 400 rupees down to about 210. So the thesis here, because the other alternative that you have is Sun TV, where the optionality of the cricket team leaves a lot more valuation comfort.
We've discussed this before, Mangalam, but our thesis is pretty much exactly what it was, is that really the content is the most important thing. The stock in question has wonderful content. If you look at, they are dominant in their geographies. Significant amount of cash flow is what they generate. No debt on their balance sheet. Growth levers are, when you look at it on the regulatory side, you're going to have incrementally the, let us call it the platforms which use their data, because what do platforms do? They use somebody's data and they go and get the revenue from it. Incrementally need to share their revenues with the with companies, with the content provider. Same is happening on the AI front. There are cases going on of that in US. So stock, since at least over the last some time, has been, a modest performer. But the way we see it is that sooner or later we ready when we believe in something to come in early, wait patiently. Let's see how it goes. But you've got valuation comfort on your side. You've got something at near single digit P, high dividend yield, something very comfortable.
What about Sirma SGS, Shahzad? Because there has been a lot of talk on this EMS space, and particularly so with regards to the cash flow issues that a lot of these companies are facing, especially Keynes being a case in point. What drives your conviction here, specifically in comparison to both Dixon and Keynes, considering the fact that Dixon has been a very big outperformer over the last, say, 4 or 5 years before this current underperformance that it has had. So Sirma versus its peers.
Okay. The way we see Sirma is that they have actually transitioned extremely well. If you look at the way their margins have improved because of value-added products, they are transitioning extremely well. A lot of their JVs, which they are putting in place too, are, early days yet, but appear to be playing out reasonably well. Their earnings growth has been fairly strong. Cash flows are, they are stretched for any business, which is, when I say stretched, means relatively better off though compared to what may be considered the peer group. But they're doing fairly well on that front. Earnings growth continue to be strong, and they happen to be, to our mind, the most reasonably valued stock in the EMS space. And at this point in time, with what we know, we continue to be happy to hold on to that. Right.
All right, Shahzad, thanks very much for your time here on CNBC TV 18. On that note, we'll slip into a short break, but don't go anywhere. We're back with the markets in just a short break.
Welcome back. The recovery from lower levels continues. So now this is a 230-point recovery as we speak from the low. So 23,555 being the low. We got tantalizingly close to 23,800. We are still hovering around those levels. So technically we are at the highest point of the day on the index. So a 260-point cut, still a percent lower. Some flashes at the bottom of your screen. Bosch in its analyst's call is mentioning the fact that they will receive a 22% revenue boost from the latest acquisition that they are doing, and an EPS accretion of 5% as well based on the FY25 numbers. So positive commentary coming in from Bosch, and their stock recovering from the lows of the day. But the focus has been on the currency as well with regards to what has happened over the weekend. The rupee back above the mark of 93, and even as higher crude prices and the likely prolonged blockade of the Strait of Hormuz. Lata is here with more on the currency first. Lata.
Well, the fact that there can be a rather prolonged and intense blockade of the Strait of Hormuz is the dominating theme in Asian currency markets today. Rupee is one of the bigger casualties, losing about 0.7% and even crossing that 93 mark. The bigger casualty is actually Philippines, which is down between 0.8 and 0.9%, because these countries are much more dependent on the Strait of Hormuz. And that clearly is reflected in the currency moves. Even other currencies are weak. But, countries like Malaysia and Indonesia have domestic energy resources, and therefore they're just less affected than India and Philippines are. But the Indian market had other reasons as well. You must remember that on Friday, the markets went into close short on the dollars, according to dealers, because there were high expectations from the US-Iran talks. And therefore, that short covering also pushed the dollar above the 93 mark. More importantly, there was this sale of dollars, open dollar positions by Indian banks, which had to be completed by April 10th, as per the Reserve Bank's strict rules. That sale is also over now, so that liquidity is less. But today, dealers were speaking about actual demand, probably coming in from importers. They didn't hear much from FPIs. More of the demand for dollars is from importers, according to the few dealers I spoke with. Some supply is coming from the Reserve Bank. That is, public sector banks were supplying dollars at about that 93.40 mark. So maybe that's a level which at the moment will get supported. But those are, of course, only current levels. There is a feeling that there is going to be pressure until this geopolitical crisis is out of the way.
Take that point, Lata. Thanks a lot for that. What about the March consumer price inflation, the CPI, which is due today? What is it that the street is anticipating? But more than that, do you think there could be a bit of an impact by virtue of the increased oil prices?
Well, March CPI itself is seen coming, according to a poll, at 3.46%, of course higher than February at 3.2, and Jan, which was only 2.7. And this rise is actually because of the Hormuz Strait problem. LPG prices were raised, and even aviation turbine fuel, ATF prices have gone up. Premium petrol went up, but that may not come into CPI much. Now, I'm not giving you numbers prior to Jan or a year ago numbers, because this is a new series with a new base year. The MOSPI changed it at the start of this year. The more important number now we will track is core CPI. Core CPI is actually expected to jump fairly sharply to 3.6%, because there people will notice whether global petrochemical prices are having an impact on the non-fuel, non-food part. More important will be the May or June inflation numbers, not so much March and April, simply because the expectation is that petrol and diesel prices will be increased after the elections, the state assembly elections. The last of them is on April 23rd. So, prices can rise for the month of May. Food CPI also, please keep an eye, because that is expected to jump to 3.7 compared to around 3.47 in February. Why we have to keep an eye on it? Because the IMD releases the forecast, the monsoon forecast, first forecast data, and there are these El Nino fears. So, food CPI bears watching. If it's starting on a higher base, then that's not very good. Again, another number we should watch out for in future, that is tomorrow, is the WPI numbers. Wholesale price index are not impacted by whatever the government does to consumer prices. That may more clearly reflect international prices. Again, bears watching. Our poll was about 3.35%, but that's a sharp increase from the 2% last month.
Lata, thanks very much for giving us a sense of what to expect when those CPI numbers come out later today. On that note, markets, of course, at the high point of the day, though still in the red. We're going to wrap up on this edition of Trading Hour. From Mangalam, Hormaz and me, it's a goodbye. Stay tuned. Halftime report will be up next.
Trump's tweet reignites fears of a long disruption as he calls for a blockade of Hormuz and Strait of Hormuz and puts military action back on the table. Auto and financials are the big drags, even as utilities buck the trend. Rupee slips 0.8%, is one of the weakest EM currencies today.
RBI proposes a new 1 lakh crore rupee assets under management criteria to classify as NBFCs as upper layer. The move will lead to state lenders REC, PFC, IRFC and HUDCO being included, while PNB Housing Finance and Sammaan Capital will exit.
And crude leaps after Trump says that the U.S. will blockade Strait of Hormuz from 10 a.m. Eastern Time. If done, this will cut off supplies for key Asian buyers like China, India, South Korea and Japan, who had seen some of their supply sales coming through.
Delhi, a key market for automobiles, is set to usher in new rules aimed at boosting sales of EVs and hybrids via incentives, while curbing registrations of polluting three-wheelers and fleet vehicles. It also calls for EV charging provisions in all new buildings. Hello and welcome to Halftime Report. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Vinny Motiwala. Vinny, good afternoon. Well, we continue to be lower because of the uncertainties that we've been seeing because of the West Asia war, but there is a recovery which is underway. We did see that in the markets as well. We are at that 23,790 mark as we speak, but the mid-caps and the Bank Nifty has recovered from the day's low. So has the Nifty, and that is at the day's high. Across the board, there is some red, but media, energy and CPSE, these are some stocks which are doing well in trade today, and those are some sectors which are in the green as well. If we talk about some of the big movers on the Nifty, Adani Enterprises, we do have power names doing really well in the broader markets and the Nifty pack as well. So NTPC is doing well. ICICI Bank has led to some of the recovery that we are seeing. The other names include some pharma names like Sun Pharma. Apollo Hospitals also doing well. So yes, there is some recovery, but we'll have to see whether that sustains or not, considering it continues to be very volatile.
Absolutely, and today obviously is the expiry as well, since tomorrow is the holiday, so we'll keep an eye out on more action on that front. Broader end of the market also continues to be under pressure with the benchmark indices. Advance decline ratio obviously favor of declines versus advances in today's trading session. But we have a very exciting lineup for you all on the show today. We'll put the spotlight on the CAFE 2027 draft and the Delhi EV policy with Farah's CEO. Then we'll move on and we will also put the spotlight on HSBC initiating coverage on the power stocks. They've been buzzing in the last couple of trading sessions. Today, specifically two names, CleanMax and Enviro, as well as Acme Solar. And in other buzzing stocks, we will put the spotlight on Jyoti CNC, Gallant Ispat, and key NBFC stocks buzzing on the back of RBI's new classification rules. But first up, let's go across to Vivek, who's going to take us through all the stocks that are moving around in the trading session. Good afternoon, Vivek.
Well, good afternoon. What actually transpired is that there's been significant buying that's emerged from lower levels, especially after the sharp intraday dip that we saw in terms of individual stocks, individual sectors that we are tracking in today's trading session. Quite a few names actually hit the list. First on the list, the entire Tata Group pack. Remember, there are a lot of news reports regarding the likely or possible listing of Tata Sons. On the back of that, companies that hold significant stakes there are seeing an up move. Tata Chemical, Tata Investment Trust amongst them. Sterlite Technology is one of the top movers as far as the broader end of the market is concerned. 5% higher, good volumes amongst the top gainers as far as the NSE 500 index is concerned. Electra Greentech as well as JBM Auto increased push coming in from Delhi as far as their EV policy is concerned, especially for buses. Both of these names doing quite well. Entire power pack, both renewable as well as conventional thermal power companies doing quite well in the session. Wari, Premier, Tata Power, all of these names doing quite well and good volumes as well. And Aavas Financiers, this particular name, some news reports indicating there could be a change at the helm. That particular stock amongst the top small cap gainers today. On the other hand, quite a few laggards as well. The entire auto pack, a few headwinds emerging, especially in terms of CAFE 3 norms, in terms of the EV push. So some of the conventional names actually taking a bit of a hit today. Maruti, Eicher, Ashok Leyland, TVS Motors, all of these names under significant pressure. Have a look at some of the select PSU banks, Union Bank, Bank of India, a couple of downgrades coming in over there. Have a look at OMC's rising crude oil prices not being seen as positive for these names. HPHCL down almost 4%. Swiggy, a change. One of the co-founders has quit the company. That particular stock down almost 3%. And Jyoti CNC, that particular name has taken it on the chin. The French subsidiary is under investigation and Street clearly doesn't like that, down almost 14% today.
Okay, all right. So that is where I'll take the cue from. Thank you, Vivek, for joining us with all those details. Vinny, Jyoti CNC under pressure. Some investigation happening there.
Absolutely. So, we had some clarification or more further notification that came in from the company also yesterday. Now, first, let's talk about what the issue was. French authorities, they've initiated some formal judicial investigation on its French subsidiary. This investigation, what was it for? There was an alleged export of some dual-use machinery, which was in violation to EU's export control laws. And because of that, there's this investigation which took place. Now, the company has said that they've taken 3 measures as of now. One, the Director General of the subsidiary, he has been, temporarily barred from his duties. Apart from that, the bank accounts totaling to around 4 million euros and 2 residential properties of Jyoti SAS, that is a French company, have been seized so far. And a formal judicial investigation is underway. This is the clarification that they've given. But the company is refuting allegations and intends to contest this as well. So that's the update come from the company. Now, obviously, what would be the impact? This is an early stage of investigation. They have not mentioned any impact on the financials so far. So any update on that front? that has to be determined. Then we have a liquidity strain that would come in as a near-term risk for the company. What would be that impact on the Indian company as well will be key to watch out for, given the French subsidiary is around 10% of the revenue. So that will be key to watch out for. What is the impact that overall comes in on this front as well. But as of now, Jyoti CNC is under pressure, down 14% in trade. Let's move on and now talk about NBFCs. The Reserve Bank of India has released draft amendment directions on methodology for identification of classifying upper layer and government-owned NBFCs. Ritu Singh is joining us to give us more details on this one. Ritu?
Well, these are draft amendment directions that propose changes in how upper layer NBFCs are going to be classified. And the biggest shift is that RBI is proposing to scrap the existing parametric scoring model, which is currently used to identify them, and replace it with something much simpler, where any NBFC with an asset size of 1 lakh crore and above is going to qualify in the upper layer list. RBI is also proposing to remove the automatic inclusion of the top 10 NBFCs into the upper layer. And importantly, the restriction on government NBFCs currently from entering the upper layer is also proposed to be removed. Now, keep in mind, upper layer classification comes with tighter credit concentration norms, so exposure limits coming down to 20 to 25% of Tier 1 capital from as high as 40% earlier. It also involves stricter regulatory, capital, governance, and disclosure requirements. Now, specifically to ease the transition for government NBFCs, RBI is proposing to allow them to exclude the loans that have state government guarantees when calculating the exposure limit. And this is important because many of these lenders have large concentrated exposures to state-backed projects, so they can continue lending to them without breaching this limit, and it eases the transition for them as well. Now, in terms of impact, of course, all of these large government NBFCs that have assets of more than 1 lakh crore, your REC, PFC, IRFC, HUDCO, they can potentially fall in the upper layer list. And on the other hand, smaller players like PNB Housing or Sammaan Capital that are currently part of the upper layer but have assets of less than 1 lakh crore can potentially move out of the list, depending on the final classification. As for Tata Sons, the question mark remains. These changes do not give them any explicit relief, and whether they get an exemption from listing is going to very much depend on what RBI decides to do with their deregistration application.
Okay, Ritu, thank you so much for joining us with all those important details. In fact, let's also hear out what Abhizar Divanji of Neostrat Advisors LLP had to say on the norms and Tata Sons listing as well.
I don't think Tata Sons is impacted by this. Now, you have to understand Tata Sons issue in a little different format. First of all, I don't think this regulation has come out in any way detrimental or for Tata Sons. The whole issue around upper layer NBFCs was that they are very much nearing that of banks. And if they are nearing that of banks, then two things are required: better and more stronger supervision, higher levels of capital, provision of liquidity, and biggest among them is transparency through listing. So these are the considerations or tenets based on which this was formed. And why should PSUs not be part of it? Clearly, by reading of that, it's very clear. RBI says anything over 1 lakh crore has to be there's no discretion. There is no list. It says that they come out with another list, but that list also has to be within the ambit of, as they say, paragraph 24, which basically says 1 lakh crore. So at the end of the day, 1 lakh crore cannot be breached.
Okay, now let's move on and talk about Galantis. But this stock has been buzzing around in the trading session today as well. It's up almost 25% in the last 1 month. Let's go across to Nigel to give us some more details or color on this one as well. Nigel, good afternoon.
Well, that's right. Galantis spot is up close to 25% in the past 1 month or so, but it's still a distance away from the 52-week high. Well, their recently disclosed operational update looks pretty good. You know, the billets are up by close to around 30%. The MS bars are up by close to around 8%. Remember, the company produces pellets, which are converted into sponge iron and then into MS billets, which basically means their end product or their sales will be TMT bars. So that's where the ultimate, selling product is. Even for the year, if you look at it, well, the operational performance is more or less decent. Nothing really to write home about. Capacity utilization levels of around 86%. The steel sales were around 850,000 tons, which is a marginal growth of just 3% on a year-on-year basis. The company, remember, has a 1 million ton finished steel plant. They have captive power and they have close to around 300 crores of land bank. This is as per the presentation that they've given post their Q3 numbers. Now, they have the manufacturing units at Kutch in Gujarat and Gorakhpur in Uttar Pradesh. On the financial side of things, well, the EBITDA has surged very well. In the last few years, if you pull up a chart from around 300 crores odd, it's moved to around 700 crores in FY25. And they've guided for a very strong showing in Q4 FY26. But even taking that into account, the stock is not very cheap, right? When it's doing EBITDA number of from 7 to around 800 crores or thereabouts, for a market capitalization of around 16,000 crores, though it has no debt on its books as per their presentation. Additionally, the promoters hold close to around 70% stake in the company, but it lacks any kind of institutional holding, and that will be the key to track from here on. What are the other triggers you're looking at on ground with regard to the operational performance bettering from here on? Two factors. One is the capacity addition. They have planned the capacity to move their capacity from around 1 million tons to around 1.23 million tons odd. That's across, the expansion at their Gorakhpur unit as well as their Kutch unit. So one is the expansion. Secondly, they're focusing on raw material focus. They've laid out a capex of around 1,500 crores in the Uttar Pradesh as well as the Rajasthan mines. So they're focusing on backward integration. And the company says that they're looking at securing the raw material linkage and achieving EBITDA per ton improvement of around 2,000 rupees per ton. Now, that'll be interesting to see because that could give a bit of a booster shot to the EBITDA number. So short point is, Gallant Ispat has been buzzing in trade, no institutional holding, and valuation-wise not very, very cheap, but they've got a couple of triggers in store, so we'll have to see how that plays out. Back to you guys.
Okay, all right. Thank you so much for explaining that move to us. That's Gallant Ispat with the fundamentals and the risks, as Nigel pointed out. Let's sip into a short break now. Up next, FADA CEO Saharsh Damani will join us to discuss the CAFE 2027 draft, the Delhi EV policy as well. Stay tuned for that conversation. Thanks for staying tuned into Halftime Report on CNBC TV 18. Now, the government has actually released a new draft notification on CAFE 3 norms as it looks to accelerate the pace of EV adoption. So, Darshan is here to give us more details on this one and what the implications could be. So, Darshan, afternoon.
Afternoon. So over the weekend, we have seen from the government that they have released the draft of CAFE emission norms, and it will be implemented in the phases. So first, there are certain major changes that have been done. First, strong hybrid super credit has been cut from 2 times to 1.6 times. Explicit 3G CO2 per kilometer concession for small cars has been scrapped, and derogation technologies has been introduced, which can reduce EV mix by in the range of 2 to 4%. In case of non-compliance, OEMs can buy credits from BEEE, that is Bureau of Energy Efficiency. Now, Nomura has written the note. It believes that regulation to accelerate EV adoption, and it prefers Mahindra & Mahindra, Hyundai, and Sona Comstar, and it believes that policy direction is moving towards faster electrification. And now, if you compare amongst all the auto OEMs, and for Maruti, the mix is 1.3% they can reach. By 1 to 3%, they can achieve the CAFE emission norm. Similarly, for Hyundai, it's 4 to 7%. Tata Motors passenger vehicle, it's 4 to 7%. Mahindra and Mahindra, it's 13 to 15%. And Nomura believes that EV mix requirement for Indian OEMs look achievable, but for companies like Nissan, Renault, and Volkswagen will need to accelerate EV launches to achieve these norms. Now, as far as the stock impact is concerned, Nomura believes changes are going to be positive for Mahindra and Hyundai. It's easier for Mahindra and Hyundai to meet CAFE norms. For Maruti and Toyota, it may need to reevaluate if it's still viable to launch hybrids, because Maruti and Toyota had an advantage if strong hybrid credits was higher and small cars had got extra credits. As far as auto ancillary companies are concerned, Nomura again has written that accelerated shift toward electrification will be positive for Sona BLW and also positive for Uno Minda, Motherson Wiring, Samil, and even stocks like Sansera Engineering.
Okay, take that point. Thank you for explaining that. But it's been a busy morning for you. There's another draft that the Delhi government has released for Delhi electric vehicle policy. Tell us more about that, Sudarshan.
So like central government, even Delhi government has come out with a norm, and it's the updated new EV draft policy, and the main objective is to transition to electric vehicles at the earliest for entire fleet, whether it's talk about cars, whether you talk about electric two-wheelers, electric three-wheelers, and the rationale behind this is first to curb pollution and accelerate transition to cleaner transport, because focused on cutting emissions, because currently almost 23% of pollution in Delhi comes from the vehicles. Now, so the details are, it's going to offer incentive like 100% road tax waiver for electric cars, and to expand charging infrastructure, build a stronger EV ecosystem. Now, talk about details in the cars. So cars up to rupees 30 lakh will get 100% exemption from road tax and registration, and this exemption will be valid till March 31st, 2030. Electric two-wheelers, incentives for electric two-wheelers with X factory price up to rupees 2.25 lakh. In the first year, incentive would be up to rupees 30,000. In second year, 20,000. And in the third year of registration, it would be 10,000 rupees. For electric three-wheelers, from Jan 1 of 2027, only electric three-wheelers will be allowed for new registrations. And incentive, first year 50,000, second year 40,000, and third year 30,000. As far as school fleets are concerned, phased electrification has been proposed, and 10% electric has to be done within 2 years, 20% within 3 years, and 30% by March 31, 2030. As far as government fleets are concerned, all vehicles will be only electric except exempt categories once government notifies this rule. Now, they have put out certain restrictions also. They will not induct new, for fleet operators, they cannot induct new petrol or diesel vehicles after notified timelines, and limited exceptions for certain categories will be till December of 2026. And EV charging and swapping infrastructure, land owning agencies will identify sites for public charging and battery swapping stations, and all new buildings and infra projects must be EV charging ready. So objective of Delhi government, they had this policy in 2023 which had expired, and they had extended up to 2026. Now they have come out with this new draft. They have sought the public feedback. Let's see what all changes are made. But as of now, it's not completely beneficial for the industry, but they are going ahead with the transition to electric vehicle.
Absolutely. A transition to EV is happening, and EV seems to be the theme there. Sudarshan, thank you so much for that. But to discuss this forward, we are now joined by Saharsh Damani, who's the CEO at FADA, to take this conversation forward. Mr. Damani, good afternoon. Thank you so much for joining us on the show. First, let's start by talking about this corporate average fuel efficiency norms that have come in, or CAFE 3 norms. One, what are you making of this? As well as any feedback that you have coming in terms from dealers, industries, on ground, how are they taking it?
Yeah, thanks a lot, and good afternoon to you and to all the viewers of CNBC. Yes, the new CAFE norms have come into play, and if you see, it is essentially, India telling the auto industry the era of incremental tweaks is over. From April 27, manufacturers need to meet significantly tighter fleet-wide fuel efficiency targets. And the norms have already seen some evolution, with the latest draft easing the curve slightly, particularly for small cars. But the direction is, unmistakable. It is cleaner, more efficient vehicles across all powertrains. EVs and hybrids get super credits under these norms, which means that every EV vehicle sold actually helps a manufacturer overall compliance position. So there's a very strong built-in incentive towards electrification for sure. From the dealers network on the ground, the feedback is one of a cautious preparedness. Dealers are already seeing a more diversified power mix coming in. EVs, hybrids, CNGs, and efficient petrols, which are more stronger hybrids. They now are constituting more than 36% of the total passenger vehicle sales. The showroom of today looks very different from 3 years ago. And I'll say this, that whether whether the Cafe 3 gets implemented on schedule or sees a slight delay, which is getting discussed right now. And the direction of travel, but for sure is now set. So dealers and manufacturers are not waiting for this notification, but they are already preparing for a cleaner and multi-fuel future for the growth of the country.
Okay. So, Mr. Damani, at the end of the day, it could be greener and cleaner, but what would it mean in terms of cost for the end consumers? There will be higher costs. If it is compliance, then it would also be the change in the model, right? Do you think that is something which can be passed to the consumers considering the situation that we are in, or some of them could take a margin hit?
Yeah, so generally, we have seen a lot of efficiency norms which have already been announced in the past as well. But honestly, it's a bit of both right now. And I think that's the practical reality also. Cleaner technology, cost money, and OEMs who have invested in compliance will need to recover that. So some price increase is inevitable. We are seeing that this will, with every regulatory transition, whether it was BS4 to 6 or any other Cafe 1 norms also, they are the best examples of how, the price hikes happened earlier. But can they pass on the fuel cost? The market may not allow 100% of the passing over. India is, as you see, deeply price sensitive, especially in the mass market segment. And if you push too hard on the price, you lose a lot of sale there. So what we'll see is manufacturers absorbing a portion, passing on a portion, and also recovering the rest through achieving scale and localization efficiencies. So, while ICE vehicles, face an inflationary trend due to compliance cost, EV prices are actually moving in the opposite direction, and battery costs are also falling globally. So the price between ICE and EV is narrowing every year, and that is a good thing for the customers.
Okay, surely a good thing there for customers. Mr. Damani, the other draft rule that came in was that the Delhi government is proposing to ban new petrol two-wheelers. That's going to be from 2028. What does this mean for the dealer network in NCR region, right? Could we see a bit of a disruptive impact coming in for them as well?
So yes, the Delhi EV draft policy was announced 2-3 days back, and we had given a lot of inputs to the state government for the new draft policy. But what has been released right now, the government is again asking for our comments. So at this point of time, I would like to refrain from answering anything on this, because we are still in discussions with our members in terms of how do they see this as the new draft. So I'll keep my answers to that, right.
Okay, all right. So things are still developing. So in that case, you need more clarity to give an idea on that one. But Mr. Damani, pleasure speaking with you. Thank you so much for joining in with your thoughts on the new Cafe norms and a possible Delhi EV policy as well. Of course, we'll get more details in times to come. With that, we'll slip into a short break. Ashish Kyal of Wave Strategy Advisors will join in with some trading strategies on the other side. Stay tuned for that. Welcome back. Well, there's a definite recovery which is underway. Nifty is above that 23,800 mark. We are at the 23,833 mark for now. 217 points lower, but nevertheless, it's the Bank Nifty which has recovered sharply. It's down just 550 points as we speak. Was down almost 900 to 950 points when we started trade. So there's a big recovery that we have seen on the Bank Nifty as well. Some of the stocks from the broader markets that continue to do well. Equus is one of them. It's a recent listing. It was up on Friday as well. And today in a weak market like this, it's up another 6.5%. So watch out for that name. Tata Chemicals, Tata Investments, these two names, of course, in focus on the back of a possibility of Tata Sons listing. Tata Chemicals hold a substantial chunk in that name. Though the stock has come off from the highs of the day from 9% higher, it is up just around 6%. Transformers and Rectifiers is the other name which is doing really well in trade. Atul Auto is the stock which is doing well, 18.5% higher on that one. We have Enviro Infra, which is also a recent listing, up 14%. Zydus Wellness is the other one, which is up around 10%. And Aether Energy is the other stock which is doing well in trade. And also a lot's happening in your space, power and renewable equipments today.
All of them, power, renewable and cap goods along with that as well. They are buzzing. So whether you look at a Thermax, transformer rectifiers, Acme Solar, all these names surely buzzing around. Also, Puravankara has spiked up in trade after this Q4 update that has come in. Average realizations are up 21% YOY. The stock is up 10% as of now. Last 5 days also, it's gone up around 22%. Obviously, 10% move is coming in today itself. Customer collection for real estate business is up 36% as well. Pre-sales up 190%. More details on that one, but as of now, the stock has spiked up. But let's also bring on board Ashish Kyal, CMT author, Wave Strategy Advisors, joining us right now to take us through the market check as well as in terms of the technical levels that we should keep an eye out on. Ashish, good afternoon. First up, let's start with the markets today, right? Started off on the lower side and then came up and has seen a recovery. Sonal was mentioning it as well. Important levels that we should keep an eye out on. As of now, we're back about 23,800. So what is the key today to watch out for?
Hi, afternoon to you and all the viewers. See, if you look at the overall market, there was a big gap down post what happened on Saturday. But Nifty is managing to claw back above and attempting to fill the gap. So I think overall undertone is positive because that is what we are seeing over the past 6-7 days already. And any dip from here again back to 23,750 can be an opportunity to buy. We can expect it to again move toward the psychological level of 24,000, 24,020. Crossing that is not going to be easy because of the expiry today, and there is a lot of call buildup at those levels. I think there is short straddle around 24,000, so it's not going to be easy to cross that. So the level to watch on upside is going to be 24,020, and on the downside, any dip towards 23,750 can be used as a buying opportunity. Having said that, the strong reversal that has come in is really from the Bank Nifty, and within the banking space, if you look at the private sector banks, something like Axis Bank or ICICI Bank, those are the ones that are helping the market recover from the lower levels.
Okay. What about individual names? Are you playing something on the banking space?
Yes, on the banking space, I think Axis Bank can be something that can be considered at the current levels. It's trading in positive already. And I think it's going to move, give a very strong breakout for a move towards 1420 on the upside. On the downside, one can maintain a stop loss for Axis Bank somewhere around the levels of 1320. So the risk reward is appealing for creating long position in Axis Bank at current levels. And the next stock that has to be looked at is MCX. We can clearly see that the stock is bucking the trend and has managed to sustain on the higher side throughout the past week. Also, the overall tone for MCX is positive. We can expect the targets on the upside at around 2885, and the stop loss for MCX can be maintained at 2650 levels.
Okay, we'll keep an eye out on those levels over there and the stocks as well. Ashish, thank you so much for joining us on the show. Let's move on and get a check in terms of the F&O space as well. What's happening there? We have Mangalam at the F&O desk to take us through all of that. Mangalam, over to you.
Well, it is weekly options expiry today on account of it being a trading holiday tomorrow. But ahead of that, one thing is fairly clear. The market is firmly off the lows. The Nifty has cut its deficit by almost to about 200 points, and it's recovered by about 250 points from the lows as well. So today's low now marks an important level to track as the week goes along. Uncertainty was what was there over the weekend. The markets opened lower, and thereafter they've seen recovery. All these are signs which makes bulls feel a lot better. Apart from that, if you look at some of these option writers, put writing is fairly active. We've seen writing at the 24,700 put, 23,700, 23,600. 23,500 puts, all of them fairly active, telling you that, today's low will be protected and the support for the market has moved higher. There is some punt buying at the 24,000 call as well for sub 5 rupees a pop. Maybe someone is expecting a bit of an up move that will come by towards the end of trade. Let's see how that pans out. But the only fly in the ointment and the one data point that you need to track very closely is the put call ratio, which ahead of expiry has gone to 1.44. Typically, the market tops at around 1.2, 1.3, which indicates that there could be overheated moves that may be taking place. But ahead of expiry, you give it some leeway. Maybe the bulls are trying to push their luck, so that's something that is playing out. So that's a thing we'll have to monitor as we move along. A lot of stocks which are on our radar this afternoon. We are seeing a lot of long positions being added in a bunch of these names. Power seems like the theme of the day. So we have Wari, which has seen a fair amount of long positions being built up as well. And the prognosis of a heat wave coming in, maybe a name like Voltas and Blue Star come up for you as well, seeing some long positions being added. But on the short side, Eicher Motors is one that really stands out in terms of fresh shorts being added. And alongside that, we have APL Apollo Tubes as well. A lot of short positions being added on that stock too.
Okay, take that point. Thank you so much, Magnam, for joining us with all those FNOQs. And with that, we'll slip into a short break. As we do that, here is some good news for our viewers. India's business news leader is now click away. Introducing CNBC TV 18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV 18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back. Joining us now is Amina Becker from Kepler. Amina, hi. Thank you so much for joining in. First of all, some data on table really, because we do understand that 90% of vessel passage through Strait of Hormuz was down by nearly 90% in the month of March. That is, what has been the case until time in April?
So far, since the ceasefire, we have seen a slight uptick in the number of vessels, but still, the traffic is around 7% to, I would say 5 to 7% from what it was pre-war. So we're nowhere close to the pre-war levels, and volumes remain really, really constrained. At the same time, we had the news overnight that the US is going to be adding another blockade, which is going to be stopping Iranian vessels.
Oh, absolutely. And how are you reading that? Amina, that's one part of it. And we do understand that Iran oil usually does go to China. Are we looking at a supply shock to China now? What numbers are you looking at?
Well, of course, I mean, this is going to restrain supply even more. And part of the reason why the U.S. removed the sanctions and gave a waiver to Iran was to make sure that there's enough supply on the market. If you further constrain that supply, that means higher oil prices. And this is what we're looking at. I mean, just with the opening on Monday, oil is already trading above 100. I wouldn't say that it's a kind of an overreaction. It could have been a lot worse. But with constrained supplies to the market, even from Iran, this would further, I mean, this is an escalation in the situation and an escalation in the deficit that we have in the market.
Sure. How are you also, I mean, are now looking at various other areas like Bab el-Mandeb? There are reports that Houthis perhaps could be blocking that as well.
Yeah, that does risk the Bab el-Mandeb for sure. And Saudi Arabia has been using that route. Do you understand? The East-West pipeline has been carrying crude to the Yanbu Western Port. And Saudi Arabia has been able to export using that route, which compensates some volumes. But the blockade, I mean, given that it's an escalation and it's going to be happening at 10 a.m. Eastern time today, that might prompt some proxy action, mainly from the Houthis in Bab el-Mandeb. Overnight, we heard reports that a vessel got attacked in Bab el-Mandeb, but there are still no signs of like constraints to that route. But definitely, there's a higher risk concerned.
Oh yes. How are you also looking at various vessels or various a huge amount of oil really stranded at Strait of Hormuz? Last report I was reading of you, Amina, says 130 million barrels is just sitting there.
Yeah, we have 130 barrels, which is basically trapped there in the Gulf. And add to that the supply shut-ins that have been happening for Middle Eastern states, that's north of 11.5 million barrels a day. And the fact that now Iranian oil also is going to be constrained. So all of that is really adding to a very, very kind of dire and bleak situation when it comes to supplies in the market. I think what the U.S. is betting on, that by doing this, they would be able to pressure Iran, use Iran's leverage in the strait and use that against them to force them to open the strait. The talks, as you know, happened in Islamabad, didn't yield any kind of result, but we've been hearing that this is just a first step, and it was unrealistic to expect a peace agreement in the first meeting.
Amina, how are you reading the various reports suggesting that if continues until April or May or June for that matter as well, you're saying the best case scenario is a ceasefire with Iran giving it all in, and a worst case scenario, what are you reading into that?
Well, worst case scenario is that the strait remains closed and it's already kind of piling up. And we need to see a reopening of the strait as soon as possible without a toll system, with free flowing vessels like we had at pre-war. Till now, we have around 300 million barrels of that haven't been produced from the Middle East and supplied to the market. If we wait until the end of April, our calculations now show that we're going to have 700 million barrels that we're missing. This is going to prompt a demand destruction at some point. It's going to have an effect on the global economy. So, I mean, it's not wrong to say that this is the biggest supply crisis that the world is facing in history.
Oh, absolutely. I mean, of course, for the Asian countries, it's even a bigger problem, especially Japan and Korea and India for that matter. How are you looking at the crude oil prices from here on? I mean, we are holding above 100 for the longest time. Inside all of last 6 weeks, that is.
It all depends really on how long the situation lasts for, and if escalation continues, and how long this double blockade lasts for. So if we're talking about, you know, an extension into the end of April, the best case scenario and the base case that we have now is resumption of flows by May, and that's just a scenario. But if the situation continues, I mean, I don't think that $150 per barrel is completely out of the question.
I mean, how are you also looking at this double blockade impacting markets going forward? There is Red Sea and there are various other areas that Saudi Arabia also seems to be looking at in sense of routes. How much oil really is passing through that? And also your sense, one, on the kind of premium that the spot markets are holding. And second, this WTI premium that we are looking at in sense of Brent.
Sure. I mean, in terms of the premium, we've seen suppliers, including Iran, actually sell their oil at a premium of $7. Aramco is also, I mean, their OSPs, they're selling at $19. So there definitely is a premium to be factored here, and the premium is just going to increase as long as we have the supply deficit. And for Saudi Arabia, just looking at last month's exports, they were able to export around 5.3 million barrels a day of crude. And that came from the East-West pipeline from Yanbu, but also it came from releases or stocks that they hold in countries that are outside Saudi Arabia. So if you have Yanbu, the exports from there, constraints, that's knocking out something like 4.5 million barrels a day. It's definitely going to be a big hit to the market. And if we have a continuation, if this ceasefire doesn't hold and Iran decides to target energy infrastructure in the Gulf again, that would put all the production at risk. Saudi Arabia just recovered 600,000 barrels a day that were lost because of attacks. It recovered 300,000 of them, and it managed to repair its East-West pipeline that was also targeted. So an end to the ceasefire is definitely a worse escalation. Who's exposed more? You're absolutely right. It's the Asian states. It's also developing states that cannot afford this new price.
And a final question, really. I mean, and this one is on the $2 million that Iran seems to be charging right now per every vessel. I mean, that's huge revenue for Iran, even if we do not count anything else.
Well, we haven't kind of received confirmation from vessel owners around how the payments are being made. I've read reports about the 2 million. I've also read reports suggesting that Bitcoin is being used for, or cryptocurrencies are being used for the payment. But I can tell you one thing, that vessel owners don't like this environment where you have a lot of volatility, a lot of risk in security. And in general, vessel owners are trying to avoid the strait altogether. Maybe it's because of the threat of mines, because the security situation isn't great, because of the double blockade. So all of this uncertainty is not helping vessel owners make the decision to cross the strait.
Okay, Amina as well as Manisha, thank you so much for taking us through that conversation. The opening of the strait now is going to, and it stays open, that's going to be the key. No hit coming in on Saudi on their infrastructure is also something to watch out for. But thank you so much for that conversation there. On that note, we're going to slip into a very short break. After the break, we'll get you more in terms of stock-specific action. We'll be putting the spotlight on these power stocks as well. Stay tuned in.
Welcome back. You're still tuned into Halftime Report. Well, a lot of stocks from the broader markets which are buzzing around in trade. The power stocks, they are in focus. HSBC has initiated coverage on both Acme Solar and Clean Max. This is with the buy rating. When you tell us more, most of them are new listings.
Absolutely. Most of them are new listings, but that's the flavor, right? Seems like it. At least on Friday, we had an initiating note that came in on some of these other names on solar PV modules. Now, today, it's on Acme Solar as well as Clean Max. So, HSBC initiating coverage, buy rating, target price for Acme Solar is 350 rupees per share. Clean Max, the target price is 1,150 rupees per share. First, Acme Solar, what are they saying? It is that they believe that India's power industry is going to grow, renewable side is going to grow. So, with that, they think that Acme Solar is one of the fastest growing companies, where a vertically integrated company, independent power producer for renewable energy, and it could work out well for the company if India's power industry is growing. Currently, they have a capacity of 6 gigawatt. Contracted capacity is what they have. Long-term earnings visibility that shapes up well. Projects are there on the renewable front, BESS front as well. That will improve the returns for the company going forward. So they're forecasting an EBITDA CAGR growth of around 72%. In FY26 to FY28. Now, for Clean Max, also they've initiated coverage. Clean Max is obviously the largest provider for renewable energy for the commercial and industrial side users. They expect strong growth for this company as well. Overall, they're saying, which is when they look at this company, green energy, they believe this could work out well for the company. Forecast for EBITDA CAGR growth, that's around 60% for FY26 to FY28. So both these plays, they believe, could work out well for the company, Sonal.
Okay, all right. So both these stocks doing really well. By the way, the recovery in the market, don't lose sight of that. And that continues to be the story that we are tracking. But for now, we'll slip into a short break. When we come back, we'll get you more on markets and stock-specific action on the other side. Stay tuned for that.
Welcome back to Halftime Report on CNBC TV 18. Obviously, we're seeing a sharp recovery that's coming in the market through the day as well. Opened up somewhere around 23,550 was the low, and as of now, 23,800, about that mark, is what the Nifty continues to trade at. And the last 1 hour or so, we've seen AstraZeneca, Schneider, NLC India. These are some of the names that have seen up move coming in from the broader end of the market as well. So recovery continues. Today is the expiry as well. Keep an eye out on that. But with that, we're absolutely out of time on this edition of Halftime Report. So thank you so much for tuning in. Up next, your Business Sun should take you through all that action.
Donald Trump's post reignites fears of a long disruption as he calls for a blockade of the Strait of Hormuz and puts military action back on the table. Auto and financials are the big drags, even as utilities buck the trend. The rupee is down close to 1% and is one of the weakest emerging market currencies today.
RBI proposes a new 1 lakh crore rupee assets under management criteria to classify NBFCs as upper layer. The move will lead to state lenders REC, PFC, IRFC and HUDCO being included, while PNB Housing Finance and Sammaan Capital will exit.
Oil prices leap after Donald Trump says that the US will block the Strait of Hormuz from 10 a.m. Eastern Time. If done, this will cut off supplies for key Asian buyers like China, India, South Korea and Japan, who have seen some of their supply sail through.
Delhi, a key market for automobiles, is set to usher in new rules aimed at boosting sales of EVs and hybrids via incentives while curbing registrations of polluting three-wheelers and fleet vehicles. It also calls for EV charging provisions in all new NW buildings.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. With me as always, Arundhati Raman. And Arundhati, good afternoon.
Good afternoon, Hormuz. I mean, everything we talk about is the West Asia war, right? We've got that 21-hour conversation they had yesterday. No deal, fears of an escalation, global markets in the red, oil prices going up. So that's how the market started as well. But now we're seeing a recovery.
There is a recovery from lower levels, yes. And there is an almost 250-point recovery from the lows of the day. And that's impressive if you are a bull. We are down to around 23,555, which is the low of the day. We are back at 23,800 now. So technically, we are at the highest point of the day. Today, of course, being the weekly expiry of the Nifty contract. So that will see some action in the second half of the trading session. And of course, tomorrow is a holiday. So we need to keep that into account as well. There is a lot to monitor on the global front with that Donald Trump 10 a.m. deadline from today evening. That and of course, what transpires over the next 24 hours as well. The recovery today has been led by the Nifty Bank. It's a almost 1,000-point recovery that we have seen from the lows for the banking index, and it is an important week as well for the Nifty Bank. Come Saturday, we'll have HDFC Bank, ICICI Bank, Yes Bank, all of them reporting results, and therefore the recovery today has assumed greater significance simply because of the fact that it is the index that is leading the Nifty higher. And look at ICICI Bank now at the highest point of the day. That is the one that has led the recovery from the lows. The currency not doing very well today, and oil prices too are back above the $100 a barrel mark, but the second half now assumes greater significance.
Absolutely. And, you know, as you pointed out, if you take a look at the sectors, we've got auto stocks that are feeling the pressure, right? In fact, two of the top losing stocks on the Nifty index is Maruti Suzuki and Eicher Motors, both of them down over 4% in trade. Ashok Leyland is also down 3%. So the auto pack not having a very good day today. We've got the PSU Bank index also, which is down over a little over 1%. We've got Central Bank, SBI, UCO Bank, all of them over 1% in the red. We've got defense stocks, which are the only stocks, some of them that are in the green. We've got BEL, which is mildly in the green. DCX Systems was in the green, but now also lower. Data patterns over 1% in the green. Metal stocks also, the index was doing well, slightly in the green as we speak. But let's move on to our top story in the afternoon.
The top story, of course, is nothing but the failed talks between the US and Iran, when they failed to reach a peace deal after those 21-hour talks in Pakistan to end the war. US Vice President J.D. Vance blamed the failure of negotiations with Iran on the country's refusal to abandon its nuclear weapons program, while Iranian delegates have claimed that Washington needs to do more to win their trust. Now, President Donald Trump has said that the US Navy will start blockading all and any ship trying to enter or to pass the Strait of Hormuz, and that would also interdict every vessel in international waters that has paid a toll to Iran. The US Central Command has announced that the blockade would only begin on a Monday at 10 a.m. Eastern Time, which is around about 7:30 p.m. Indian time. Dan Murphy is joining us now to tell us more on the latest. Dan, what have been the major developments that have transpired ever since the futures market began trading this evening?
Well, good morning to you both. This 6-week conflict has certainly entered a new and dangerous phase because in less than 7 hours from now, the US Navy is going to begin its blockade of the Strait of Hormuz. And this morning, this region is really trying to calculate exactly what that means. Of course, US Central Command has confirmed the timing for 6 p.m. local time. President Trump also warning that any Iranian forces that fire on US troops or commercial shipping will be, in his words, blown to hell. Now, of course, executing this blockade is one thing, but sustaining it is another. The strait is very narrow, it's exposed, and it's lined with Iran's coastline. And Iran, of course, has mines in the water as well. We've spoken with analysts today who say the US military certainly has the resources to mount this blockade, but any renewed Iranian attacks would quickly complicate this mission. The president, however, has compared this operation to his Venezuela blockade. You'll remember that, saying it would be something very similar to that, but at a higher level. Again, what that means remains to be seen at this point. What we do know is that this military operation was ordered after Vice President Vance ended 21 hours of talks in Islamabad without a deal and went home without a set date for a new round of talks as well. Unsurprisingly, Iran refused to give up its nuclear program, which was apparently a red line for President Trump and his negotiation team. Iran is ultimately betting that it can hold out longer than the United States now. And of course, the Iranians have survived decades of sanctions. It has absorbed thousands of strikes. And if cornered, it also retains the option of striking the Gulf states and their critical infrastructure once again. And of course, at the same time as well, the Wall Street Journal also reporting today that President Trump is weighing resuming limited military strikes on Iran if necessary to break the stalemate. So while the ceasefire is still in place, it's looking increasingly fragile at this point, and all eyes are on the clock right now as we count down to 6 p.m. local time to see exactly what transpires inside the Strait of Hormuz, which is now the focal point of this conflict. It's back over to you both.
Absolutely. Thank you so much for that, Dan. So we have to count down and wait and watch what happens in the West Asia war. But let's listen into U.S. President Donald Trump's comments on the Strait of Hormuz situation amid rising tensions with Iran.
Their military is destroyed. Their whole Navy is underwater. You know that. 158 ships are gone. Their Navy's gone. Most of their mine droppers are gone. We have a lot of people, as you know, at 10 o'clock tomorrow, we have a blockade going into effect. That'll be 10 o'clock tomorrow. Other nations are working so that Iran will not be able to sell oil. And that would be very effective. Iran will not have a nuclear weapon. Will not have. There is no way that they're going to get. They still want it. And they made that clear the other night. Iran will not have a nuclear weapon.
Now, Trump also said that many boats are heading towards the U.S. to load up with oil, and they have more oil than Russia and Saudi Arabia combined. Listening.
What we notice and what we see and what I think is maybe my idea, maybe not, I don't know. But there are many boats heading toward our country to fill up with oil and then go and take it. So they're not going to go through the Hormuz Strait. And ultimately that'll be corrected. But in the meantime, they're using us. We have more oil because of drill, baby, drill. We have more oil than Russia and Saudi Arabia put together.
And Donald Trump has also criticized Pope Leo, calling him very liberal and saying he is not a big fan of his views. His comments came in after the Pope suggested a delusion of omnipotence is fueling the US-Israel war in Iran.
We don't like a pope that's going to say that it's okay to have a nuclear weapon. We don't want a pope that says crime is okay in our cities. I don't like it. I'm not a big fan of Pope Leo.
Take a short break. More news and updates follow on the other side. Stay tuned.
Welcome back. You're still with us on Business Lunch. Now, crude prices have surged above $100 a barrel after the US-Iran peace talks failed. Manisha Gupta joins us now with all of those details. Manisha, oil on the boil?
It is, absolutely. And after a 10% decline in the previous week, a 9% open in the Monday morning today clearly tells you that the situation has reversed here. With US now announcing blockade of the Strait of Hormuz, many people are calling it a double blockade. One, Iran is blockaded some past, and now US says that any vessels coming in and from port of Iran will now not be allowed. Well, that would really mean that 1.5 to 1.7 million barrels per day is what Iran exports is as of now temporarily off the market, giving that support to the prices therein. Iran says that any military presence that they feel around Strait of Hormuz would lead to ceasefire violations. So we have heard a lot of statements coming in from both those parties and then some more. The whole thing led to a collapse. This is after Iran asking for no curbs in uranium enrichment, also having control of Strait of Hormuz and accessing the overseas curbed assets that they have, which of course US has not allowed as. When you look at the overall numbers, well, Iran is an important one when it comes to oil exports. And when you look at the overall numbers, 2025 was 1.6 million barrels per day of an export. This is higher than what they saw in the year 2024. Now, when you break it even further, for the month of March, we've seen Iran export 1.9 million barrels per day. This is slightly lower than what they did in the month of Feb, but much higher in what we've seen in the last 3 or 4 months therein. So that basically effectively is out of circulation. Markets also are looking at impact of that coming in from various countries which also take in Iranian oil, which is UAE, which takes it to refine it and then, of course, redistribute it. China takes in 10% of Iran oil consumption, and the markets do believe that various Iran exports that we've seen in the first quarter of this year basically have gone into China. So markets are looking at Asian countries really facing a brunt of this, with $100, with 120 on the higher side expected timelines.
Manisha, thank you for that update there. Let's now listen to Timothy Moore, the Chief Asia Pacific Equity Strategist at Goldman Sachs, who gives his outlook on oil prices.
No one really has an edge in terms of the short-term direction of markets. I think that's painfully obvious with the events over the weekend, so we don't have to belabor that. So recognizing that, we have to say, well, how can we add value in an uncertain environment? And our strongest view, just to get that on the table up front, is to stick with the themes that we liked from a longer-term structural perspective before the war that may in fact be given a tailwind by the ripple effects, the consequences of the war, or at least not be impeded by them. And to be more specific, there are 4 key things that we feel a high degree of conviction on. Number one, maybe super obvious, but still valid nevertheless, is energy security.
India's March consumer price inflation, or CPI, is due later this evening. A CNBC TV18 poll sees March CPI at 3.46%, up from 3.21% in February. Core CPI is, however, seen higher at 3.6%. Lata Venkatesh is here with all of those details. Lata, what can we expect?
Well, March CPI itself is seen coming, according to our poll, at 3.46%, of course higher than February at 3.2%, and Jan, which was only 2.7%. And this rise is actually because of the Hormuz Strait problem. LPG prices were raised, and even aviation turbine fuel, ATF prices have gone up. Premium petrol went up, but that may not come into CPI much. Now, I'm not giving you numbers prior to Jan or a year ago numbers, because this is a new series with a new base year. The MOSPI changed it at the start of this year. The more important number now we will track is core CPI. Core CPI is actually expected to jump fairly sharply to 3.6%, because there people will notice whether global petrochemical prices are having an impact on the non-fuel, non-food part. More important will be the May or June inflation numbers, not so much March and April, simply because the expectation is that petrol and diesel prices will be increased after the elections, the state assembly elections. The last of them is on April 23rd. So, prices can rise for the month of May. Food CPI also, please keep an eye, because that is expected to jump to 3.7 compared to around 3.47 in February. Why we have to keep an eye on it? Because the IMD releases the forecast, the monsoon forecast, first forecast data, and there are these El Nino fears. So, food CPI bears watching. If it's starting on a higher base, then that's not very good. Again, another number we should watch out for in future, that is tomorrow, is the WPI numbers. Wholesale price index are not impacted by whatever the government does to consumer prices. That may more clearly reflect international prices. Again, bears watching. Our poll was about 3.35%, but that's a sharp increase from the 2% last month.
Latha, thank you for that update there. All eyes on the CPI numbers later this evening, especially after the US CPI figures that were released on Friday evening. Now, the Reserve Bank has released draft amendment directions on methodology for identification of classifying upper layer and government-owned NBFCs. Ritu is joining in with more details on this. Ritu.
Well, these are draft amendment directions that propose changes in how upper layer NBFCs are going to be classified. And the biggest shift is that RBI is proposing to scrap the existing parametric scoring model, which is currently used to identify them, and replace it with something much simpler, where any NBFC with an asset size of 1 lakh crore and above is going to qualify in the upper layer list. RBI is also proposing to remove the automatic inclusion of the top 10 NBFCs into the upper layer. And importantly, the restriction on government NBFCs currently from entering the upper layer is also proposed to be removed. Now, keep in mind, upper layer classification comes with tighter credit concentration norms, so exposure limits coming down to 20 to 25% of Tier 1 capital from as high as 40% earlier. It also involves stricter regulatory, capital, governance, and disclosure requirements. Now, specifically to ease the transition for government NBFCs, RBI is proposing to allow them to exclude the loans that have state government guarantees when calculating the exposure limit. And this is important because many of these lenders have large concentrated exposures to state-backed projects, so they can continue lending to them without breaching this limit, and it eases the transition for them as well. Now, in terms of impact, of course, all of these large government NBFCs that have assets of more than 1 lakh crore, your REC, PFC, IRFC, HUDCO, they can potentially fall in the upper layer list. And on the other hand, smaller players like PNB Housing or Samman Capital that are currently part of the upper layer but have assets of less than 1 lakh crore can potentially move out of the list, depending on the final classification. As for Tata Sons, the question mark remains. These changes do not give them any explicit relief, and whether they get an exemption from listing is going to very much depend on what RBI decides to do with their deregistration application.
Ritu, thank you for that update there. Now, listed companies TCS and Anand Rathi Wealth find themselves in the midst of controversy following FIRs filed in lieu of sexual harassment incidents. Santya is here with more on this. Santya.
At present, Maharashtra police is investigating 2 different matters of sexual harassment at workplace, which allegedly took place in 2 key companies. Let's start with TCS first. Nashik police is investigating multiple allegations against multiple employees of TCS. The allegations include rape on pretext of marriage, forceful religious conversion, and sexual harassment at workplace. So, according to Nashik police, the timeline of these crimes is between February 2022 and March 2026. A victim accused another employee of raping her on pretext of marriage, and another man of sexually harassing her. When the complaint reached the police, police investigated the case and found out there are multiple other women, at least 7 other women, who accused the same set of men of sexually harassing them. Nashik police has so far arrested 7 men, 6 are accused, and 1 is operational manager who, according to police, did not act on the complaint filed by the victims. Let's talk about Anand Rathi case. An FIR has been filed in Pune where a woman has accused an employee of sexual harassment and others of not cooperating and not filing her complaint. Pune police is also investigating the matter.
All right, Santya, many thanks for those details. Now, in response to the said allegations, Anand Rathi Wealth has said, in connection with the said complaint, the complaint was repeatedly called to the police station for inquiry. As per the complaint, no cognizable offence was found and the complainant was requested to register a formal case. However, each time the complainant avoided registering the offence. This is frivolous matter against the senior executives of the company and all necessary legal steps are being taken. End of quote.
Now, a large number of employees of a factory complex are protesting over their demands for a salary increment in phase 2 of Noida. Vehicles and properties were damaged and there is heavy police deployment. Now, heavy traffic congestion on the Delhi-Noida DND flyover is also being seen. Let's now go across to CNN News 18's Simran Babar for more details on this.
Industrial units and factories in the phase 2 of Noida have been seeing an unprecedented action from this morning, 3 days after there have been hundreds of working factory members or factory employees that have turned the protest very violent this morning. These working employees that have staged a massive protest across many routes have been assured complete action by the authorities, the police and the district, and in fact the government as well, saying that the action will be taken into increasing their wages, because of which they have been protesting of a significant wage hike and other service conditions that they have demanded in their protest. But they have nobody that is raising their demands and putting a very nuanced way before the government. And what you can see right now, a person carrying the board of Hamari Mange Puri Karo 8 Ghante 20,000. That is the strategic, in fact, demand that they have been making. They are not happy with nearly 13,000 money or the salary that they are getting. As many are shouting around me, this is a place which is witnessing a very violent, aggressive and unprecedented turn in the protest of the factory workers in Noida.
On that note, it is time for us to head into a short break, but more news and updates coming up on the other side. Stay tuned.
Welcome back. Shifting focus to Hungary now, where Viktor Orban is no longer the Prime Minister of the country, despite consolidating support via constitutional reforms and the media, as well as a visit from US Vice President J.D. Vance. Orban is out after 16 years at the helm. He'll be replaced by the centre-right leader, Peter Magyar. Nearly 80% of registered voters cast votes. That is the biggest turnout in Hungary since the collapse of communism. More than 98% of the votes counted, where Magyar's TISA has bagged a supermajority on course for 138 seats compared to Orban's 55. Orban had already conceded defeat overnight.
And in some somber news, as we wrap up the show, veteran playback singer and the iconic voice of Bollywood, Asha Bhosle, has passed away yesterday at the age of 92, marking the end of an extraordinary era in Indian music. She was admitted to Mumbai's Breach Candy Hospital after suffering from cardiac and respiratory complications. The singer's mortal remains were brought back from the hospital this morning, where a large number of people have gathered to pay their respects. The last rites will be held at Mumbai Shivaji Park this afternoon.
A voice that indeed defined a generation, in fact, many generations. And with that, we take a leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. Recovery, that's definitely something that we are witnessing today, but we continue to be in the red. It's the weekly options expiry, considering it's a holiday again tomorrow. But nevertheless, not complaining, exactly. Nevertheless, so whether we sustain this recovery throughout the trading session is something we'll be watching out for. But yes, some of these pockets doing well in trade today.
Good afternoon, Sonal. Absolutely right. So the theme today, of course, after this sharp gash we saw in the morning, been a very good recovery, especially among some of the names. The power theme is doing very well, the renewable energy theme doing quite well. But a lot lined up on the show, two very important corporate conversations as well. So let's start off with the top headlines. Trump's post reignites fears of a long disruption as he calls for a blockade of Hormuz and puts military action back on the table. Auto and financials are the big drags, even as utilities and realty buck the trend. Rupee slips in trade and is one of the weakest EM currencies today.
RBI proposes a new 1 lakh crore rupee assets under management criteria to classify NBFCs as upper layer. The move will lead to state lenders REC, PFC, IRFC and HUDCO being included, while PNB Housing Finance and Sammaan Capital will exit.
Jyoti CNC Automation falls more than 14% after French authorities initiate a probe on its subsidiary Huron for allegedly export of dual-use machinery in violation of EU export control laws.
Shares of Electra Greentech, JBM Auto and Ather Energy gain in trade as Delhi is set to usher in new rules aimed at boosting sales of EVs and hybrids via incentives while curbing registrations of polluting three-wheelers and fleet vehicles.
And shares of Puravankara zoom in trade on the back of a strong Q4 business update. The company reports a 190% jump in sales, while average realizations rise 21% year-on-year.
Okay, those are the top headlines that we are tracking. The market recovery, of course, is the big talking point today. But, you know, it's a massive recovery that we're seeing in the Bank Nifty. And that is up almost 1,000 points from the lows of the day. And leading to that is the recovery that we're seeing in the Nifty pack as well. Similar is the story with the mid-cap. So let's talk about all the mid-caps that are on our radar. This is our special segment, Mid-Cap Movers. Sudarshan is here to take us through that list. Sudarshan.
So amidst major recovery in the market, one segment that has been buzzing in the trade is the power-related names. All the stocks, if you take a look on the screen, JSW Energy, Tata Power, Adani Power, BHEL, Var Energies, all these stocks are sharply higher with strong volumes. And another theme that is working is the EV-related names. Sona BLW, Auto Ancillary Company, that is sharply higher, up almost 3%. Ather Energy, that has been moving higher for the last 2 to 3 weeks, up 8%. Electra Greentech too, like Ather Energy too, this stock too up almost 2%. Ola Electric is sharply under pressure. The stock is seeing profit booking after almost 70% move over the last 2 weeks. And some of the other mid-cap losers, Jyoti CNC, as you talked about, there is a probe related to its one of the subsidiary. That's the reason this stock is sharply down almost 14%. Swiggy, it's one of the co-founders, has resigned, and that's the reason this stock has fallen almost 4%. PV Fintech has fallen with healthy volumes over the last 2 to 3 sessions. This stock had moved sharply higher, but today this is under pressure, down more than 3%. And lastly, tracking the crude move, all the OMC names have fallen. HPCL down more than 3%.
Well, thank you so much, Sudarshan, for joining us and giving us a list and highlighting all of the top stocks that are moving around in the session today. But moving on, an important conversation lined up for you. The prototype fast breeder reactor at Kalpakkam in Tamil Nadu has achieved its first criticality. With this, India decisively advances into the second stage of its 3-stage nuclear power program. To discuss more on this, we are joined by Anil V. Parab, the whole-time director of L&T, and we will be focusing on 3 key focal points. Number 1, India's aspiration of reaching 100 gigawatt by 2047, the excitement and understanding what exactly is a small module reactor and the total addressable market and how exactly players can capture a piece of this particular pie. Well, thank you so much, Mr. Parab, for joining us. First up, let's actually understand this particular development. What is L&T's role? And if you could give us a sense of how exactly we progress from here on.
Yeah, I think the 3 bullet points, what you said, I'll take one by one. The first one you talked about 100 gigawatt by 2047. Now, this is basically pertaining to stage 1 of India's nuclear program. And here I would say India needs to add capacity at a rate of 4.3 gigawatt average per year. And these rates in past are already achieved by countries like USA and to a lesser extent, France and China. Now, that was, I would say, in late 80s, early 90s. So today, with the latest technologies available at your disposal, I think this is very much possible and it is realistic, achievable. You talked about second bullet, which is what is the role of a small modular reactor. Now, in the nuclear, there are two parts. One is the power reactors, which are 700 megawatt and higher in size. And the second part is basically the India's commitment to achieve net zero carbon footprint by 2070, and also meet its aspiration for the cutting edge technologies like artificial intelligence. Now, there you need the small modular reactor, which are more for captive consumption of hard to abate industries, hyperscaler data centers. So it has got a different segment, and which will be approximately, I would say, 15 to 20% of the total plan, which is in fact made by the government of India. And both are required for different needs. That's how it is all about. Now, you ask what will be the addressable market out of this.
Right.
I would say a company like L&T, we have been in EPC, high-tech manufacturing. So we will continue to play and be the industry trendsetter, market leader in nuclear in this particular segment. And over a period of time, we will also extend our offerings to plant services, which will be required with more and more capacity coming on stream. These nuclear power plants, for their reliable operation, they will need such life extension plant services, which also L&T will address in over period of time.
Okay. Mr. Perhaps you mentioned that there is increased demand for nuclear. Of course, we are seeing that because of the surge in clean energy demand as well globally. And a lot of these countries are already using nuclear energy, and India is making strides there. So two-part question here. One, when you said L&T will be the market leader, what kind of revenues do you have from the nuclear space currently? How do you plan to scale it up once the second stage is operational as well? And the second part of that is about the operationalization of the second stage. We have received criticality, but to get to the operational phase, how long do you think that will take? Do you think it is a while before we complete stage 2 and get the benefits of the criticality that we have achieved?
I think a lot is being talked last 1 week since 6th April on the stage 2 of the Indian nuclear program. So I'll first address that part of it. I would say that when a reactor becomes critical, it is self-sustaining nuclear reaction, which is a big milestone. And the very fact that India has achieved it for the stage 2, and India will be the only second country in the world. And many developed countries have tried it earlier and not succeeded. So I think, considering that, I congratulate all the nuclear scientists, the Bhavini, IGCAR, Department of Atomic Energy, and all the industries who played a very important role in it. I would say now, having started the stage 2, we will have to scale up the stage 2, where more such fast breeder reactors capacities will be added by the government. Immediate plan is, after about a year of operation of this prototype fast breeder reactor, they intend to add 2 more fast breeder reactors of the similar capacity at the same location, whereby you can set it up on a fast track basis, and then some more will have to be added for the stage 2. So I think it is very clear now, completely deterministic. There is no uncertainty which is left behind. So that's what about the stage 2.
Yeah. Yes, Mr. Parab.
You talked about the revenues.
Yes.
You will appreciate, being a listed company, we can't give you the breakup, what is shared with the analyst and the stock exchange. Beyond that, I can't really share on such media. But what I can tell you is our current nuclear revenue, what we are achieving, I do see in next 5 years that will be in a most realistic way, will increase from 3 to 3.5 times, depending on how the government launch various new reactors, plants. If it is faster, it can be faster. If it is slower, so it all depends on finally how the government as well as
Get that point, sir. Absolutely.
because the private players also will be entering the fray.
Right. Mr. Parab, let's try to break this down in another manner. You've given us a good sense of how exactly the system works and what needs to be done as far as a policy point of view is concerned. We spoke to a couple of analysts. One number that came out as far as discussions were concerned was that for every megawatt of nuclear capacity that we will be adding, we will need to spend close to 20 to 25 crore rupees. Number one, would you corroborate and agree with that number? And number two, would you be able to break down that particular number in terms of what will be the share of each player in the ecosystem?
I think, first of all, what you shared is only one type of technology, that is the pressurized heavy water reactor, which is the Indian domestic technology. And the other technologies, which are light water reactor, they are not 20 to 25 crores, what you said. But generally, I will tell you the breakup, if you see, the plant and machinery will be, depending on which technology you select, will be 20 to 35% of the total cost. The remaining will be the construction and the associated commissioning cost.
Okay, take that point.
It doesn't include the fuel cost, which is separate.
Okay, but do you think India's grid and transmission infrastructure is ready for a large nuclear and renewable energy project at the current stage, or do you think it'll take some more time?
I think the transmission and distribution, India is quite mature in terms of large nuclear reactors are concerned. What you must be reading is there are challenges where some of the power plants which are in remote location, they are ready, but the power evacuation infrastructure is not ready. But overall, wherever the nuclear plants are coming up, already the power transmission distribution infrastructure is in place and government is constantly scaling it up.
Okay. Thank you so much, sir, for joining us, giving us a sense of the opportunity, for explaining to us how it will work, and a certain sense of how exactly economics will work as well. Well, with that, we'll slip into a short break. On the other side, more news as well as stock reactions is something that we will discuss.
Welcome back. You're still tuned into Midcap Radar. DE Development is the next management on the show. The stock is up 74% in 2026 so far. Company recently commissioned seamless pipe plant in Anjar with capacity of 7,000 metric tons per year. To discuss more, we are now joined by Chairman and MD KL Bansal, and we'll be discussing 3 points. The first, of course, is the impact of West Asia war. The second is incremental revenue from the Anjar plant. And third is outlook on the order book. Mr. Bansal, good afternoon. Thank you so much for joining in. You know, in March, you had put out a press release saying that some of your export orders are getting impacted. Yes, there are no cancellations, but there could be delivery delays as well. 1 month into that, what kind of changes have you seen? Are you seeing cancellations or are they just delays? And are you seeing higher costs because of freight issues and container issues as well?
Thank you so much. We are not facing any such issues, as I told in my earlier discussion also. We definitely have some delay, which we told that it will happen for fiscal FY26, which is a gone case now. So, you know, whatever revenue loss we had that, which is around, I think, 30 crores odd rupees. But rest, everything is in place. Nothing is changing. This month's supplies are on track. Since, you know, most of the freight costs, sea freight cost is in our customer scope. So we are not impacted by that. And as I said earlier also, you know, we have all the raw material for Q1 sales. So we are not much concerned on this particular war as such at the moment. I mean, if it, let us say, escalates more, or if there is some more serious issues, there may be something. But as of now, considering our present order book, considering our present infrastructure, considering our consideration that we shall be doing majorly 60% of our total revenue from the power sector, and out of that 60%, 50% will come from the domestic market. And so, you know, we are targeting more revenue from the domestic sector in this Q1 and Q2, as a matter of fact. And then, you know, in next Q3, Q4, we shall be concentrating more on the export revenue.
Okay, Mr. Bansal, we want to discuss the domestic market as well. But before that, you know, just want a few hygiene questions out of the way. Number one, so you've said that, you know, whatever hit had to be taken in terms of supply chain disruptions will be done in Q4 and Q1 FY27. Everything is on track. The second question which we want to ask you is, has there been a significant escalation as far as input cost materials are concerned? You said that you are good as far as inventory is concerned, but in case there's an escalation, what could be the impact on EBITDA margins?
There may be, you know, as I said, you know, most of our orders which we are having in hand, we tie up at the same time with our vendors also. So, you know, we are not expecting any major thing to happen, because 80 to 85% of our raw material for the orders in hand is already tied up. So we are not expecting anything, but, you know, at the same time, I will say that we have seen these many cycles in our history of the company. And there has never been a hit of more than 1.5% on overall basis as far as the margin squeeze is concerned.
Okay, so there is no issue right now. At present, things are as usual. And if the war prolongs, then you will have to assess the situation again. Let's talk about your Anjar plant then. Your seamless pipe plant went commercial in March, 7,000 metric tons of capacity which is coming in. What would the full capacity utilization revenue look like? Will you achieve that in FY27 itself?
Should be, but at least 80% is for sure to be achieved. But we are targeting for full revenue in the coming financial year, because the order inflow has already started. We are quite upbeat on this particular plant that we should be able to go full scale and achieve our targets as far as this plant is concerned.
What is the revenue target that you have here at full capacity?
Should be anything around 300 or something like that.
So right now at 80%, you should be able to do 240 crore rupees in FY27. Is that a fair assumption?
Exactly, that should be the case. But of course, you know, it all depends upon our total guidance which we have given, which we are telling again and again that we expect to do around 1,500 of top line from at group level in the coming year.
Okay. Mr. Bansal, so FY27, 1,500 crore top line is what you're targeting. Closing order book for March 2026 was close to 1,940 crore. L1 in an additional slightly over 200 crore. FY27, two questions. What is the order inflow that you're targeting? And what is the order prospect pipeline for you?
We are targeting around 2,000 crores of additional order flows in the coming financial year. And the pipeline is very large. It's almost around 4,000 to 5,000 crores worth of pipeline is there. But
so you're saying that, 50% is the hit ratio that you have in terms of winning most of the tenders you participate in.
This is what we are targeting. Out of our present, that's right. This is what the target is.
Mr. Bansal, you have spoken about diversification into nuclear, there's semiconductors, pharma infrastructure. Where are we in that case? And what kind of capex do you think you'll be putting into this diversification that you've been talking about?
Our major focus, ma'am, right now is that we shall be focusing on the nuclear sector first, which is likely to be on the shop floor. I will say that in the coming 3 years. For that, we do require very little capex. I will not say that it's any substantial capex is required. It's part of our plan already as part of maintenance capex or whatever you call it. It's some additional machines will be required, which we shall be able to arrange very quickly without any issue in that. And, the main concern in that is that we have to have the formal approvals from concerned authorities, for which we are working very hard. We have already hired few people for this particular sector, so that, we get proper guidance. Our applications are already in process. The plant visit is likely to happen maybe in this month or maybe in the coming month at the most. So, once that stage is over, we shall at least fall in the queue to get the inquiries, to quote for the bids. And even, after all this thing happens, we still feel that the real action on the shop floor will not be there before 3 years.
Thank you so much, Mr. Bansal, for joining us, giving us your view as far as the opportunities are concerned, and also on the recent plant that's been inaugurated. Thank you so much once again. Well, we'll now slip into a short break. We'll get you on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. You're still tuned into Mid-Cap Radar, where sources tell CNBC TV 18 that Tiles major Nitco is likely to sell large land parcel in Alibag to House of Abhinandan Lodha. Yash is joining us with more details, and the stock is surging on the back of this news. Yash?
Well, what we've been given to understand from our sources is that NITCO has sort of sealed a very large transaction, and this is to monetize one of its large land parcel that is based in Alibag. The monetization agreement is towards House of Abhinandan Lodha. What we've been given to understand that the agreement involves joint development of this large land parcel, for which the revenue potential, according to our sources, is likely to be about 6,000 crore rupees between, of course, House of Abhinandan Lodha and NITCO. The company in the past also has expressed that it has large land parcels. These are based out of Mumbai and Alibag, and has expressed the intention to monetize them through JDA or joint development agreement for a long-lasting revenue visibility. And this is exactly what the company has done with respect to its large land parcel, signing a joint development agreement with House of Abhinandan Lodha. I understand that the agreement is formally expected to be signed very soon, but of course the value is important, and a large value of revenue potential of about 6,000 crore rupees. We've written to NITCO as well as House of Abhinandan Lodha as far as this particular development is concerned. A response from both parties is still awaited.
Well, thank you so much, Ash, and we'll keep you updated as and when we get the response and when that particular deal does, they do sign on the dotted lines. That particular stock higher by over 7%. Well, a quick recovery in terms of private financials are concerned. Both Axis Bank as well as ICICI Bank have now moved to the day's highest point. It's a very quick and sharp recovery, especially as far as ICICI Bank is concerned. The other stock that's seeing quite a bit of a recovery is Bharat Forge. That particular stock higher by 1.5%. And one name from the broader end of the markets within the defense space is Solar Industries. That particular stock higher by close to 3%. But with that, it's all the time we have on this edition of Mid Cap Radar. Your stocks when we return.
Hello and welcome to Your Stocks live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramanan, and with me as always is Vinny Motiwala. Good afternoon, Vinny. Hi, guys. It's been over the weekend, right? We had that 21-hour conversation. There was no result that came out of it. So there are fears of an escalation in the West Asia war, right? And then to add to it, we've seen all the global markets lower. We've got oil prices that have gone higher. They're above $100 a barrel. So the Indian markets also started that way. They were lower in trade and they continue to be in the red. But we have seen some sort of a recovery from the lows of the day. So the Nifty currently at 23,892, about 0.5% in the red. And we've got the Nifty Bank that has seen a bigger recovery, and now that's only 0.3% in the red. We saw it led higher by ICICI Bank, which is currently 2% higher. And that was what led the recovery, as we can see on the Nifty Bank. So that stock there, 2% in the green. The mid caps also doing better than the blue chips, 0.2% in the red. Sensex, Nifty, both of them 0.5% in the red as we speak.
Hi, afternoon. So surely at least a recovery is what we're seeing in the market, right? News flow negative. We're not seeing anything on the ceasefire. You mentioned all of that, but recovery is what's coming in. I just want to highlight a couple of bright spots of the trading session. One, obviously, media and energy continue to do well. Apart from that, we have all the sectors that are trading more on the negative side. Pharma, slight bit of a gain, right? Flip-flopping between the red and the green. So let's keep an eye on that. Overall, the markets are seeing a recovery. So there, we're seeing some bit of a recovery as well. Let's move on and get started with the show then and answer all your stock-related queries. And to do just that today, we have our experts joining us. Vaishali Parekh, Vice President Technical Research at Prabhudas Lilladher, as well as Sneha Poddar, VP Research Wealth Management at Motilal Oswal Financial Services, joining us to answer all the stock-related queries. Vaishali, as well as Sneha, good afternoon. Thank you so much for joining us on the show. Let's get started with the first query for today. We have Rajiv, who's writing to us from New Delhi, wants to know the fundamental as well as a technical view on Transtrail writing for the next 6 months. So short-term query is what they have. They've not said that whether they've bought it or no, but maybe if they're looking to buy, is it a good time to look at this one? Sneha, first up on the fundamentals.
Okay, good afternoon. So basically, see, Transtrail Lighting is a specialized player which is into the high voltage power transmission and distribution. And though it's a thin margin business, but then they eventually moved up the value chain and started with the manufacturing of high margin monopoles and the tower structure. So basically, it's a good play wherein they are targeting the 2.40 lakh crore, the national grid expansion projects. And currently, they have a very strong order book of about 10 to 12,000 crores, which provides good revenue visibility over the next 2 to 3 years. But the stock saw a good correction recently because of the recent regulatory warnings and the income tax surge. Though nothing concrete was found, the stock did recover a little. Now, given the 6 months view, if anything further comes out on this, then probably the stock would remain under pressure. But otherwise, if we just look at the pure fundamentals, wherein the order book visibility is there and the grid expansion is a multi-tailwind opportunity, so Transtrail Lighting from that angle will stand to benefit.
All right, we'll stand to benefit from that angle. But Vaishali, let me bring you into this Transtrail Lighting, right? Over the last year, it's actually gained about 11%. It's at 547 today. Over the next 6 month period, any levels that you can watch out for to sort of enter the stock, or what's your take on it?
Hi, very good afternoon, ladies. So I think Transtrail, when I'm looking at the longer term chart, right from 850, it has corrected, and a couple of times, twice in fact, it's taken support at 460. So right now, if I were to ask me, it's coming in a trend, and I think it is showing signs of revival. So if I were to take a view on this, I would say 500 would act as a good support, and this stock needs to move past 560, 570 decisively to expect higher targets of 650. So for now, I would expect a range of 500 to 650. Only about 650, I would say that it is getting into a strong trend. So for now, it is a trading strategy.
All right, it's now a trading strategy. The next query is coming in from Sri Krishnan, who writes to us from Chennai. He holds a few shares of Axis Bank at 1,200 rupees. He wants to know if he should continue to hold, add more shares, or sell at current levels. So Axis Bank is the stock that he has, and the stock is at 1,364 as we speak. Sneha, let me come to you first. What do you make of the stock? Should he continue to hold or add more shares at this point?
Okay, my suggestion would be to hold on to it. See, basically, the bank is trying to focus on the overall. I mean, their strategy clearly surrounds around the growth, profitability, and sustainability. And recently, they are scaling up the premium wealth segment post the acquisition of the City wealth business. And already the synergy benefits have started reflecting in the fee income and the premium retail matrices. So we can expect a steady earnings growth from there. But in this segment, the bank is also witnessing high attrition that could pose as a challenge in the near term. Even our fair value stands roughly around 1400 from 1 year perspective. So I wouldn't suggest adding at these levels. Probably he can hold on for some more time and take a final call post the Q4 numbers and the outlook that the bank shares in the con call.
Maybe take a call post the Q4 numbers. Vaishali, in terms for the technical levels, they bought it at 1,200. They're making a bit of a profit on this one. Should they continue to hold or maybe book out of this one? Because given when I'm looking at the bank side as well, or the Nifty Bank constituents, Axis Bank has been one of those companies which have actually done better than the other banks in the last 3-4 months, the YTD performance. So what's your view here?
The chart, even from a longer term perspective, even from the yearly charts and all, the stock shows a lot of strength. I think it is poised for a next target of 1450 to 1500 levels. So I would say definitely continue to hold. And if he has to add more, I think there was a chance at around 1250, 1260 levels. So for now, if it retraces by any chance, then that would be the level to add, but otherwise continue holding.
Okay. Continue holding is the word coming in there in the technicals. Let's move on then to the next query, where Anuj, who is writing to us from New Delhi, he's bought 1,000 shares of Finolex Cables, and this is at a price of 1,000 rupees, making a loss on this one right now. Considering, the raw material prices that are increasing, global conditions that are worsening as well, what should they be doing right now? He also wants to know the 3 months and 6 months target. But first, on the fundamental front, Finolex Cables, what's your view, Sneha?
See, fundamentally, normally these cable companies, they pass on the higher copper prices to the end users. So though there could be some impact on the transition phase, but normally it gets passed on. Now, when we come to Finolex cable, we prefer more of Polycab and KEI compared to Finolex because, if we talk about Finolex, they are more on the electrical and the telecommunication side, whereas KEI and Polycab, they focus more on the infra projects. So there they tend to benefit. Though, their overall balance sheet is pretty healthy. And but what they're trying to do is they're trying to evolve into a full-scale FMEG business, and they're trying to expand more on the telecom side, where though the opportunity is huge, but it's happening with a lag. So there could be short-term pressure in between if the telecom capex doesn't pick up that quickly. But on the other hand, my suggestion would be to switch to Polycab or KEI, where they are benefiting from the huge opportunity which is being thrown open from the data center theme. So that theme is a structural theme which provides a good long-term bet.
All right, so you're saying switch from this stock would be the way to go about it. But, Vaishali, he wants a 3-month and a 6-month target for the stock, which is, Finolex Cables, which he bought 1,000 shares of at 1,000 rupees last year. So 3 and a 6-month target. And should he stay or should he, get out of the stock at this point?
Well, I would say if he's held on for so long, continue holding, because when you see the chart, 1700 levels was the high sometime a few years back. That is at around in 2024. But now we are seeing the stock consolidating and attempting to show some signs of revival and improvement. So since I would give a view for 3 to 6 months, I think this stock can bounce up to 1050 levels and keep a stop loss of 750. 1050 would be an ideal level to get off the stock and probably switch to the better ones.
All right, switch to the better ones. Next query is coming in from Sri Ram. He writes to us from Chennai. He has invested in a few realty stocks. There's Lodha Developers, which he bought at 1,192 rupees, Brigade Enterprises, which he bought at 1,018 rupees, and Soba, which he bought at 330 rupees. So he wants to know if he should average Lodha Developers and Brigade and add more shares of Soba. So that's his query. He wants to know if he should average Lodha Developers and Brigade and add more shares of Soba. So Vaishali, let me come to you. First. What do you make of the stock, and any targets that he needs to watch?
Definitely. So overall, the realty sector has seen good amount of corrective move, and now I think it's ready for a bounce back. So talking about Lodha, perhaps it is definitely a good opportunity to add more at these levels. And first target that I would look at is 900 and 950. And gradually we can have a relook from there on. So according to me, it is definitely worth adding at these levels. Now, talking about Soba also we are seeing that similar pattern. And I think this stock is also on a road to recovery. 1250 would act as a support. And in times to come, this can see 1500. 1500 should act as a a strong resistance. That is where you can book profits.
Okay. That's the word on the technicals. On the fundamentals, three names: Lodha Developers, Brigade Enterprises, as well as Soba. Sneha, what's your view on all three of them?
Okay, on the real estate front, basically, though the overall, the demand had moderated a little, but having said that, it still remained pretty healthy despite the ongoing macro scenarios. And the supply was also limited, so there was as such no demand-supply mismatch. The inventory levels does remain quite stable, and the prices held on. In fact, we can say that the marginal price hikes could be witnessed in the sector. So now, post the sharp correction, the valuations have turned pretty lucrative. And when the market conditions were bad, still the sector held on. So now from here on, the momentum can be expected to sustain. So Lodha, which is a well-diversified, with its well-diversified presence pan India, and through their JDAs, which is a asset-light kind of business model, we believe that it's got a strong moat, and thus it can be averaged at these levels. In case of Soba and Brigade, since both are in the south market, my suggestion would be to hold on to one and exit one of the names. Both the names are good. It's just that rather than holding too much real estate names in the portfolio, it's always better to manage risk reward in that sense. And thus with Soba and Brigade both being in the south, he can look at least exiting one and averaging the second one.
Okay, that's a word coming in there on the real estate names. But on that note, we're going to slip into a very short break. We'll come back with more of your stock-related queries after the break. Stay tuned in. Welcome back to your stocks on CNBC TV 18. As of now, you can see, right, more stocks on the decline versus the advances, but we have seen a recovery in the market. At one point of time, we were at the 23,890, about that level. We've come off that, but still around the day's highest point. Though we have HDFC Life, Adani Enterprises, ICICI Bank among the top gainers, while losers coming in from the auto pack, Maruti, Eicher among the top losers. Apart from that, Bajaj Fin and Reliance also on the downside. But let's keep it going with all your stock-related queries, and let's move on to the next query then. Aru, over to you.
Absolutely. So Nalini Jindal is writing to us from Patiala with an investment query. She asks if she can invest in Biocon right now. The stock is trading at 344 rupees a piece. Sneha, let me come to you. What's the fundamental view on the stock? Do you think it's a good time to start investing in it?
We are positive on Biocon. Basically, the company has built significant capacity across biologics, generics, and CRDMO, and a majority of their operational cost has been largely absorbed. So now they're trying to unlock the value, through the commercialization of the biosimilars and by scaling up the generics in the high margin US and the EU markets. They are also into the R&D into oncology and the rare diseases, which is likely to provide good visibility going ahead. So the problem with the company was because it was into the R&D phase, so the debt burden had gone up substantially, which now they are deleveraging. And recently, in fact, they followed up with a QIP through which they are deleveraging. So that will help the company to reduce the interest burden. And they also recently got the rating upgrade from S&P, which is beneficial for the company. So given the couple of product launches that they've planned for FY27, in which they'll be commercializing the biosimilar products, so the revenue growth will be visible, and with the majority of the costs being absorbed, so the pressure on the margins will not be there in FY27. So from that angle, one can really look at Biocon from the next 2 years perspective.
Okay, from the long-term perspective, one can look at Biocon, is what you're saying. But on the technical front, Vaishali, Biocon in the last 1 year, actually in the last 6 months specifically, has seen a further fall coming in. So what should you do for Biocon now?
Well, so I would say technically it has come close towards a good support. The trend is not damaged for a long-term perspective. And near-term, what we are looking at, yes, it has corrected quite a bit. But I think at this level, it has a very limited risk. So risk-reward ratio is very favorable. There is a good support band of 320 to 340. So this is a level where one can start buying. And first to look at a target of around 380 to 420. And then it can give higher returns. But for now, definitely, for at least this type of a return, it is a good value buying.
Okay, it's a good value buying is what you're saying for Biocon right now. Let's move on then to the next query. This is an investment query coming in from Midhun, who's writing to us from Pune. He's asking if it's the right time to invest in HDFC Bank and Bajaj Finance. Sneha, HDFC Bank, Bajaj Finance, your view on both these names?
See, HDFC Bank post the merger with with its parent HDFC Limited. What they're trying to do is they are trying to mobilize the deposits and they're trying to bring down the overall loan to deposit ratio for the bank, which is currently about 98-99%. So that they're trying to reduce to 90% and cross-sell the banking products to the legacy mortgage customer base. So basically, they're trying to convert the mortgage-only clients to the full service retail clients, which will eventually drive the NIM expansion for the bank. So it's a long-term strategy, but it has started yielding results, though it's a very gradual and slow recovery. But the valuations are very attractive. The bank is currently trading at 2 times FY27 price to book, which is lower than their 10-year average of 3x. Thus, the synergy benefits have started playing out, and with the valuation being attractive, I believe one can enter at this price level. In case of Bajaj Finance, the company is trying to evolve itself into a fintech giant rather than just being a NBFC. So even in the very volatile macro environment, they've been able to maintain the 20 to 25% CAGR in the AUM, which is commendable. And the aggressive rollout of the AI is expected to eventually lower the cost to income ratio over the next 2 to 3 years. They have a good customer base of about 115 million, and with their commendable cross-selling ability, they will definitely be able to come back to their original growth rate. So from the long-term perspective, it's a good stock to have it in the portfolio, wherein the AI rollout will help the company to sustain the 25% AUM growth in the long run.
All right. So, Vaishali, coming to you then, HDFC Bank and Bajaj Finance. Is it the right time to invest? Any levels they can watch out for?
For investment point of view, yes, definitely. HDFC Bank as well as Bajaj Finance is done with its corrective round. But if you were to look at it closely, HDFC Bank had a good support at 720. So if you want to watch it closely and buy at better levels, then 760, 770 would be a level to start buying. And as far as Bajaj Finance is concerned, 850, 830 is a good support level. So investment purpose, I would definitely say yes. But if you're looking at a shorter term horizon, then buy on dips.
Okay. All right, so buy on dips is what it is for the short term, but otherwise in the longer term, it is a good investment. The next query coming in from Ishwar Singh, who's writing to us from New Delhi, and we're sticking with the theme of financials. The next query is for ICICI Bank, and he's asking if he can invest in the bank right now. So, Sneha, let me come to you. Long-term view, ICICI Bank, is it a good bet? And it's currently trading at 1,351.
ICICI Bank is a very good bet, and especially at this price level, it really makes sense to enter into it. Basically, the bank is trying to prioritize the business banking and the SME loans over the traditional corporate lending. So this is helping them to inch up their yields because they have superior profitability compared to the corporate lending. Under Mr. Sandeep Bakshi, obviously, the bank is very well positioned to sustain the overall healthy loan growth momentum, and they'll continue to deliver the best-in-class profitability. So, it's a very a stable play with 17 to 18% kind of ROE. And though there was some one-off provisions in Q3, but still we believe for FY26 they'll be able to end the year with 2.2% ROA, and which is expected to improve further in FY27-28. So at 2.5 times price to book, it's a very reasonably valued, and thus one should actually look at it from the long-term perspective.
Okay, point taken there, Sneha, as well as Vaishali. Thank you so much for joining us this afternoon and taking us through all the stock-related queries, helping us answer them as well. So thank you so much for joining in. And viewers, thank you so much for sending your query. Keep sending them in. We'll solve them on Monday, Wednesdays, Fridays at 2 p.m. Number on your screens will come up. You'll have the email address as well. So do send us your stock-related queries. And up next, we have closing bell now. So take you through the last hour of trade. So don't go anywhere.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
It's a negative start, yes, but not as negative as feared.
There is a fear whether this CPI number could be terrible, but it won't be.
Negotiations between Iran and the US basically, you can say, collapsed.
My gut is till the ceasefire is in place, the bulls will remain optimistic, and at lower levels, they'll be looking to get in a little bit.
We have a lot of people, as you know, at 10 o'clock tomorrow, we have a blockade going into effect.
So very quickly, coming back to the 23, 650, 660 kind of levels.
The US says that they will only target the vessels that are transiting the Strait of Hormuz to and from the port of Iran therein.
Importantly, the restriction on government NBFCs currently from entering the upper layer is also proposed to be removed.
Now, proposed standards are scheduled to come into effect as of now from April 1, 2027.
We are the second most weak currency, losing about 0.7%.
As far as government fleets are concerned, all hired and leased vehicles will be only electric.
So the theme today, of course, after this sharp gash we saw in the morning, been a very good recovery.
Well, that was the day so far. Hello and welcome to Closing Bell. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Reema Tendulkar. With me are Prashant and Nigel. And in the red, but there has been a significant recovery from the day's low. We had a gap down opening on the back of the surge in crude prices, geopolitical tensions, the blockade which comes into effect from US time today, 10 a.m. So markets opened straight away, gap down. There was a deep gash of more than 400 points at the day's low. The Nifty was down to levels of 23,550. But from there's been a steady recovery in the market. Look at the Nifty Bank in particular. That's down 200 points, but at the day's low, it was down nearly 1,500 points. And the mid-cap index, too, has managed to trim the losses just down to about 0.3%. Hi, guys.
Rima, hi. Nigel, hi. Hi. And, in the morning we were saying that we start lower and then perhaps a recovery. Yes. And 300-point recovery. And markets are awaiting some form of taco, right? Some change, softening, not a complete reversal, because that will be hard to do. The blockade, the naval blockade is only going into effect today evening at 7:30 p.m. our time. So that'll be too much to expect. But, something over today and over the next 24 hours, 36 hours before we come back to trade, the next day. There's a flash at the bottom of the screen, right? France's Prime Minister saying we'll organize with UK in coming days a conference with countries regarding the Strait of Hormuz. I mean, trust the Europeans to, conference it. And we'll get more details on this one. But we've heard from the British Prime Minister, very explicitly saying that we'll not join the war and we would not sort of, send our ships to try and attempt to open the Strait of Hormuz, etc., etc. So 23,881 is where we find ourselves at, and the Sensex 76,994 or so. So it's not a bad-looking screen at all, given, of course, the big spike in oil, etc. An eye, of course, on U.S. futures, which I think are still down just less than 1% or so, and oil prices, which for now remain slightly high. Nigel.
All right. And the good part, I think, Prashant, is if you look at the breadth of the market, when we started off trade earlier today, I recall in the first couple of minutes, I had said that the breadth of the market was less than 200 stocks that were advancing. And that's quickly, totally flipped. So getting into that, midweek holiday or Tuesday holiday, it seems they won't get a little bit closer. It'll be very good news if before we wind up today, they kiss each other. So let's see, Rima, how that goes. Important. Earlier this morning, Rima was the only one in green, but a lot of stocks have joined her now in the green. So breadth of the market improving, portfolios feeling much better.
Indeed. The sectors which are seeing some selling, though, are auto, oil and gas, IT, FMCG. All these indices have cuts in excess of more than 1%. And there is a slump in the European markets, too. So frontline European indices are down close to about 0.5 to 1%. Let's run you through the top headlines, what the last hour looks like. The market staged a strong recovery after President's move to blockade the Strait of Hormuz. It results in a gap-down start. The markets, though, now are almost back in the green. The government aims to go big on accelerating EV adoption. We'll discuss that in greater detail, what the incentives look like for electric vehicles. The rupee has weakened in anticipation of an extended blockade. So we'll get you more on that. The currency right now is at 93.38, and plus the CPI inflation data print will be released today. There's a rally in solar stocks that continues. Acme Solar, Clean Max Energy are higher in trade after HSBC issued a bullish report. All that and more coming up in the last 1 hour of trade. But how should you position yourself? Mitesh Thakkar joins in as always. Mitesh, did you anticipate this kind of an intraday pullback, this extent of it? And do you see more in the last 1 hour?
Good afternoon. So, maybe partially, because in the morning I said I will not go down, go on the long side immediately post the gap down, but I look at how the market behaves around this 23,600 mark, which is where a lot of intraday as well as daily averages are converging. The 21-day exponential average right now is placed at about 23,570 thereabouts. So I think that 50-point band was very important, and we kind of held that and then recovered. So in that sense, while it was not an immediate long call, I think during the day we realized that maybe this level is holding out and we should be in for a bounce back. And the first level was around 23,860, which we have just cleared. And the next would be around 24,050, which is where the market had closed on Friday. And on Wednesday also, we had an intraday high of around 24,035 or thereabouts. So I think this 24,050 is the next level to watch out for. Having said that, on the stock side, I have a buy on DLF, and two buy calls in a market which is still not fully looking strong. But both these stocks, the patterns are good. So DLF is along with the stop at 559 for targets of around 590, 592. And Bharat Forge is a buy call as well. Keep a stop below 1789, look for targets of 1860.
Got it. Okay. All right. Thanks a lot for that, Mitesh. By the way, just pull up a few stocks in the last few minutes that have spiked up. Welspun Corp, that stock has now made a fresh 52-week high. It saw a very, very sharp correction from the peak. We had explained this company at around 700, 750 rupees or thereabouts. It's a play on oil and gas, right? And since oil and gas is going to be incremental important, the pipes could be needed. They have facilities both in the United States as well as in the Middle East. So I think, the street is looking at the earnings visibility which could come about. And I think that's why, in fact, the stock has moved up and it's recovered considerably in the last few days. Keep in mind, that's the stock that had corrected. And then, in fact, now it's bouncing back. Order book as well is rock solid. The US exposure is something that's hold them very, very well. So that one spikes up in trade. Well, let's move on. Then the government is aiming to go big on electric vehicles. 2 sets of draft norms have been released, the CAFE 3 emission norms and the Delhi government's EV policy, both which aim to accelerate the pace of EV adoption. Sudarshan joining us to run us through that neat piece. Sudarshan?
So one segment today that is under pressure is the auto stocks. You talk about Maruti, Mahindra & Mahindra, TVS Motor, Hero Motor. All these stocks are sharply under pressure, while in contrary, EV-exposed names are trading with sharp gains. And now it's on the back of over-weekend developments that we have got. Central government has announced draft of new CAFE emission norms. And second, Delhi government has announced the draft of new EV policy. So first talk about CAFE emission norms. So there are certain changes that we have seen from the earlier norms. Now the assessment would be done over 3-year blocks versus earlier that we had the assessment of every year. For example, they'll consider 3-year period of FY28 to FY30 or say FY30 to FY32. Second change, super credit, that is strong hybrid super credit has been cut to 1.6 times from the earlier 2 times that we had. Third, explicit 3G CO2 per kilometer concession for small cars has been scrapped. And third, they have launched derogation technologies which can reduce EV mix requirement in the range of 2 to 4%. And in case of non-compliance, these companies can buy credits from BEE, that's the government agency, Bureau of Energy Efficiency. Now the question is, what should be the total EV volumes for each company to meet the CAFE emission norm? So in the case of Maruti Suzuki, if they have EV volume in the range of 1 to 3%, they can meet CAFE emission norm, and that is FY28 number. For Hyundai Motor and Tata Motor Special Vehicle, the range is 4 to 7%. And as far as M&M is concerned, because they have higher contribution of commercial vehicle, their 13 to 15% of total volumes should come from electric vehicles. Now coming to Delhi EV policy. So they have launched the new draft of new EV policy for the period of 2026 to 2030, and they have announced certain incentives. So first, talking about cars, if price of an electric vehicle is up to rupees 30 lakh, then it would be exempt from road tax and registration. For electric two-wheelers, if the ex-factory price is up to rupees 2.25 lakh, they will get certain incentive amount. So like 30,000, then second year 20,000, then it reduces to 10,000. For electric three-wheelers, they are saying from the 1st January 2027, all the new electric three-wheelers that will be registered in Delhi must be electric vehicles. And there will be phased electrification of government fleets and all the other. For government fleets, once they notify the rules, all the hired or leased vehicles have to be electric. And as far as fleet operators are concerned, after the government notifies the rules, those fleet operators cannot have petrol or diesel vehicles once the rule is notified. Now, apart from all these EV companies, also we have auto ancillary companies. Those are higher because Nomura believes that once these rules are notified, the products of these companies like Sona BLW, Sansera Engineering, the demand of products will increase, and that's the reason these companies are higher, apart from Ather Energy, or you talk about Atul Auto or Olectra Greentech or JBM Auto. But legacy players are under pressure on the back of these norms.
All right, so thank you very much for that. Deepan Mehta is with us, Director at Elixir Equity. So thanks very much for that detailing. Deepan, good afternoon. Good to have you with us here. What do you make of it? You know, EV mandates, when we've seen EV mandates around the world, right? It's debatable whether they have worked or not. I would say the balance of argument says they've not worked because, I mean, the infrastructure which is required to keep pace and other factors recently have not been suitable for that pace of adoption. Actually, if anything, in Europe, what we've seen is some of these EV mandates have been relaxed. What do you make of this, Deepan?
Yeah, thank you for having me on your show. First of all, look at China. I think the only reason China is in better shape than most other countries because of its electrification program and the efforts that they have put into R&D and in terms of proliferation of electric vehicles. Their actually consumption of oil has gone down. And I think that India will certainly follow suit over there. If you want to get yourself to be energy self-sufficient, to get Atmanirbharta as far as all these energy crises are concerned, then electrification of the auto transportation sector has to be the way forward. And I think that sooner rather than later, the government will announce a slew of measures to boost electrification of transportation, be it taxation, be it PLI schemes, be it infrastructure breaks, whatever it takes. I think we have to move away from oil and gas in our transportation sector where it is easily possible. So I think that whatever the norms may have been before, and whether they were followed, not followed, they were relaxed, not relaxed, and going forward, they'll be implemented very, very seriously. And this is an awakening for the entire world, I think, with this kind of a problem which has taken place, where the actual oil flow has been curtailed like this. I think that's just totally unacceptable.
Ather Energy, Deepan, it listed exactly last year in April of 2025. The issue price was 321. And from there, it's up 3x. It's a 200% wealth creation for anyone who participated in Ather Energy. Do you have a view on this?
Yeah, absolutely. I think that we are going deeper and deeper into Ather Energy, and it's really a credible play on electric two-wheelers. And I just want to share a small piece of information that about 33% of the crude oil goes into petrol, and 60% of the petrol is going into two-wheelers. So I think the low-hanging fruit for the government is giving two-wheeler electrification a huge, huge boost, whether it is direct subsidy or otherwise. And Ather Energy certainly is a direct play on electric two-wheelers. And even Ola Electric, I think, they have also been floundering for various reasons. And there are certain controversies, quality issues. But if they get their act in order, then, the price point is very attractive for retail investors. And who knows, I think if the volumes double, triple or so, these companies can kind of generate very significant handsome profit. At the same time, I think existing two-wheeler companies, be it TVS or Bajaj also, I think they have a very solid two-wheeler rollout. And my sense is that right now maybe the electric two-wheelers for the traditional auto companies may not be profitable, but at scale I think they'll be as profitable as the traditional internal combustion two-wheeler scooters or motorcycles which they're manufacturing.
All right. Deepan, how are you feeling about the real estate basket? Those stocks have got absolutely hammered. Any of the stocks you like?
I think that in in real estate, need to follow a slightly different strategy, and I prefer companies which have annuity revenues. And two, three names come to mind. Of course, there is DLF, where I think 30-40% of revenues come from annuities, and those are also gradually rising. More and more space being kind of leased out over there. Then there's Prestige Estates also, and there's of course Phoenix, another company which we hardly discussed, which is into malls, and they also have a kind of a office portfolio, and they're into real estate on the residential side also. Fabulous Q3 released by Phoenix per se. Have a look at that. And then a better way to play real estate would be through all these companies which offer flexi space, like say a WeWork. I think that's also quite interesting. They're also scaling up pretty well. Another new listing called Office, AWFIS. That's also a very interesting listing. And those two companies, WeWork and Office, are kind of high return businesses because they don't actually buy the office space. They just rent it out and they refurbish it. And then they're there for all the global MNC, GCCs, to do flexible office whenever they require. I think those prospects also are pretty interesting. So the best way to play real estate is through some of the uncommon players within the industry and not the typical regular ones, because I think some sort of slowdown will definitely hit the industry.
Any idea on Shobha Developers, Dipan, on the kind of hit on account of their Middle East exposure? They typically report their monthly sales, quarterly sales numbers. There is a pre-quarter update. That's not come through this time. But if I look at just the price action, year-to-date stock is down 10%. So it's not that it's underperformed the real estate basket since the conflict began. But the street is worried about the impact on their properties in Dubai, their expansion plans in Middle East.
Right, I think, but I'm not completely aware as to what proportional revenues come from the Middle East. And more than that, I think that their area, which is Bangalore, I think if this whole artificial intelligence and slowdown of hiring and a kind of attrition levels increase over there, and if the number of employees in the software services does not increase, then Bangalore would be the first market to be hit. So from various factors, I would just be a little underweight or avoid Shobha Developers. As I said, I think my preference is for companies, which are doing flexible leasing of office space or which have got annuity revenues. You could even look at Lodha Developers, which is into data center. And I read somewhere that that's going to be a great business 2-3 years down the line, or other big business for them 2-3 years down the line. They have the land, they have the connectivity, they are in kind of the location is very attractive. Set up data centers as well. So something which is not run-of-the-mill ordinary real estate company, but something which is, I think I would say, different, and it should eventually provide some sort of steadiness in their revenues.
That point about Bangalore and employment and IT, AI, etc. When we were chatting with Rajiv Batra of JP Morgan, he said that the FIs have three concerns when it comes to India. Rupee weakness, the earnings, that double-digit earnings growth is not coming through. And particularly when it comes to AI, they're worried about the structural impact AI will have on employment in India going forward. And that's the Bangalore play, the hit that you were talking about. Dipan, stay on because we want to talk about the rupee. The rupee has crossed the 93 mark against the dollar today. It's down 0.5% given the rise in crude prices, the blockade of the Strait of Hormuz. Lata is now joining in to tell us what's happened on the currency front today.
Well, the fact that there can be a rather prolonged and intense blockade of the Strait of Hormuz is the dominating theme in Asian currency markets today. Rupee is one of the bigger casualties, losing about 0.7% and even crossing that 93 mark. The bigger casualty is actually Philippines, which is down between 0.8 and 0.9% because these countries are much more dependent on the Strait of Hormuz. And that clearly is reflected in the currency moves. Even other currencies are weak. But, countries like Malaysia and Indonesia have domestic energy resources. And therefore, they're just less affected than India and Philippines are. But the Indian market had other reasons as well. You must remember that on Friday, the markets went into close short on the dollars, according to dealers, because there were high expectations from the US-Iran talks. And therefore, that short covering also pushed the dollar above the 93 mark. More importantly, there was this sale of dollars, open dollar positions by Indian banks, which had to be completed by April 10th, as per the Reserve Bank's strict rules. That sale is also over now, so that liquidity is less. But today, dealers were speaking about actual demand, probably coming in from importers. They didn't hear much from FPIs. More of the import demand, more of the demand for dollars is from importers, according to the few dealers I spoke with. Some supply is coming from the Reserve Bank. That is, public sector banks were supplying dollars at about that 93.40 mark. So maybe that's a level which at the moment will get supported. But those are, of course, only current levels. There is a feeling that there is going to be pressure until this geopolitical crisis is out of the way.
Thank you very much for that. Moving on now to the oil and gas space. The government has hiked the export duties on fuel exports. Sonal joins in to tell us the potential impact on refiners, city gas distributors and the explorers. Sonal.
Thank you so much for that. Well, a couple of things happening in the oil and gas space currently. Of course, the fact that oil has crossed that $102 per barrel mark. Additionally, the government has now increased the export duties on diesel. It has been increased to 55.5 rupees per litre from 21.5 rupees per litre, increased to 42 rupees per litre versus 29.5 rupees per litre. Nomura has written on the conditions that we are seeing in West Asia right now. They say that there will be another war premium on crude oil from here on, and that is something that could continue because peace talks have stalled, and oil supply may face further pressure if the US enforces a Straits of Hormuz blockade that Donald Trump has been talking about, and this would impact supply of 2.3 million barrels per day of oil. Additionally, there could be impact on gas passage as well, and that is because LPG supplies that could be impacted to Asia and specifically India. On this particular export price hike that has come by. Now, remember, this export tax has been levied for more domestic availability of fuels. This will be largely positive for oil marketing companies because, remember, standalone refiners will now be exporting less and will be selling it to the OMCs at the capped price that we discussed last week for their refining transfer price. Additionally, Reliance's export refinery is likely exempt, so domestic units will only be impacted, which is around 50% of their total refining capacity. Standalone refiners may sell to OMCs at a lower post-tax price, and this will reduce procurement price for OMCs. So it is not like they'll have to pay lesser, it's just their losses will be reduced from the current marketing losses that these companies are making. HPCL will benefit the most because it has the most amount of external sourcing, so now they'll get more from these domestic refiners. So all in all, positive for them. But of course, crude oil prices have risen, so that continues to impact their marketing margins, and that is something which is a cause of worry for these companies.
Yeah, no, absolutely. Thanks very much, Sonal, for that. The other one, of course, is Reliance, right? 2.5% lower. And I suspect, it's, of course, the number one drag on the index with its weight. So stocks at about 1,300 or so, 1,320 or so at this point. Anything out of this space, downstream, upstream, Diban?
No, Prashant, I think when it comes to oil and gas, if you're a betting man, then you should definitely look at ONGC. And I normally avoid all oil companies, but ONGC is in a situation where now I think the government will give it a lot of boost for exploration purposes. And it's cash rich, it has got the resources, the technology, and it can easily try and scale up exploratory activity within India. And maybe you look at deals overseas as well. And ONGC, given its size and importance, will become the principal vehicle for the government to increase oil production within India and to go towards our goal to become more and more self-sufficient when it comes to oil and gas. So, and its valuation is really attractive. And, end of the day, we have seen despite all the government interference and everything, the company gives a decent dividend yield. It can easily give returns which are in line or slightly higher than the Nifty. And because of its size and importance, you can make it as a part of your core holding as well. So it means you can take a relatively large position in it in terms of weightage in your portfolio. So normally I'm not in favor of oil marketing companies or the oil and gas, PSU oil and gas, but ONGC I think is looking more and more attractive. And who knows, I think, it could go the PSU defense way also. Those companies also were in slumber for a long, long time. till the government decided that defense is our focus. So.
Okay, all right, Dipan, thanks a lot for that. Wishing you a good Monday evening and have a good break on Tuesday. Hopefully we come back on Wednesday and things looking up, particularly on the geopolitical front. Well, let's quickly run you through the FNOQs because today's the weekly expiry as well that will take place. I think the biggest positive before we get to the options data is the advanced decline ratio. The number of stocks advancing has moved up from 200 to 1200. That's nice. Portfolio is not feeling too bad. But there is clearly signs of writing, even on the call side. 23,900 call. The premium has come down from 230. I think the last I checked it was only 14 rupees. Remember, these contracts will expire in the next 45 minutes. Similar is the case, 23,800 call. Premiums down to $5 from around 60 rupees or thereabouts. I think that needs to come up actually for this particular strike. So we'll keep an eye out on that one as well. And on the put side, the premium is down to around 18 rupees from around 71 rupees. Now that's further come down because there is aggressive writing being seen on that particular strike, which is telling you for this expiry, which gets done in the next few minutes, 23,750, 23,800 should hold out on the upside, while on the upside, 23,950, that shouldn't get breached. So we're in that bit of a range. The volatility index, that cooled off from 29 all the way to 19, but that spiked up yet again. So that's up close to around 8% or thereabouts, but it's not flying away and you don't want that to get past 25, 30 or thereabouts. The Nifty and the Nifty Bank, one would bet that if the ceasefire holds out, this 20 DMA, that's the very, very crucial level on the downside. As you can see on the Nifty, it's close to 500 points away. And on the Nifty Bank as well, it's quite some distance away from current levels. So 20 DMA, significant importance. Individual stocks in focus. ICICI Bank, that's the banking name that's outperforming today. Fresh buying being seen on that counter. Voltas has come in for a bit of a short covering bounce in today's trading session. We're bracing for very, very intense summer. So that's coming for a bit of a bounce. And Adani Power, that's the other stock that we're looking at in today's trading session. That as well, some signs of fresh buying on that counter. So net, it's actually been an encouraging trading session if you look at the headline index as well as the breadth of the market. We'll slip into a short break though. You come back. Varun Goel of Mirae Asset will be joining us. Stay tuned.
Welcome back. Let's identify stocks now where you are seeing price and volume action. Hormus now joins in to put the spotlight on the top movers.
More movers on the upside than the downside in today's list. Clean energy names are doing very well in today's session. Not just today, they have done fairly well for the last couple of weeks now. And look at NTPC Green, look at MV Photovoltaic, Acme Solar as well. Acme Solar received a positive brokerage note today. MV received a positive one last week. And NTPC Green among the best performers today, but still trading below its issue price of 108 rupees. And volumes today are fairly decent as well. The NTPC Green is 3x its 20-day average. MV Photo is around double or 2.5 times. And Acme Solar too, more than 3 times its 20-day average. But if you take a look at the delivery volume so far, well, for NTPC Green, it's almost around about 25%. For MV, it's around 40. If the stock is near its 52-week high. For the other two names, they are down anywhere between 10 to 12% from their 52-week high still. The other one that's was doing well, at least in the morning, was Tata Chemicals. The stock is down around 7% from the highs of the day. At one point was up around 11.5%. Yet it's still the 4th day of gains for the stock. It's gained in 6 out of the last 8 sessions. At the highest point of the day, the stock was up around 32% in this 8-day stretch. Now it's up around 25%. Today's volumes are the highest since October of 24. Close to 1.5 crore shares have been traded today. The 20-day average is around 10 lakh shares. And the stock is still down around about 30% from its 52-week high from September of last year. And the big underperformer today has been Jyoti CNC as the top loser on the Nifty 500 today. The biggest single-day fall since its listing. The stock down in 4 out of the last 6 sessions. Volumes the highest in a month. 70 lakh shares traded today. The 20-day average of close to 9 lakh shares. So still around 6 odd times, 7 odd times its 20-day average. 45% of those shares marked for delivery. And courtesy of today's fall, the stock is back near its 52-week low, which has almost halved from its 52-week high. But despite halving from its 52-week high, the stock is still up more than 100% from its issue price.
All right, thanks very much for that. Varun Goyal is with our Senior Fund Manager, Equity, Mirae Asset Investment Managers. Varun, good to have you with us here. Thanks for joining in. You know, the entire move, and we had Sudarshan explaining it, there is, of course, policy-related changes as well, EV mandates from the Delhi government and so on and so forth. Stocks have done well, especially names like Ather, etc. Is this, you know, more of a, I don't want to say just purely thematic. Of course, there is a institutionalized push towards electrification of vehicles and the auto industry. Sometimes they can, I mean, you know, given what's going on and the broader sort of, you know, tailwind of moving away from oil because of the imperative and the problems one is facing, it kind of takes a life of its own, the theme that is, and then you run away from reality. What's your sense? I mean, is it pricing in real expectations here? Do you own anything? Go on.
Yeah, good afternoon, Prashant. Thank you so much for having me on the show. I think the broader change in energy, you know, from conventional sources to green is a theme which is going to be very prominent for the next decade or so. And I think, you know, now with the recent crisis, this theme will get further strengthened. So I would be personally very positive on you know, the whole solar, wind power ecosystem, all utilities on that side. I think as far as the auto space is concerned, I think we've already seen a very successful ethanol blending program, and hopefully something will come for the diesel also. And I think you know, the shift from ICE to EVs as far as auto is concerned will further get strengthened. And I would expect in the next few months, various state governments and central governments to come up with you know, more programs on that side. So if you look at China today, almost every second car you know, which is sold today is a EV. And I think you know, India will also be forced to kind of accelerate this transition going forward. So as such, the outlook for this space remains promising. One has to, of course, pick and choose you know, what makes investment sense, but broadly the outlook should be positive.
Welspun Corp is a stock that you like. It's a part of your small cap fund, and it's done well, 22% up since the start of the year. So at a time when many small caps have been getting hit, this is a stock which has done well. Now, not getting into the recommendation, though, you know, with the appropriate disclosure, it's a part of your portfolio. Can you tell us the broad thesis behind a stock like Welspun Corp from here on?
Then without getting into stock specifics, but broadly the theme is that the oil and gas as a space has seen very little capex in the last 10, 20, 30 years globally. I think if you look at America, where the declared policy is drill, baby, drill, which means more capex in oil and gas pipelines. I think if you look at the whole Middle Eastern market, Saudi Arabia in particular, we see much more capex happening, and I think there'll be some damage because of war, and we expect some replenishment, reconstruction to happen, and therefore those companies which can participate in the oil and gas capex in some of these geographies are likely to do well, and therefore we would be positive on this space.
What are the other themes that you like over the longer term? We can see from your portfolio the private sector banks, etc., HDFC Bank, a part of your portfolio. But other than that, some niche themes?
Yeah, I think with the kind of correction that we have seen, I think there is a lot of value which has emerged in the whole banking, NBFC, and the capital market theme. I think that's where the earning outlook remains extremely robust. I think specifically if you look at small cap space in particular, we have seen almost a 2 years kind of earnings holiday. And the earnings in FY26 will be very similar to what they were in FY24. On that very low base, we expect a 20% plus kind of earnings growth, even despite the war that is going on. Before the war, the estimates were upwards of 25%. Even with a little bit of cut, I think the earnings outlook remains very positive. So I think auto ancillary, consumer durables, the whole auto space remains one of the biggest beneficiary of the GST cuts, and we believe that momentum will sustain at least till Diwali. I think if you look at the whole capex related activities, defense, railways, we expect a further boost to capex on that side. We already spoke about renewable sources of power. So overall, I think the cyclical India story remains extremely promising. And we believe that the cyclical recovery that we're witnessing in India in the last 2-3 quarters will sustain despite the war, although the strength may reduce a little bit. I think if you look at GDP growth, expectation still remains closer to 7. So we continue to be positive on India-centric themes going into the next 6 to 12 months.
All right. Hi, Varun. Good to see you. Been talking about India's focus themes. Cement players, that's something that I'm going to be looking at very, very closely. I'll tell you why, because they'll have a bit of a headwind owing to rising input cost, because they'll have inventory for around 60 days. So till May, they should be okay. But from May onwards, that input cost spike will hit them. However, that's giving them a reason to go ahead and increase prices as well. After having a very January to February, in terms of volumes, now margins could pull back a little bit. How do you approach this theme, and what do you like? The large cap names, the mid-sized name, or some of these small cap names that are trading at a sharp discount to their replacement cost?
I think broadly, the base case remains that the war should end sometime this month, maybe a few weeks down the line. And therefore, we expect crude oil to pull back from almost $100 a barrel to, let's say, $80, $85 a barrel for the next few months, and thereafter pull off further. And therefore, I think all the companies or industries which are big users of crude oil as an input will suffer for 1, 2, 3 quarters because of raw material price increase. But I think that is largely kind of priced in the big price damage that we saw in the last few months. Incrementally, I think I would be positive on the users of oil as a raw material, and which basically means companies in the adhesive space, companies in the paint space, companies on the cement side. I think from the valuations at which they are trading, hopefully we should see the damages much less than what is being penciled in at this point of time. And our base case remains that the demand should hold, and therefore we should see a fairly healthy revenue out.
We'll leave it there. Varun, thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC TV 18. 190 lower on the Nifty, 23,866. We'll take another quick commercial break here. We'll come back with D-Street chatter. Nimesh will help us with that. We'll get you some trading ideas on the other side as well.
Welcome back. That bit of a pullback actually has got sold into a little bit. We're still down 220 points, but much better than what we were at the start of the trading session. That said, let's go across to Nimesh, who's joining in on D Street Chatter with an insight into what he's picking up. Nimesh, first at 6:30 p.m. on Friday evening. Well, you were bang on. The FIs turned sellers. So good on that, mate. But
No,
what
they turned
about
buyers.
today?
I think what you meant is they turned buyers, right?
They turned buyers, sorry. From sellers, they turned buyers.
Yes.
Today, what's the buzz like?
I'm not sure whether it'll be net positive number today, but even if it's a sell number, it's not going to be very large. So from a flow perspective, it's a mixed day of trade, but there is a small MOC buy basket and leading FI desk. So that's from a flow point of view. But there's been a decent recovery across the board, whether it's Nifty, Bank Nifty, as well as in the broader market. We've seen a very sharp recovery. The mid-cap index has rallied almost 2.5% from the intraday low. So clearly the momentum seems to be in the broader market names, even in today's trade. From a sector point of view, energy and utilities stands out in terms of big gains, whereas the only drag has come from autos because of the potential headwinds there. Of course, IT2 is a bit of a drag in today's market. The interesting thing is the Nifty Bank. While the index has recovered from the intraday lows, at least there I'm seeing mixed flows with a bit of selling as well in some select banks as well as in some select NBFCs as well. So this is one space which is quite mixed from a larger institutional point of view. As I said, the breadth has turned quite positive for the broader markets in the last couple of hours as the index has recovered almost 2.5%. So clearly the momentum is shifting towards the broader market names, both from HNI retail investors as well as institutional investors. And today what stands out is power and utility space in terms of big movers there.
Okay, all right. Nimesh, slip of the tongue on that one. I think I was already into the weekend, into the Tuesday holiday. What about individual stocks, Nimesh?
So the first on my list is UPL, United Phosphorus. It's been consolidating in the last couple of weeks, but I understand there could be a corporate development very soon. A potential inorganic move in the overseas market is the buzz as far as UPL is concerned. So that's the first name. The second stock is Clean Max. The entire renewable space is doing good, but Clean Max stands out in terms of aggressive bids from large institutions as well as the HSBC initiating report as well. Remember, in Clean Max, the delivery volumes are quite low. So even with small volumes, you might see a big uptick. So that's playing out today in Clean Max. The third name is Vedanta. Within the metal names, this stands out in terms of delivery-based buying for the last couple of days, and that's the trend today as well. So expect high volumes, high delivery volumes in Vedanta in today's market. And the last couple of names where there is selling today, Shriram Finance as well as Chula Investment. No specific news, but there is delivery-based selling from larger institutions in both those NBFC stocks today.
Thank you very much for that. Let's get in a few last-minute trading ideas as well. Mitesh Thakkar, as always, is back with us. Mitesh, what do you have for us?
We had two long calls at the beginning of the show. The market is still looking good, but then there's always the risk of overnight event which could kind of give you a gap up or gap down, and then you don't even have time to hedge your position. But yet I think given the fact that we've held on to an important technical level in our recovery, we'll go with the long bias calls. I'll go with a buy on DMart or a BTST on DMart with a stop at about 44.25 for targets of around 44.90 to about 4500, maybe higher, but that's the near-term target. And the other stock which I have is a BTST on HAL with a stop at about 40.75 for targets of 41.30.
Okay, all right. Any view on BHEL? I think there is a bit of a rebalance that's likely to take place today. And there could be a bit of a volume spike towards the end of trade today. BHEL, how's it looking in the charts?
I think BHEL to me is a very strong chart. One of the outperformers. And when I was looking at the longer term charts, I think there's a pivot at around 300, 305, and then at about 315. But once these levels are cleared, this 300, 315 zone, I think the stock has the potential to get up to 350, 360 easily and maybe even more. So one of the strongest charts around right now. But yeah, 300 is an important pivot. So from a trading point of view, if somebody has trading positions, I think that's the area to look at taking some profits.
Thank you very much for that. Let's talk about Jyoti CNC. It was a stock that Hormus had highlighted on account of very large delivery volumes and price action. Now, there's news here. French authorities have initiated a probe on the company's subsidiary. Vinny joins in with the details.
Hi, afternoon. So yes, Jyoti CNC, the stock is under pressure, down almost 15%. The French authorities have initiated a judicial investigation on its French subsidiary, that is Huron SAS. Now, obviously, it is important for the company, the subsidiary as well. What is the main reason for this investigation? There was an alleged export of a dual machinery, which was in violation to the laws of the EU's control as well as export laws. So because of that, there's an investigation which is started. Now, the company also came out with a press release. They said that they've taken some measures also. One, the Director General of the subsidiary has been already temporarily barred from the duties currently. Apart from that, the company also highlighted that, in this investigation process, there were bank accounts totaling to around 4 million euros, and 2 residential properties of Jyoti SAS have been already seized by them. A formal judicial investigation is on. The company saying that they're going to, they're refuting all these allegations that have come in, and they intend to contest this allegation as well, which is there against the French subsidiary. Now, what is the impact? Right now, the company has not mentioned the financial quantum of this impact. It's in early stage of investigation. So we'll have to keep an eye out on the impact overall on the financials of the company. Liquidity strain, that is a possibility that could come in as well in terms of near-term execution risk. Is that a big concern? And apart from that, on a consolidated basis, what's going to be the impact overall coming in? French subsidiary accounts for around 10%, 10 to 15% of the revenue, but that's on a consolidated basis. Now, individually from India, is there any impact? That also is something that we'll have to understand.
Can't let you go at that, Vinny. Stay with us. Tell us about the solar stocks. They're up and about in today's trading session. HSBC has come out with a couple of notes on Acme Solar as well as CleanMax Enviro. Run us through those calls.
Absolutely. So initiating coverage, buy call on both of them as well. So Acme Solar initiated coverage, HSBC has initiated coverage, buy rating, target price of 350 rupees per share. Overall, what's the story that they're playing? That power is going to do well in India. Power industry is growing. Renewable energy, that's growing. And these companies will be the beneficiaries that will come in. Now, Acme Solar, what HSBC highlights, that is one of those fastest growing companies, vertically integrated companies, independent power producer of renewable energy as well. So that is why the company would see good growth going forward. The renewable energy projects that are coming in as well, BESS, that will improve the returns of the company. And on the back of that, they are forecasting an EBITDA CAGR growth of around 72% over the next couple of years. For CleanMax also, CleanMax is India's largest provider of renewable energy to the commercial and industrial user side. They expect a growth for this company to come in because of the green energy side of the story, which is around 30 to 45% cheaper than grid power prices. So that is why CleanMax will have an upper hand over here. Apart from that, what HSBC also highlights that they are forecasting a growth of around EBITDA growth of around 60% over the next couple of years. So positive on both these names, and both the stocks are passing in trade.
All right, Acme and CleanMax, thanks very much, Vinny, for that. Amrish Baliga is with us with what she'd want you to do. Amrish, good afternoon. Good to have you with us here.
Good afternoon.
This entire non-oil, which is doing well. This, EV, renewables, solar, what have you. Yeah, I mean, is it just it's not a fad, obviously, but, sometimes bases these kind of things episodically, you can run with it for a while. But the point is, you got to know when to sell.
Absolutely. Because, Prashant, see, the highlight of the US-Iran war is energy shock. So I think energy security would be the clear buzzword going ahead. So, I mean, as far as India is concerned, there's no point focusing on oil because we really don't have oil. So I think the focus would be on power, and that too green energy. And as far as auto is concerned, I think what possibly demonetization in COVID did for the online transactions, probably I think this war will do for EVs, especially in India. And I think the Delhi's EV policy, I think that could also get replicated in other states. So I think this is a sector or a segment to be washed out, at least in the foreseeable future, next possibly 3-4 years, because we'll see, multi-growth in this space.
Do you track a company called Electra, Amrish? I mean, buses, basically. Electric buses.
Yeah, you just see as to what sort of orders are being placed by various state transport corporations on this company. So I think, like I said, possibly the next 3-4 years, you'll see a huge growth for most of them. And even something like Ola, I just see the way it has bounced back.
Okay, all right. But in the mood for a snack, I think you're looking at Bector's Food as well.
Absolutely.
You like that stock at current levels? If yes, give us a rationale. And what kind of returns are you looking at on this name?
See, Bector's basically is biscuits and bakery products, flagship brands like Kanika and English Oven. Decently large range of products. In North India, they are number 2 in the mid-premium and premium biscuit segment. In West and South, they are increasing their footprint. Operations have started in Kolkata and the Bangalore facilities, so these regions should also pick up. And overall, the retail outreach should reach about 3.8 lakh outlets by end of FY27. That compares to about 3.4 lakh outlets currently. And the health focus offerings are also gaining traction. So this is surely with better margins. And they supply buns exclusively to QSRs like McDonald's. They also supply to Subway, Burger King, and KFC. And Cadbury's, they manufacture Oreo biscuits and Choco Bakes. And one of the leading exporters of biscuits from India, about 12% of the total biscuit exports from India is from them. And exports are expected to grow in high teens for the next 2 to 3 years. And most of the capacity expansion has already been done. Small expansion, I think, is remaining in Bangalore facility. So the company can actually generate about 3,000 crores of top line with this capacity, whereas the projected revenue, should grow from 2,050 crores currently to about 2,700 crores by FY28, which means no further capex, at least for the next 2 to 3 years. And operating margins are also expected to move to about 14.6% by FY28. So my expected EPS for FY28 is about 8 rupees, and my target is 240.
Thank you. Ambrish, we'll come back to you. For now, it's time for a short break.
Welcome back. Final few minutes of trade today. We have Amrish Palika who's still with us. Amrish, I wanted to ask you about Sagar Cements, if there's any view on this particular name. One of the big underperformers. The stock has come up drastically from the top. I remember a few years ago when you have Premji Fund, they put in money at around 265 rupees. The reason I'm asking you is because this is one of the lone cement stocks that are in the green. It has valuation comfort as well. What's your take? Avoid it? Or, would you look to do some kind of bottom fishing in stocks that are trading at a sharp discount to the replacement price?
No, I think the only positive for this, the major positive is the discount to replacement price. They had taken over Andhra Cements. So I think that integration also has been taking a bit of a toll. But expected that sooner or later that should turn profitable. So if one has a view or at least a holding power for the next 12 to 18 months, I think at these levels could be bought.
Okay, all right. Any view on Sarda Energy? That's the other stock that's up close to around 4.5%. One of those steel players that have actually moved into power. Now, most of their profitability comes in from power. And the management has told us on the channel that they want to continue their focus on the power segment. They believe it's non-cyclical. Your view on the name, it's a 19,000 crore market capitalization now.
Nigel, in fact, I don't track this very closely, so a bit difficult for me to really give it.
No worries.
Amrish, we've seen disparate moves in the private sector banking names. So in the last 1 year, an Axis Bank is up 12%, and HDFC Bank is down. Sorry, Axis Bank up 26%, HDFC Bank is down 12%, which means Axis has outperformed HDFC by 38%. In the same period, an ICICI Bank is flattish in the last 1 year, while a Kotak Mahindra Bank is also down 10-11%. If you had to pick one private sector bank to bet on, which one would it be?
No, I mean, a private sector bank from an investment perspective for the next 1.5, 2 years plus clearly would be HDFC Bank. First of all, this the amount of controversies which are there actually helped this stock to come down sharply. So for people like us who normally look for contra bets, I think it's a good pick at this point of time. And Axis and a Kotak possibly could be decent from a short to medium term trading perspective. There could be, I think, further upside of about 5 to 7% more from here.
And in the IT space, is there a contra bet?
IT space, yes, it's on watch, but as of now, at this point of time, I'll still possibly wait a bit longer, maybe wait for a quarter or two more before buying. And again, there it will be more on the mid-cap space as compared to the large cap funds.
This Ather Energy has been on a tear ever since its listing. Issue price was 300 rupees plus 321 a year back. Stock has hit a fresh 52-week high, and stock is up 200% in that period. It's taken a lot of people by surprise, this kind of an up move. Where does it go from here?
I think, the way they have been increasing market share, I think it can still go further. I'll not be surprised if we see levels of about 1150, 1200 possibly in the next 6 to 8 months.
Frozen market cap, Rima. Right, and I'm just looking at, trying to look at the numbers here. So I think F5, I think there was basically, I think it's a turnaround story, right? Because there's a loss for the full year. If you're on a net level, there was a loss in F525. That's the last number that we have. 26 numbers, I'm not sure. Of course, we're waiting for the 26 numbers with the fourth quarter number, which should be out. But expectation is, Amrish is absolutely right. In terms of market share, TVS and Ather have done really, really well.
Two contrasting tales, right, Prashant? Two companies listed, Ola as well as Ather, two contrasting promoters as well, one would say by nature. Yeah. And the stock price is absolutely contrasting to what they have done, right? Ola listed with a lot of fanfare and then it's corrected big time, big underperformer from the top, while Ather, well, the stock has listed, it's gradually building onto the gains. And I think that technological advantage is what they have, where people are preferring, they're okay to pay for the kind of technology that they are focused on. And that stock has just moved from strength to strength. Both IIT boys, promoters with a dream, but share prices actually have done very, very divergent moves.
And I think there was that overhang of Ola Electric, the performance on Ather Energy when it listed. Because once it listed, it had a very modest opening. I think it was a flattish opening of 2-3%. And as you said, in the last 1 year, it's seen a steady climb up. I think what the street is awaiting is their capacity expansion plan, which comes up on stream, I think, towards sometime this year. They have 2 plants in Hosur in Tamil Nadu, and the third one is going to come up in Maharashtra, and that will ramp up the company's capacity.
Well, that's right. Well, Amrish, we thank you for joining in and giving us the view on all the stocks that we discussed. Have a good Monday evening. Take a break tomorrow. Wednesday morning, hopefully, markets continue to look up. Let's wrap down the markets for you. Then we end with a cut of more than 200 points, but at least it's better than 350, 400 points that we started off on the back foot. Stocks that did well in today's trading session. First, from the Nifty pack itself, there were a few outperformers. HDFC Life, Adani Enterprises, ICICI Bank, actually, that was a rank outperformer on a day when the Nifty Bank was down 300 points. What underperformed? Eicher Motors came in for selling, Maruti Suzuki was down, Bajaj Finance and big boy Reliance Industries approaching that very crucial 1300 rupee mark. Since crude oil prices spiked up and now there is uncertainty in the globe, so that's why Interglobe Aviation, that came in for profit taking, that was down close to around 2.5%. From the broader markets, what did well? Enviro Infra, there's a good positive news. They won a big order out there. The stock flying away up more than 10%. New India Assurance, remember, very limited free float out there. That stock was up 9%. NTPC Green Energy was up close to around 7%. The stock has seen a big correction from the top. And Sarda was up close to around 5%. What didn't do well in today's trading session? Ola Electric, well, it lost its current today. The stock was down close to 7%. Ashok Leyland as well was down close to around 3%, while you have Zee Entertainment that was down 2.5%. Net, the markets ended with the red, but I'll tell you what, at 3:30 p.m., you're much happier looking at the screen in comparison to 9:15 a.m. when the market started gap down and there were only 200 stocks that were advancing. We end up with close to around 1,200 stocks that ended in the green. So pretty good outcome in this sort of a backdrop. We'll wrap up on this edition of Closing Bell, but you stay with us. Markets Forward team is waiting for you on the other side.
Fears of an escalation in the West Asia war weighs on markets. The last street ends in the red but sharply off lows. Nifty and Sensex fall nearly 1%. Broader markets outperform. ICICI Bank and Axis Bank bat for the bulls.
Delhi, a key market for automobiles, is set to usher in new rules aimed at boosting sales for EVs and hybrids via incentives, while curbing registrations of polluting three-wheelers and fleet vehicles. It also calls for EV charging provisions in all new buildings. Auto stocks under pressure, index falls over 2%.
Crude oil prices surge past $100 a barrel as traffic at the Strait of Hormuz grinds to a halt. The rupee falls below 93 against the dollar, hits its weakest level in 3 weeks.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to get up for the next trading day. I'm Sonal Bhutra and with me is my colleague Ritu Singh. Ritu, what a day, such a sharp recovery from the lows of the day. We did end in the red, but look at that. Bank Nifty off 1,200 points from the lows of the day. Similar story is what we saw at Nifty as well, ending above the 23,800 mark.
Well, yes, it was quite the recovery from the lows that we started with. I mean, at some point, you had the frontline index down almost 2%, but it's good that we've ended with just, down 0.9% as we speak. The Sensex also had crashed by almost 1,600 points during the day, but we've closed with cuts of about 700 points. The recovery from the lows, you had some outperformers in trade. That said, but Nifty Bank, all of that, PSU names like State Bank of India, Union Bank, didn't do quite so well in trade today. But keeping in mind oil prices, Sonal, that you've been tracking, surging 8% overnight and staying up, not a very bad day, here on the Indian stock markets. But here's a lineup of what we have in store for you today on Markets Forward. We'll start with the top movers and shakers of the day with Vivek Iyer. We'll also take stock of the government's bid to go big on EVs and what it means for the auto pack. We'll also tell you why HSBC is betting big on clean power and decode the rupee fall. Last but not the least, we'll also delve into the key market events to watch out for in tomorrow's trading session. So straight away, let's go to our first segment of the day. Vivek Iyer is standing by on the big wall with the top movers and shakers.
That's right. When you're talking about the important stocks, very all-round sharp recovery that we saw from the intraday lows markets. Like you mentioned, the Bank Nifty clearly leading the pack. So the first set of stocks have to be amongst the private financials. Have a look at both Axis Bank as well as ICICI Bank, especially in the last hour of the trading session. Both of these names surged from sharp and staged very sharp intraday recoveries. The other set of stocks that did very well with the entire Tata Group pack. Remember, a lot of news flow regarding a likely mandatory listing of Tata Sons is something that is keeping a lot of companies who have stakes in that particular name abuzz in the session. Tata Chem, another 4% on top of the 6% up move that we saw on Friday. Tata Investment by almost 7%. Sterlite Technology, this particular stock has been a clear outperformer today. Another sharp up move on very strong volumes as far as Sterlite Tech was concerned. Electra Green Tech as well as JBM Auto, sharp push coming in as far as EV mandate is concerned. On the back of that, both of these names did very well. And the entire power basket, especially renewables as well as names that have a certain amount of renewable energy as part of the overall portfolio, did very well. Waaree, Tata Power, with names like JSW Energy were among the sharp moves, especially in the last or in the second half of the trading session. On the other hand, quite a few drags as well, none more so than the auto pack, Cafe 3 norms, as well as the EV push going ahead and becoming a bit of a headwind as far as some of the automakers were concerned. So we saw selling pressure across the C names, we saw across passenger vehicles and even some of the two-wheeler names. And Policy Bazaar, one particular name that stood out from the mid-cap space, sharp down move seen, almost one of the top laggards as far as the F&O space was concerned. OMCs, again, crude oil prices spiking once more. All three of these names ended the day with sharp cuts. A name like Swiggy, again, you did see one of the co-founders resigning. That particular piece of news took the stock low by almost 4%. And Jyoti CNC, one of the French subsidiaries of the company, is under a bit of a probe by the French authorities on the back of that, down by 14%. And that stock didn't really recover even in the second half of the trading session.
Okay, all right. Some interesting names there and some big moves to news as well. Thank you, Vivek, for bringing us all those details. Let's move on to another important story. The government is aiming to go big on electric vehicles. Two sets of draft norms have been released, the CAFE 3 emission norms and the Delhi government EV policy, both of which aim to accelerate the pace of EV adoption. Sudarshan Kumar gets us all the details. Sudarshan?
So one segment today that is under pressure is the auto stocks. You talk about Maruti, Mahindra & Mahindra, TVS Motor, Hero Motor. All these stocks are sharply under pressure, while in contrary, EV-exposed names are trading with sharp gains. And now it's on the back of over-weekend developments that we have got. Central government has announced draft of new CAFE emission norms. And second, Delhi government has announced the draft of new EV policy. So first talk about CAFE emission norms. So there are certain changes that we have seen from the earlier norms. Now the assessment would be done over 3-year blocks versus earlier that we had the assessment of every year. For example, they'll consider 3-year period of FY28 to FY30 or say FY30 to FY32. Second change, super credit, that is strong hybrid super credit has been cut to 1.6 times from the earlier 2 times that we had. Third, explicit 3G CO2 per kilometer concession for small cars has been scrapped. And third, they have launched derogation technologies which can reduce EV mix requirement in the range of 2 to 4%. And in case of non-compliance, these companies can buy credits from BEE, that's the government agency, Bureau of Energy Efficiency. Now the question is, what should be the total EV volumes for each company to meet the CAFE emission norm? So in the case of Maruti Suzuki, if they have EV volume in the range of 1 to 3%, they can meet CAFE emission norm, and that is FY28 number. For Hyundai Motor and Tata Motor Special Vehicle, the range is 4 to 7%. And as far as M&M is concerned, because they have higher contribution of commercial vehicle, their 13 to 15% of total volumes should come from electric vehicles. Now coming to Delhi EV policy. So they have launched the new draft of new EV policy for the period of 2026 to 2030, and they have announced certain incentives. So first talking about cars, if price of an electric vehicle is up to rupees 30 lakh, then it would be exempt from road tax and registration. For electric two-wheelers, if the ex-factory price is up to rupees 2.25 lakh, they will get certain incentive amount. So like 30,000, then second year 20,000, then it reduces to 10,000. For electric three-wheelers, they are saying from the 1st January 2027, all the new electric three-wheelers that will be registered in Delhi must be electric vehicles. And there will be phased electrification of government fleets and all the other. For government fleets, once they notify the rules, all the hired or leased vehicles have to be electric. And as far as fleet operators are concerned, after the government notifies the rules, those fleet operators cannot have petrol or diesel vehicles once the rule is notified. Now, apart from all these EV companies, also we have auto ancillary companies. Those are higher because Nomura believes that once these rules are notified, the products of these companies like Sona BLW, Sansera Engineering, the demand of products will increase, and that's the reason these companies are higher, apart from Ather Energy, or you talk about Atul Auto or Olectra Greentech or JBM Auto. But legacy players are under pressure on the back of these norms.
Take that point, Sudarshan. Thank you so much for joining us and explaining that to us. To take this forward, we are now joined by Ruchit Jain from Motilal Oswal Financial Services and Ambrish Baliga, who is an independent market expert. Thank you, gentlemen, for joining us on the show. Before, Ruchit, I come to you and ask about market levels. Ambrish, comment on this. The draft rules that have been assigned, we are talking about EVs all over and some compliance that would come by and increase costs as well. We were speaking to FADA and they said maybe these OEMs will not be able to pass on the entire costs. Do you think that is one of the reasons why these stocks are under pressure? What do you make of these policies?
No, I think there's a very clear shift going ahead from IC to EVs. And I think this clearly is due to the sort of energy shock which the US-Iran war gave us. And I think the buzzword going ahead is going to be energy security. And like I was just discussing a while earlier also, that what demonetization and COVID did to online transactions, probably this war will do for EVs, especially in India. And the Delhi's EV policy, the draft EV policy, I think would surely get replicated over the next few years across the other states. So I think, EV, the way we have seen the growth, at least in the recent past, I think we should see much better, possibly over the next 4-5 years by 2030, 2032.
Ruchit, any view on some of these EV names? Ather doing exceptionally well in the market. Between that and Ola, there's a clear divergence.
Yeah, hi, very good afternoon to everyone. Well, I think Ether clearly stands out. It's not only in last 1 or 2 trading sessions, but if you look at last 2 months when entire the broader markets had seen a corrective, price-wise corrective phase, Ether was one of the stocks which did not see any kind of price-wise correction. So during the bad times when the markets were not doing well, the stock was rather showing a good consolidation, relatively outperforming the other stocks within the same sector. And now when we have seen some momentum resumption on the higher side, we can see volumes clearly improving over there. So I think Ether should continue its uptrend. Going by the retracements, the stock has potential to surpass that 1,050 range, in the near term. So in terms of outperformance, I think Ether should do well.
Okay, all right. Ether should do well in terms of outperformance. But let's talk about some more stocks. Then HSBC has initiated coverage on Acme Solar and CleanMax, flagging strong upside potential in both names. They have highlighted robust growth visibility and steady earnings outlook because of the rising clean energy demand that we've been talking about. Vinny Motiwala is joining us with more details. Vinny, what's the target price? What's their rationale for initiating coverage on both these names?
Hi, so absolutely, like you mentioned, right, the focus that comes in on renewable energy. India's power industry is now moving more towards renewables, and that's where the growth story will lie for these companies as well. So for Acme Solar, HSBC has initiated coverage with a buy rating, target price of 350 rupees per share. They're saying that this is obviously one of the fastest growing companies in vertically integrated independent power producer for renewable energy. There was 6 gigawatt of capacity currently, which is there, which is for long-term earnings. It provides a good growth visibility as well. The FDRE projects, which are the renewable projects that are coming in, we have BESS that's coming in as well, and that will provide improved returns for these companies, especially Acme Solar. The forecast for EBITDA that they've given, EBITDA CAGR growth over the next couple of years, is going to be 72% is what they expect for Acme Solar. Now, CleanMax is the largest provider of renewable energy for commercial as well as industrial users. They expect strong growth as more companies are using now green energy, which is around 30 to 45% cheaper than the grid power prices. So more demand comes in for clean energy as well. And that's why they believe that CleanMax also could do well. Forecast for EBITDA CAGR growth for CleanMax is at around 60% over the next couple of years. So good growth story that will work out for these companies is what HSBC believes.
Vinny, thanks very much for taking us through that. Well, yes. Amrish, any view on these clean energy stocks? Further upside from here? Where do you see opportunities?
I think, as far as power sector is concerned, I think the major growth will come from clean energy. And among them, clearly, Acme Solar stands out, basically because of the valuations. even after the sort of move which you've seen, it is still comparatively cheap. Going by about 8x FY28 EV by EBITDA. So that's, I think, the lowest among the peers. And if you're talking about the growth, I think 27 we should see 1.5 gigawatts being added. FY28 also, I think a similar quantum would get added. And again, we're talking of a 72% EBITDA CAGR, which I think very few companies in India can show that sort of a CAGR. So I think even at the current level makes a lot of sense.
Current levels, it makes a lot of sense. Anything that stands out for you, Richard, technically in the power space, be the clean energy plays or even our traditional energy? We did see a lot of them making strides today in trade.
Yeah, so if I take the entire energy sector as a whole, then I think Tata Power is one stock which technically looks poised for a breakout after about 1.5 years of consolidation phase. So I think a lot of other names also witnessed good price volume action today with stocks like Adani Power or CSE. But Tata Power, I think from a risk-reward ratio perspective, the stock has already seen a good price-wise as well as time-wise corrective phase. So the risk-reward ratio now seems to be favorable. So at current levels also, one can look for adding in this for the portfolio if one has next 3 to 6 months perspective, then the stock can head high towards 450, 460 kind of levels.
All right, gentlemen, do stay on. We also have to focus on the rupee, which slipped past the 93 mark against the dollar today, hitting its weakest level in 3 weeks. It is now down about 0.7% and pressured by rising crude oil prices and concerns about a prolonged blockade of the Strait of Hormuz. Lata Venkatesh joins us now to take us through the rupee weakness we saw in trade today. And Lata, obviously that 10th April deadline is now behind. We're seeing real moves, but what was the trigger today?
Well, the fact that there can be a rather prolonged and intense blockade of the Strait of Hormuz is the dominating theme in Asian currency markets today. Rupee is one of the bigger casualties, losing about 0.7%. and even crossing that 93 mark. The bigger casualties actually Philippines, which is down between 0.8 and 0.9%, because these countries are much more dependent on the Strait of Hormuz. And that clearly is, reflected in the currency moves. Even other currencies are weak. But, countries like Malaysia and Indonesia have domestic energy resources, and therefore they're just less affected than India and Philippines are. But the Indian market had other reasons as well. You must remember that on Friday, the markets went into close short on the dollars, according to dealers, because there were high expectations from the US-Iran talks. And therefore, that short covering also pushed the dollar above the 93 mark. More importantly, there was this sale of dollars, open dollar positions by Indian banks, which had to be completed by April 10th, as per the Reserve Bank's strict rules. That sale is also over now, so that liquidity is less. But today, dealers were speaking about actual demand, probably coming in from importers. They didn't hear much from FPIs. More of the import demand, more of the demand for dollars is from importers, according to the few dealers I spoke with. Some supply is coming from the Reserve Bank. That is, public sector banks were supplying dollars at about that 93.40 mark. So maybe that's a level which at the moment will get supported. But those are, of course, only current levels. There is a feeling that there is going to be pressure until this geopolitical crisis is out of the way.
Okay, all right. Thank you so much, Lata, for explaining this to us. We did see a recovery in the markets today. Richard, let me come to you first on this. Technically, what are you making of the moves? Nifty above the 24,800 mark for now. We have a holiday tomorrow. Do you think we could continue to see higher levels on the benchmark?
I think a lot of buying interest is seen in the broader markets. We see a good relative outperformance from the mid cap and the small cap space today, as well as last 7 to 8 days. So this move could continue. Technically, that gap area which we have recently formed, in this entire range of 23,500 to 23,200, is likely to act as a good support. And today, in spite of that 450, 500 points gap down opening on the Nifty, we did not see markets going below that level during the day. And mid-caps index have in fact ended flat to marginally negative. So I think looking at this broad-based buying interest, I think market should do well, unless of course something shock comes where the crude oil again surpasses that 114, 115, then that could be a different story. Otherwise, even if the crude stays stable at current levels around 100, then we should see a gradual recovery in Nifty towards 24,500, where the 50-day EMA for the markets is placed.
Well, yes, Ruchit, markets are hoping for some taco trade from Trump tomorrow or in the coming days. But Ambrish, apart from the markets, just a quick question on the NBFC space as well, whether, the potential inclusion of some of these government-owned NBFCs, these PFCs, RECs, Woodcos of the world, does it change your view on the fundamentals, given that potentially they may be subject to some stricter regulations if the rules are implemented as is?
Yeah, in fact, with the stricter regulations, possibly you may have, increased provisions. So I think that's something which could bother analysts. So that needs to be looked at.
Okay, take that point. Ruchit and Ambrish, thank you so much for joining us today with your thoughts in different sectors and the markets as well. With that, we'll do one thing. We'll slip into a short break, but when we come back, we'll come back with some key market events to watch out for on the other side.
Welcome back. You're watching Markets Forward. Now, NBFCs was one space that was in focus today, and that is on the back of the Reserve Bank of India's proposed new guidelines on how upper layer, that is large NBFCs, are now going to be classified. This is still a draft. Final rules are awaited, but there's three big changes. One, the qualitative and quantitative parameters are all out the window. It will be a simple classification that will be based on the asset size. So above 1 lakh crore, and the NBFC will classify to be put in the upper layer bucket. Two, there will be no more automatic inclusion of the top 10 NBFCs in this layer. And three, government NBFCs, which were earlier exempt from being classified as upper layer, will no longer have this exemption. In terms of what this means, you have the names of REC, PFC, HUDCO, IRIDA that have asset sizes of more than 1 lakh crore but were so far exempt, could potentially be included, whereas the smaller NBFCs, names like PNB Housing and Samman Capital, that have asset sizes of less than 1 lakh crore, could potentially see an exclusion. What that means is easier regulations if you're out of the list, tighter regulations if you remain within. As for the question of Tata Sons and what happens to their fate, not much changes because of these guidelines. We'll have to see whether or not RBI grants them an exemption with their deregistration application still pending before the regulator. So that's as far as the NBFC space is concerned. Before we wrap, we'll also get you some of the key market events to watch out for. Upasana Bhatt is standing by with the key events to focus on. Upasana.
Well, firstly, let us look at the domestic cues. Now, companies like Den Networks, ICICI Prudential Life Insurance, Nuvoco Vistas will be reporting their Q4 FY26 numbers tomorrow. So that certainly will be on the top of the radar for tomorrow. NHPC board will consider the proposal of monetization of future cash flows from power assets. The board meeting is scheduled for tomorrow. Now, also in terms of the other events, PM Narendra Modi to inaugurate Delhi-Dehradun Expressway tomorrow. And tomorrow also marks as the second day in New Delhi for the 9th India Pharma Annual Conference 2026. Now, on the flip side, let us look at some of the global cues in terms of economic data. China will be reporting its trade figures for the month of March. US PPI, that is Producer Price Index, tomorrow evening will be out. World Economic Outlook press conference will take place tomorrow evening. And lastly, even IEA monthly oil market report will be out tomorrow afternoon. So all in all, these are the cues that we'll be closely watching out for tomorrow morning. Looks like a eventful day.
Okay, all right, Upasana, thank you so much for joining us with all those details. And with that, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. President Trump threatens to impose a blockade at the Strait of Hormuz after talks broke down in Islamabad. U.S. military clarifies the embargo will apply only to vessels entering and departing ports in Iran. The blockade is scheduled to begin at 7:30 p.m. India time today. Iran's military calls Trump's threat to block Hormuz illegal and warns no port in the region will be safe. British Prime Minister Keir Starmer opposes the blockade. China calls for unimpeded navigation. Crude oil prices surge past $100 a barrel as traffic at the Strait of Hormuz grinds to a halt. Stock markets decline across Asia and Europe. Investors fear a prolonged blockade of Hormuz could worsen the energy shock. The Sensex and the Nifty end in the red but recover sharply from their intraday lows. The rupee also weakens against the dollar as oil prices surge. The IT department flags concerns over multiple startups misusing the tax benefit clause, urges the DPIIT to enhance vigilance to ensure that the benefits reach genuine startups only. An investigation by the department reveals that several registered startups did not have any real business operations. Protests by workers in the industrial belt of Noida turns violent with incidents of arson, vandalism and stone pelting. Workers demand higher wages and better working conditions. Hundreds of police officials deployed as the situation remains tense. Police in Nashik arrest 7 employees of IT major TCS over alleged sexual harassment and forced religious conversion. TCS says the accused employees have been suspended. The company is cooperating with the police. Hungary's far-right leader Viktor Orban's 16-year rule comes to an end. 45-year-old Peter Mayer is set to become the country's next prime minister after his party wins a 2/3 majority in parliament. A close ally of Donald Trump, Orban's ouster is likely to align Hungary more closely with the EU. President Trump launches an extraordinary attack on Pope Leo, calling him weak and terrible over his criticism of the war in Iran. Pope Leo says he's not afraid of the Trump administration, adding, "I will continue to speak out loudly against war." Politicians, film personalities and admirers gather to pay their last respects to the legendary playback singer Asha Bhosle. Her last rites are scheduled to be held this evening. Bhosle, whose career spanned close to 80 decades, died at the age of 92 yesterday. Well, let's start with the news that's just coming in. Macro data, inflation in the month of March has inched higher to 3.4%. Now, this is the highest rate that we've seen in the last 12 months. Latha joins us now with more. Latha, along expected lines?
Yes, in fact, you can say that it's a little less than expected. Our averages were tending between 3.45 and 3.5, and that it's come in at 3.4, means that the inflation is slightly lower. Perhaps the surprise is the food inflation. That's come in at 3.87%, and our poll was coming in, a little towards 3.7 or even less. 3.7 was the exception of the respondents in my poll. We will still have to wait for the calculated number as far as the core inflation is concerned. As always, as expected, rather, the personal services is the one that has risen the most. The inflation is 18.8% over there. But that's because in that personal services segment, we also include gold and silver. From year-ago levels, it is still high, even if gold fell in the month of March compared to February. That accounts for that year-on-year rise. It's a slightly skewed representation. Among others, that's higher are some vegetable prices, tomato and cauliflower in particular, which have a higher, month-on-month increase as well. And that explains the rise in the food inflation, which was not expected to be as high as 3.8. We'll have to come with a core inflation number that will require some calculation at the disaggregated level. But suffice it to say that this is not a place where you must expect too much angst. The inflation numbers are at a modest level because the fuel prices have not been passed on. Petrol and diesel have not been passed on. The expectation is that after the voting in the Tamil Nadu Assembly on April 23rd and the second phase of Bengal as well, probably the state assembly elections behind us, we may see a rise in petrol and diesel prices. So the real number to watch out for will be the May prices, not even the April inflation. We have to also watch very crucially what happens to the WPI number. The wholesale price index numbers come day after tomorrow, and there you may see a greater seepage of inflation because there is no control. Whatever is the international prices seep in all the petrochemical and chemical prices that have risen globally, copper prices, all that will get reflected, and we may see a sharper rise. WPI was running very low at 2% for the past 12 months and sometimes even negative. It may jump to, closer to 4%. That would be a very sharp rise, and that is only the first month after the war. So these are the numbers to watch out for. It's not yet percolated to the CPI level. We will see that only probably in the month of May. At the moment, all's well.
Well, at the moment, along expected lines, even though it's coming at a 12-month high, that's the inflation print for you. Lata, many thanks for joining us. And we'll, of course, have our experts joining Lata shortly to decode those numbers as well as the way forward. But let's go back to the top story this evening. Fresh tensions in West Asia. President Trump's threat to blockade the Strait of Hormuz is setting up a new showdown. This after talks in Islamabad broke down. Now, let's take a look at the key developments so far. Now, U.S. President Donald Trump has declared that the U.S. Navy will start blockading the Hormuz Strait and even has threatened to bomb Iran's water treatment plants. The blockade is scheduled to begin at 7:30 p.m. India time. The U.S. military has clarified that this will not be a total blockade and that the embargo will only apply to ships and vessels entering or departing ports in Iran. Iran's military has called Trump's threat to block Hormuz illegal and has warned no port in the region will be safe. Iran's Revolutionary Guard Corps has warned any military vessels approaching the Strait of Hormuz will be dealt with severely. Traffic at the strait is pretty much at total halt and crude oil prices have soared past the $100 barrel mark once again. Now, all of this comes after a breakdown in the negotiations in Islamabad. The talks ended after 21 hours without a resolution. The U.S. accusing Iran of not giving up on nuclear enrichment, Iran's Foreign Minister Sayed Abbas Araghchi accusing the U.S. of shifting the goalposts during the talks. Iran's Parliament Speaker Ghalibaf also took a dig at the U.S., showing a picture of rising gas prices near the White House. The move to block the strait is sparking disagreement globally. British Prime Minister Keir Starmer says the UK is not supporting the blockage. Starmer also promised to put more efforts to ensure the strait is fully open. China has urged all sides to exercise restraint in the strait. Chinese officials say keeping the key waterway safe and stable serves the common interests of the international community. Foreign ministers from ASEAN have also called for safe passage of ships in the strait. Amidst all of this, the two-week ceasefire appears to be holding for now. There have been no fresh attacks in Iran since the ceasefire was declared last week. Here's President Trump on the Hormuz blockade and more.
Their military is destroyed. Their whole Navy is underwater. You know that. 158 ships are gone. Their Navy's gone. Most of their mine droppers are gone. We have a lot of people, as you know, at 10 o'clock tomorrow, we have a blockade going into effect. That'll be 10 o'clock tomorrow. Other nations are working so that Iran will not be able to sell oil. And that will be very effective. Iran will not have a nuclear weapon. Will not have. There is no way that they're going to get. They still want it. And they made that clear the other night. Iran will not have a nuclear weapon. What we notice and what we see and what I think is maybe my idea, maybe not, I don't know. But there are many boats heading toward our country to fill up with oil and then go and take it. So they're not going to go through the Hormuz Strait. And ultimately that'll be corrected. But in the meantime, they're using us. We have more oil because of drill, baby, drill. We have more oil than Russia and Saudi Arabia put together.
Well, President Trump there on the U.S. announced blockade that comes into effect 7:30 p.m. our time this evening. Now, Israel has continued its attacks on Lebanon over the weekend after the U.S. and Iran failed to reach a peace deal. Reports suggest that at least 11 people were killed in two Israeli strikes on towns in southern Lebanon. The Israeli military said it carried out a raid on a Hezbollah infrastructure site. Lebanese media also reporting that Israel carried out mass detonation in border villages. Israel and the U.S. have maintained that Lebanon is not covered under the Iran ceasefire. Israeli and Lebanese officials are set to hold rare talks in Washington this week. Prime Minister Netanyahu said Israel will negotiate with Lebanon on two conditions: that there be a peace agreement and the disarmament of the Hezbollah. Now, President Trump has criticized the Pope after he raised concerns over the Iran conflict and has called for de-escalation. Trump calling Pope Leo, and I quote, weak on crime, and I quote again, terrible for foreign policy. Pope Leo responding, saying he's not afraid of the Trump administration, asserted that he will continue to speak out against the war.
We don't like a pope that's going to say that it's okay to have a nuclear weapon. We don't want a pope that says crime is okay in our cities. I don't like it. I'm not a big fan of Pope Leo. He's a very liberal person, and he's a man that doesn't believe in stopping crime. He's a man that doesn't think that we should be toying with a country that wants a nuclear weapon so they can blow up the world. No, I'm not a fan of Pope Leo.
The message of the church, my message, the message of the gospel, blessed are the peacemakers. I do not look at my role as being political or a politician. I don't want to get into a debate with him. I don't think that the message of the gospel is meant to be abused in the way that some people are doing. And I will continue to speak out loudly against war, looking to promote peace, promoting dialogue and multilateral relationships among the states, to look for just solutions to problems. Too many people are suffering in the world today. Too many innocent people are being killed. And I think someone has to stand up and say, there's a better way to do this.
Well, that's Pope Leo there responding to President Trump. Now, fears of an escalation in the West Asian conflict have rattled markets the world over, including ours. The Nifty and the Sensex closed down nearly 1%, though they both did come off their intraday lows. So 200-point cut there on the Nifty, 700-point cut on the Sensex. The Nifty Bank down 300 and 300 points down on the Nifty mid-cap as well. ICICI Bank, Axis Bank led the recovery, while reliance on the auto stocks weighed on the markets today, and the broader markets outperformed. Prashant standing by now to wrap up the day's market action. Volatile day, but finally coming off their intraday lows, Prashant.
Under pressure, 200 points lower, but off the lows as well. We were down 450 plus points in the morning. And from that level, the market came up quite nicely and ended around the 23,800 plus levels. Nifty Bank, something similar, mid-cap, small-cap indices. I mean, overall, advanced decline ratio ended negative, but not deeply down in the red or anything. Actually, if anything, if you look at it, right, I mean, oil prices by the time we ended were still, Brent was up 8%. That was the rate when we started in the morning as well. So equity indices recovered quite a bit, and it's not as if it was on the back of oil prices which cooled off. We'll have to see what happens later today with regards to the blockade, and there are some who believe that the blockade will not snap into place. There'll be something which happens before that. Others of the view that even if the blockade were to happen, I mean, it's a negotiating lever rather than anything else, and we go down the ladder as far as escalation is concerned and not up. Anyway, having said that, let me just quickly run you through a bit of what happened today. Just losing on the losing side, autos were down about 2.25%. We've been, of course, covering the Delhi EV policy and other developments on the electric side on the auto and electric side for you. You had the oil and gas space, which was down 1.33%. Reliance, of course, the big mover there on the downside. And the FMCG index was down about 1.25% as well. On the upside, Wix went up 9% and the defense index was up about 0.5% or so as well. Just a quick word as far as large caps are concerned. Eicher Motors was the big loser, 5% lower. Maruti down 4.5%. You had something like Indigo, which was down about 2.6, 2.7% as well. On the upside, HDFC Life up 2.5%, Adani Enterprises up about 2.25%, and ICICI Bank, which was up about 2% or so as well. Broader space, just 4 to 5 names here. So you had Jyoti CNC Casualty. There was, of course, reports of a fraud there, 14-15% lower. Chola Finance was down about 5%. Cummins India down 3%. Polycab, APL Apollo, and a Force Motor, which were down about 2.5% as well. On the upside, Aether Energy continues to be the big rallying stock, 5% higher. Zydus Wellness, fantastic last 5-6 days now. MCX, Vari was another one which was up and about. And a bunch of these Adani Group stocks were up. Adani Enterprises, Adani Energy Solutions, and so on and so forth. Tomorrow, of course, is a market holiday in India. But the rest of the world, of course, is trading and will be reacting to the headlines that we get out of the US and elsewhere. Back to you.
All right, Prashant, many thanks. Well, that was the stock market action. Let's talk about the rupee. It weakened 65 paise against the dollar, courtesy rising oil prices and a stronger dollar. The rupee ending at 93.37 against the greenback today, ending at its worst level in 2 weeks. In fact, the rupee was the second weakest currency in the emerging market basket today. Now, Sir Dorabji Tata Trust and Sir Ratan Tata Trust are reportedly set to hold crucial meetings next month. As per a report by Money Control, the meetings are likely to take place on the 8th and the 12th of May. This comes ahead of an important board meeting of Tata Sons in June, where the extension of N. Chandrasekharan's tenure and the possible listing of Tata Sons may be discussed. Neither of those items are so far officially on the agenda. Now, shares of Jyoti CNC Automation faced heavy selling pressure in today's trading session. This after the company disclosed that French authorities have launched a judicial investigation into its subsidiary, Huron Grafenstenden, over alleged violations of export control norms. French authorities have temporarily restricted the Director General of Huron from performing duties and ordered the seizure of bank accounts worth €4 million. The Income Tax Department has flagged concerns over multiple startups misusing the tax benefit clause. Sources tell CNBC TV 18 the investigation wing is probing multiple firms, with early findings pointing to entities that may exist only on paper to claim tax benefits. The Central Board of Direct Taxes has urged the Department for Promotion of Industry and Internal Trade to enhance vigil. The government is likely to implement stricter verification and action against non-genuine startups. Up next on CNBC TV 18, protests by workers in the industrial belt of Noida turned violent with incidents of arson, vandalism and stone pelting. We bring you the latest when we return. The situation in Uttar Pradesh, Noida remains tense as industrial workers continue their protests, demanding higher wages and better working conditions. Now, the demonstrations turned violent today with incidents of arson, vandalism and stone pelting being reported. One female worker was allegedly struck during police action. Heavy police deployment has been made in sectors 60 and 62 in Noida's Phase 2. Timsy Jaipuria brings us the ground report.
Massive protest going on. People are in anguish. These are minimum wage workers. They are saying government has announced a hike in wages, but still they are not getting the hike. They are saying they are faced by high inflation costs. They are facing LPG crisis. They leave their families at home, little kids at home, to come to work, and still they are not getting even one weekly off. For whatever off they take, their salaries get deducted.
सैलरी नहीं बढ़ाते हैं, खाली इन लोगों को काम चाहिए, काम करवाते हैं इतना 80, 90, 100 पीस लेते हैं, 3 घंटे काम कराते हैं, ये लोग सैलरी नहीं बढ़ा रहे हैं। 1 किलो सिलेंडर 400 रुपए का, 45 रुपए किलो आटा है, क्या खाएंगे, क्या बच्चों को खिलाएंगे, बताइए। महीने का 4 छुट्टी
छुट्टी होना चाहिए कंपनी की तरफ से, महीने का 4 छुट्टी होने चाहिए कंपनी की तरफ से, और वो कंपनी को देना पड़ेगा।
वो कंपनी को देना पड़ेगा। ठेकेदार भी काम कर रहे हैं, वो भी नहीं देते। चाहिए सैलरी चाहिए, दिहाड़ी नहीं चाहिए।
This anguish is not just at one place here at Sector 59 in Noida. This is going across Noida, across the industrial belt, be it an SEZ of hosiery, be it any industrial belt in Noida. The situation is same. Massive protest, vandalization has been happening because these people, these are laborers based on which the entire manufacturing units of Noida function. कितने घंटे की ड्यूटी करते हैं ये अभी
तो ये 10 घंटे की करते हैं सर। 10 घंटे एक मिनट को तुम भी बोल लो। 10 घंटे की करते हैं।
ओवर टाइम मिलता है?
हाँ, ओवर टाइम मिलता है। मैं बोल रहा हूँ। लेबर कोड वाले आते हैं, उनको घूस देकर भगा दिया जाता है।
झूठे दिलासे हैं, समझ रहे हो अब ये बात?
ये घूस देकर भगा देते हैं। ये लेबर कोड आते हैं, भाई घूस देकर भगा देते हैं। ये हम लोग की बात को नहीं सुनते।
एक तो ये अनावश्यक रूप से जो आपको निकाल दिया जाता है।
सर ओवर टाइम मिलेगा नहीं तो हम कहाँ से करेंगे?
ओवर टाइम कह तो रहे हैं, अगर ओवर टाइम करेंगे तो आपको मिलेगा।
When the police came out to announce what is the decision that has been taken by the Noida authority, the DM, along with the government and the factories union, announcing their wages, they say that the announcement that has been made is of old wages. It is not the new wages that was promised. Thus, they are right now again saying that they won't work till the time they get an assurance of their increased salaries.
Well, that is the latest. There are sectors 60, 62 in Noida, which really is the industrial belt, seeing widespread unrest today, and that's also causing huge traffic jams going in and out of Noida. Now, IT major TCS issuing a statement over the case of alleged sexual harassment and forced religious conversion at its Nasik office. TCS has said all accused employees have been suspended. The police have arrested 7 people so far. Now, separately, in a different incident altogether, Anand Rathi Wealth Management is also facing allegations of sexual harassment at its Pune office. Santhe joins us now with more details on both these cases. Santhe, let's start with TCS. Where has the investigation led officials to?
Key companies in Maharashtra have found themselves mired in controversy surrounding multiple complaints of sexual harassment at workplace, forceful religious conversion at workplace, and rape on pretext of marriage. These 2 companies are TCS and Anand Rathi Wealth Limited. Let's start with TCS. Recently, Nashik police received a complaint where a victim employed at TCS's Nasik unit accused a colleague of hers of raping her on pretext of marriage. She also accused another another colleague of hers of blackmailing her and seeking undue sexual favors. She also accused her operational manager based out of Pune of not cooperating with her, not acknowledging her complaint, and asking her not to take the matter further. Nashik police started investigating the case, and according to Nashik police, they found out that it's not just this victim alone. Multiple other women, overall 7 more women came forward and accused the same set of men, 6 accused in total, of sexually harassing them at workplace. They also accused another woman, that is 6 plus 7th accused, of mocking their religious identity, mocking their religious practice, and another man came forward accusing these 7 people of forcefully converting him. Nashik police is investigating the matter and has arrested 7 people in the case. 6 the men accused of sexual harassment, and 7th is the operational manager who didn't act on the complaint. Talking about Anand Rathi Wealth Limited, a victim has accused a colleague of hers of sexually harassing her, and 4 more people, her seniors, of not acting on her complaint. The FIR has been filed by the Pune police, and the company here has said that the company provided her all the legal assistance and asked her to approach the posh department of the company, which the victim didn't do. And the company also says that a company has denied all the allegations leveled by the victim here.
All right, many thanks, Santhya, for joining us. Now, Anand Rathi Wealth has responded to the allegations. The company said, and I quote, the complainant was repeatedly called to the police station for inquiry. As for the complaint, no cognizable offence was found and the complainant was requested to register a formal case. However, each time the complainant avoided registering the offence. This is a frivolous matter against the senior executives of the company and all necessary legal steps are being taken, end of quote. Well, the big international story, Hungary heading towards a regime change after 16 years. Far-right leader and Eurosceptic Viktor Orban conceding defeat in the recently concluded elections. Peter Mayer, once a powerful insider in Orban's party, will become the next prime minister. His party registered a landslide victory, winning two-thirds majority in the Hungarian parliament. Mayer had based his election campaign on rising costs, corruption and declining public services. He had described the election as a referendum on Hungary's future. A close ally of US President Trump and Russia's leader Putin, Orban's ouster lays the path for Hungary to align more closely with its European Union allies.
Hungary's veteran nationalist leader Viktor Orban conceded defeat on Sunday after a landslide election victory by the upstart opposition TISA party. The result is a setback for both Orban's allies in Russia and U.S. President Donald Trump's White House. Challenger Peter Magyar's center-right party grabbed a two-thirds majority in parliament, enabling deep institutional reform and allowing the new government to restructure key institutions. The result marks the end to Orban's 16 years in power and has significant implications not only for Hungary, but for the European Union, Ukraine, and beyond. Half an hour before polls were due to close, data showed close to 78% of voters cast ballots, up from nearly 68% 4 years earlier. Orban, a Eurosceptic, carved out a model of an illiberal democracy, seen as a blueprint by Trump's Make America Great Again movement and its admirers in Europe. But many Hungarians have grown increasingly weary of the 62-year-old after 3 years of economic stagnation and soaring living costs, as well as reports of oligarchs close to the government amassing more wealth. TISA's leader Magyar successfully tapped into this frustration in the win. Orban's exit deprives Russian President Vladimir Putin of his main ally in the EU and sends shockwaves through Western right-wing circles, including the White House.
In fact, just before the Islamabad talks, J.D. Vance, the U.S. Vice President, was in Hungary attending a rally for Viktor Orban ending his 16-year term. With that, it is time for us to wrap up this edition of Business 360. The news will continue on CNBC TV 18. Stay tuned. We're back with plenty more.
Welcome to the Special Indianomics. The consumer inflation for March has come in at a benign 3.4% versus 3.2 in February, but 3.4 is lower than the CNBC TV18 poll of 3.46%. Core inflation is even more benign at 3.3% for March versus 3.4 in February, and the CNBC TV18 poll of 3.6%, so much lower than street expectation. Only food CPI has come in higher at 3.87% versus our poll of 3.7%. All told, the fury of the war and the surge in crude prices and the gas scarcity have not yet hit the consumer index. But is this the last of the low CPI numbers? What can be the hit in the months to come? And will the hit to growth be even harder? For a 360-degree check on the Indian economy, I'm joined by Indranil Pan, the chief economist at Yes Bank, Sakshi Gupta, senior economist at HDFC Bank, and Anita Ranga, the chief economist at RBL Bank. We also have with us the currency and bond expert, Ashish Vaidya, managing director of global financial markets at DBS. Ladies and gentlemen, thank you very much indeed for your time. Let me first ask the economists what they have made of the numbers. Sakshi, you go first. Is at the outset the numbers a benign set? I think you're on mute.
Yeah, sorry. You're absolutely right that the number that has come in was lower than, as you said, the consensus as well as our estimates, and seems to suggest that the pass-through of the higher energy costs hasn't really played out in a big way in the month of March. I think a couple of points just from the data that I want to kind of put forth. One, as you said, core inflation is lower. That's happened because, gold prices actually have been trending lower over the last couple of weeks. And that's helped bring down the core inflation print. Secondly, if you look at some of the details, if you look at the monthly momentum, right, in the CPI basket, I think most indicators are showing very comfortable monthly momentum apart from two categories. One is the fuel category, which we measure through electricity, gas, and other fuels, where the monthly momentum has actually gone up. So it's picking up the LPG price increase, as well as the restaurants and accommodation category, where again, there's been a slight uptick in the monthly momentum.
Okay. And perhaps we are going to see a little more of it if the shortages don't end. I take a point there. Indranil Pan, is there anything worrying at all about these numbers?
On paper, these are definitely sort of reasonable numbers. On paper, definitely not a lot of a worry immediately. But March, I think, is too early to actually factor in the inflationary impact of the war. As Sakshi rightly pointed out, it has picked up the LPG price increases which has happened. We really do not know whether petroleum and diesel price increases also happen and push up the cost for the fuel cost of transportation. So that's something that we need to look and see what really happens. I think the March also is a very early period to understand the pass-through that could be happening from the WPI to the CPI because of the war impact, because of the higher crude prices, and also the supply disruptions, because in March, I think the inventory stock would have been adequate to which would be taken in the previous price of the inventories. Going forward, the inventory costs are definitely going to go higher, and that is what is likely to impact the core side of the inflation. So yes, this number is benign, but going ahead, we might have a bit of a surprise.
Okay, that's what I'm coming to, Anita. What are you penciling in terms of likely increases in April or in May? Have you revised any of your numbers? The Reserve Bank itself for April, May, June is standing at 4%. Will it be worse than that?
I think it will be close to 4%. Like my initial estimates for March itself were much higher than what this was. But I still think that April, May, June can still be around 4%. The reason being, I think there will start to be a quicker pass-through of the energy price inflation, particularly the commercial fuel prices have gone up, especially the LPG, gas cylinders and so on. While the retail for consumers, it has not gone up, the commercial side has gone up. Also, we have seen that large amount of workers have migrated back to the rural side because they are not able to manage at the urban side. But all these things will start to reverse because things have to normalize faster and production has to start to pick up, and then you will start to see perhaps a faster pass through of these prices. And therefore I'm expecting that going forward the pass through will be far more quicker, because that's probably the way normalization will happen.
Fair.
And also if we take a look at the RBI survey which just came along with the RBI's monetary policy, the inflation forecast, which has actually was being downward, has been revised, not for RBI, but the consumer survey that they take, RBI survey, has actually gone upwards. So which means that consumer sentiments which were possibly captured during the March period have already been revised upwards. So consumers are bracing in for a price hike, and therefore it will be easier for producers to start passing on. The second order effects possibly will come faster this time along with the first order effects.
Yes, we already have been reporting from Delhi. There have been protest marches for higher salaries. So clearly it is pinching somewhere. Otherwise, we haven't heard of these kinds of protests in some time now. But now for the place where the action is and where everything is distilled, the bond markets. Ashish Vaidya, thank you very much for your time. The bond yields have ticked lower from 6.95 to 6.93. Clearly happy with the numbers. But what is your sense about the trajectory of bond markets? First, the initial reaction and then the trajectory.
So initial reaction, I think the way the bond markets have already priced in what has come in. I think the bond market is also pricing in what's likely to come in. And that's the reason why we saw the sell-off earlier during the month, and then some sort of respite with the war, on the hold for now. But having said that, the impact on the fiscal is real. A lot of pass-through have not happened. And like all my colleagues in the economic fraternity are saying, I think we will see an upward tick on the inflation. And clearly, there are no real demand triggers on the fixed income side. So I would think that I think it's more or less that interest rates will be either here or moving upwards. And eventually, in a situation where the currency is also under stress, you really can't hold local interest rates much lower than the FX implied rates, which naturally make the currency less attractive. So it's a tug of war. We'll actually have to see how long this lasts. And then really the markets will probably speak out its mind.
Okay, fair point. Actually, today was the first day that we saw the real dollar demand supply impact, because up until Friday, that is April 10th, there was the selling spree of banks. They had to bring down their open dollar positions. Ashish, what are you looking at in terms of rupee pressure? Is the NDF market indicating a lot of pressure? The difference has narrowed, is what we hear.
No, absolutely, the difference has narrowed, and that is obviously going to happen as the positions have got cut. The important point to note is the forward points, which is the difference between the 1 month, 3 month, and 1 month, 6 months, have stayed flat. That means a lot of people will have to sort of take out the position 1 month forward from now so 1 cross 3, 1 cross 6 kind of positions yet has to be covered. So that's going to keep the market on the tenterhook. And fundamentally, we are not seeing any inflows into the country. And we are seeing pressure on the current account. That has to start reflecting, and there are no positive triggers which I'm seeing. So I'm not saying I'm completely bearish on the currency, but at the same time, there are not positive, enough positive triggers. So I think as the war continues and the inflationary pressure, etc., and the local macro starts to deteriorate, we will continue to see pressure both on the currency as well as the rate side.
Okay. You have a range for the currency now, say, I'm not asking you for the year end, but say a range up till June 30th.
So I would put anywhere between 92.5 to 95. It probably can make a double top, is what I think. That's on the currency. On the rate side, I think we should be at about 690 to 705, 710.
Okay. Well, Sakshi, what is your sense in terms of the growth hit? Do you I mean, we're going to get the March numbers only on May 31st, but will the GDP hit be significant?
Lata, for the Q4, which is January to March, we are not pricing in a big hit, right? Because it's just 1 month and it was still early days. Plus, the Jan to March quarter also has a seasonal impact. So January and February were actually doing pretty well in terms of momentum, right? But of course, going forward, our estimates for Q1 are now contingent on, of course, the duration of the war, and we have a number that is lower than what the RBI is estimating right now. So we are expecting closer to 6.3, 6.5 for Q1 FY27 at this point.
Okay, fair point. Indranil, that brings us to the RBI's dilemma. By the time you come to the third quarter, the Reserve Bank is looking at 5.2%. At 5.2% inflation, we are actually in negative real rates. If 5 quarter is the repo rate, I mean, we are almost, flat. Do you see a possibility of a rate hike, or do you think that because growth is what, the way Sakshi is putting it, if growth is under pressure, we may not see a rate hike in FY27? Where do you stand?
I think as per growth estimates for the RBI at this point in time, we have a 6.9. Economic survey tends to point out that the full employment growth for India is at around 7%, with 6.9 is not a bad number. So even if growth goes down to 6.5%, while inflation goes up to 5.2%, I think from a balance of risk perspective, the RBI would be more focused on inflation rather than the growth risk. That's number one. Number two, the MPR clearly brings out that if in the event that oil prices are at 95, compared to their base case estimate of 85 and a currency at 94, and also if the currency is higher, the estimate for inflation for RBI for FY27 then changes to 5%, not from the 4.6%, which means that the chances that the 5.2% is even higher by a 20 to 30 basis points realistically exist. So under these circumstances, definitely there could be a rate hike that we can see, but it's too long drawn out a forecast that we are looking at. A lot can change in between. The only thing that I can say is that in the first half of the financial year, we are not really factoring in any rate changes by the Reserve Bank.
Fair enough.
Yeah.
No, one can sense that it won't be an early rate hike, but whether they will have to do it by the end of the fiscal year, even if not the calendar year, remains open. If, as you say, the hit to inflation is more than the impact on growth. Actually, on that point, if I can take a rapid fire from the economists, Ashish has already given me what is his 10-year range as well as his rupee range for June. But from the inflation numbers, 4.6 is where RBI stands for inflation in the current year. Sakshi, where do you stand?
So, Lata, I have a forecast of 4.9 for FY27.
And do you have a rate hike expectation?
No, I don't have a rate hike expectation at this point. I mean, it's still within their target range, right?
Fair enough. What about you, Anita? What is your inflation expectation for the year and RBI action?
Inflation is close to 5, and RBI I'm expecting at least a 50 bips rate hike.
Oh,
two rate hikes will be there. Yes, I'm expecting.
Okay, well, there are a few people, that group is increasing of people expecting a rate hike. Indranil, your position?
So 4.7% is the inflation, and I'm factoring in a minimum of one rate hike, maybe in December or Feb. If they start in December, then one more warranted in Feb.
Okay. Ashish, your rate hike expectation?
First, let me put my mind stack into place. So first, after the geopolitical stress, you get the price hit. The second step is the supply side effect. The third one would be the impact on balance sheets and corporate earnings. And finally, so we will probably see rate hikes in that third phase. I would tend to think somewhere about August, if this dislocation continues for at least another two months or so. I think I would put it at least 50 to 75 basis points. And I'll not be surprised if the entire market is getting dislocated in a very, very meaningful manner, a 100 basis point hike also coming through.
Oh my God, really? I was not expecting such an position that Sakshi gets outvoted 3-1 and there are rate hike expectations. My sense initially was that the Reserve Bank would be worried more about growth since inflation in this case is a supply side hit and not necessarily demand generated. No arguments in that favor, Ashish? You're going with what the bond markets is saying?
No, absolutely. Going with what the bond market is saying. See, the point is, like I mentioned, right? The monetary policy, while it is always looking internally at the local macros, it's very important to figure out what's happening in the global macros also. So I think fine balance between how the rupee has to behave and how the rates have to, sort of remain in the local economy will also play its role. And that's why my entire assumption about 50 to 100 basis points, actually the bond markets probably are pricing in just about 50 to 75.
All right. Okay. Fine. Let's see what the stock markets take from this. Bond markets clearly is a no-no as far as you all are concerned, because three of you are forecasting rate hikes. But if there is a rate hike, and to the extent that you are saying, then banks become a buy, because that's what they're waiting for, a rate hike cycle, aren't they? Ladies and gentlemen, there is Indranil, Sakshi, Anita and Ashish. Thank you very much for giving us a spin, a 360-degree perspective of the economy. We have to take a break on that note, but don't go anywhere. We have one more economist joining us. The economist of the biggest bank, Soumyakant Ghosh, joins us with his take after this break. Welcome back to this special edition of the State of the Economy. We've just got the CPI numbers for March, and those numbers are actually benign. Lower than what the street was expecting, lower than the CNBC TV18 poll at 3.4%. The headline inflation, particularly benign, is the core inflation coming in at 3.3, whereas the poll expectation was actually 3.6. And even February, we had a core inflation of 3.4. What is surprising is only food going up to 3.87 compared to 3.47. So that's a sharp increase in food. And, there can always be El Nino fears. Joining us now is Soumyakant Ghosh, the Group Chief Economic Advisor at State Bank of India. Also, of course, formerly member of the 16th Finance Commission. Soumya, thank you very much for joining us. The number is benign, the March inflation number. What is your sense about going forward? Are you expecting that even the 4.6% forecast for FY27 may be too high? Or do you think inflation could be worse than that, considering that we are, still in very serious position as far as the Strait of Hormuz is concerned?
Thank you, Lata, for having me on the show. I think regarding the first question, I think the most important point regarding the data is that the headline inflation has come in benign. But the overall imported inflation, which is basically the 22% of the new CPI basket is contributed by imported inflation. And the overall contribution of that imported inflation in the number is at around 42.5% or 43%. And this number has been consistent in the range of 40% to 44% for the last 1 or 2 months. So that's actually the bottom line. The second point which I mentioned to is that the RBI inflation projections at 4.6% as of today looks just reasonable. There could be an upside because if you remember when the monetary policy was announced, the day before there was a expected truce, but today standing 2 days later, I think there is the truce has actually appears to have been broken. So there could be an downside to the growth projections, and there could be an upside to the inflation projections from what was announced in the last policy. I'm just going purely by what is happening in the market.
Cannot forecast geopolitical factors too much, but the IMD is forecasting the monsoon numbers, and that at 92% of the long-term average is not looking all that good. I mean, it's clearly veering towards the deficient. It also says, the IMD that is, that El Nino conditions are likely to continue during the monsoon season. Weak La Nina is moving towards El Nino. That also is not a very good prospect in terms of the quantum of monsoon. Would you start worrying that this 3.87% food inflation might start looking uglier as we get into the second and third quarters?
Yes, I think that's a very good point, Lata, which you mentioned. I was just coming to that point. I think if 92% is the overall rainfall distribution, I think that is supposed to be the weakest ever since 2009 when we had the drought. So I think at that point of time, it was around 80 to 89%. So from that perspective, I think it is going to be a very weak year, and there are prognosis saying that it could be a super El Nino year. So that is point number one. The second point to note is that food prices could have an upside bias in the new CPI series, because if you remember, there are no free goods in the CPI right now. The PDS basket will have to be has been replaced. So from that point of view, the food prices purely with an upside bias. So my sense is that if the current trend continues, the inflation numbers could have an upside bias. The only thing to note forward is that growth remains weak, because if you compare the rural and the urban CPI distribution today, rural is running at 3.63 and urban is running at 3.11, and with the core at 3.38, indicating that the demand continues to be a cause of concern. So purely from that perspective, I think the central bank should look into this growth inflation paradox from a growth perspective, but I will not be surprised if the inflation number actually inches lower. In fact, the September-October inflation projections which we have, and also from the RBI, looks at the number could actually cross 5% for the first time in many months.
Okay. You know, the RBI has 4.4% for second quarter and 5.2% for the October, November, December quarter. You think we may cross 5 in the August-September quarter itself? July, August, September?
In September, October, our inflation projection, in-house inflation projections shows that there is a spike. The number could actually be close to 5.5%, but the things are evolving rapidly.
Okay.
But an inflation of more than 5% in the third quarter looks more likely at this point of time.
Yeah, 5, that's where the Reserve Bank stands. But Soumya, where does all this leave the Reserve Bank's policy? If it were to reach 5 or 5.2, then we don't have, the real policy rate drops to almost zero. That comfort zone of 1% real policy rate is not there. So do you think that the circumstances are leading to a likely rise in interest rates, at least one rate hike in calendar 26 or fiscal 27?
No, I think, Lata, the question on real rate is very logical, but my sense is that you need to, one need to appreciate how the real rate is measured in the Indian context. There are several measures. I think when Dr. Rajan was the governor, I think he suggested the 90-100 treasury bills. So one option could be that the RBI could look through this cycle and could actually look into the market microstructure and take steps which pushes up the short-term rates and balances the long-term rates. Because remember that the government also and the state governments will also have to borrow a significant amount from the market. So my sense is that as long as the scenario doesn't get too ugly, and the way you define real rates is always a matter of debate. Basically, you can take the treasury bills, you can take the CPI. So my sense is that RBI will hold on, because at this point of time, growth looks a little bit uncertain given the current geopolitical context.
Fair point. So that will be the last question to you. Soumya, do you think growth takes a hit? See, there is a problem in the agriculture scenario, because there is a forecast of El Nino and 92%, which is lower than the long-term average. There is also the worry that fertilizers may not be adequate or may be pricier. Given this combination, do you think both demand and rural demand in general and the prices of food grains can make for a lower GDP forecast?
Yes, it's possible. I think the projections for RBI is at 6.9% as of now. But I think if you look into the new series for the last 3 years, this year we had a growth rate of 7.6%. The year before, I think we had a 6.5% growth rate also in between. I think 6.5 there, which was revised from 7.1% to 6.5%. So I think the new series is actually sensitive to the distribution between the formal and the informal sector, and to the extent that there is an impact on the informal sector because of the labor conundrum and the LPG hikes, there could be some sort of an impact on the growth rate. It's too early to say, but if the things continue, and you have to remember that the infrastructure sector, the Middle East has been also badly hit. So from that perspective, it will need a rebuild up. So I'll not be surprised if there is a downside bias to the growth as of today of 6.9%.
All right. In which case, the Reserve Bank would perhaps look through the inflation increase as well if there is a damage to growth. Thank you very much, Soumika Ghosh, for giving us an initial understanding of all the macros. We can clearly see that the economist community is divided. There are 3 people who are expecting a rate hike, and 2 people, including a very prominent economist like Soumya, not expecting a rate hike at this juncture, expecting the Reserve Bank will look through the inflation hike simply because there is also a hit to growth, and the Reserve Bank will be sensitive to that. All this leaves us in a very in a very mixed position. The inflation number for March itself is benign, but the monsoon forecast puts a kind of a mixed picture on the way in which food inflation, inflation in general, and growth will take on from here on. We are in a very, very mixed and confusing situation. That's a wrap on this edition of the State of the Economy. Thank you very much for joining us. More news and updates continue right here on CNBC TV.
इसमें PGM। Hello and welcome to this special broadcast on the West Asia tensions. I'm Ashmit Kumar. Now, the United States military is set to enforce a blockade on vessels entering and leaving Iranian ports today. This comes after talks between Iran and the US faltered. The US President Donald Trump said that either Iran allows all ships to pass or no ships will be allowed through the strait. Meanwhile, Iran's Islamic Revolutionary Guard Corps has called the move illegal and termed it piracy. Trump also claimed that the ceasefire is holding well despite the failed weekend talks. Iran's Foreign Minister Abbas Araghchi has said that the breakdown in talks was due to Washington maximalism and shifting the goalposts. Meanwhile, Iran Speaker Mohammad Bagher Ghalibaf took a swipe at Donald Trump, warning that any disruption in the Strait of Hormuz would trigger a sharper spike in oil prices and that the US would be nostalgic about gas prices around $5. Crude prices have already surged, trading above $100 per barrel before the US announced the blockade. LSEG data showed that 2 oil tankers had exited the strait. Meanwhile, UK Prime Minister Keir Starmer has said that the UK will not join this blockade, but will continue to assist the US with minesweeping and anti-drone capabilities. French President Emmanuel Macron and Starmer are all set to host talks to restore freedom of navigation. Experts believe the Islamabad talks are likely to pave the way for further negotiations, but warn that hostilities could resume. However, over the weekend, Donald Trump said that he does not care whether they return to talks or not. Meanwhile, the situation in Lebanon continues to be dire, with the Israeli military carrying out strikes in the southern Lebanon. Even as both sides are set to begin direct talks in the US tomorrow in an attempt to reach a ceasefire agreement.
Their military is destroyed. Their whole Navy is underwater. You know that. 158 ships are gone. Their Navy's gone. Most of their mine droppers are gone. We have a lot of people, as you know, at 10 o'clock tomorrow, we have a blockade going into effect. That'll be 10 o'clock tomorrow. Other nations are working so that Iran will not be able to sell oil. And that would be very effective. Iran will not have a nuclear weapon. Will not have. There is no way that they're going to get. They still want it. And they made that clear the other night. Iran will not have a nuclear weapon. What we notice and what we see and what I think is maybe my idea, maybe not, I don't know. But there are many boats heading toward our country to fill up with oil and then go and take it. So they're not going to go through the Hormuz Strait. And ultimately that'll be corrected. But in the meantime, they're using us. We have more oil because of drill, baby, drill. We have more oil than Russia and Saudi Arabia put together.
Well, joining us now to take this discussion ahead is with us Anahita Hosseini Lewis, Research Fellow at the Institute for Criminal Policy Research. We also have with us, joining us, author and journalist Ray Locker. To both our panelists, thank you so much for joining us. Mr. Locker, let me come to you first. Again, before we dive into the Iran question, blockade or not, whether or not there will be further talks, Donald Trump unquestionably is the most influential man with respect to the region right now. He holds all the cards, is holding them close to his chest. From a man like that to have a social media post where he is played out to be Jesus Christ, where he's trying to heal a person who's sick, followed soon after by a clarification from none other than the Pope himself, saying that he does not have reason to fear the Trump administration. Again, the theater of the bizarre is what many are calling it. What exactly do we have on our hands? What are we looking at?
What we're looking at is the world's major superpower is run by a lunatic, a 34-time convicted felon incapable of telling the truth. The film clips that you showed had him changing positions multiple times, telling things that just aren't true. And so how do you deal with that? I mean, I live here. I see it every day. I've seen it every day for the last 10 years, 11 years. If I'm somewhere else in the world, first of all, I'm thinking, how do I deal with this person? Second, you shouldn't be afraid of him, even though he is crazy, because you're seeing his weakness all around you. And, yesterday's elections in Hungary show that even more, that people can take on an autocrat and survive and thrive. So those are my major conclusions right now.
Sure. Let's, in fact, dive into the question of the Iran conflict and what happens now post the Islamabad talks. Ms. Lewis, let me come to you again. The decision by Donald Trump to blockade the Strait of Hormuz, a clear application of military force. What many analysts are saying that perhaps lessons from the last 40 days have not been learned. What many analysts are now arguing is that last 40 days, if they show anything, is that military coercion is clearly not working with Iran. Is Donald Trump at risk of miscalculating and trying a strategy that hasn't worked for him in the last month or so?
Well, thank you. It's a very important and interesting question, of course. I think the answer is slightly twofold. So on one hand, America, certainly US and Israel have had a military supremacy over the Islamic Republic, and they have been able to destroy Iran's traditional military power to a high degree. That's not just propaganda, that has actually happened on the ground. However, on the other hand, Iran does have certain strength. The Islamic Republic has certain strengths. It has still managed to keep a lot of its military apparatus, such as it's powered for still using its missiles and drones. And it's also able to produce this under these conditions. That's what some military experts are telling us. In relation to, the latest developments in the Strait of Hormuz, what we're hearing from military experts is that America does have naval supremacy. It is able to impose a high level of blockade. But where I think the challenge will come in for the US is that whilst they have destroyed Iran's traditional navy to a high degree, the IRGC, the Islamic Revolutionary Guard Corps, still does maintain weapons that could make it effective in challenging US's blockade of the Strait of Hormuz. And these include things such as small boats, a very high number of marine mines. I think the estimates are at 5,000. And the most important thing here is not, the balance of the military power, in which obviously the Islamic Republic is disadvantaged at, but also the willpower. The Islamic Republic has figured out that the Strait of Hormuz is a very big leverage for it. It has given it a very unexpected leverage, in fact. So they will be basically very willing to take risks. This includes, with their personnel in order to make sure that the US cannot take full control over the strait.
Let me then also ask you a follow-up question, because given where we are, given what we've seen over the last 40 odd days, are we in a situation where the worst case scenario is a resumption of hostilities, that concentration of military assets in that smaller region? Many experts say could point towards a great likelihood of perhaps a resumption of hostilities, perhaps a miscommunication or miscalculation. Is that a very legitimate and a real risk that we have on our hands?
I think it is certainly a real risk. The reason being that the Islamic Republic came to this war having one very important, from its perspective, objective, and that was to survive this war. At the very beginning, 6 weeks ago, perhaps many analysts would put, the odds against it, but it has shown that, despite a very real mass dissatisfaction with the state inside Iran, mass uprisings did not happen during the war, as some had expected, that there will be a military conflict, there will be a war, like Iran's military power, Islamic Republic's military power will decrease, and then mass uprisings will essentially lead to a collapse of the regime. This has not happened. So the Islamic Republic has managed to maintain its hold over the country, and it has, as we discussed, shown that it does have a level of military resiliency, especially in using tactics of horizontal and asymmetric wars. From its survival perspective, continuing hostilities, as long as it thinks that it will not damage its overall chance of survival, it would probably see it to its benefit. On the other hand, we can see that the US is not willing to compromise and basically give Iran, the Islamic Republic, a very clear win. So I think the continuation of hostilities possibilities at this point is a real, real danger, and what we will probably see in the upcoming weeks.
Sure. Mr. Locker, coming to you now. With respect to this blockade, again, I'm just one more question on that one particular issue. This blockade that we've seen over the last 40 days, China has been a beneficiary. It has been benefiting from access to Iranian oil. So when Donald Trump says that I will not allow ships to leave the Iranian port, is that a dig at China? Is that aimed at China? And I ask you this because a statement coming in from the Chinese Minister of Defense very clearly says, expect others to not meddle in our affairs. Iran controls the Strait of Hormuz, and it is open to us. So I ask you again, is this aimed at China?
Well, I don't know if it's aimed at China specifically. I don't think Trump is thinking that clearly, like, oh, I'm going to say this and it's aimed at China. Obviously, that's a consequence of this. And, you know, the Chinese are not going to look favorably upon a U.S. warship trying to stop a Chinese tanker or any kind of ship from entering or exiting the Strait of Hormuz. So whether he meant it as a dig at China or not, it's a problem. It's going to be a problem with the United States and China, or any other country that owns a ship that's trying to navigate that strait.
So moving ahead, I mean, given where we stand right now, given that it may not be a dig at China, are we looking at a situation where this blockade provides some clarity with respect to perhaps non-Iranian oil? Is that something that you expect? US CENTCOM is quite clear. They will only be targeting Iranian ports, ships coming to and from Iranian ports. Is that likely to give any form of certainty assurance to some of the other Gulf countries?
Well, maybe, but I mean, you're looking at a situation where it's not necessarily that governments are controlling the transit through that area. It's insurance companies. You know, if you own a ship and you can't get insurance to go through there, you're not going to do it. And how many people want to send one of their ships loaded with oil through a navigation passageway that is very challenged, very dangerous? You don't know if you're going to get attacked or not. And so that's a consequence of all of this. People aren't sure if they want to go through that area or not.
Well, on the flip side, despite all the back and forth we've seen over the last 48 hours, one thing that is true is that both sides are holding firm. They're not attacking each other's facilities. There are no missiles and drones that we're hearing about. Is that a reason for some hope that perhaps there could be room for resumption of dialogue and that we could have a second round of Islamabad talks?
Well, I think it's hopeful whenever people aren't shooting at each other. So yes, and I don't think that either country wants there to be a shooting war. I know Trump doesn't really want it. He talks tough. I wasn't surprised at all that he backed down from his threats to wipe out Iran's infrastructure because he really didn't want to do it. And that's the way he does business. He's going to make a lot of threats and then kind of back down. So I think it's always encouraging when people aren't shooting at each other, and I hope that continues.
Ms. Lewis, same question to you. How much appetite is there between Tehran and Washington to have a round two, perhaps, of Islamabad talks?
I think whilst the situation with the Strait of Hormuz is, going through this uncertain phase, it might be hard to see past, the possible escalation that might happen in the next few hours or days. However, I think there still is an appetite for talk from both sides. As we saw in Islamabad, whilst both sides' officials did blame each other for not reaching a final negotiation, but they both also kept the door open, saying that they made a lot of progress on certain issues. So I think there is certainly a possibility of talks. I don't think it will be imminent, but it will also depend on if they can come to a common understanding or a compromise on the key issues that the both sides have been emphasizing on. So that would be Iran's nuclear issue, the Strait of Hormuz, and possibly regional matters related to Iran's links with its so-called proxies and so on. And I think we have to wait and see what happens. The next few hours and days will be quite crucial in seeing how much self-restraint both sides show during this announced blockade of Strait of Hormuz.
Right, Ms. Lewis, I'd request both of our panelists, Mr. Locker, Ms. Lewis, to stay on with us. We're slipping into a very short break. We'll continue this conversation on the other side. Welcome back. Now, ever since the war began, President Donald Trump's rhetoric over the Strait of Hormuz has been shifting constantly. Sample this statement from the 9th of March. 1 week into the war in Iran, Trump declared, and I quote, "I'm thinking about taking over the Strait of Hormuz," end of quote. Now, just a day later, Iran's Revolutionary Guard Corps effectively blocked the strait for Israel, US, and nations they considered as unfriendly. 4 days later, on the 13th of March, Trump warned Iran will be hit 20 times harder if it does anything to disrupt the flow of oil. But Iran remained defiant. 2 days later, on the 15th of March, Trump called up NATO allies as well as Japan and China to send warships to secure the strait. But none of those countries were ready to send troops. 6 days later, on the 21st of March, Trump issued a 48-hour ultimatum threatening to obliterate Iran's power plants if they did not open the Strait of Hormuz. The president was clearly growing frustrated with Iran and even as his allies for not supporting his military operations. On the 26th of March, Donald Trump claimed Iran had given a present to the United States. This present, according to Donald Trump, was Iran giving permission to 10 oil tankers to pass through the strait. But just a day later, President Trump lashed out at NATO allies, showing more signs of frustration. Trump said, and I quote, "Build up some delayed courage, go to the strait and just take it, use it for yourself." On the 3rd of April, President Trump said, and I quote, "With a little more time, we can easily open the Hormuz Strait, take the oil and make a fortune. It would be a gusher for the world." Now, 24 hours after this came a profanity-laced post from President Trump threatening to blow up all power plants and bridges in Iran. In just 3 sentences, Donald Trump used a couple of expletives to warn Iran. And finally, on April 8th, Iran and the US agreed to a 2-week ceasefire. Iran said that it will ensure safe passage for ships through the Strait of Hormuz, while Donald Trump said that the US will help with the traffic in the strait. He even hinted at the US making money out of this. Cut to Sunday, Donald Trump announced that the US will begin a Navy blockade of the Strait of Hormuz after talks to clinch a peace deal broke down in Islamabad. Well, let's go across to our guests once again. Anahita Hosseini Lewis, Research Fellow at the Institute for Criminal Policy Research, as well as author and journalist Ray Locker. Mr. Locker, again, this back and forth that we have seen from the President of the US, do you think this deadline will hold firm? We're looking at 10 a.m. ET time. Do we think Donald Trump will come through on this naval blockade that he seeks to propose, which again seems outrageous to many stakeholders? Donald Trump is keen on it.
Well, I think he may try, and I think there are probably some ships that are going to move in that area. I mean, the big challenge is what happens when they come across a ship that doesn't want to comply. Are they going to shoot at some unarmed tanker or some other cargo ship going through the area? I mean, that's the big question. I certainly would hope not. I think he probably will threaten something like that, and then we'll see what happens when there is a confrontation, because I think there will be one.
Well, speaking of a confrontation, Keir Starmer has taken a very diametrically opposite position to Trump, saying that they will not be a party to this blockade, instead saying that the UK, along with France, will be hosting talks between 40 nations to work out some form of conciliatory mechanism for ensuring safe passage through the Strait of Hormuz. What is that middle ground that Keir Starmer can look at? Is it through the payment of toll that perhaps one can secure? Is that finally the end game here, that let's agree to pay Tehran a toll for passage of these ships?
Well, I hope it doesn't come to that. I mean, I think that's obviously a possibility. Remember, passage through this waterway was free up until a few weeks ago. And also remember, we had a nuclear deal with Iran that was signed in 2015 that Trump tore up in 2018, and here we are. Iran didn't have a serious nuclear capability then. It does now, if you believe what people are saying in Israel and in the administration. And so we're dealing with a lot of questions that were not issues a few years or a few weeks ago.
Well, that's a very interesting point that you make with respect to the nuclear deal. Let me go across to Ms. Lewis on that. Ms. Lewis, Donald Trump, courtesy his social media post, has made it clear that it is the nuclear missile, the nuclear weapon, that is, in fact, the red line for Donald Trump. But what's interesting is that in 2015, that's way back in 2015, Iran had already agreed to not go in for a nuclear weapon. That deal was torn up by Donald Trump himself. Again, does that put him in a very tricky position trying to navigate these talks with Tehran, especially at a time when Tehran appears to exercise control on the Strait of Hormuz?
Yes, I think it actually absolutely does. And if you look at, the background of this whole question, Iran has always maintained, so the official narrative of Iran state has always been that we are not after a nuclear weapon. We are enriching uranium. We want to have nuclear power for peaceful purposes. And of course, in 2015, there was a deal reached we call it the JCPOA, that Iran would lower its enrichment of uranium to a very low percentage, around 3. And what has happened since then is that, the U.S. exiting the JCPOA, Iran continued its enrichment, and later, after the 12-day war, essentially, Iran passed a law that they did no longer allow the IAEA, the Atomic Energy Agency, to monitor the levels of enrichment in the country. So this whole situation, from the perspective of what is happening with Iran's nuclear plans, could have had a more sustainable answer to it, potentially.
Sure. Mr. Locker, again on that question of what the road ahead may look like in terms of the nuclear aspirations, many have critiqued Donald Trump for viewing it from a maximalist position, which is a binary, either nuclear or no nuclear at all. Whereas many analysts who've been watching Tehran very carefully say that Tehran is happy to give up nuclear weapons as long as they're provided the freedom and the flexibility to continue with enriching uranium for civilian purposes. Is that a middle ground that perhaps that can serve as a via media for the two sides between Washington and Tehran?
At one time, I would say yes. Now I'm not so sure. I mean, Trump seems pretty well dug into his position. I mean, we have the question, why does Iran need nuclear power anyway? I mean, the dynamic in energy has changed so much over the last 5-10 years. Renewables are so much more viable than they used to be. You could probably get the same amount of energy production from solar or wind in a much faster time period than you can if you try to, ramp up a nuclear power plant somewhere in Iran. And so I think Iran has other options than nuclear power, and you have to wonder what they actually want. I mean, I think if you're trying to enrich uranium, you're thinking maybe I'm more secure if I do have a nuclear weapon. I think that's probably been part of their calculus. They don't need one, and if they made some agreement like we had, in 2015 where there was inspections, I think that would be better, and maybe we can come to agreement on that.
Well, that's, of course, that's a big question mark, whether or not there will at all be a round 2 of these Islamabad talks for them to actually thrash out this position going forward. But my one final question to you, Ms. Lewis, is that as far as the last 40-odd days, what we've seen, again, there's been a terrible human cost as well. Is that something that will weigh on the minds of the leaders as they brood over the question of whether or not to go in for a round 2 of talks?
Yes, as you mentioned, there has been a human cost because, the war has cost a lot of a lot of loss in Iran, both military loss of lives and civilian loss of lives. However, what is regrettable is that Iranian state has displayed that as long as it sees a way for the state to survive this war, it will have a high tolerance for both damages to civilian lives and infrastructures. On the side of that, we also have the situation, as you might and your viewers might know, that in January 2026 and December 2025, there have been mass uprisings in Iran in which the state essentially massacred a high number of protesters in the streets of Iran. And Iranian society is still dealing with the aftermath of that. So at the same time that the war is imposing, a lot of civilian loss, infrastructure damages, the Islamic Republic has been executing political prisoners during the war, and they have also shut down the internet for regular Iranians, which not only disrupts the flow of information, but has had also a very negative economic impact for many Iranians whose everyday livelihood is dependent on, accessing internet, doing works with service, and so on. So we have a situation where the ongoing internal aggression and the internal oppression are both very effectively negative, having a negative impact on the lives of Iranian people. And of course, we have the broader impacts in the region, which for lack of time, I won't get into. What has been regrettable, I think, for this round of talks is that the human rights question has never really entered any part of these discussions. And I think this kind of also reaffirms the point that analysts have made from before this war started, that the US and Israel are not starting this war to help the situation of human rights in Iran, because as we can see now that they're at a impasse situation, and they want to essentially make a deal with the state that they thought might collapse, but it has not. The situation and the question of human rights has not been considered in the negotiations. And I think this is regrettable that Iranian people and the people in the region have to deal with this situation.
Sure, an ever worsening situation there. We'll have to see whether or not this blockade makes the situation even worse. I'd like to thank both of our panelists for joining us, Ms. Lewis, Mr. Locker, for joining us with your precious insight. With that, it's a wrap on this edition of News Center. More news and updates will continue right here.
The Reserve Bank of India has proposed a significant overhaul of the framework used to classify upper layer NBFCs. It's now shifting to a much simpler asset size based methodology. So basically, NBFCs who have a 1 lakh crore asset size will qualify as an upper layer. Ritu's been talking about this since morning. Abizar Divanji, founder of Neostrat Advisors, is now joining in on the show. Thank you very much, Abizar, for joining in. I think the big change is also now the inclusion of PSUs and government-owned NBFCs in this classification of upper layer NBFCs, which means there are implications for an REC, PFC, IRFC, etc. Give us your initial thoughts on this particular and the impact on PSUs.
I don't know why there was a distinction earlier anyway, Rima. I don't think that kind of distinction was ever required because these are large PSUs, PSU NBFCs. The other thing is that, the whole issue around upper layer NBFCs was that they are very much nearing that of banks. And if they are nearing that of banks, then two things are required: better and more stronger supervision, higher levels of capital, provision of liquidity, and biggest among them is transparency through listing. So these are the considerations or tenets based on which this was formed. And why should PSUs not be part of it? I think it's a logical conclusion now to say that these are nicely independent run companies. Once they get listed, there will be even more transparency. Some of them are already listed though. Though it's important to note that when RBI came out of the list in 2023, 15 companies are classified as upper layer, none of the PSUs were in there. That's because the regulation did not cover them. But now it does.
Yeah, absolutely. Abizar, hi. Sandeep, hi. So PSUs is one. What happens to Tata Sons now? Abizar?
So I don't think Tata Sons is impacted by this. Now you have to understand Tata Sons issue in a little different format. First of all, I don't think this regulation has come out in any way detrimental or for Tata Sons. Now this is simply a simplification from the earlier regulation which said that there is a subjective basis. Now we come to an objective basis, which is 1 lakh crores. Tata Sons falls within the 1 lakh crores? Surely it does. But if you look at the regulation, there's a layered regulation here and you have to understand that. One is, under the earlier regulations where RBI had the discretion, in 2023, Tata Sons was the only CIC to be included in RBI's list of companies that need to get listed as upper layer. Under the new regulations, that flexibility is gone. And the only criteria left is 1 lakh crore. Now, under the 1 lakh, it says RBI can use its discretion, but within the 1 lakh crore limit. So that is one. Now, the second and the most important issue is Tata Sons likely to remain a CIC? That's a very important question. Now, what are the classifications of a CIC? It says you have to have 90% of your assets in securities, whether debt or equity, and of which 60% has to be equity. That's one condition. Condition number two is you should have directly or indirectly public deposits involved in funding those assets. If there are no public deposits left on the Tata balance sheet, which frankly we don't know because it is not a listed company, then very clearly the justification that Tatas would have is actually we are not a CIC and hence why does the listing regulation even apply? But if it is classified as an NBFC, then the listing regulations will apply. There is no way out of that because there is no subjectivity there.
Right. Abizar, let me get Sandeep in as well. Sandeep, Abizar, of course, explained that, but just come in on this Tata Sons issue, because the point is if it is just based on asset size, the discretion is gone. So then, the discretion for RBI to give exemption is gone, and it's just that's a change from the earlier side. So where does that leave Tata Sons?
So I think Abizar said it correctly. I don't think it impacts Tata Sons at all. Essentially, even earlier, I think based on the complex rule they had, Tata Sons would fall within 1 lakh crores. Obviously, they fall within. So there's practically no change in terms of how it impacts Tata Sons. It would certainly have a huge impact on public sector NBFCs. And when I say that, I mean, there are certain NBFCs which are actually very dedicated to a sector. And as you know, there are exposure norms with respect to companies and with respect to an industry. So, entities like REC and PFC, which overwhelmingly kind of by mandate of law probably are required to lend to power distribution and power generation, will have an issue really. Either RBI will have to create carve-outs for them, or for them to fall in line is
Sandeep,
not very clear to me.
Yeah, the earlier regulation, right? There was a composite scoring methodology, qualitative, quantitative factors, with a degree of regulatory discretion by the Reserve Bank of India. All that is now gone. It's just so.
That's right.
So I mean, when we say that it doesn't, there's nothing changes for Tata Sons. I mean, will they have to get deregistered as an NBFC to stay out of this?
No, so here's the thing. See, I think based on the numbers I have, 3 NBFCs would exit this list, right? And Tata Sons is not one of those 3. And of those 3 also, the norm is that there's a 5-year kind of cooling off period, so they cannot exit. So unless RBI changes the norm to say that, the 5-year exit norm is no longer applicable for these 3, they will still have to fulfill all the requirements for the next 5 years.
Yeah. So, Abhizar, you want to just come in there on that question?
I would just look at it, see, every regulation is devised out of logic. And the clear logic of any listing or classification, something as an upper layer or even as an NBFC, should be the involvement of some kind of public money. And if there is no public money, very frankly, why should a company which is just a holding company of shares?
No, I don't disagree with the logic, Abhizar, but I'm just saying that given the new, given the change now from the earlier regulations, just purely by a reading of that was the question.
No. So clearly by reading of that, it's very clear. RBI says anything over 1 lakh crore has to be there's no discretion. There is no list. It says that we come out with another list, but that list also has to be within the ambit of, as they say, paragraph 24, which basically says 1 lakh crore. So at the end of the day, 1 lakh crore cannot be breached. Now, what has happened, interestingly, you have to see between 2023 and now. 2023, 15 NBFCs were classified as upper layer. Most of them went to the market and got themselves listed, luckily at a time when the markets were great. Today, the number of companies that fall above 1 lakh crores are mainly 6 or 7. Some of them are already listed. So ideally, some of the NBFCs which were below 1 lakh crore are already listed now because they were in the RBI's October 23 list. So now, frankly, what are we left with on current regulation? 2 things. One is large NBFCs which have not yet listed and figure out how to get them listed. And the other is let there be a consolidation or a listing within the government entities. Because government NBFCs, the problem is they're normally controlled by some or the other PSU. And the idea is like take the Power Finance Corporation. So or Power Trading Corporation, PTC. Some of these companies need to consolidate, come together and become much larger infrastructure service finance providers. I see the logic there.
Any unlisted companies which may get classified as an upper layer and therefore, because there is that mandatory listing in a period of 3 years?
Yes, so I think all the entrants are actually all the public sector ones. So so the third is Piramal Finance.
Piramal Finance.
So PNB, Piramal and Saman are the exiting companies, and there are 7, all of them are public sector, I think, except one, I guess, Bajaj Finserv and Jio. Okay, two private and 5 public, which will enter.
Yeah. That, Abhizar, this 5-year lock-in, right? Once you are in the upper layer, so how do you get out?
I think the only way you can get out is applying to the RBI, frankly, because these are all directions of RBI. This is not part of the Banking Regulation Act or not part of any other banking act. It's a regulation of RBI. If you go to RBI and prove that sort of thing, that if you are not taking any form of public finance, then why are you an NBFC? The only way to get out is to declassify yourself from NBFC. Now, all the companies that Sandeep named, except, of course, the CIC company, Tata Sons, all the other companies actually are in the business of NBFC because they're in the lending business. So their ability to get out of NBFCs is difficult. Their ability to get out of being upper layer is there now. But some of them are already listed. So very frankly, I don't know. It's only the level of regulation that will now get impacted. When you come to CICs, the only CIC ever classified as an upper layer was Tata. Every other NBFC per the RBI's rules, CIC rather, as an RBI rule is classified as a mid layer. So I think we boil down to this one issue saying is Tata Sons an NBFC? If it is an NBFC or a CIC, then very frankly, Hobson's choice, it has to list. If it is not one, it doesn't have to.
Will there be, Abhizar, out of the listed companies, right? In your opinion, will this they will be, I think they'll be regulated to exposure limits, etc. as well, right? So maybe you'll have to diversify. Will there be any issue there? I mean, diversification is good, but it can impact growth as well.
So somebody from RBI told me a few months ago that even if we have for upper layer NBFCs, regulation like banking, if bank is regulated at a scale of 8, the upper layer NBFC is not regulated at a scale of more than 4. So still, I think the regulatory arbitrage even between upper layer NBFCs and banks will remain. Exposure norms will become issues, but the advantage is going to be on the liquidity side, because I think RBI will open up some liquidity window for upper layer NBFCs because of their systemic risk.
I see. Sandeep, you want to add to that?
No, I think Abhijit captured it accurately. I think essentially there will be exposure limit, which will be an issue for at least 2-3 of these entities, which are very specialized entities like REC and PFC, which kind of very focusedly lend to one sector only, and there are group exposure norms which they will breach on day one. So either they will have to kind of have a path to get into other things, which is pretty much opposite of what they were set up for, right?
Yeah.
Or they get an exemption from RBI. It will have to be one of the two for at least 2-3 of these companies, which will not be able to meet with the exposure norms.
Yeah, absolutely. Abhijit, great insights. Thank you very much, Sandeep. Appreciate your time here, and good conversation, gentlemen.
Joining us today to discuss these proposed overhauls for the NBFCs are AM Karthik of ICRA and Sanjay Doshi of KPMG. Gentlemen, thanks very much for joining us here. Karthik, to begin with you, specifically on the government-owned NBFCs, the likes of HUDCO, PFC, RFC, etc., the state government exposures are significant. Even with the exemption that has been provided, do you think some of them could still be in breach? And secondly, and I'm talking about the likes of HUDCO that don't only have government-backed exposures, that don't only have government-backed exposures, and does it also effectively neutralizes, the stricter rules that come along with being an upper layer NBFC?
Yeah, hi, thanks. The government-owned NBFCs will easily qualify for the upper layer. There are two things which have come up. One is, the classification versus the asset size, based on which all these entities will classify for the upper layer criteria. The exemption has been provided specifically for the concentration norm, which applies to an IFC, depending upon whether it is in the middle layer or the upper layer. So the points that you talked about specifically on the state government related exposure and the exemptions from a concentration norm perspective, which was applicable at the middle layer level, is also applicable now to the upper layer entities, which is a change that the RBI has done with the draft regulation. But more importantly, what has changed is that when an entity is moving from middle layer to upper layer, the concentration norms which are applicable for an IFC in the middle layer were, 35% of tier 1 and 30% of tier 1 and 50% of tier 2 from a single and a group exposure point of view. So that will get tightened when they move to the upper layer entity. So the group exposure norms, which were about 50% of tier 1 when they were in the middle layer, becomes 30% of tier 1 in the upper layer. But at the headline level, we don't estimate that to be a major concern at this point in time, because a lot of these entities do have a sizable guaranteed exposure, state government guaranteed or the central government guaranteed
except
exposure.
IRIDA, Karthik, though. But Karthik, IRIDA has, I think, almost 71% private concentrated exposure, not government. What happens to them?
So we'll have to look at it. Basically, most of them are significantly below the levels which are stipulated even now. So we'll have to see essentially what will be the impact. But headline should not have any major impact on any of these entities.
Sanjay, what is your reading? I mean, even the fact that government-owned NBFCs with these large exposures are getting all kinds of exemptions to ensure that their transition is easier, does it uneven the playing field between government and privately held NBFCs? And overall, do you think just sticking to the asset size of 1 lakh crore as the threshold, does it risk diluting some of the risk sensitivity, the interconnectedness, etc., parameters that would have typically been looked at to qualify for tighter regulations?
Sure, Ritu. So, see, there are two parts to it. So, one is, of course, all these regulations is kept in mind with the systemic risk if any particular institution is bringing to the market, and hence how you really mitigate it. Now, when you look at this entire thing around, as you were putting it and as Karthik mentioned, around the state government loans, etc., right? So there are two parts. One is the exposure norms, and second is the capital, which the NBFC has to have to really cover from a capital adequacy perspective. From an exposure norms, anything which is guaranteed by the government or state government, I think the treatment is the same, whether it's for private or whether it's for public sector NBFCs, where they are excluded to the extent there is guarantee available. But for state government guarantees, there is a requirement for a capital to come in. So effectively, it's been there. And hence, is it going to really, this particular draft, if it becomes a regulation, is it really going to make a material change? The answer is no, definitely in a short to mid-term. But longer term, I'm sure, I think slowly and steadily, there will be a direction where do you really need this kind of guarantees, or you really want to bring public sector entities and private sector entities completely to market factors. So that's the other perspective to it. But net-net, we don't really expect a major mid to long-term change, mid to short-term change in terms of any such transition or change happening.
But Karthik, the draft also speaks about the fact that there will be a proposed 5-year review cycle for the upper layer asset threshold. And currently, out of the 15 upper layer NBFCs, it's only Tata Sons that is not in compliance with this 3-year mandatory listing norms. It is supposed to be listed by September. But now, do you see that with this, there have been experts who have told us that this would not impact Tata Sons and they have options with them as well of declassifying themselves as an NBFC. Does that option still lie on the table for them? And if so, what can Tata Sons do otherwise to navigate this listing criteria?
Very difficult to comment on the entity-specific question, but it's up to the regulator and the entity to decide on the way forward. But going by this new regulation, it's completely dependent on the asset size, and the asset size qualification applies for Tata Sons. But we'll have to see how it is worked out. So it's entity specific. I think it will be between the regulator and the entity to decide on how they navigate through this. But having said that, we'll have to look at the 5-year life cycle, which is applicable for any upper layer entity. So the transition which is applicable for an entity to be, once it is classified an upper layer, it continues to be in upper layer for a period of 5 years. And also there is an option at the regulator to look at entities which are moving towards upper layer. Right? So entities which are not qualifying for upper layer but will become an upper layer definition maybe in the near term. So they typically tend to sensitize those entities. This is part of the regulation which is already there in place. So typically tend to sensitize and see what is the way forward if the upper layer becomes applicable for these entities over a period. So these are all discussions which happen between the regulator and specific entities, and things which is completely between the two, and they decide on the way forward. So difficult to exactly comment on what will be the way forward for a specific entity that you brought about in the question.
No, we take that point, and periodically as the economy grows, as these entities grow, etc., these norms need to be revised as well. But one more point, Karthik, which as of now do you see outside of what is there in the upper layer and what has been discussed already in the unlisted space, do you think could make the cut in the very near future? Do you have any, guesses out here, any calculated predictions that you can make?
I think all of them are listed which may qualify for this criteria at this point in time. So we don't see any unlisted entity which will make the cut. We'll have to see how the RBI transitions on the entities which are currently there in the upper layer category, but may not necessarily make the cut of 1 lakh. They do have the time of till September 27, when the 5-year timeline lapses for some of them. And that the RBI and those entities which are currently upper layer and not possibly making the cut which the RBI is proposing on the asset size, they will decide on on the way forward. So not on the unlisted space which can make the cut and and not be listed at this point in time.
Sure, that's PNB Housing and Sammaan that are below that 1 lakh crore threshold. But keep in mind, they have a 5-year window from 2023. So it's not that they will immediately exit, even if these guidelines are implemented as is. But Sanjay, a final question. Some of these smaller NBFCs that are perhaps significantly below or just below that 1 lakh crore threshold, do you think we could see some active balance sheet management to ensure they remain below it, for the time being, to avoid tighter regulations, especially when it comes to bank-like regulations for these smaller NBFCs? Do you think they'll actively manage their balance sheets to avoid doing that?
So active management, I think slowly and steadily, it's going to be a group level exposure. Means how do you actively manage is effectively, do you really want to go off balance sheet, which ideally people and especially larger NBFCs like to have loans on their balance sheet, number one. Number two is, can you split and have multiple NBFCs? Again, that has a lot of restrictions. So their ability to maneuver and keep the balance sheet size lower effectively will not work in a mid to long term. Short term, maybe they can try to do a bit. So the reality of life is for them to really accept it and start preparing to get into the upper layer NBFC. I think the other point which you all also highlighted is on, and if I don't want to go into specific entity as Karthik mentioned, is it the entire core investment companies, right? The CICs. How RBI is going to look at CICs which are really above that particular size of 1 lakh crores? Are they really bringing risk back to the market in terms of a systemic risk perspective, from a public funds perspective? So I think the decision making will really lie whether a CIC, however large it is it something which the group really wants to have, or the shareholders wants to have effective control within their own subsidiaries and within their own groups, and hence they are not really bringing any kind of systemic risk to the market. So then should they be registered, and hence should be an NBFC, and hence should be an upper layer or not? So two aspects. One is, yes, anything which is slightly less than 1 lakh crores, be ready. Start getting your act ready in terms of preparing yourself for the tighter regulations which are going to come in if this becomes regulations. And the second one for CIC is really make a decision whether they want to or they should become an NBFC or not, if they don't have any risk from a public funds perspective.
Yes, and I believe the CIC are referring to as Tata Sons. We'll have to see what happens to their deregistration application. But Karthik, Sanjay, both of you, thanks very much for giving us your time here and helping us understand these important regulatory changes for NBFCs. Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. President Trump threatens to impose a blockade at the Strait of Hormuz after talks broke down in Islamabad. U.S. military clarifies the embargo will apply only to vessels entering and departing ports in Iran. The blockade is scheduled to begin at 7:30 p.m. India time today. Iran's military calls Trump's threat to block Hormuz illegal and warns no port in the region will be safe. British Prime Minister Keir Starmer opposes the blockade. China calls for unimpeded navigation. Crude oil prices surge past $100 a barrel as traffic at the Strait of Hormuz grinds to a halt. Stock markets decline across Asia and Europe. Investors fear a prolonged blockade of Hormuz could worsen the energy shock. The Sensex and the Nifty end in the red but recover sharply from their intraday lows. The rupee also weakens against the dollar as oil prices surge. The IT department flags concerns over multiple startups misusing the tax benefit clause, urges the DPIIT to enhance vigilance to ensure that the benefits reach genuine startups only. An investigation by the department reveals that several registered startups did not have any real business operations.
Protest by workers in the industrial belt of Noida turns violent with incidents of arson, vandalism and stone pelting. Workers demand higher wages and better working conditions. Hundreds of police officials deployed as the situation remains tense. Police in Nashik arrest 7 employees of IT major TCS over alleged sexual harassment and forced religious conversion. TCS says the accused employees have been suspended. The company is cooperating with the police. Hungary's far-right leader Viktor Orban's 16-year rule comes to an end. 45-year-old Peter Mayer is set to become the country's next prime minister after his party wins a 2/3 majority in parliament. A close ally of Donald Trump, Orban's ouster is likely to align Hungary more closely with the EU. President Trump launches an extraordinary attack on Pope Leo, calling him weak and terrible over his criticism of the war in Iran. Pope Leo says he's not afraid of the Trump administration, adding, "I will continue to speak out loudly against war." Politicians, film personalities and admirers gather to pay their last respects to the legendary playback singer Asha Bhosle. Her last rites are scheduled to be held this evening. Bhosle, whose career spanned close to 80 decades, died at the age of 92 yesterday. Well, let's start with the news that's just coming in. Macro data, inflation in the month of March has inched higher to 3.4%. Now, this is the highest rate that we've seen in the last 12 months. Latha joins us now with more. Latha, along expected lines?
Yes, in fact, you can say that it's a little less than expected. Our averages were tending between 3.45 and 3.5, and that it's come in at 3.4, means that the inflation is slightly lower. Perhaps the surprise is the food inflation. That's come in at 3.87%, and our poll was coming in, a little towards 3.7 or even less. 3.7 was the exception of the respondents in my poll. We will still have to wait for the calculated number as far as the core inflation is concerned. As always, as expected, rather, the personal services is the one that has risen the most. The inflation is 18.8% over there. But that's because in that personal services segment, we also include gold and silver. From year-ago levels, it is still high, even if gold fell in the month of March compared to February. That accounts for that year-on-year rise. It's a slightly skewed representation. Among others, that's higher are some vegetable prices, tomato and cauliflower in particular, which have a higher, month-on-month increase as well. And that explains the rise in the food inflation, which was not expected to be as high as 3.8. We'll have to come with a core inflation number that will require some calculation at the disaggregated level. But suffice it to say that this is not a place where you must expect too much angst. The inflation numbers are at a modest level because the fuel prices have not been passed on. Petrol and diesel have not been passed on. The expectation is that after the voting in the Tamil Nadu Assembly on April 23rd and the second phase of Bengal as well, probably the state assembly elections behind us, we may see a rise in petrol and diesel prices. So the real number to watch out for will be the May prices, not even the April inflation. We have to also watch very crucially what happens to the WPI number. The wholesale price index numbers come day after tomorrow, and there you may see a greater seepage of inflation because there is no control. Whatever is the international prices seep in, all the petrochemical and chemical prices that have risen globally, copper prices, all that will get reflected, and we may see a sharper rise. WPI was running very low at 2% for the past 12 months and sometimes even negative. It may jump to, closer to 4%. That would be a very sharp rise, and that is only the first month after the war. So these are the numbers to watch out for. It's not yet percolated to the CPI level. We will see that only probably in the month of May. At the moment, all's well.
Well, at the moment, along expected lines, even though it's coming at a 12-month high, that's the inflation print for you. Latha, many thanks for joining us. And we'll, of course, have our experts joining Latha shortly to decode those numbers as well as the way forward. But let's go back to the top story this evening. Fresh tensions in West Asia. President Trump's threat to blockade the Strait of Hormuz is setting up a new showdown. This after talks in Islamabad broke down. Now, let's take a look at the key developments so far. Now, U.S. President Donald Trump has declared that the U.S. Navy will start blockading the Hormuz Strait and even has threatened to bomb Iran's water treatment plants. The blockade is scheduled to begin at 7:30 p.m. India time. The U.S. military has clarified that this will not be a total blockade and that the embargo will only apply to ships and vessels entering or departing ports in Iran. Iran's military has called Trump's threat to block Hormuz illegal and has warned no port in the region will be safe. Iran's Revolutionary Guard Corps has warned any military vessels approaching the Strait of Hormuz will be dealt with severely. Traffic at the strait is pretty much at total halt, and crude oil prices have soared past the $100 barrel mark once again. Now, all of this comes after a breakdown in the negotiations in Islamabad. The talks ended after 21 hours without a resolution. The U.S. accusing Iran of not giving up on nuclear enrichment. Iran's Foreign Minister Syed Abbas Araghchi accusing the U.S. of shifting the goalposts during the talks. Iran's Parliament Speaker Ghalibaf also took a dig at the U.S., showing a picture of rising gas prices near the White House. The move to block the strait is sparking disagreement globally. British Prime Minister Keir Starmer says the U.K. is not supporting the blockage. Starmer also promised to put more efforts to ensure the strait is fully open. China has urged all sides to exercise restraint in the strait. Chinese officials say keeping the key waterway safe and stable serves the common interests of the international community. Foreign ministers from ASEAN have also called for safe passage of ships in the strait. Amidst all of this, the two-week ceasefire appears to be holding for now. There have been no fresh attacks in Iran since the ceasefire was declared last week. Here's President Trump on the Hormuz blockade and more.
Their military is destroyed. Their whole Navy is underwater, you know that. 158 ships are gone. Their Navy's gone. Most of their mine droppers are gone. We have a lot of people, as you know, at 10 o'clock tomorrow, we have a blockade going into effect. That'll be 10 o'clock tomorrow. Other nations are working so that Iran will not be able to sell oil. And that will be very effective. Iran will not have a nuclear weapon. Will not have. There is no way that they're going to get. They still want it. And they made that clear the other night. Iran will not have a nuclear weapon. What we notice and what we see and what I think is maybe my idea, maybe not, I don't know. But there are many boats heading toward our country to fill up with oil and then go and take it. So they're not going to go through the Hormuz Strait. And ultimately that'll be corrected. But in the meantime, they're using us. We have more oil because of drill, baby, drill. We have more oil than Russia and Saudi Arabia put together.
Well, President Trump there on the U.S. announced blockade that comes into effect 7:30 p.m. our time this evening. Now, Israel has continued its attacks on Lebanon over the weekend after the U.S. and Iran failed to reach a peace deal. Reports suggest that at least 11 people were killed in two Israeli strikes on towns in southern Lebanon. The Israeli military said it carried out a raid on a Hezbollah infrastructure site. Lebanese media also reporting that Israel carried out mass detonation in border villages. Israel and the U.S. have maintained that Lebanon is not covered under the Iran ceasefire. Israeli and Lebanese officials are set to hold rare talks in Washington this week. Prime Minister Netanyahu said Israel will negotiate with Lebanon on two conditions: that there be a peace agreement and the disarmament of the Hezbollah. Now, President Trump has criticized the Pope after he raised concerns over the Iran conflict and has called for de-escalation. Trump calling Pope Leo, and I quote, weak on crime, and I quote again, terrible for foreign policy. Pope Leo responding, saying he's not afraid of the Trump administration, asserted that he will continue to speak out against the war.
We don't like a pope that's going to say that it's okay to have a nuclear weapon. We don't want a pope that says crime is okay in our cities. I don't like it. I'm not a big fan of Pope Leo. He's a very liberal person, and he's a man that doesn't believe in stopping crime. He's a man that doesn't think that we should be toying with a country that wants a nuclear weapon so they can blow up the world. No, I'm not a fan of Pope Leo.
The message of the church, my message, the message of the gospel, blessed are the peacemakers. I do not look at my role as being political, politician. I don't want to get into a debate with him. I don't think that the message of the gospel is meant to be abused in the way that some people are doing. And I will continue to speak out loudly against war, looking to promote peace, promoting dialogue in multilateral relationships among the states, to look for just solutions to problems. Too many people are suffering in the world today. Too many innocent people are being killed. And I think someone has to stand up and say, there's a better way to do this.
Well, that's Pope Leo there responding to President Trump. Now, fears of an escalation in the West Asian conflict have rattled markets the world over, including ours. The Nifty and the Sensex closed down nearly 1%, though they both did come off their intraday lows. So 200-point cut there on the Nifty, 700-point cut on the Sensex. The Nifty Bank down 300 and 300 points down on the Nifty mid-cap as well. ICICI Bank, Axis Bank led the recovery, while Reliance and the auto stocks weighed on the markets today, and the broader markets outperformed. Prashant standing by now to wrap up the day's market action. Volatile day, but finally coming off their intraday lows, Prashant.
Under pressure, 200 points lower, but off the lows as well. We were down 450 plus points in the morning. And from that level, the market came up quite nicely and ended around the 23,800 plus levels. Nifty Bank, something similar, mid-cap, small-cap indices. I mean, overall, advanced decline ratio ended negative, but not deeply down in the red or anything. Actually, if anything, if you look at it, right, I mean, oil prices by the time we ended were still, Brent was up 3%, 8%. That was the rate when we started in the morning as well. So equity indices recovered quite a bit, and it's not as if it was on the back of oil prices which cooled off. We'll have to see what happens later today with regards to the blockade, and there are some who believe that the blockade will not snap into place. There'll be something which happens before that. Others of the view that even if the blockade were to happen, I mean, it's a negotiating lever rather than anything else, and we go down the ladder as far as escalation is concerned and not up. Anyway, having said that, let me just quickly run you through a bit of what happened today. Just losing on the losing side, autos were down about 2.25%. We've been, of course, covering the Delhi EV policy and other developments on the electric side on the auto and electric side for you. You had the oil and gas space, which was down 1.33%. Reliance, of course, the big mover there on the downside. And the FMCG index was down about 1.25% as well. On the upside, Wix went up 9%, and the defense index was up about 0.5% or so as well. Just a quick word as far as large caps are concerned. Eicher Motors was the big loser, 5% lower. Maruti down 4.5%. You had something like Indigo, which was down about 2.6, 2.7% as well. On the upside, HDFC Life up 2.5%, Adani Enterprises up about 2.25%, and ICICI Bank, which was up about 2% or so as well. Broader space, just 4 or 5 names here. So you had Jyoti CNC Casualty. There was, of course, reports of a fraud there, 14-15% lower. Chola Finance was down about 5%. Cummins India down 3%. Polycab, APL Apollo, and a Force more % as well. On the upside, Aether Energy continues to be the big rallying stock, 5% higher. Zydus Wellness, fantastic last 5-6 days now. MCX, Vari was another one which was up and about. And a bunch of these Adani Group stocks were up. Adani Enterprises, Adani Energy Solutions, and so on and so forth. Tomorrow, of course, is a market holiday in India. But the rest of the world, of course, is trading and will be reacting to the headlines that we get out of the US and elsewhere. Back to you.
All right, Prashant, many thanks. Well, that was the stock market action. Let's talk about the rupee. It weakened 65 paise against the dollar, courtesy rising oil prices and a stronger dollar. The rupee ending at 93.37 against the greenback today, ending at its worst level in 2 weeks. In fact, the rupee was the second weakest currency in the emerging market basket today. Now, so the Robji Tata Trust and Sir Ratan Tata Trust are reportedly set to hold crucial meetings next month. As per a report by Money Control, the meetings are likely to take place on the 8th and the 12th of May. This comes ahead of an important board meeting of Tata Sons in June, where the extension of N. Chandrasekharan's tenure and the possible listing of Tata Sons may be discussed. Neither of those items are so far officially on the agenda. Now, shares of Jyoti CNC Automation faced heavy selling pressure in today's trading session. This after the company disclosed that French authorities have launched a judicial investigation into its subsidiary, Huron Grafenstenden, over alleged violations of export control norms. French authorities have temporarily restricted the Director General of Huron from performing duties and ordered the seizure of bank accounts worth €4 million. The Income Tax Department has flagged concerns over multiple startups misusing the tax benefit clause. Sources tell CNBC TV 18 the investigation wing is probing multiple firms with early findings pointing to entities that may exist only on paper to claim tax benefits. The Central Board of Direct Taxes has urged the Department for Promotion of Industry and Internal Trade to enhance vigil. The government is likely to implement stricter verification and action against non-genuine startups. Up next on CNBC TV 18, protests by workers in the industrial belt of Noida turned violent with incidents of arson, vandalism and stone pelting. We bring you the latest when we return. The situation in Uttar Pradesh, Noida remains tense as industrial workers continue their protests, demanding higher wages and better working conditions. Now, the demonstrations turned violent today with incidents of arson, vandalism and stone pelting being reported. One female worker was allegedly struck during police action. Heavy police deployment has been made in sectors 60 and 62 in Noida's phase 2. Timsy Jaipuria brings us the ground report.
Massive protest going on. People are in anguish. These are minimum wage workers. They are saying government has announced a hike in wages, but still they are not getting the hike. They are saying they are faced by high inflation costs. They are facing LPG crisis. They leave their families at home, little kids at home to come to work, and still they are not getting even 1 weekly off. For whatever off they take, their salaries get deducted.
सैलरी नहीं बढ़ाते हैं, खाली इन लोगों को काम चाहिए, काम करवाते हैं इतना 80-90, 90-90, 100 पीस लेते हैं, 3-3 घंटे काम कराते हैं, ये लोग सैलरी नहीं बढ़ा रहे हैं। 1 किलो सिलेंडर 400 रुपए का, 45 रुपए किलो आटा है, क्या खाएंगे, क्या बच्चों को खिलाएंगे, बताइए।
महीने का 4 छुट्टी होना चाहिए कंपनी की तरफ से, महीने का 4 छुट्टी होनी चाहिए कंपनी की तरफ से, और वो कंपनी को देना पड़ेगा।
वो कंपनी को देना पड़ेगा।
ठेकेदार भी काम कर रहा है, वो भी नहीं
चाहिए, सैलरी चाहिए, दिहाड़ी नहीं चाहिए।
This anguish is not just at one place here at Sector 59 in Noida. This is going across Noida, across the industrial belt, be it an SEZ of Hosiery, be it any industrial belt in Noida. The situation is same. Massive protest, vandalization has been happening because these people, these are laborers based on which the entire manufacturing units of Noida function. कितने घंटे की ड्यूटी करते हैं ये अभी
तो ये 10 घंटे की करते हैं सर। 10 घंटे एक मिनट को तुम भी बोल लो 10 घंटे की करते हैं।
ओवर टाइम मिलता है?
हाँ ओवर टाइम मिलता है। मैं बोल रहा हूँ लेबर कोड वाले आते हैं उनको घूस देकर भगा दिया जाता है। झूठे दिलासे हैं समझ रहे हो अब ये बात। ये घूस देकर भगा देते हैं। ये लेबर कोड आते हैं भाई घूस देकर भगा देते हैं। ये हम लोग की बात को नहीं सुनते।
एक तो ये अनावश्यक रूप से जो आपको निकाल दिया जाता है।
सर ओवर टाइम मिलेगा नहीं तो हम कहाँ से करेंगे?
ओवर टाइम कह तो रहे हैं, अगर ओवर टाइम करेंगे तो आपको मिलेगा।
When the police came out to announce what is the decision that has been taken by the Noida authority, the DM, along with the government and the factories union, announcing their wages, they say that the announcement that has been made is of old wages. It is not the new wages that was promised. Thus, they are right now again saying that they won't work till the time they get an assurance of their increased salaries.
Well, that is the latest. There are sectors 60, 62 in Noida, which really is the industrial belt, seeing widespread unrest today, and that's also causing huge traffic jams going in and out of Noida. Now, IT major TCS issuing a statement over the case of alleged sexual harassment and forced religious conversion at its Nasik office. TCS has said all accused employees have been suspended. The police have arrested 7 people so far. Now, separately, in a different incident altogether, Anand Rathi Wealth Management is also facing allegations of sexual harassment at its Pune office. Santya joins us now with more details on both these cases. Santya, let's start with TCS. Where has the investigation led officials to?
2 key companies in Maharashtra have found themselves mired in controversy surrounding multiple complaints of sexual harassment at workplace, forceful religious conversion at workplace, and rape on pretext of marriage. These 2 companies are TCS and Anand Rathi Wealth Limited. Let's start with TCS. Recently, Nashik police received a complaint where a victim employed at TCS's Nasik unit accused a colleague of hers of raping her on pretext of marriage. She also accused another another colleague of hers of blackmailing her and seeking undue sexual favors. She also accused her operational manager based out of Pune of not cooperating with her, not acknowledging her complaint, and asking her not to take the matter further. Nashik police started investigating the case, and according to Nashik police, they found out that it's not just this victim alone. Multiple other women, overall 7 more women came forward and accused the same set of men, 6 accused in total, of sexually harassing them at workplace. They also accused another woman, that is 6 plus 7th accused, of mocking their religious identity, mocking their religious practice, and another man came forward accusing these 7 people of forcefully converting him. Nashik police is investigating the matter and has arrested 7 people in the case. 6 the men accused of sexual harassment, and 7th is the operational manager who didn't act on the complaint. Talking about Anand Rathi Wealth Limited, a victim has accused a colleague of hers of sexually harassing her, and 4 more people, her seniors, of not acting on her complaint. The FIR has been filed by the Pune police, and the company here has said that the company provided her all the legal assistance and asked her to approach the posh department of the company, which the victim didn't do. And the company also says that the company has denied all the allegations leveled by the victim here.
All right, many thanks, Santya, for joining us. Now, Anand Rathi Wealth has responded to the allegations. The company said, and I quote, the complainant was repeatedly called to the police station for inquiry. As for the complaint, no cognizable offence was found, and the complainant was requested to register a formal case. However, each time the complainant avoided registering the offence. This is a frivolous matter against the senior executives of the company, and all necessary legal steps are being taken. End of quote. Well, the big international story, Hungary heading towards a regime change after 16 years. Far-right leader and Eurosceptic Viktor Orban conceding defeat in the recently concluded elections. Peter Mayer, once a powerful insider in Orban's party, will become the next prime minister. His party registered a landslide victory, winning two-thirds majority in the Hungarian parliament. Mayer had based his election campaign on rising costs, corruption and declining public services. He had described the election as a referendum on Hungary's future. A close ally of US President Trump and Russia's leader Putin, Orban's ouster lays the path for Hungary to align more closely with its European Union allies.
Hungary's veteran nationalist leader Viktor Orban conceded defeat on Sunday after a landslide election victory by the upstart opposition TISA party. The result is a setback for both Orban's allies in Russia and U.S. President Donald Trump's White House. Challenger Peter Magyar's center-right party grabbed a two-thirds majority in parliament, enabling deep institutional reform and allowing the new government to restructure key institutions. The result marks the end to Orban's 16 years in power and has significant implications not only for Hungary, but for the European Union, Ukraine, and beyond. Half an hour before polls were due to close, data showed close to 78% of voters cast ballots, up from nearly 68% 4 years earlier. Orban, a Eurosceptic, carved out a model of an illiberal democracy, seen as a blueprint by Trump's Make America Great Again movement and its admirers in Europe. But many Hungarians have grown increasingly weary of the 62-year-old after 3 years of economic stagnation and soaring living costs, as well as reports of oligarchs close to the government amassing more wealth. TISA's leader Magyar successfully tapped into this frustration in the win. Orban's exit deprives Russian President Vladimir Putin of his main ally in the EU and sends shockwaves through Western right-wing circles, including the White House.
In fact, just before the Islamabad talks, J.D. Vance, the U.S. Vice President, was in Hungary attending a rally for Viktor Orban. Viktor Orban ending his 16-year term. With that, it is time for us to wrap up this edition of Business 360. The news will continue on CNBC TV 18. Stay tuned. We're back with plenty more.
Hello and welcome to Startup Street, and I'm Arundhati Ramanan, and with me as always is Shruti Mishra. These are the headlines from the startup world. IT department flags concern over multiple startups misusing the tax benefit clause, urges DPIIT to enhance vigilance to ensure that the benefits reach genuine startups only. An investigation by the department reveals that several registered firms did not have any real business operations.
Major leadership shake-up at the Flipkart Group as Nandita Sinha steps down as head of Myntra. Senior executive Sharon Pies takes charge of the fashion giant immediately. Reporting to Group CEO Kalyan Krishnamurthy, the transition also sees Kapil Thirani appointed to lead Flipkart Fashion.
AI-driven auto service marketplace Smart Garage has secured 2.4 crore rupees in pre-Series A funding. This is the first slice of a larger 15 crore capital target that the startup aims to raise over the next 18 months. The funds will fuel an expansion drive to hit a 80 crore rupee revenue run rate by FY27.
British Prime Minister Keir Starmer is calling for an end to mindless scrolling, warning social media giants like Instagram and TikTok that the addictive algorithms need to go. Speaking to BBC Radio, Starmer confirmed the government is consulting on a potential ban for under 16.
UK financial regulators are holding urgent talks with banks and cybersecurity officials after Anthropic's new model, Claude Mythos Preview, identified thousands of flaws in widely used software. Authorities are now assessing potential cyber risks to critical financial infrastructure posed by the AI's ability to uncover system vulnerabilities. Those were the headlines that we're tracking for you this evening. But on What's Brewing today, India's tax authorities have flagged several startups for allegedly misusing benefits under Section 80 IAC meant for genuine early-stage ventures. The Income Tax Department's investigation wing has flagged many companies for claiming substantial tax breaks without having any real business operations, raising concerns about fraud and exploiting tax loopholes. Timsi Jaipuria joins us now with all of the details. Timsi, what is the government saying?
In a significant crackdown, India's tax authorities have identified several startups for allegedly misusing the tax benefits under Section 80 IAC, that is the startup tax exemption. Sources have told CNBC TV 18 that the investigation wing of the Income Tax Department found that a several number of entities had little or no real business operations but were still claiming tax holidays meant for genuine startups. Sources say that the findings have been escalated by the Central Board of Direct Taxes to the DPIIT, which is the nodal ministry, raising concerns over possible loophole in the startup recognition process. Sources also added that some firms may have been created primarily to avail the tax exemptions, securing DPIIT recognition without substantive commercial activity. And now the government is looking at tightening the verification process to ensure that only genuine startups benefit from this tax exemption. For the benefit of our viewers, under Section 80 IAC, eligible startups can claim 100% tax deduction on the profits for any 3 consecutive years within their first 10 years of incorporation. The provision was introduced to promote innovation and ease of financial burden on early-stage ventures. However, sources say gaps in oversight may have allowed this misuse, and the authorities are now considering stricter checks and possible recovery action in cases where violations are established. Let's see what finally happens.
Thank you, Timsi, for those details. Appreciate you joining us. Despite generating large volumes of scrap domestically, India continues to underutilize this resource, largely due to a fragmented and opaque ecosystem. Critical Minerals firm Attero is looking to change that with Metal Mandi, its digital scrap trading platform that has already crossed 2 lakh downloads and is now targeting 5x growth and 10,000 crore rupees in revenue over the next 5 years. The larger play, building a transparent, tech-driven and self-reliant supply chain for critical materials. Joining me now is Nitin Gupta, the co-founder and CEO of Attero. Nitin, welcome back to Startup Street. 2 lakh downloads in under a year. What's driving this rapid formalization of India's scrap economy? And you've also spoken about geopolitical disruptions and resource nationalism. Is scrap now becoming a strategic asset for countries like India? And can platform like yours meaningfully reduce India's dependence on imported critical materials?
Yeah, first of all, good evening, Shruti. Thanks for having us. It's always a pleasure to be back on the show. So absolutely. So as the demand for critical minerals is increasing, and it's becoming more and more needed in, let's say, countries' energy requirements, defense requirements, and even other sort of aspects, the very fact that we cannot be reliant on any geopolitical actor for the sort of critical minerals that we need is of prime importance. In that, the secondary economy or the scrap plays a very important role. In our opinion, through a formalized collection network, if the scrap is properly collected and using technology recycled and these critical minerals are placed back in the sort of economy, India's import dependence on these metals and minerals will reduce anywhere between 30% to 75%, depending on which metal we're talking about, right? For example, for copper, we can reduce our dependence by 30%. For cobalt, we can reduce by 75%. For rare earths, we can reduce by 75%. So this does play a very pivotal role in how we think about India's sort of self-reliance and how do we think about geopolitics playing out in the entire ecosystem here.
Okay. Nitin, you're offering real-time price discovery in a market known for opacity. How are you ensuring these prices are both accurate and trusted? And how disruptive is this for an industry that has traditionally lacked transparency?
So extremely good question, Shruti. So essentially, we have built an AI-based pricing engine, which runs at the back of Metal Monday. That basically takes out pricing from, let's say, the leading global metal exchanges, and then converts them or predicts the local Indian price based on taxation, local demand, supply, and other factors, both domestic and international. And then bases a very significantly high database that we have of what kind of scrap has what kind of metal content. We throw prices of various kind of scrap on a regular basis, like at least 15 to 20 times a day across 1 lakh plus categories of scrap, right? So the entire pricing engine is based on real-time information from across the world, combined with an AI engine, which basically looks at different sort of inputs and throws out very accurate pricing. This does sort of bring in a lot of transparency into an opaque supply chain. This transparency helps cut out the middlemen. This transparency helps the actual scrap collectors get them the best prices for their, let's say, end-of-life material, and make sure the entire supply chain is more transparent and traceable.
Okay, we delve deeper into that in just a bit, but you know, AI-led quality inspection using image detection sounds powerful, but how reliable is it when dealing with something as variable as scrap? And is this where your real moat lies, Nitin? Data, AI, and price intelligence rather than just the marketplace itself?
Absolutely, Shruti. So the entire technology stack we build is built around making sure that we provide the best prices on a real-time basis to the scrap collectors. That's one leg of it. The second leg of the tech stack, as you rightly pointed out, is the fraud detection or the image processing engine, which basically looks at the quality of the scrap even before it is picked up and gives the sort of assurance to the buyer that the quality is assured. Now, how do we do that? As a simple example, if you look at an end-of-life air conditioner, right, it can have a compressor which can drive the pricing. The compressor can have a copper winding or an aluminum winding. Our image processing engine, by looking at the image, can tell with a 99.5% plus accuracy whether it's a copper compressor or an aluminum compressor.
Okay. All right. Nitin, let's talk about numbers. With over 1.1 lakh users and 15,000 metric tons traded monthly across 100 plus cities, scale is clearly building. But as you target 10,000 crore rupees in annual revenue over the next 5 years, what does the monetization engine look like?
So at this point in time, Shruti, the only buyer on Metal Monday platform is Atero, which is India's largest recycling company as well. We take out 22 plus critical minerals and have developed significant patents around our technology as well. But slowly and steadily, we are looking to open up this platform to other buyers of secondary materials in the country as well, both large and small. So the monetization strategy is essentially a certain percentage of the traded value of the goods on the platform, Shruti.
Okay. Nitin, you are moving towards a full-fledged marketplace with direct buyer-seller interaction. You touched upon this earlier. Does this mean cutting out middlemen entirely? And also, if you could take us through your revenue growth and expansion targets.
Absolutely. So the objective is twofold. One is in the scrap supply chain, the value should accrue to the people who are doing the maximum bulk of the work and not to aggregators or middlemen who really add no value, right? That's what the pricing engine takes care of, and that's what scale takes care of, right? The other value add is for buyers to get a very transparent and traceable supply chain, which they can believe on quality, which they can trust on KYC, which is what the platform offers. So on both legs of the buyer and supplier, this platform solves significant problems that exist in the supply chain. As in terms of how we're building scale internally, we're obviously increasing our recycling capacity for electronic waste recycling roughly by 5x in the next 3 years. We have opening up new facilities in Pune, in Ringus, in Bangalore, in Faridabad. We are increasing our battery recycling capacity by 3x in the next 5 years. We're increasing our rare earth magnet recycling capacity by 100x in the next 5 years, right? So significant capex expansion as well, keeping in mind the opportunity that's there, Shruti.
All right, one final question before I let you go. With recovery efficiency of over 98% and purity levels above 99.9%, that's what you claim. How competitive is India in the global race for critical minerals? And if Metal Mandi succeeds at scale, what fundamentally changes, not just for your business, but for how India sources, values and secures its resources?
So from a technology perspective, Shruti, the tech that we have built is the best in the world, not only in terms of recovery efficiency, which you rightly pointed out is more than 98%. Global average is around 80%. So for the same input, using our tech, we are able to recover 20% more value. Our tech also has a lowest capex per ton, which is lower by 40% compared to anybody else in the world, right? So obviously, from a tech perspective, this is the best in the world today. And we're always continuing to work on it to make sure that we can incorporate other streams of scrap as well, and continue to improve wherever there are lacunas. In terms of what changes fundamentally for India, Metal Mandi as a platform, as and when it scales up dramatically, will offer sort of other players in the country to make sure that they can collect more and more scrap in a more organized fashion, formal fashion. And as they scale up their own recycling capacities, India as a country becomes less reliant on geopolitical actors and becomes more self-reliant on domestic supply chains for critical minerals.
All right, on that positive note, let me wrap up our conversation. Nitin, many thanks for joining us again on Startup Street. Wish you the very best for all your aggressive growth targets.
Thank you, Shruti. Thanks for having us.
And moving on, India's wealth story is evolving, and with it, the appetite for global investing is growing rapidly. As outbound investments surge and the rupee remains under pressure, more Indian investors are looking beyond domestic markets for diversification and returns. But access, compliance, and trust have long been key barriers. Valura.ai, a UAE-based AI-native investment platform, is now making its India debut. Even before its official launch, the platform has onboarded over 1,000 wealth advisors and built a 3,000 crore rupee pipeline. So what's driving this early traction, and can Valura truly simplify global investing for Indian HNIs? Joining me now to discuss this further is Priyesh Ranjan, the CEO of Valura.ai. Priyesh, thank you so much for joining us on the show today. You've onboarded 1,000 odd wealth advisors even before you've launched, right? Now, that's a signal of what's to come. What gap in India's wealth ecosystem are you sort of solving for that existing platforms haven't been able to address?
Hi, very good evening to you and your audience, and thank you very much for having me here. Look, I've been in this business for 20 years, mostly in Dubai, and one of the questions that me and the team always kept facing from Indian customers or Indian consumers was, how do we invest in global markets, equities, bonds, ETFs, so on and so forth? And unfortunately, the regulatory constraints and the absence of a platform was a big detriment, and people were not able to get that opportunity to make those investments. So the demand was always there. The infrastructure wasn't. And therefore, we decided we are going to only solve these three things when we go to India. We are already existing in Dubai, and we have become the largest wealth tech platform in the UAE. And when we went to India and drafted our India strategy, we looked at three fundamentally broken things to solve. One was access. So the global investing is in its nascent stage, and there are a few players who have tried to solve it, but the solution is mostly around stocks. So there is nobody who has solved bonds, ETFs, structured products, international mutual funds, or even private equity funds, hedge funds from outside. So that's, or a Sharia compliant, let's say, instrument, so to say. So the access was missing. We went ahead. We had a good tailwind in Dubai. We used that, and we solved that and created a platform which could give an Indian an access. The second problem we saw was that of safety. So in Indian investors, money was being taken and sent to the US or Europe to offer international equities. Now that's a little, that goes into a domain where an Indian investor doesn't feel very comfortable doing that. When India launched, or the government launched the GIFT City, and it expanded it to allow people to open broker-dealer licenses, etc. That gave us an opportunity to ensure that we build a platform which is loaded with all kinds of instruments that Indians have been asking for quite some time, and it is domiciled in India. So essentially, the safety angle, where an Indian's money as well as his assets sits in the country and looked after by an Indian authority, was something that is something that we solved. And the last was the convenience. No matter what you say, the entire issues around KYC, LRS, and TCS, your tax at source, etc., was very tedious. So we have solved all of those, and today we can proudly claim that today we are able to do the KYC within 5 minutes.
Sure.
We finish LRS within hours, and the TCS is solved within weeks. So that whole convenience has also been solved. So those are the three pillars on which Valura.ai has created a solution for the Indian investors.
Absolutely. And you've sort of laid that out very neatly for us. But if you could quickly tell us, India's outbound investments are clearly rising, right? Access has always been fragmented. So how does your GIFT City structure change the game in terms of compliance, taxation, and ease of investing for Indian HNIs and advisors?
So that's a brilliant, and this is an evolving topic, and I must give a lot of best wishes to the Indian government for being flexible, for working on the GIFT City. There has been a lot of regulatory clarity. A lot needs to still be done. We are IFSCA regulated. I'm very happy to say that the regulatory clarity makes sure that an investor can have a peaceful investment sitting in GIFT City, monitored by IFSC. The tax efficiency is I think we are 90% there. While the government can do a little bit by reducing the TCS, but at least the clarity is there, and I think with passage of time, with passing years, we will see the TCS coming down. But as far as clarity on the taxation is there, that also has been solved very well by GIFT City. And I think for an investor, this is transformational, because now something that they have been looking at, let's say an investment in Europe or a Japanese exposure, for corporates for that matter, they have been wanting to invest in securities to hedge their treasury, their cash management, and have not been able to do it. And cannot take positions in equity, can be solved here.
Yeah, and speaking of the securities, right, you're offering access to over 100,000 global securities, equities, pre-IPO, and even Sharia-compliant products, right? So which segments are you seeing the strongest demand from Indian investors today?
Yeah, so the fixed income bonds has been an underserved sector. People have not had the opportunity. Unfortunately, India doesn't have a bond market. And when you get bonds which can yield 10, 11, 12%, on US dollar terms, I think that makes for a very alluring opportunity for Indian investors. Pre-IPO opportunities are seeing crazy demand, and the 3,000 crore does not even account for it. And we are soon be launching a very, very critical partnership with one of the largest pre-IPO providers, which is a Morgan Stanley subsidiary. And we'll be doing a roadshow. We are seeing phenomenal demand on Perplexity, Anthropic, SpaceX, Polymarket, and so on and so forth. And last but not the least, the Sharia-compliant product. I mean, the kind of response that we are seeing from people for Sharia-compliant mutual funds, Sharia-compliant bonds, etc., is phenomenal.
Absolutely. And you've sort of built this 3,000 crore rupee pipeline already, right? How much of this do you realistically expect to convert over the next 12 to 18 months? And what kind of revenue visibility does that sort of give you in a market like India?
Yeah, so 3,000 crore we should be able to cross very easily, because we've just gotten started. And this is just coming from the partners. We have also started reaching out on our own, and we are reaching out to the fund managers, and the response, like I said, the pre-IPO itself could be a 1,000 crore instrument for us. We are looking at closing, we want to cross approximately 5,000 crore. That's the target, internal target we have taken in the first 12 months. And we do not see a reason why we will not be able to pull it off. The tech is there, it's proven, the partnerships are there. And the entire life cycle is available to the investors, which are tested. It's doing phenomenally well in UAE, and we have been doing well there. So we are looking at an AUM of around 5,000 crores that should give a visibility of 60 to 70, let's say 70, 75 crores of revenue in the first year of operations.
All right, that's quite a big target in your first year of operations itself. And you are a bootstrap company, and you're entering a competitive space, right, with global players and domestic wealth platforms. So what sort of keeps you ahead of competition?
Yeah, so we are a tech company, and we have been awarded. We are an NVIDIA Inception program. We have been adjudged as the top 50 startup in the fintech domain globally by Money 2020. So we have had our fair share of success in the UAE. So that's one moat. The other one is the partnership that we have built. It's easy to go and sell equities, but to be able to build partnerships where you can make available private equity funds, hedge funds, etc., bonds, Sharia compliant, mutual fund, all these are big partnerships that we have evolved over the last 2.5 years. And then most importantly, licenses. So you'll see a lot of fintech companies, but you'll not see a lot of fintech companies who have the advisory strength like we do. We have around 30 advisors and all the necessary license to satisfy the entire journey of an investor, right from inception up till monitoring and hedging.
Absolutely. All right, Priyesh. Thank you so much for taking time out and being here with us on Startup Street. And we'll catch up with you once, you start your India journey.
Absolutely. Thank you so very much for having me. Have a nice evening.
Well, with that, it's time for us to head into a short break. But coming up next, PV Sindhu and Harmanpreet Kaur speak to Meghna Sen, unpacking the relentless discipline, fitness regime and mindset it takes to consistently perform at the highest level. Stay tuned. Welcome back to Startup Street. It's not just about winning medals anymore. It's about building a fitter nation. Two of India's biggest sporting stars, PV Sindhu and Harmanpreet Kaur, share their thoughts on what it takes to stay at the top. Speaking to CNBC TV 18's Meghna Sen, they talk about the growing importance of fitness beyond athletes, gaps in women's sport, and why discipline, especially diet, remains critical for success.
Women in general, there's been a lot of change, like in the era, like back then, there was Wang Yihan or Tai Zuing or Carolina, and now it has completely changed. The game has changed, the game has evolved, so it's good to see a lot of women changing the game, a lot of youngsters coming up, but especially when I'm talking about India, definitely yes, there needs to there are a couple of youngsters who are coming up, but there is a little bit of gap. I'm sure there's a lot of talent, there's a lot of potential, and it's good to see that they have started from the grassroots level, from the schools to colleges. So I think again it takes you to being physically fit and being physically strong. I think that's where I think Puma also is doing a good job by encouraging and starting off with these things called high rocks, so that a lot of people go towards it and actually be physically strong and fit. Yeah.
Your thoughts on the same?
Yeah, I mean, as Sindhu mentioned that, we need that awareness not only in, people who are participating in sports, but in general public also, and in that case, I think Puma is doing really a great job, bringing high rocks in our country and, doing in multiple cities, which, definitely spread a lot of awareness in our country regarding fitness, and hopefully, in upcoming years, we'll see many people will come and participate.
During the 2016 Olympics, we have heard that you had a very strict diet and also no social media feeds. Could you tell us about that?
Yeah, I think it's very important. I think diet in particular, you need to be strict in what you do, because, for some people, some things might not suit, or, they'll have to maintain their weight, because, our sport is something where you need to be agile on court and, be fit and physically and mentally, and at the same time, you need to be quicker on your feet. And like our games sometimes go up to like, let's say, 1 hour, 1.5 hours with the very high intense. So I think we'll have to make sure what we eat, we have to take care of what we eat. So yes, diet is very, very important in our sport.
What do you think? Like how, the restriction that there is there on the diet. So what do you think about it?
I think every athlete, we are very, very careful about what we eat, what we do, because we have accountability on everything. So I think it's very important what we are, eating, because, as the athletes it's our responsibility. And secondly, if you want to perform, you have to, be very particular about these small things, because if you're missing out something, that will cost you at a crucial time. So I think as an athlete, it's very important, being accountable and, doing the right things.
How does your 2026 schedule look like, and any important matches that you're looking forward to?
Yeah, I think, we just came back from the Asian Championships, and now we have Thomas Uber Cup coming up in the next 1 week. And then after that, we have back-to-back, we have the Asian Tour coming up. So it's a packed schedule. So yeah, I just hope, I'm injury-free and just train and give my best in my training sessions, and the rest, of course, matches, let's see how it goes. But otherwise, yeah, the main aim is, to stay injury-free and, perform.
Right, yeah. So 2026 is packed for the Indians women cricket team, but the one match I think that all Indians are looking forward to is the Test series at Lord's. So what do you have to say about that?
I think test matches is something, which I think every cricketer enjoy the most, because, we all, grown up watching test matches, and we all wanted to be part of test matches. So I think we are really looking forward for that. Hopefully we'll give our best.
Thank you so much, both of you, for joining CNBC TV.
Thank you.
And with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye, and many thanks for watching. More news and updates on the other side.
Well, hello and welcome to CNBC TV 18 Commodity Town Hall. Indian markets have been on a roller coaster ever since the tensions in West Asia escalated. Volatility has spiked, commodities are on the move, while global cues remain more or less uncertain. Premiums in the Indian markets have come off sharply if you compare it to the emerging markets and global peers as well. So where do we really stand in this shifting landscape? And more importantly, what's next from here on? Well, to help us answer that question, we have a couple of guests who are joining us in the studio. Vikas Kumar Jain, India strategist and India research head at CLSA, as well as Anand Shah, head of PMS and AIF at ICICI Prudential. And joining me to co-host the show, I have Nimesh Shah as well.
Thank you, Nigel.
Welcome to the show, gentlemen.
Thank you to the guests. Thank you.
Thanks for having us.
Since crude oil prices have spiked up, and that's been a bit of a darling for the Indian markets, right? We didn't have to bother for many, many years. Now, earnings estimates will get pulled back a little bit. And as this, India has underperformed. First, we struggled with the AI trade. Then you had, this Middle East war as well that broke out of nowhere. In that sort of a backdrop, India has always enjoyed premium multiples, premium valuation in comparison to the globe, in comparison to China as well. Now, that's come down a fair bit. Do you think at these levels now, at around 16, 17 times forward earnings, that premium has come down to a level that you would actually get more optimistic on the Indian markets?
So let me put it the other way around. You've been actually negative on the markets for the last 18 months. Is this now turned to turn positive? Is valuation good enough to now turn positive?
So Nigel, I really love the way that you say that we've always enjoyed premium multiple. That always is made up of last 4 or 5 years. So
yes.
The reality is far more longer term than that. What we need to, so just taking a step back, there are 3 things which typically define market moves. One is valuation, second is sentiment, and third is narrative. Say 18 months is what you mentioned, say sometime towards the end of 2024 or around that time, second half of 2024, we warned that all 3 things were adverse. We were at really premium valuations, and this was the first sign of China waking up. Our sentiment, now we have a proprietary sentiment gauge, it's called the India Bull Bear Index, which gives us investor sentiment in a quantitative way and not in an anecdotal way. That was at 97% bullish. And third thing, our narrative. Narrative was super positive about India, as if nothing could go wrong. I think from that point onwards to now, sentiment is 1% bullish. This was the reading on 31st of March, 30th March. That's the most negative sentiment for me has been, other than COVID and GFC. That's how negative it was. Valuations are far more palatable. It's below 10-year average, slightly above 20-year average, both on an absolute and relative basis. What is pending is narrative. And narrative is something which typically follows performance. So I think I would say that there is, valuations are not mouth-watering, but they are far more palatable, near average levels. So the complaints that someone had from India should reduce significantly, given 2 out of those 3 factors are now in our favor.
See, for now, we don't have to complain because the domestic guys are pretty sanguine and supporting the markets for a very long time. But Anand, in this context, in this whole scenario where commodities are going to go high up, you are of the belief that the last 10 years, the last decade was low inflation scenario, and the next 10 years are going to be very, very different. If that is the base case for you, that inflation is going to go up, as a fund manager, how are you looking to invest into Indian markets?
Yeah, so look, even much before this crude shock that has come through, there were elements which were making us convinced that we will have a lot more inflation than what we had since GFC to almost 2020, 2021. One was obviously from globalization to more localization, more friend-shoring. That is generally more inflationary. Second is anti-involution in China. So China, having created GDP, now wants to have profits as well. So there is a drive which wants the competition within China to reduce among the states. Third is obviously geopolitics. We had a significant long period of stable, geopolitics, and the trade routes were safe and so on and so forth, and that's getting upsetted. And we are seeing today, as the gentleman was saying, there's enough crude, but the supply chain has disrupted the crude price. So geopolitics has changed. Also consolidation. Typically a difficult environment leads to a lesser. So we can see that in telecom, in airline, many industries, we have lesser competition. Even for that matter in metals. Over a decade back, before 2007 and now, we have a lot less competition in those sectors than we had before. And last but not the least is rupee depreciation. So I'm saying, when I mix oil to this, now you see what oil does. It leads to fertilizer, leads to food, leads to plastics. So it will be slowly and steadily, energy will be all pervasive. So we are of the belief that inflation is here to stay. Otherwise also, and now oil brings it to the forefront.
All right, Anand, so what is this? Is this a structural shift or is this a temporary reset, you'll think, for the Indian markets?
No, so if you see even the markets over the last 4 years, there has been a structural shift. There was one set of businesses which used to do very well from 2007 to 2020, 21, which was more consumer facing. In a low inflation environment, you're better off closer to the consumer. You have pricing power, you will exercise that pricing power despite of a very low inflation on the input side. So you would have seen in that decade, you had a margin expansion for most of the consumer facing businesses, paints and autos and everybody. Last 3-4 years have been very tough because now we have inflation and your consumers are not ready. Fast forward another 6 months, we'll have everything becoming expensive. Consumers will be further under stress. So a consumer facing business ability to pass on the inflation that will hit at the raw material end might not be equal for everybody. So I'm saying you will have to be more careful of giving high multiples, which was very normal for almost 1.5 decades to give a very high PE multiple if you're a consumer facing business and a very low PE multiple if you're a core manufacturer. Things can actually change. You're seeing what's happening in aluminum. If you are one whose energy price is not going up because you're coal based, but you're producing aluminum, it all flows to your bottom line. So our preference is more for core manufacturing, intermediate manufacturing, but less for somebody who is manufacturing or a provider of services to the consumer, because consumer is stressed for the next decade, if you ask me.
So you'll be tilting more towards old economy stocks? Would that be the case?
The way to say is you're better off with iron ore than steel. You're better off with steel than auto ancillary. And you're better off with auto ancillary than auto if thesis is what it is. But again, will be more bottom up. That doesn't mean that all auto companies will suffer, and that also doesn't mean that all steel companies will do well. But I'm saying, generally speaking, this is how things will play out.
But Vikas, let me come across to you. If March 2026 was, washout because of the war, February 2026 was a washout for the tech names. They got absolutely slammed. No one wanted to listen to anything. And talking about narrative, the street believed that this is going to be a big, big headwind for some of these tech companies. And that's why the index pulled back. But from the start of the war, actually, that one index that's outperformed has actually been the tech space. How are you placed out there? Because I was reading a note, I think you believe that AI ultimately will actually be a tailwind for our IT services companies. So how are you placed out there?
Sure. So that's the opinion that we as a house have, that will lead to more work to our services company. See, I think there are two ways of thinking about AI. One, that AI will eventually be something that will do all of things, everything on its own. The other, that it will just make whatever we do a more efficient, give it a more efficient way of doing things. See, if you believe in this latter, then you would need some intermediary to give you solutions to make it an efficient use for you. Okay. So if that is the case, very simply put, then that's where some of our IT services companies could get up their jobs.
Okay.
So that is our thought on the sector, that unlike the popular belief that it is lose-lose for IT services, that's not going to be the case. That's the opinion. However, one needs to also take a look at that opinion in the changing dynamics.
Right.
So if at this juncture, when we are talking of the war-related changes which have happened, then is that the top sector in your mind? Or would you want to go with something like banks? Would you want to go with... So that's a portfolio choice that one has. But our view on AI is that, India in general, which has the youngest of populations, the advantage of having a young population is we are able to leapfrog rather quickly. Like we leapfrog from, 2G to 4G.
Yeah.
So the usage of AI can catch up far faster in India. But portfolio choices can depend on the kind of market that is dealt your hand. That's not what you choose.
You all were a little bit cautious on the market 18 months or so ago. When the market was going gung-ho, people were thinking this market's going to keep zooming and it's going to be unstoppable. What happened at that point of time was mid and small caps, the breadth of the market was brilliant. Broader markets were running up. That fraud seems to have got cleared out. After the kind of correction that we have seen, do you think now, post this clear up, post this stark underperformance, markets, the Nifty is down 12% or 13% at most. But the broader markets, there are stocks down 20, 30, 40, 50% as well. Do you think actually now it's time to start looking at some of these broader market companies, not the run of the mill, but select stocks that have actually corrected and now valuation-wise, they're pretty okay?
See, the advantage of India is in terms of large and liquid opportunities, we are the market which has the third or fourth highest large or liquid number of stocks. So bottom-up stock picking can always work if you do that. But let me give you a top-down thought process on that.
Okay.
The top-down thought process is, say in 2024, India was the darling for most global investors.
Yes.
Everybody wanted a piece of India. So they were willing to do the hard work to go and find a small cap company, a mid cap company, to really ensure that they get a piece of India, they get the beta in India. That's gone. We have come to more palatable valuations, but we have not come to a point that India again becomes the darling.
Correct.
At this point of time.
Yeah.
So people will start with, munching into large caps. So I am, and plus valuations for small and mid caps are still not that palatable.
Okay.
So I would want to stay focused on large cap. Do not be super greedy about very large returns, because although sentiment for me is down to similar levels at 2020 and 2008, valuations are not. They're just down to long-term averages. So that is what one needs to bear in mind, that this is maybe a more fair return market that we are getting into.
Okay, just since you mentioned darling a few times, the FIs have just broken our heart. They keep selling. I mean, March was very, very bad. April is equally as bad. You're seeing $1 billion of outflow. Do you think it's coming to a stage in terms of valuations being a little bit more palatable? Hopefully, we've seen peak rupee at around 95 or thereabouts. That's the hope at least. And, hopefully earnings as well start picking up. Do you think it's time for them to return? I think they own 15-16%, the lowest in the last 10 years or so. Your view, Vikas?
So I think the message that should, that just brings me back to the point of what you said as always. Given that we've seen whatever we've seen of the last 4 or 5 years, the domestic investors, as well as I would say even policymakers, have started believing that FIs have a fiduciary duty to invest in India. Yeah. They do not. So they have choices. Yeah. They will go to wherever they believe is where they can make money based on whatever the narrative is. I'm sure they will come back because there is improvement. But there are several other complications when you are investing in India that just increases the cost of capital in their mind when investing in India. Okay. So it will be a slow process. But the setup that I also see post-war is back to a correction in dollar leading to more money flowing into EMs. And by virtue of that, as the overall EM pot grows, money will also start coming into India. But at least to start with, they will sell lesser.
Okay. So hopefully some kind of way to a patch up. Let's see how that goes. We have a couple of...
Before we go to the audience, I just want to ask one question to Anand. On this debate on mid and small cap versus large cap, given this current environment, would you advise investors and audience sitting here to stick to the market leaders because they'll have a larger capability to absorb the shocks? That's one question. And two, if you can leave us with one or two themes which you think could be a decadal theme which investors can look at.
So yeah. So first and foremost, we even before February 28th, we were saying this is a year we need to go bottom up, not large cap, mid cap, small cap, not one sector versus other sector. We will have to do stock picking because over the last 4 or 5 years, a lot has got discovered. Yeah. So even the cheap segments of the market, manufacturing and allied also got re-rated. And to that extent, it's unfair to say that there's so much of inefficiency in the market. It's not. So you'll have to go bottom up for very sure. In terms of opportunity into the next decade, I think one we obviously said, which is manufacturing, will make a comeback, and a lot other factors than just inflation and rupee depreciation. There is very clearly a need to have more and more supply chain under control rather than dependent outside. So there will be opportunities in manufacturing, which was not the case for almost 10 to 15 years. Within consumers, we have a preference for services over products because as the per capita income grows, your consumption of products stagnate and your incremental income goes into services. So what we saw in terms of wealth creation in the consumer products, be it FMCG to auto, we will see similarly a lot of opportunities in the services industry as the per capita income grows and India becomes richer.
Okay, all right. Let's throw get in the audience. I think we have a few queries. Please go ahead, gentlemen. First query from the gentleman in the black.
Good evening, everyone.
Good evening.
I would like to say I was just reading that the equities market, Indian equity market, is 25% expensive compared to the other markets. After these corrections, do you feel it has bottomed out or there's still space left for this?
So, as per us, almost since September 24 peak, I think we would have underperformed global world markets by 40% and emerging markets by 44%. Yeah. So that premium which we used to have in September 24 vis-a-vis the world equity market is down to 2% or something, and versus the global emerging markets also it will be far lower than around 11-12%, which is far lower than our long-term averages. So yeah, valuations have come off, but as Vikas said, look, the reason for our valuations to come off also, we were sort of, in a way, we didn't have that much of an AI play last year, and today, in the environment where the energy prices and we being significantly net importer of energy, that's also in that context negative. So this valuations premium coming off versus the rest of the market is in line with what's happening today.
Okay, yes, sir. Yeah. Please, if you could get a mic there. Yeah.
Yeah, hello. My question would be a little different from the normal question. Just wanted to understand whether last 4-5 years Indian market was more liquidity and speculative driven. Now liquidity has gone and people have come to the base. So whether there is really any fundamental strength in the market for it to go up, considering the fact that there are a lot of threat from China in terms of manufacturing, and whatever, a large house want to put up a project, they look at China, they're having spare capacity, they might dump anytime, and projects are not coming, large scale. So that's what I wanted to have your views on this.
Kas?
Sure. So I think, see, liquidity and fundamentals, those are terms which can be seen as one's own definition. It's basically, if the market is there, that's for everybody to kind of have their own horizons and kind of deal with it. The way one can say whether it is speculative driven or whether it is not is how quickly the money has moved out and moved in. Now, if you believe that domestic investors were speculating, then they've still stayed in the market despite not getting great returns for the last 15, 18 months. So this is not something that I will say is that as a completely speculative market. See, when there is excitement, then people get greedy. That's human nature. Like in today's market, even one can argue the way, say, the Korean market moves. It moves in steps. It doesn't move gradually. I mean, there's rarely a day when it does not move 5%. There is a lot of speculation which is obviously there. But that is part and parcel of whatever market kind of, that's how financial markets work. So, and that's how human greed works. I do not think that there is any special element of speculation which was there in Indian markets versus any other asset class.
One
All right,
question, if somebody wants to,
one more question, if we could. Please go ahead, ma'am.
Thank you. I just had a question from the aspect of a small-time investor. We get very confused with the kind of uncertainties that are taking place in the global economy. So how do we navigate through this? Like, what is the kind of way we should go about and like wave our way through it?
Anand?
Sure. I think the starting point is that this global uncertainty and volatility in market is a constant. It's not going away anywhere. So that has to be one starting point, that when you're actually investing into equity, you have to expect that. And to counter that, what you do is actually you have a longer term horizon before you come into the market. And what Vikas said, the domestic investors have picked up SIP in a big way, which is from a very starting point, you're saying, I might not make money immediately, but I want to start investing every month a certain amount to create a certain corpus at the end of 10 years, 20 years and 30 years. That's a very good product, very good way of investing into equity markets. And in which case then the other thing you are saying, you are delegating all these worries of global uncertainty and challenges to the fund manager. And then you can sleep well.
In short, he's saying you should invest in the small cap fund and not invest directly.
Yes.
So, maybe the other way to also look at it, of course, that's the, this is a professional's job. Yeah. So maybe people like Anand, who manage money, who's been doing it for years, are the ones who would be taking all your worry in. But more importantly, that just gives me to the saying of it. The title is to investing in times of war. Yeah. But I would say that when we look at any kind of crisis, what is the point when you start, and this is just empirical evidence of, having being a student of history, if I may call it so. There's the point where the probability of maximum worry reduces. That typically is roughly the point where we see that bottom in that crisis. For example, I mean, for any student of who understands, markets and uncertainties, it's remarkable that during COVID, the day on which we started our lockdown was the precise day on which we hit the bottom. Yeah. I mean, that doesn't make sense at all. And that's why, markets sometimes can go ahead of expectations in terms of pricing in a lot of good things and pricing in a lot of bad things. Yeah. So that's where it needs a professional to understand. Perhaps, if you believe that the point of max uncertainty is behind us with this ceasefire, then maybe the markets are bottomed. If you have a different opinion, then maybe you will not agree with me. But that's a tough job, and that you'll have to go beyond that when you're trying to make money, and you'll need to stomach all of that risks and uncertainty.
Okay, all right, perfectly answers that. Thanks a lot, gentlemen, for joining Anand as well as Vikas. Appreciate you all coming down, and thank you to all the audience as well. It's been a fruitful session. We have all learned something or the other, and we go out enriched with knowledge. Well, on that note, though, we'll wrap up on this edition of Commodity Town Hall. Stay tuned for the latest news and updates on the other side. Thank you. Well, hello and welcome to CNBC TV 18 Commodity Town Hall. Indian markets have been on a roller coaster ever since the tensions in West Asia escalated. Volatility has spiked, commodities are on the move, while global cues remain more or less uncertain. Premiums in the Indian markets have come off sharply if you compare it to the emerging markets and global peers as well. So where do we really stand in this shifting landscape? And more importantly, what's next from here on? Well, to help us answer that question, we have a couple of guests who are joining us in the studio. Vikas Kumar Jain, India strategist and India research head at CLSA, as well as Anand Shah, head of PMS and AIF at ICICI Prudential. And joining me to co-host the show, I have Nimesh Shah as well.
Thank you, Nigel.
Welcome to the show, gentlemen.
Thank you to the guests. Thank you.
Thanks for having us.
You know, since crude oil prices have spiked up, and that's been a bit of a darling for the Indian markets, right? We didn't have to bother for many, many years. Now, earnings estimates will get pulled back a little bit. And as this, India has underperformed. First, we struggled with the AI trade. Then you had, this Middle East war as well that broke out of nowhere. In that sort of a backdrop, India has always enjoyed premium multiples, premium valuation in comparison to the globe, in comparison to China as well. Now, that's come down a fair bit. Do you think at these levels now, at around 16, 17 times forward earnings, that premium has come down to a level that you would actually get more optimistic on the Indian markets?
So let me put it the other way around. You've been actually negative on the markets for the last 18 months. Is this now turned to turn positive? Is valuation good enough to now turn positive?
So Nigel, I really love the way that you say that we've always enjoyed premium multiple. That always is made up of last 4 or 5 years. So
yes.
The reality is far more longer term than that. What we need to, so just taking a step back, there are 3 things which typically define market moves. One is valuation, second is sentiment, and third is narrative. Say 18 months is what you mentioned, say sometime towards the end of 2024 or around that time, second half of 2024, we warned that all 3 things were adverse. We were at really premium valuations, and this was the first sign of China waking up. Our sentiment, now we have a proprietary sentiment gauge. It's called the India Bull Bear Index, which gives us investor sentiment in a quantitative way and not in an anecdotal way. That was at 97% bullish. And third thing, our narrative. Narrative was super positive about India, as if nothing could go wrong.
Yeah.
I think from that point onwards to now, sentiment is 1% bullish. This was the reading on 30th March. That's the most negative sentiment for me has been, other than COVID and GFC. That's how negative it was. Valuations are far more palatable. It's below 10-year average, slightly above 20-year average, both on an absolute and relative basis. What is pending is narrative. And narrative is something which typically follows performance. So I think I would say that valuations are not mouth-watering, but they are far more palatable, near average levels. So the complaints that someone had from India should reduce significantly, given 2 out of those 3 factors are now in our favor.
See, for now, we don't have to complain because the domestic guys are pretty sanguine and supporting the markets for a very long time. But Anand, in this context, in this whole scenario where commodities are going to go higher, you are of the belief that the last 10 years, the last decade was low inflation scenario, and the next 10 years are going to be very, very different. If that is the base case for you, that inflation is going to go up, as a fund manager, how are you looking to invest into Indian markets?
Yeah, so look, even much before this crude shock that has come through, there were elements which were making us convinced that we will have a lot more inflation than what we had since GFC to almost 2020, 2021. One was obviously from globalization to more localization, more friend-shoring. That is generally more inflationary. Second is anti-involution in China.
Yeah.
So China, having created GDP, now wants to have profits as well. So there is a drive which wants the competition within China to reduce among the states. Third is obviously geopolitics. We had a significant long period of stable, geopolitics, and the trade routes were safe and so on and so forth, and that's getting upsetted. And we are seeing today, as the gentleman was saying, there's enough crude, but the supply chain has disrupted the crude price. So geopolitics has changed. Also consolidation. Typically, a difficult environment leads to a lesser. So we can see that in telecom, in airline, many industries, we have lesser competition. Even for that matter, in metals, over a decade back, before 2007 and now, we have a lot less competition in those sectors than we had before. And last but not the least is rupee depreciation. So I'm saying, when I mix oil to this, now you see what oil does. It leads to fertilizer, leads to food, leads to plastics. So it will be slowly and steadily, energy will be all pervasive. So we are of the belief that inflation is here to stay. Otherwise also, and now oil makes it, brings it to the forefront.
All right, Anand, so what is this? Is this a structural shift or is this a temporary reset, you'll think, for the Indian markets?
No, so if you see even the markets over last 4 years, there has been a structural shift. There was one set of businesses which used to do very well from 2007 to 2020, 21, which was more consumer facing. In a low inflation environment, you're better off closer to the consumer. You have pricing power, you will exercise that pricing power despite of a very low inflation on the input side. So you would have seen in that decade, you had a margin expansion for most of the consumer facing businesses, paints and autos and everybody. Last 3-4 years have been very tough because now we have inflation and your consumers are not ready. Fast forward another 6 months, we'll have everything becoming expensive. Consumers will be further under stress. So a consumer facing business ability to pass on the inflation that will hit at the raw material end might not be equal for everybody. So I'm saying you will have to be more careful of giving high multiples, which was very normal for almost 1.5 decades to give a very high PE multiple if you're a consumer facing business and a very low PE multiple if you're a core manufacturer. Things can actually change. You're seeing what's happening in aluminum. If you are one whose energy price is not going up because you're coal based, but you're producing aluminum, it all flows to your bottom line.
Yeah.
So our preference is more for core manufacturing, intermediate manufacturing, but less for somebody who is manufacturing or a provider of services to the consumer, because consumer is stressed for the next decade, if you ask me.
So you'll be tilting more towards old economy stocks? Would that be the case?
The way to say is you're better off with iron ore than steel, you're better off with steel than auto ancillary, and you're better off with auto ancillary than auto if thesis is what it is. But again, will be more bottom up. That doesn't mean that all auto companies will suffer, and that also doesn't mean that all steel companies will do well. But I'm saying, generally speaking, this is how things will play out.
But Vikas, let me come across to you. If March 2026 was washout because of the war, February 2026 was a washout for the tech names. They got absolutely slammed. No one wanted to listen to anything. And talking about narrative, the street believed that this is going to be a big, big headwind for some of these tech companies. And that's why the index pulled back. But from the start of the war, actually, that one index that's outperformed has actually been the tech space. How are you placed out there? Because I was reading a note, I think you believe that AI ultimately will actually be a tailwind for our IT services companies. So how are you placed out there?
Sure. So that's the opinion that we as a house have, that will lead to more work to our services company. See, I think there are two ways of thinking about AI. One, that AI will eventually be something that will do all of things, everything on its own. The other, that it will just make whatever we do a more efficient, give it a more efficient way of doing things. See, if you believe in this latter, then you would need some intermediary to give you solutions to make it an efficient use for you. Okay. So if that is the case, very simply put, then that's where some of our IT services companies could get up their jobs.
Okay.
So that is our thought on the sector, that unlike the popular belief that it is lose-lose for IT services, that's not going to be the case. That's the opinion. However, one needs to also take a look at that opinion in the changing dynamics.
Right.
So if at this juncture, when we are talking of the war-related changes which have happened, then is that the top sector in your mind? Or would you want to go with something like banks? Would you want to go with... So that's a portfolio choice that one has. But our view on AI is that, you know, India in general, which has the youngest of populations, the advantage of having a young population is we are able to leapfrog rather quickly. Like we leapfrog from, 2G to 4G.
Yeah.
So the usage of AI can catch up far faster in India. But portfolio choices can depend on the kind of market that is dealt your hand. That's not what you choose.
You all were a little bit cautious on the market 18 months or so ago. When the market was going gung-ho, people were thinking this market's going to keep zooming and it's going to be unstoppable. What happened at that point of time was mid and small caps, the breadth of the market was brilliant. Broader markets were running up. That fraud seems to have got cleared out. After the kind of correction that we have seen. Do you think now, post this clear up, post this stark underperformance, markets, the Nifty is down 12% or 13% at most. But the broader markets, there are stocks down 20, 30, 40, 50% as well. Do you think actually now it's time to start looking at some of these broader market companies, not the run of the mill, but select stocks that have actually corrected and now valuation-wise they're pretty okay?
See, the advantage of India is in terms of large and liquid opportunities, we are the market which has the third or fourth highest large or liquid number of stocks. So bottom-up stock picking can always work if you do that. But let me give you a top-down thought process on that.
Okay.
The top-down thought process is, say in 2024, India was the darling for most global investors.
Yes.
Everybody wanted a piece of India. So they were willing to do the hard work to go and find a small cap company, a mid cap company, to really ensure that they get a piece of India, they get the beta in India. That's gone. We have come to more palatable valuations, but we have not come to a point that India again becomes the darling.
Correct.
At this point of time.
Yeah.
So people will start with, munching into large caps. So I am, and plus valuations for small and mid caps are still not that palatable.
Okay.
So I would want to stay focused on large cap. Do not be super greedy about very large returns, because although sentiment for me is down to similar levels at 2020 and 2008, valuations are not. They're just down to long-term averages. So that is what one needs to bear in mind, that this is maybe a more fair return market that we are getting into.
Okay, just since you mentioned darling a few times, the FIs have just broken our heart. They keep selling. I mean, March was very, very bad. April is equally as bad. You're seeing $1 billion of outflow. Do you think it's coming to a stage in terms of valuations being a little bit more palatable? Hopefully, we have seen peak rupee at around 95 or thereabouts. That's the hope at least. And, hopefully earnings as well start picking up. Do you think it's time for them to return? I think they own 15, 16%, the lowest in the last 10 years or so. Your view, Vikas?
So I think the message that should, that just brings me back to the point of what you said